to get a lot better very quickly at making its own
Right.
chip designs and all that kind of stuff. And it feels like it backfired a little bit.
Yeah, you've also advocated for the US restricting sales of some NVIDIA chips, which are crucial in training AI systems, to buyers who don't agree or who refuse to use them ethically and safely. So what do you think is the best way the US can actually flex its power? Is it through the technological innovation or by stifling effectively some of its adversaries through regulation?
The first thing I should say about that is I don't think now is the time to do that. I mean, I think in theory, when the time comes, if the time comes for us to adopt a kind of global anti-proliferation strategy, we're worried about technologies being so powerful that we have to stop their spread. If that moment arises, and I think we're quite a long way from experiencing that, then technically that would be an appropriate containment strategy. Because much as this technology is manifested in software, it lives on the internet, it still sits on chips, whether you're training a model or serving a model. So in order to ask a model a query, you have to have access to one of those NVIDIA GPUs. And, for what it's worth, there are really only like one major company in the world that produces those high-end GPUs, NVIDIA, and they manufacture the vast majority of their chips at TSMC in Taiwan that use one single company, ASML, a Dutch company that manufactures the core chip that produces the chips, and they sit in the Netherlands. So it's actually a very narrow supply chain. And so I think the point I was sort of trying to make is that if you wanted to adopt a containment strategy, there is a supply chain where you can impose chokeholds on it.
And in 10 years from now, which country do you think will be leading the world in AI? Is it going to be the US? Will it be China? Will it be Europe?
It's going to be the US, I'm pretty sure of that. I mean, the fundamentals in the US innovation ecosystem are unquestionably the best in the world. I mean,
what could flip that balance of power?
Well, I mean, I think it's hard to say. I mean, I really do think that the US is in the strongest possible position. At the end of the day, it's talent that drives, this innovation. And talent still concentrates around a small number of physical places. Despite everything that we've experienced in the pandemic and people wanting to work remotely, it's still really important to be physically proximate to other people who, are working with you in the office. I mean, I think that trend isn't going to change. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities. But that is going to take 5 years or so. The export controls that the US has implemented, are real, and they really will prevent China from getting access to the next frontier of models, so the GPT-5 onwards. Right now, I don't really see how China could train those kinds of models.
Is there any downside, any unintended consequences that could come from this containment strategy the US is employing?
Yes, I think it is a very aggressive strategy. The counterattacks have already started, right? The China restricted gallium, which is a raw material used in chip manufacturing. And I expect them to have their own reactions in time. We're very dependent on their supply chain. And so the idea that we could completely decouple, I think, is misguided.
I'm going to just put you on the spot really briefly and wonder, can you tell, because we're all friends here.
Sure, go for it.
Do you have a major regret about your work in AI? And do you also have a major single goal?
Yeah, my major single goal is to show that it is possible to create safe and ethical artificial intelligences which are accountable to humans. There is a possible trajectory where some groups may recklessly experiment with algorithms that can self-improve. And if in 10 to 15 or 20 years time, those kinds of AIs are set loose on the open web in a reckless way, then I can imagine that possibly causing serious harm. And so for as long as I can remember, almost 15 years that I've been involved in AI, I've been trying to raise awareness and concern about the possible ways in which it can go wrong. And part of doing that is to show a bunch of practical ways that it can go right, both with writing my book and laying out a series of containment strategies and things that we have to do in politics to improve our governance and regulation, but also in actually building and making Pi, which I think is hopefully going to continue to remain a very safe and controllable personal AI that can work for you.
Mustafa, thanks so much for coming in. Been a pleasure.
Thanks very much for having me. It's been great.
Helen Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, that some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the US is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things where China is not so good, but there are big areas in which China is way outbuilding the US.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain, and they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors, but what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from US sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the US really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, US policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
How does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like, he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, or that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's
That's
not
right.
the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China. in terms of what you're saying?
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to, opt in to different uses. Of course, in China, there's always the exception, unless the security services, think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology, really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Trump backs down. The U.S. president drops the proposed Hormuz cargo fee after urging from Gulf allies. But Washington intensifies its military pressure with fresh strikes on Iran. Asian stocks rally as softer U.S. inflation trims Fed rate hike bets. Tech shares lead gains with South Korea's Kospi jumping as SK Hynix surges on AI optimism. And China's growth engine sputters. The economy slows more than expected to the weakest in more than 3 years. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. A lot of market news, a lot of geopolitical news as well. But before we get into that, let's take a quick look at where markets are this morning. U.S. futures in the green, pointing perhaps to another positive session in the S&P 500 later today. Now that follows a gain in the S&P 500. So now we're seeing S&P futures 0.2% higher. A little bit of a retrospect, but let me run you through some of the numbers that we saw coming out of the biggest banks in the United States yesterday. It does show that Wall Street traders have cracked the code, perhaps, when it comes to equity trading, despite the geopolitical news that we're seeing out of the Middle East, the AI rout. 5 of the biggest U.S. banks reported yesterday. That includes Goldman Sachs, JP Morgan, Citi. Some of the numbers there: JP Morgan, $6 billion from stocks alone, 85% higher year on year. Goldman, $7.4 billion. That's a new industry high, up more than 70% year on year. In Citi, 45% jump, and perhaps on a regular day that would be extremely good news. But in comparison to some of its peers, investors saw that as shallow, and that's why we saw the stock decline yesterday. Now, there are many factors pointing to this staggering performance, really, that we're seeing across the financial sector in the United States. The explosion of AI investment, the spending there that's been boosting wider economic activity. And let's not forget about the monster $75 billion SpaceX IPO that offered some $500 million or so to banks. But Jamie Dimon put it out the best, probably. Markets are booming right now. It's getting as close to as good as it gets. We just don't know how long this is going to last. And this is especially the case with the volatility that we're seeing in markets. And speaking of that, Asian equities are trading 2.3% higher, led by the Kospi in South Korea. We're seeing gains in SK Hynix, both the ADRs, but also the performance this morning in Seoul. It jumped as much as 11%. The ADRs had risen 27% yesterday. So attention once again turns to chip makers, as there is some repurchasing activity that we're seeing there. And then we're also keeping an eye on Brent crude pricing. A little bit of steadying activity this morning, 1.3% higher. $86 on the barrel. We will talk more about the Strait of Hormuz on the show later on. And then the other big news for us is the yield on the 10-year notes, 4.5 or 4.6 at this point almost. The Treasuries did steady after CPI data had sent the yields sharply lower yesterday. We keep an eye on two things, or we kept an eye on two things. Kevin Moore testifying in front of the Congress, not pointing to a hawkish tilt, but saying that the battle is not over despite the softer than expected CPI report that came out for June yesterday. But we're also seeing that the chances of a hike, as put out by traders this month, sank below 20%. So perhaps not a rate hike for July, but keeping an eye out on that hawkish tilt for the remainder of the year, maybe September or October. Those are the things we're watching out for in the market. Some individual names there as well that are important. But most importantly, from our region, is the strikes that we're seeing. U.S. President Donald Trump has backed away from his plan to impose a 20% charge on cargo shipments through the Strait of Hormuz after U.S. allies in the Gulf urged him to.
UAE, Qatar, Bahrain, and Kuwait, primarily, and then others. I spoke to all of them, and they would love to invest more money in the United States at record amounts, and that would be very acceptable. And this way, there's no fee.
Now, even as Trump dropped the plan, the U.S. announced it had resumed its blockade on Iranian shipping. American forces also launched a fresh wave of strikes on Iranian targets meant to degrade its abilities to hit commercial ships in the waterway. For more on this story, we're now joined, as usual, by Stuart Livingstone-Wallace, our executive editor for the Middle East, North Africa, and Russia. Stuart, less than 24 hours probably, we saw President Trump announcing the 20% tariff and then backing away very quickly after saying that Gulf allies, including Saudi Arabia, the United Arab Emirates, had urged him not to. Just how surprising is that?
I think it was maybe more surprising they announced it in the first place. It was a very bizarre policy statement on two fronts. Number one, the scale of it. I'm not quite sure who advised him that 20% would ever be acceptable to anyone. It effectively bankrupts the industry at that level. By our own calculations, a supertanker would have to pay $30 million. Secondarily, it allowed the Iranians in a completely bizarre world to come out and say we were offering a much better deal on the tolls because ours were around $2 million a supertanker. I think there has to be back to the original position that there needs to be an international agreement on what fees might look like, or indeed whether there should be any fees at all. And as you know, I think the regional position, at least from the Arab side of the Gulf, is that there shouldn't be. It should be free navigation as it has been for decades.
And then we're also seeing that the blockade on Iranian ports and shipments has returned. This is according to President Trump's Central Command as well. Is it fair to say we're back at square one when it comes to this conflict? Yeah,
more or less. I would say two caveats to that. Number one is that the shipping companies have got somewhat better at sneaking out through the Strait of Hormuz, and we have seen a trickle of tankers coming out. So there is a playbook now for getting past all of that, and I think that's true both for, again, the west side of the Gulf and the Iranian side of the Gulf. And then the second thing that must be said as the caveat is that in terms of the strikes themselves, they are very focused. In other words, what they're trying to do here is send signals to each other. So if you look at the US, they're largely only targeting coastal military installations. As far as we're aware, there's been very little attacks or deliberate attacks on infrastructure of any sort beyond the military. And then from the Iranian side, similarly, they're mostly going after US military assets. There have been some exceptions, of course, like in Kuwait. So it's a very different level to what we saw in the first 2 months of the war. I think when that changes is when we should take that as a signal that things are escalating on a very, very serious level.
Sir, President Trump made the claim that he will get massive investments from Gulf allies in the region. That was in exchange for revoking that levy or that fee, the 20% fee. How likely is that the Gulf leaders are going to make those further investments, should I say, in the United States?
No, and I think that's exactly the key word, the further bit. So we already know that they'd pledged to invest certainly hundreds of billions, possibly trillions, in the US, and I think they were serious about that. We have seen a lot of deal flow this year. It's been very surprising the level at which it's happening. And we know that the Wall Street banks are going out and hiring a ton of people to manage it because it's on an unprecedented scale. So it is definitely happening. Whether the further element is true is a different matter. Now, we did get one source at one regional government who said that is not going to be the case. Whether that reflects everyone, I don't know. But I think given the scale they were already investing at, it would be difficult to do much more.
Yeah, and we haven't heard officially from these governments whether they have agreed to do this or not. But Stuart, thank you, as always, for joining me on the table. Stuart Livingstone-Wallace, our executive editor for the Middle East, North Africa, and Russia. Now, turning back to the U.S., U.S. consumer prices declined in June for the first time in 6 years, with a key gauge of underlying inflation little changed. Fed officials are likely to welcome the data ahead of the central bank's upcoming meeting at the end of the month, though inflationary pressures remain. I'm now joined by Bloomberg's David Savage, who is with our MLive team. David, good to have you on this morning. Softer than expected inflation data that we saw coming out of the United States. Traders are now pairing their bets for a hike in July. Has the news changed anything else at all when it comes to the hike for the remainder of the year?
Yeah, I think that's exactly it. It certainly changed expectations in terms of pricing of that July hike. It basically took that July hike off the table for now. But the general trajectory, it remains relatively unchanged. We still are pricing a hike for 2026 and another hike potentially leaning in that direction in early 2027. And so the earliest hike for now would be September, October. So I think that leaves a lot of economic data in between. But I think what that does is if the July hike is off the table, it really puts the spotlight back on where we're seeing oil trend. And I think that'll have more influence on where bonds are trading than commentary from the Fed in the very near term.
And David, another topic slightly different from monetary policy. We are kicking off earnings season. I was just speaking about banks in the United States. We're also waiting to hear more about the AI route and the AI trade, essentially. And we know that ASML and TSMC are under the earnings spotlight. What can we expect out of those two companies, and how would it solidify this artificial intelligence game that we're seeing in markets?
Well, that's exactly it. These earnings are coming at a very critical point where we've seen this, very relentless semiconductor rally, equity momentum rally, really come under pressure in the last couple of weeks. Now, it's really seemed to have gotten, a breath of new life here today on the back of this CPI data. But these earnings are really a test. We've seen actually, preliminary earnings from Samsung earlier this month. Really failed to stem some of the selling. We saw really positive sales numbers from TSMC also do little to stem the selling. So markets are more upbeat today, but they're really going to be looking at I think particularly the guidance and the capex guidance to get a gauge of number one, are we starting to continue to see that trend where the companies continue to guide higher on top of beating earnings expectations. But also, how are the profits, evolving in the value chain? There's been, some fundamental concerns that, it's getting too concentrated in areas and it's unsustainable. So it will be interesting to see, how the capex guidance comes through and whether again they raise further.
All right, David, we're going to have to leave it there. David Savage, Bloomberg M-Live strategist. Now, coming up, the outlook from Emirates NBD. Next, Tad Miller, chief economist and group head of research, joins us next. This is Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view. The members of our committee have no tolerance persistently elevated inflation, and we share a resolute commitment to ensure price stability. Productivity growth has been strong, predating gains from AI adoption. America's labor force appears stable. Job creation has in fact kept pace with the workforce. We want economic growth to be more broad-based. This committee had long committed to a 2% inflation target. That is our resolution. That's what I'm here to say and double down on.
That was Fed Chairman Kevin Warsh speaking to U.S. lawmakers yesterday. The surprise slowdown in U.S. inflation is reshaping market expectations for Federal Reserve policy. Bond yields fell on the back of the news, and the dollar weakened after traders pushed expectations for the next Fed rate hike back to September or October. To discuss more on this, let's bring in Nick Stadmiller, Chief Economist and Group Head of Research at Emirates NBD. Nick, good to have you on the show. Welcome to the show. You just heard Fed Chair Warsh speaking about the mission is not accomplished despite those cooler than anticipated headline numbers on the CPI that we saw come out for June yesterday. Now, traders have pared down their bets for a July rate hike. They were expecting that 50-50 up until yesterday. Do you think that's the right way to go about it?
I do, Abir, and we've held for several months now. Our call has been that the Fed will remain on hold through the remainder of the year. And Warsh kind of surprised markets when he first came in as the chair and talking much more hawkishly than expected at his last press conference, at his first meeting as chair. And in a certain way, Warsh talking hawkish is doing some of the job for him. By talking hawkish and raising expectations for future hikes, it reduces the pressure on him actually to deliver on those hikes. So we think that inflation will moderate through the remainder of the year, especially in core prices, whatever happens to volatile food and energy prices, but that ultimately the Fed can hold policy where it is and let the existing amount of tightening do the job for it.
But while yesterday during his testimony to the Congress, he did not flat out say that he will either cut or hike or provide a lot of clarity on the path forward, but he did give a little bit more of a tilt towards possibly a hike towards the end of the year. Did you find that a little bit surprising, or do you think that he's just trying to appeal to the public?
Well, look, the Fed has a dual mandate, and that is price stability and maximum employment. And unemployment is already pretty close to where most Fed officials think the long-term average should be, or the sort of target rate. And so it's really inflation where they're missing. So it really behoves Chair Warsh to talk about inflation and underscore that commitment to get price growth down. Ultimately, I think that he and other Fed officials have to concede that a hike is a possibility because inflation is still above target and price growth does look a little bit sticky. But again, simply by acknowledging that, I think it allows the Fed to keep control of the narrative and to keep inflation expectations well anchored. If Warsh were talking overly dovishly, I think you would see inflation expectations, really start to grind higher. So it's really a matter of letting the rhetoric do the work for policy. Okay, and just returning to the geopolitics, the region itself, we've been seeing escalations over the past couple of days or so from the Middle East, and I've been asking this question to quite a lot of people, just because it's timely, it's a fast-developing situation. Do you think the market has mispriced just how long this conflict could go on for, and has mispriced those flare-ups that could potentially and are happening? Well, I think these sort of tail risks in geopolitics are one of the hardest things to price. And ultimately, what oil traders have to do is trade supply, especially at the front end of the curve. So short-term delivery, I'm not talking about the long-term futures, but in the front end, traders have to price supply and demand as they see it. So a couple of weeks back, essentially what was happening is refiners were already running at max capacity, the refiners that are online, and oil was coming out onto the market as Hormuz was opening up, and prices had to come down because there was extra supply and lower demand. So it's not really an expectation story. And then when you have that dynamic as prices were coming down, ultimately it doesn't really make sense to buy oil and hold it just in case something might flare up. So I think the answer to your question really is it's not something that traders can price accurately. They just have to price the information that they have in front of them at that moment.
Okay, and let's focus on the economies of the region a little bit now. And I wanna point to one major, the biggest economy in the region, Saudi Arabia. It's seen a lot of benefits from higher oil prices. The exports are at an all-time high. It's doubled down on other routes. But our own calculations suggest that the fiscal break-even for Saudi Arabia is higher now, especially if you account PIF spending. So and the infrastructure spending as well. So when it comes to the outlook on Saudi Arabia, just generally, what does that look like now?
Well, you raise a very good point, Abir, because I think the narrative back in March and April was, oh, higher oil prices are more than offsetting the production declines, and therefore the budget deficit should unambiguously improve. And there are a couple of dynamics going on. One is oil prices go higher, subsidies to Saudi citizens for energy go up. Also, obviously, defense spending has gone up in Saudi Arabia this year. And then third, as you point out, is the infrastructure. And so last year, there was a real recalibration underway, reevaluating some of the more ambitious projects in Saudi Arabia. And now what we've seen this year is not only sort of a doubling down on the projects that they think are most economically viable and that they want to prioritize, but also looking at things like supply chain resilience, adding redundancy to some of their pipelines, and all that spending starts to stack up. So we think that the budget deficit will tighten a little bit from where it was last year, but it's still going to be elevated because they have those ambitious spending plans.
Okay, so a little bit of a silver lining for Saudi Arabia this year. Nick, thank you for joining us this morning. Nick Stadmiller, Chief Economist and Group Head of Research at Emirates NBD. Now, Warren Buffett has pledged to completely dispose of his roughly $140 billion stake in Berkshire Hathaway over the next 8 years. He's announced a new round of donations to charities tied to his family, but he paused donations to the Gates Foundation for the first time in nearly 2 decades. This comes after the release of documents reigniting scrutiny over Bill Gates' ties to the late sex offender Jeffrey Epstein. And IBM is in focus after it posted the biggest drop in nearly 6 decades following preliminary second quarter revenue that missed estimates. Sales came in at $17.2 billion versus expectations of $17.9 billion, while infrastructure revenue fell 7%. CEO Arvind Krishna said IBM was caught off guard as customers shifted spending towards servers, storage, and memory. And payment processing firms Stripe and Advent International have offered to buy PayPal in a deal valuing the company at more than $53 billion, according to a Reuters report. The 60.50 a share dollar represents 28% premium to PayPal's closing price on Tuesday and is backed by about $50 billion in committed financing from banks. The two suitors would jointly own PayPal with equal stakes and do not plan to break up the company, according to the report. Now, still ahead, as China's GDP growth drops to a 3-year low, will Beijing unleash stimulus? More analysis next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Chinese AI startup DeepSeek is set to be laying the groundwork for an IPO, with a filing possible as soon as this year. Sources say the company is working with accounting firms on its financials and is targeting a market debut around late 2026 or early 2027. We are told that DeepSeek is also seeking fresh private funding ahead of the offering at a valuation of at least $71 billion. And Saudi Arabia has become the biggest buyer of drones from Taiwan, purchasing a record $47 million worth last month. The shipment made the kingdom Taiwan's largest export market for drones, and the purchases come as Taiwan seeks to grow its drone industry and position itself as an alternative supplier to China. And coming up, we will talk to Megan Sutcliffe, Middle East Principal Analyst at SEBI, as President Trump threatens to hit Iran's power plants and bridges next week. That is coming up next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Trump backs down. The U.S. president drops the proposed Hormuz cargo fee after urging from Gulf allies. But Washington intensifies its military pressure with fresh strikes on Iran. Asian stocks rally as softer U.S. inflation trims Fed rate hike bets. Tech shares lead gains with South Korea's Kospi jumping as SK Hynix surges on AI optimism. And China's growth engine sputters. The economy slows more than expected to the weakest in more than 3 years. It's just gone 8:30 a.m. across the Emirates. I'm Abir Abu Omar in Dubai, and we still have a lot to get through for the program. But a quick look at where equity benchmarks are sitting at half past the hour. U.S. futures are still tilting higher, 0.2 higher at this point. Asian equities 2.1% higher. But the big story out of the United States yesterday really was with those big banks reporting their earnings, their staggering earnings. We saw the likes of Goldman, JP Morgan, Citi reporting their earnings. And JP Morgan, for example, $6 billion gain from stocks alone, a personal best, an 85% gain. Goldman Sachs, 7.4 billion. That is an industry high, a new industry high. And just to add a little bit more context to that, Goldman's equities revenue this quarter was slightly more than its full year result in that division in 2019. That's just 7 years ago. So in comparison, Citi's 45% jump in the division was seen as shallow by investors, and that is why we saw a decline in the stock by the close. Multiple reasons leading to this gain. We're seeing the explosion of AI investment over the past couple of quarters. The spending there has boosted wider economic activity, and also we cannot forget about the SpaceX IPO that handed about $500 million or so in fees to a bunch of banks. M&A activity alive and well. Morgan Stanley recently put out a note saying that volumes in mergers and acquisitions are on track to make this year the biggest year for deals. But Jamie Dimon, JP Morgan's chief, put it out the best. We just don't know how long this performance is going to last. We're also keeping an eye out on individual names. IBM dropped 25%, the most in decades, with those preliminary results worse than expected. But Asian equities are climbing today, 2.1% higher, led by the Kospi in South Korea. I'm taking a look at it now, about 7% higher. SK Hynix now trading 9.3% higher after a staggering performance in the ADRs yesterday. And then the story with oil is the same story that we've been chasing over the past few days. 1% higher almost. The movement in the Strait of Hormuz, something to keep an eye on. And then the yield on the 10-year notes, not doing much today. They did rally yesterday after that softer than expected U.S. consumer price report for June came out. Fed Chair Warsh not really signaling a rate hike or a rate cut, but giving just a little bit more clarity on the situation. But perhaps the most important element in all of this is that after the CPI rate came out, the chances of a hike for this month sank below 20%. So traders clearly keeping an eye out on those economic data reports coming out of the United States. Now let's turn back to the geopolitical story from the Middle East. President Trump has told Fox News that the U.S. will hit Iran's power plants and bridges next week. This is unless Iran comes to the negotiating table. Trump said he will target Iran's energy infrastructure last. It comes as the U.S. ramped up economic sanctions on Iran.
I gave them a chance. I wanted to give them a chance at making a deal. You know, we had a deal 2 days ago. It was done. And then all of a sudden, they couldn't do it. They didn't like something about the deal. They couldn't do it. And they shot first. And that was a big mistake that they shot first, because we have been knocking the hell out of them.
Joining us now to discuss the latest in the region is Megan Sutcliffe, Middle East Principal Analyst at SEBI. Megan, good to have you on this morning. Thank you for joining us. Let's just start with where things are in the region right now. The MOU that was signed over 3 weeks ago at this point has all but collapsed. First of all, is that a fair assessment? And then second of all, we're also nearing the August deadline for those negotiations that are seemingly not happening. So where does this whole thing leave us when it comes to the technical talks?
Good morning. You're certainly correct that what we are witnessing right now is the slow collapse of the Memorandum of Understanding between the United States and Iran, and that the longer that this process persists, the less likely it is that we're going to see a major diplomatic breakthrough before the MOU formally expires on the 20th of August. Right now, what we're also seeing is, of course, the United States and Iran engaging in increasingly escalatory exchanges of fire, with the attacks that we're seeing in the Middle East becoming intense day by day. These are also paired with threats by US President Donald Trump indicating that the US will soon begin striking energy infrastructure or bridges within Iran. And that is extremely concerning from a regional stability point of view. But at the same time, it is notable that we've already seen those claims and threats from the United States before. It doesn't guarantee that they're going to happen, and it's likely a negotiating tactic at this point to try and trigger a breakthrough.
Megan, I was taking a look at some of the notes that you had earlier, and you mentioned that it is unlikely for Israel, which is a third party in all of this that led the initial attacks with the U.S. on Iran, that it is unlikely for Israel to get involved for the time being. Do you think that the elections, the upcoming elections there, have a part to play in this? And what are the other reasons you don't think Israel, that was up until a few weeks ago a major player in all of this, not getting involved?
You're absolutely correct that Israel was an integral part of the initial war campaign that the United States launched on the 28th of February. And it has also been a part of the ceasefire process, given its adherence to the ceasefire when it first came into force in mid-April. At the moment, of course, the election that is going to be upcoming within Israel and that will have to happen before the 28th of October is going to be weighing on the national calculus. But generally speaking, when it comes to national security, at this point in time, Israel is highly aware of just how delicate and changeable the relationship is with the United States. That's something that's true for all regional parties. And so going forward into the next few months, it's unlikely that we're going to see Israel acting unilaterally when it comes to Iran. Though, of course, there are other factors that could push us closer to an Israeli intervention, such as the relaunch of major combat operations on the part of the United States, which could well draw in Israel as a cooperating party or as an ally.
And Megan, we're also seeing a parallel thing at play here between Yemen's Houthis and Saudi Arabia, a flare-up yet again. So perhaps this is an existential question at this point, but what would it take at this point to bring this much-needed stability to the region?
Well, I think that if I had the answer to that question, I'd be in a slightly different job than I currently am. However, when it comes to what is going to be needed for a breakthrough here, of course, many have noted that it is incredibly easy to start wars, but it is incredibly challenging to finish them. And every war that has finished in the past has either occurred through a victory or through some kind of mediated settlement and negotiation. It's clearly demonstrated in this situation that the United States has been unable to entirely best Iran and claim victory or topple the regime within Tehran. And the same can be said when it comes to the Houthis in Yemen and various other Iranian proxies that are active throughout the region. So in absence of a clear victory, of an absolute imbalance of power that facilitates the routing of an adversary, the other option, of course, is going to be negotiations. And it's only in those situations that we're likely to see a breakthrough. That's not to say that that process would be simple. Of course, when it comes to Yemen, this is a conflict that has gone on for over 15 years. However, it is one of the ways that we'll be going forward. It's something we've seen Saudi Arabia pursuing over the past few years, and likely something that we're going to continue seeing Saudi pursue, as well as other parties in the region at this point in time.
And just finally, President Trump also met with Iraqi Prime Minister, the new Iraqi Prime Minister Ali al-Zaidi yesterday, with the U.S. pledging to leave Iraq. Quite a monumental development there. How significant is that development in the midst of everything that's happening in the Middle East?
It is significant in the context of both Iraqi politics and, of course, the regional developments that we've seen over the past few months. Currently, the US is engaged in a broader drawdown of its troops from Iraq, and this was something that began in September of 2025. And, of course, US troop deployments into Iraq are far lower than they were 10 years ago, for example. Last year, at the beginning of the drawdown, there were only 2,500 US service personnel stationed within Iraq. And what we saw being announced in the meeting yesterday was a clarification on timelines, that essentially the US will complete this drawdown by September. In the context of Iraqi politics, of course, that presents many concerns when we're looking at the global anti-ISIS coalition that is still operating within Iraq and within Syria, as well as the broader tensions between the United States and Iranian-backed proxies in the region. That's something that's going to continue to be an issue, but the drawdown will likely continue.
All right, Megan, we're going to have to leave it there. A pleasure to have you on this morning. Megan Sutcliffe, Middle East Principal Analyst at SEBI. Now, turning back to another region, China's economy slowed more than expected last quarter to the weakest in more than 3 years. The country's National Bureau of Statistics cited external uncertainty and domestic supply-demand imbalance for the slowdown. The data now turns attention to what policymakers will do next to ensure their annual growth goal is met. Let's get more on the latest numbers out of China from our Bloomberg China Economy and Government Editor, Alan Wong. Alan, good morning. Good to have you on. Just talk us through some of the weaknesses that we saw in the headline number and what exactly led to that slowdown.
Yeah, of course. The Statistics Bureau put it as an imbalance. That is kind of an understatement of the problem that China's economy faces. We're seeing very weak domestic demand, including investment and consumption. Investment actually fell year over year, which is not something that you would expect from an economy like China's, which has been growing nonstop over the last few decades. So that spells trouble for China, and part of that story is obviously the property market crisis. Their home prices kept falling, even though in the month of June the fall eased a little bit, but the overall story and trajectory is still going down. That's not good news for China's consumers because they're seeing their wealth evaporate, and that will hurt their sentiment in terms of spending. And in terms of investment, that too has been falling, and that means that the private sector doesn't want to invest and start new factories, and that is a problem for China's economy because that makes up a big chunk of growth. So that is mostly the main source of domestic weakness, and then I think the next natural question is what can China do?
Yeah, and that's exactly my next question. What actions can we expect from Beijing to return to target growth?
Yeah, exactly. So the problem is that China has signaled that it doesn't see an urgent need to do a lot more than it has promised to. And based on the conversations we've had with economists, there's a consensus that China will improve the implementation of previous policies and will for now hold off from any fresh stimulus measures. One area they could look into is fiscal spending. Chinese government spending in recent months have slowed down to many people's surprise, but that's one leverage that China has used previously to try to boost the economy. For example, it could pick up the pace of investing in infrastructure. Launching these large projects can often be a good source of growth for China, as we've seen in previous years.
All right, Bloomberg's Alan Wong keeping on top of those China numbers for us there. And coming up, 4,000 participants are taking part in Ethiopia's national dialogue to address its deep political divisions and internal conflicts. We'll bring you the latest on that story next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Ethiopia is launching a month-long national dialogue to address its deep political divisions, internal conflicts, and strained regional relations. The initiative faces major hurdles as key opposition groups have already refused to participate. For more on this story, we're now joined by Bloomberg's Fasika Tadesse in Nairobi. Fasika, good morning. Thank you for joining us. This issue, why does Ethiopia need a national dialogue, really, and what are the issues that this dialogue is intended to address?
Thanks, Sabir. So, as you mentioned on the intro, Ethiopia is going through a systemic and deep division among Ethiopians between the political parties, civil societies, and among the nations. So that's one of the reasons the country needed the national dialogue. The second one is there is a tension or ethnic tension and conflicts all over the country. You can in the northern part of the country or in Amhara, in Oromia. So there are different conflicts across the country. That's also the other reason for the national dialogue. And also there is a disagreement over the constitution how the country should be led. So there's a difference among Ethiopians and political parties on that as well. And also there is a trust issue between regional governments and with the federal government and among the people. So those are the reasons why the country is needed the national dialogue with the aim of addressing all these challenges.
And so, Fasika, those are the issues that have been identified as priorities. So what is expected, or what are the expected outcomes of this national dialogue?
So the first thing is reaching on or generating a national consensus among these differences. And also we expect, or the expected outcome is to have a change in the government structure. And also we're hearing the Prime Minister saying several times that the outcome will lead the government to change or to limit the government term, mainly the Prime Minister or the President's term. That means to only 2 terms. That means the first time we'll be seeing the government term is limited by the Constitution. Yeah.
All right, Bloomberg's Fasika Tadesse, thank you so much for covering that story and following it for us. Now, coming up, we'll talk Wall Street. Wall Street's big banks are shattering trading records, but costs are rising. We'll bring you more analysis next. This is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Looking forward, we know that things rarely move in a straight line. While we continue to see a largely resilient economic backdrop in the U.S., risks can emerge quickly and drive periods of disruption and volatility across markets. A keen focus on risk management remains paramount as we support clients across a range of market conditions. But it's also clear that we are seeing broad-based momentum across the franchise and a very strong environment for client activity.
I can't tell you that it's impossible that we will exceed the 11%. We're just not going to box ourselves into that, given that we see opportunity to take actions on the offense, which are accretive to shareholders and support our path to our medium-term targets.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but how much better, I don't know.
Those were the chiefs of some of the biggest U.S. banks on their record second quarter results from their stock trading divisions. A good day for a lot of those chiefs yesterday. However, the revenue surge is coming with a steep rise in bank expenses as they invest heavily in technology and top talent. For more on the story from yesterday and everything around it, we're now joined by Balazs Penz, our deputy managing editor for APAC Equities. Balazs, I was talking about those staggering results throughout the show, really. The increases year on year are just phenomenal for the likes of Goldman, JP Morgan, and Citi, even despite the comparison with its peers. But there's no surprise on the trading desk revenue. What did we learn from those Wall Street earnings yesterday?
Well, I don't know if we just learned this. Maybe this was a reminder that the bank always wins. We saw record trading revenues for all these banks. We expected very strong numbers coming off of a record first quarter, but these even surpassed those expectations. And the signs are there that this increased volatility in stock trading, especially around the world, has really generated a lot of enthusiasm among investors. And while sometimes investors win, sometimes they lose, the banks are always benefiting from an increase in trading activity. So we are seeing incredible numbers. Goldman Sachs especially set a record for quarterly trading revenue. All the other banks have done really, really well as well, exceeding his expectations, as you said. So overall, just a marquee quarter for these banks.
And Balazs, but there are some caveats there because costs are rising. Are we expected to see more of this performance going forward? What about that cost element especially?
Well, interestingly, some of that cost increase is a function of that amazing trading performance. There is a huge competition among the banks for talent and for ways to kind of take advantage of that enthusiasm among investors and of the huge activity, especially when it comes to the deals front, whether it's M&A or IPO. So there's a lot of competition for the top talent, and banks are having to set aside more and more money to be able to attract or retain that talent. So that's one area where the costs are increasing and where we can probably expect them to increase further. There was one interesting note from one of the banks. They cautioned against the sort of the use of AI and token spending. It's not a huge deal as yet,
but they're seeing an increase of AI use, and it looks like that's something that they want to keep under control just to make sure the costs there don't get out of control.
All right, Balash Benz, our deputy managing editor for APAC Equities, with everything we saw happening in Wall Street yesterday. Now on to some football news. Spain are into their first FIFA World Cup final since winning the tournament in 2010 after a comfortable 2-0 victory over France. Mikel Oyarzabal opened the scoring with a first-half penalty before Pedro Porro sealed the win just before the hour mark. It was a disappointing performance from favourites France, whose star attacking lineup managed just 3 shots on target. Spain will now meet either England or Argentina in Sunday's final, which a lot of us will be watching. But before we head towards the end of the show, a quick look at where equity benchmarks are. Lots in the green, S&P futures in the green, Nasdaq 100 also 0.8 higher, and Dow Jones edging higher by the second. We're not seeing the same performance in Euro Stoxx 50 futures, a little bit lower today, perhaps impacted by the tensions continuing in the Middle East. And speaking of that, oil prices are edging a little bit higher, although steadying today in comparison with what they were doing yesterday, $85 on the barrel for Brent. That is it for Horizons Middle East and Africa. Stick around with us for Daybreak Europe. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Live from Brussels, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. The blockade is in, the fee is out, and the bombing continues. President Trump keeps the world guessing as fighting in Iran escalates. And a no-tolerance Fed. Chairman Warsh is unmoved by the first monthly decline in U.S. consumer prices in 6 years. The market weighs a dovish print with a hawkish message from the Fed. And a slowdown in China. Growth unexpectedly falls below target to its weakest level in 3 years, fueling pressure for stimulus from Beijing. Good morning this Wednesday morning. Let's bring you across the market action across the world here. We are watching what we're watching for futures in the United States and Asia Pacific already. We've got a solid trade going up about 2% this morning. Looking at the European futures this morning, looking a little bit flatter to the green, but also looking very critically there at NASDAQ futures that are trading up 0.5%. But of course, our focus is also on the futures markets within the Brent market. We're looking at Brent that has broken through $85 a barrel, something we're watching very critically ahead of what we've been watching in Iran, the escalations there. Of course, the dollar index in full focus. And of course, that U.S. 2-year yield falling almost 10 basis points yesterday after what we heard from Kevin Warsh, and of course, what we saw from that all-important CPI print from the United States. As we sort of take our attention further to the day, the risks events we're watching, 1:30 p.m. in the UK, U.S. PPI. We'll be also watching Warsh this time in front of the Senate, giving his testimony, and of course the U.S. Fed Beige Book at 7 p.m. tonight. Well, good morning. We're getting some breaking news this morning from ASML, one of the biggest company here in Europe, and of course one of the most important companies to that tech trade, and of course the AI build-out, making those lithography machines across the world. Let's get through some of the numbers that we're getting crossing the wires right now. We're looking that they're raising their 2026 view. That's something we were watching for and that was expected by the market. ASML seeing third quarter net sales of 11 billion euros to 12 billion euros. The estimate was for 10.3 billion. We also see full year net sales of 43 billion euros to 45. They saw previously 36 billion to 40. So that is a material increase there for ASML. And we should just say ASML, one of the most important companies here in Europe, probably the one in Europe that has the greatest stranglehold and greatest influence on that sort of global AI story. So something we'll be watching and we'll be getting into a little bit later in the show. But in the meanwhile, we're watching oil prices that are climbing this morning for a third straight day this morning as U.S. completes another round of strikes against Iran after reimposing its blockade on Iranian ships through the Strait of Hormuz, even as President Trump climbed down on his calls for vessels to pay the U.S. toll. Speaking to Fox News, Trump threatened further military escalation against Tehran.
Anticipate that the strikes we're seeing this week against Iran will expand. Are you considering hitting energy targets or other locations inside of Iran?
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them because next week comes the power plants. Next week comes the bridges.
For more, let's bring in Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar. From the President of the United States, we've had both escalation, we've had stepping back on some things, and we've had some threats into the future. Bring us up to speed this morning.
Good morning, Ollie. Yeah, it's all a little bit confusing. In the span of 24 hours, President Trump came out and said that he will reinstate the blockade on Iranian ports in the Strait of Hormuz. That has happened and is continuing to happen. And then he said that he will impose a 20% fee on all cargo ships that are non-Iranians going through the Strait of Hormuz, only to back out of that yesterday, saying actually he's not a fan of this fee and that he got pledges from Gulf Arab states in the GCC saying that they will make further investments in the United States if the president revokes that 20% fee. Now, our own sourcing, Ollie, suggests that at least one regional government in the region had not agreed to making further investments. Now, just bear in mind that only a couple of years ago when President Trump visited the GCC, those countries made pledges of hundreds of billions of dollars, if not even trillions at some point. And so at least one government is telling us that is not going to happen. In the meantime, the Strait of Hormuz, the traffic there is still at a trickle. We're seeing ships at a standstill at some points. Iran continuing its retaliation in the region, in Kuwait, in Bahrain. Kuwait, for example, reporting overnight that 4 naval personnel were injured. That follows attacks in the Strait of Hormuz, where Iran a couple of days ago hit 2 UAE-flagged ships, killing 1 person, injuring several others. But at least for the time being, we know that this notion that was brought up by markets over and over about the taco trade or about President Trump going back on his words has returned. So the 20% fee is no longer going to happen. We're also not clear if those investments will make their way through to the United States. And we all are keeping an eye out on whether the technical negotiations are set to continue. We have no clarity on whether those are expected to recommence. The expectation for the time being is that we're seeing this kinetic, this sort of kinetic back and forth coming back to the table, but the wider negotiations are still expected to be mediated by the likes of Qatar and Pakistan over the next few weeks. And we're keeping an eye out on the August 20th timeline that is approaching very fast. Ollie, that is the end of the 60-day negotiation period over the MOU that was signed in Switzerland. So markets are reacting a little bit more steadily towards the flood of news that we've been getting all week. Brent at around $85 a barrel, so a steadying in the action there.
Well, Abir Abu Omar, thanks again for keeping us across what is a very escalating and quickly moving story there in the Middle East in the Strait of Hormuz. I'd like to bring you a little bit more news out of ASML, the biggest company here in Europe, almost twice the size of the company that is the second biggest in Europe. That is the fact that Intel is apparently, the ASML says, has begun to use its most advanced lithography machine for chip production, showing that this new equipment that the company has now put out is ready for widespread adoption. You'll remember that Taiwan Semiconductor Manufacturing, TSMC, whose factories produce the most advanced chips in the world, they had said that the latest generation of ASML machines were too costly for mass production. So this will be seen potentially as yet another boon for ASML, who again has these numbers out today, and we can give you a little bit more of those numbers. Their full-year gross margins expected to be at 54 to 56%. Previously, they had seen 51 to 53%. So again, a pretty bullish story from ASML today. Again, they were expected to raise their forecast, so we'll see if this is enough for the market when we get that opening trade a little bit later. But meanwhile, stocks in Asia are gaining. The U.S. futures are pointing higher as the AI trade is gathering fresh momentum. Let's get more from Ven Ram, our cross-asset strategist over at Bloomberg MLive. So Ven Ram, tie this all together. Obviously, we've got the broader theme. We've got the Fed. We've got this tech rally this morning. But of course, now we have these numbers from ASML, which from what I can see so far seem pretty bullish.
Yeah, they're absolutely mind-blowing numbers, as you just pointed out, Ollie. But I think that, this is not anymore about fundamentals. Of course, the fact that ASML has come out and guided markets higher is going to buoy sentiment. And of course, the overnight tech rebound also plays into this. And we see that the Kospi is up yet again today. But what it is it's a very vicious rotational play led by leveraged, single-name leveraged stocks. That is at the center of all that is happening at the moment. And if there is pressure, and if there is, after the market's run up a whole lot, there is a tendency, because these are highly leveraged products, people tend to take money off the table, and that kind of prompts margin calls and all kinds of vicious things. So it's a very vicious rotational play. Investors are colluding with different investors, are colluding with different time frames. Some are there in the market for a long time, some are there with very short time frames, trade time frames, and that is something that investors should watch out for. But I think that, this, as long as this tech story, the narrative plays out that AI is going to be a winner, I think we are going to see these immense rotational plays, albeit the NASDAQ itself is trading around fair value. So it's not about aggregate market valuations, it's about the focus on single name stocks.
Well, Ven, thank you very much for your analysis this morning, keeping us again across all the moves in the tech space, and again sort of giving us a perspective on those ASML numbers that we just got. Ven Ram, cross-asset strategist at Bloomberg MLive. And traders have cut their bets now on a July Fed rate hike after a softer-than-expected CPI print from the United States. They now see an under 20% chance of a move higher this month, down from almost 50% yesterday, while a September hike remains in the balance. The repricing comes as Kevin Warsh delivered the first congressional special testimony as chairman, warning against complacency on inflation.
It's one data point. The reason I create a task force on data is I don't want to overread or cherry pick data. There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Let's get a little bit of perspective here and bring in Bloomberg senior editor Alistair Bull for some analysis on what we got out of the United States yesterday. So we got a fairly dovish print in terms of CPI and prices. We got a fairly hawkish chair over at the Federal Reserve. How do the markets parse this?
I think they passed it correctly, Ollie. Good morning, by the way. So, I mean, the soft CPI print takes the pressure off Walsh to push for a rate hike in July, but it doesn't remove the potential for needing to tighten monetary policy against the background of persistent elevated inflation that's been above 2% for nearly 5 years. And with Walsh continuing to sound hawkish, while without actually saying what he's going to do and avoiding explicit forward guidance, at some point he's going to have to match words with deeds unless the data does continue to go in his favor. So he said it's just one data point. If he gets a series of softer prints, that may remove the necessity to tighten again, but there's an awful lot of uncertainty out there, and with the renewed conflict, renewed tensions in the Gulf, there's headwinds from higher energy prices. So I think that's why the market correctly anticipates that the question about rate hikes is going to remain on the table, certainly for the next few months, Ollie.
So, of course, one of the questions, of course, is the rate path. That is the thing that we're most sort of immediately focused on in the short term. But there is also a focus on a sort of new regime at the Federal Reserve, what the sort of Walsh communication policy is, balance sheet policy is. What did we learn on that side of things?
He kept his cards pretty close to his chest, but he did promise to be transparent about it. He said his task forces will provide regular updates, and he hopes to have conclusions by the end of the year. But he didn't get ahead of them, which is, I think, a position that we would have anticipated. He's been careful to say that they have an open page or in a discovery phase, and he's not going to prejudge and offer his own priors. So I think we're going to have to wait and learn. He says everything's on the table, and I think we'll take him at his word, at least for the time being, Ollie.
Right. Well, Bloomberg's Alistair Bull, thank you so much for your analysis this morning and for, ahead of, well, another testimony from the Fed chair before the Senate a little bit later today. Still ahead, though, and taking it to the bank, exuberance across equity trading drives records on Wall Street. A very strong backdrop, but with a few warnings on the risks ahead. But first, pressure on policymakers as China's growth slows to its weakest in more than 3 years. More on that next, and this is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back to Bloomberg Daybreak Europe. Well, China's economy slowed more than expected last quarter, growing 4.3% from a year ago. That's the weakest growth in more than 3 years that we've got out of China and below the country's official target range. So let's bring in Bloomberg China economy and government editor Alan Wong for a little bit of analysis in terms of what we got this figure. So Alan, let's looking at this figure, 4.3%. What actually led within that to the slowdown?
Yeah, first of all, 4.3 is not a number we typically associate with China GDP growth. It's lower than expected. In fact, only one economist that we surveyed predicted a lower number than that. And then we surveyed dozens of them. So it goes to show just how unexpected that slowdown was for the second quarter. So a couple factors at play here. One story that we've heard over and over again is just how weak domestic demand is. And that weakness is with both consumer willingness to spend and also with investment. We actually saw investment fell in the first 6 months of the year compared to the same period last year. And that's unusual in a country that's still very much building new bridges and factories, but seeing that fall, it's a rarity in the last couple of decades of rapid growth for China. And then on top of that, we've also seen some signs of the home market continuing to deteriorate. Prices fell in the month of June and compared to the previous month, even though the fall eased off a little bit.
Yeah, well, listen, 4.3% probably not quite crisis territory, but you're painting a slightly gloomy picture. Are we going to expect any kind of reaction from Beijing, from government officials in order to turn that growth figure around?
So the Statistic Bureau's official attributed some of the slowdown to temporary factors, such as the energy shock from the Middle East. And there's no sign of panic in the room, and it just means that China may well accelerate its implementation of previous promises to stimulate the economy, but there's no fresh stimulus in sight based on the conversations we've had with different economists. They may expect some work to do on the fiscal front. The government may spend more in general. They may accelerate investment in infrastructure, which is a very well-used playbook by China. But in the immediate time horizon, we're not seeing any signs of big stimulus coming along. The other thing to watch out for is later this month, China's top Politburo is going to meet, and then they'll most likely discuss economic policy making. And so this quarter's print is likely to loom very large in their mind as they figure out what to do with the economy.
Great. Well, Alan Wong, our Bloomberg China and Economy Government Editor, thanks so much for your time and your analysis this morning from that important print out of the Chinese economy. Coming up next, Chancellor Rachel Reeves says there's still work to do to protect the UK's economy. I think that's what we call British understatement. In what is set to be her final Mansion House speech, we'll have her comments next, as well as the analysis from the BOE Governor, Andrew Bailey. That's next, and this is Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
The resumption of hostilities in the Middle East in the last few days has shown that our economic resilience will continue to be tested. And the market response to those changes shows that there is still work to do to ensure that our economy and our country is protected against a volatile global economic landscape.
The analysis there from UK Chancellor Rachel Reeves speaking at the annual Mansion House dinner last night. When Bank of England Governor Andrew Bailey addressed the city, he called the incoming government to prioritise economic growth and to maintain fiscal discipline. For some analysis from what we've heard on the UK economy, we're joined now by Matt Bunny. He is the UK economist at Bloomberg Economics. So listen, let's start first with what we heard from Andrew Bailey at the Bank of England. What were your takeaways from what he had to say?
So Bailey's speech was largely focused on the importance of solid regulation in supporting economic growth. There wasn't a lot of material new information there for markets or for the outlook of monetary policy. I mean, he did also mention cybersecurity risks associated with AI and the potential threat that poses to financial stability, which has become an increased focus for the Bank of England recently. I'd point to kind of the bigger issue for the Bank of England we've seen recently is the re-escalation in the US-Iran conflict. Indeed, the increase in energy prices that we've seen means that markets have upped their bets for rate hikes from the Bank of England this year to 1.5 by the end of the year, underscoring just how closely tied the outcomes in monetary policy and the Iran conflict are. It's worth saying that inflation expectations at this stage remain well anchored, and also we're still expecting the labour market to soften over the back half of the year. So altogether, that's going to help likely prevent this inflation problem becoming more persistent. So that is why we're still expecting rates to remain on hold, unlike markets.
And we also heard from him saying that the next government should prioritize economic growth and maintain fiscal discipline. We're still largely in the dark in terms of what to expect from Andy Burnham in terms of economic policy. Can we expect fiscal discipline and prioritization of growth?
I mean, certainly Andy Burnham has underscored that he wants to maintain fiscal discipline after those famous remarks about that being we're too in hock to bond markets. I mean, we can shape out the kind of we can get a sense of the broad contours of Burnham's policy based on recent public statements from him and his circle, and also his performance during time as Mayor of Manchester, where the region saw a period of particularly strong economic growth. So we're looking at things like moving powers away from Westminster towards the regions, greater public control of essential services, and also more council house building. So, I mean, whether that can deliver growth and whether Burnham can push through these policies is the key question. What is telling is that at this stage, reports are indicating that Burnham still does not know who his pick for Chancellor will be. So that will be an important signal for the direction of economic policy.
And thinking about economic policy, which is obviously in the UK, is obviously what you spend a lot of your time thinking about. Does any of the sort of parties, as we have all this debate about reform and the Tories and Labour, does anyone seem to have a formula to turn the UK economy around, something that would be favourable, at least from the market perspective?
I mean, politicians have been talking for a long time, as have economists, about how best to drive up growth. We saw the previous Labor government made a good crack at this by really trying to push up investment, and that will likely help over the long term. But clearly, it hasn't been enough to get growth up in recent years, and in particular, the issue that is facing Rachel Reeves and Keir Starmer is that living standards in the UK haven't really budged that materially since they've been in power. So the kinds of things that markets would like to see would certainly be a pickup in investment to address long-term potential growth issues. Obviously, this is weighed against the need to maintain fiscal discipline given the UK's already elevated debt burden.
Yeah, well, Matt Bunny, thank you so much, UK economist at Bloomberg Economics, for his analysis and the latest for what we can expect for this new government. Now to some other stories that we're following this morning. A new package of Russian sanctions from the United States, which was spearheaded by the late Senator Lindsey Graham, would target the top 5 purchases of Russian crude and gas, including China and India. The legislation, which has been backed by the president, would give him the authority to hit them with the tariffs of up to 100%. The bill still needs to be passed by the Senate, but the timeline for a vote is unclear. And shares in IBM fell by the most in nearly 6 decades after preliminary second quarter revenue missed estimates. The CEO says IBM was caught off guard as customers shifted spending towards servers, storage, and memory. The company says it's reviewing its books, and the final results, set to post next week, may be slightly different. And Bloomberg understands that OpenAI is planning its first push into consumer devices with a mobile, screen-free smart speaker. Sources say the product, which is still being developed, is meant to serve as a human-like AI companion that lives in the home. It will help control smart home appliances, play media, answer questions, and tap into a range of capabilities offered by ChatGPT. And payment processing firms Stripe and Advent International have offered to buy PayPal in a deal valuing the company at more than $53 billion. That's according to Reuters. The offer represents a 28% premium to PayPal's closing price on Tuesday. The report says 2 suitors would jointly own PayPal with equal stakes and don't plan to break up the company. So there's some of the news that we're watching. Coming up next, the dollar slips as traders pair July rate hike bets from the Federal Reserve to help us reprice the dollar and all the currencies, of course, across the world. We will speak with Jane Foley. She's the head of FX strategy over at Rabobank. That's next, and this is Bloomberg.
Up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from Brussels, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. Europe's most valuable company hikes its full-year sales forecast for a second time this year as a surge in AI spending drives demand at ASML. And the blockade is in, the fee is out, and the bombing continues. President Trump keeps the world guessing as fighting escalates in Iran. And a no-tolerance Fed. Chairman Warsh is unmoved by the first monthly decline in U.S. consumer prices in 6 years. The market weighs a dovish print with a hawkish message from the Federal Reserve. Good morning this Wednesday morning. Let's get a check on the markets across the board here. What we're seeing is a very sort of large reversal to what we saw earlier in the week with that sort of sell-off across tech. That really turning around today. You can see it represented there in the MSCI Asia Pacific Index up 1.8% this morning. Eurostoxx 50 futures, on the other hand, down by about 1/3%. And of course, NASDAQ 100 futures, you can see it there up almost 0.7% going into the session in the United States. Of course, we take it cross-asset as we do every day, and of course, watching very closely Brent crude up over $85 a barrel there, up about 0.8% at 85.40 is where we find Brent this morning. The U.S. dollar index down by about 1 point there, down by about 0.1%. And of course, watching the U.S. rate story, all importantly, after what the commentary we heard from Kevin Warsh, and of course, that sort of softer CPI print that we got yesterday. U.S. yields yesterday really sort of plummeting on the U.S. 2-year. You can see it there. They're trading relatively flat. 4.1997% is what you get on your 2-year yield this morning. Time now for your front pages and what we're watching across the world and across the news outlets, starting with the Financial Times, which reports that Ukraine is being allowed to use EU funds to buy Chinese drones and parts. The paper says it exposes Europe's reliance on Beijing for critical parts as it struggles to build its own defense industry. And the Wall Street Journal says the bull market is being put at risk by blockbuster stock sales by companies including SpaceX and SK Hynix. The paper says investors are growing wary of the rise in stock and bond issuance as it could outstrip demand. And El País celebrates Spain's World Cup victory over France with the headline, "A prodigious Spain captures another final." Of course, that would be the perspective from El País, but I could tell you that particularly on Bastille Day, this was something that stung particularly over in France. And you can catch a roundup for all the stories you need to know to get your day going. And today's edition of Daybreak Terminal subscribers go to DAYB Go. And we're getting some headlines and some news and some earnings out of one of the big luxury houses here in Europe, Richemont. First quarter sales at a constant FX are up 20%. That is almost doubling what the estimate was for 11.2%. First quarter sales coming in there at 6.4 billion euros. That again beating the estimate of 5.9 billion. And watching very closely, of course, the jewelry sales that seem to be up about 24%. And so it's seemingly another sort of bullish set of numbers there following ASML from Richemont this morning. And the dollar slips for a second day as expectations for the Fed rate hike this month are paired following that U.S. inflation data that we've been talking about. Traders now look to U.S. producer prices later today as the Federal Reserve Chairman Kevin Warsh signaled in congressional testimony that he is rethinking how the central bank communicates with the markets.
The last 63 months, maybe 64 months of high inflation above the Fed's objective suggests that it is immediately important to think about reforms, including in communications, and that's what we're going to do. I don't expect any of the changing communications to be about hiding the ball.
So we've got a lot to break down from that testimony yesterday. We're very pleased to do so with Jane Foley, who is the head of FX strategy over at Rabobank. So I'd like to just begin parsing, I think, what the markets are parsing today, which is a sort of more dovish print over on the CPI side, coming in less hot in a way that sort of a direction that the government probably in the United States would like to see, while at the same time a slightly hawkish message from the chairman of the Federal Reserve.
Well, to be honest, I think Warsh is doing the sensible thing. He's really trying to buy his credibility. And the market, of course, just a couple of months ago thought that he might be a lot more dovish because he was Trump's appointee. But actually, that's not been the case. But really, that is a very clever strategy because, of course, once a central bank or a central bank governor were to lose their credibility, it's very difficult to fight that back, or to win that back. So he really is asserting his inflation-fighting credibility right now. And then we'll have to see what the economic data brings further down the line, whether or not he can step back on that. So that's what we've got from Walsh. Of course, the CPI data did bring us a reprieve. A reprieve is a word that I've seen in quite a lot of commentary this morning because, of course, with the conflict on again in the Middle East, then it is likely that the July CPI data won't bring us, quite such good news.
And so how difficult is it to outlook it now? I know that's sort of an unfair question. Of course, there was a 50-50 that you get a hike this month. That obviously now seems to be off the table. Potentially now one hike coming to the end of the year. How reliable are our forecasts going to be at this time? Should we just sort of forget about trying to forecast it and just wait to see what happens in Iran?
Well, that will be a significant part of the story. Now, of course, oil prices are significantly higher than they were just a couple of weeks ago, but we're not seeing the above $100 prints, at least for now. And that is, of course, because, the market tends to look at this with a glass half full outlook. They are still hoping that there will be negotiations. They are still hoping that both sides, of course, want to bring an end to this conflict. So for now, there's a lot of tension there. There's a lot of concern, but the market, at least for now, isn't as concerned as perhaps it was. But what's really interesting with respect to the dollar is that it didn't go up yesterday morning when the market was anticipating an interest rate hike potentially as soon as July. And that does suggest that for now, those long positions in the dollar, perhaps a little bit saturated.
And thinking also about some of the other things that we're supposed to be getting from Kevin Warsh, this obviously new regime at the Fed, so-called. He's a fan of the task force. We've learned that as well. Did we learn anything, you think, material that could drive the dollar yesterday from his testimony and things apart from his view of rates?
No, I mean, he has already signalled that he doesn't want to give us too much in the way of forward guidance. We know he's not a fan of forward guidance. So he told us, there would be more reform and communication. But to be fair, that's no big surprise. That we know that he does want to do these task force. Communication will be part of that. Indeed, I think we have an ex-Bank of England governor involved in that, or will be going forward. So I don't think we had anything particularly new in terms of what he's going to do. But, what we do know right now is that he is a little bit more hawkish than many people had anticipated that he would be. That in itself should help keep a lid on inflation expectations and perhaps make it easier over the medium term for him to actually cut interest rates, if that's what the economic data do begin to suggest.
So it seems Kevin Warsh making it a little bit easier for himself to practice monetary policy. I want to go, though, from the United States to the United Kingdom. We've had some commentary from the Chancellor yesterday and, of course, also from the Bank of England Governor Andrew Bailey. Have a listen to what he had to say.
Lower productivity growth means lower growth in incomes and lower growth in living standards. It means fewer resources are available for households, businesses, and public services. So reversing this trend and continuing to reverse this trend must be a national priority. I strongly agree with the Chancellor on this and on what she has been doing.
So Andrew Bailey will be the sort of continuity going into next week when we're expected to get a new government from the United Kingdom. How are you expecting that to affect cable and the pound more broadly, this new government?
Well, over the last month or so, sterling has actually been performing quite well, suggesting that the market is willing to give the new Prime Minister Burnham, assuming that's what we're going to get on Monday, maybe a honeymoon period. But there is likely to be room for tension further down the line. Now, the first thing is that we don't know who his choice of Chancellor is going to be. Rachel Reeves last night at the Mansion House perhaps had one last-ditch attempt to keep her job, but that is not what the market is expecting. Now, if we go towards the left with Miliband, the market isn't likely going to enjoy that. They're going to be a little bit frightened of extra gilt supply. But if we look at, for instance, the Financial Times this morning, it's suggesting that Miliband will not get that job, and that perhaps will be a little bit of a relief to the market. So choice of Chancellor, important for the market as a first test, if you like. But then we need to know how Burnham will fund his job. Clearly, we've got a very high tax burden already in the UK. The electorate won't like more taxes, but at the same time, gilts won't like more supply. So there's going to be room for tension further down the line.
Well, Jane, we can't let you go yet until we get your perspective on what we've been seeing on the yen and the rate story in Japan. Obviously, there's been a sort of a bit of a battle, shall we say, between the government and what the market has sort of been indicating. Who do you think is going to win that battle, and where do you see that driving the sort of the yen in the next coming few months?
You know, this is the interesting thing. I think the yen certainly is undervalued. What is very difficult to work out is what's going to be the trigger that could turn it round. And I think there's got to be various different things coming together. Now, the first thing is that the market continues to be concerned about the government's fiscal policy. And I think there needs to be more reassurances about JGB's supply. The second thing is, of course, there's a lot of expectations that perhaps that Bank of Japan has been behind the curve a little bit on inflation. Now, CPI or core CPI inflation is within target. So perhaps that's a little bit unfair, but I think we do need to see the Bank of Japan signalling potentially that they can accelerate the pace of interest rate hikes. That could be another factor. But it has been interesting over the last few sessions about the government, the Ministry of Finance, potentially changing tack a bit and talking about repatriation from buy or Japanese funds back into JGBs. That's going to be something really interesting to watch.
Well, Jane Foley, thanks very much for that. Head of FX strategy at Rabobank, taking us across the world on the Forex forecast and, of course, what will be driving those exchange rates in the months to come. Well, Wall Street's biggest banks shattered equity trading records in the second quarter. Goldman Sachs led with a $7.42 billion haul, the highest ever posted by any bank in a single quarter. JP Morgan Chase CEO Jamie Dimon credited a surge in market activity for his bank's record profit, while cautioning that it may not last.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but how much better, I don't know.
Well, for more, we're joined by Bloomberg editor Balazs Pence. So obviously, we were expecting a blockbuster revenue record here for the trading desk across Wall Street. Was there anything in this that really stood out to you? I mean, you look at some of the moves on the stocks. Goldman up 9%, Citi down 5%. Obviously, the market was surprised by something.
Yes, I think if there was a surprise, it was just how good and how exuberant those numbers are. We did expect a near record. We got something even more than that. We got trading revenues that surpassed even that record first quarter. In Citi's case, maybe not as much as some of the other competitors, but the lesson here is that in times of volatility, in times of heightened trading, it's the bank that always wins. Investments can go up and down. Investors can suffer some losses sometimes, but when there's volatility, when there's an increase in trading activity, that's great for the banks. We see that at these trading desks. It was a very volatile period in stock markets. A lot of people wanted to get in to make money, and that's what we are seeing in these revenue numbers. When Jamie Dimon says he doesn't know how much better it can get, that tells you it's pretty good for them.
Yeah, well, Balazs, I mean, I was also struck by this. Obviously, there was a lot of exuberance, a lot of euphoria, but you heard it in the tones of David Solomon, of Jamie Dimon. There's not something that I would really qualify as fear, but really being like we are in a sort of the high watermark. There is real concern that this cannot endure, and there is real concern that things could turn around really quickly. Though the bank always wins, we are hearing some concern from some of these executives.
Yeah, so there are two reasons for that. I think one is when you get this high, when you set record after record every quarter, it just has to creep into your mind. As Jamie Dimon said, you don't know how long it's going to last, right? You know, the only way down from here, is it down, or can you notch another record in the next quarter? So you got to be cautious. You maybe got to manage expectations a little bit. The other reason is a lot of banks are talking about increasing costs, and part of that is the competition for the business, the competition for the talent, especially when it comes to deals, when it comes to IPOs and M&A activity. Banks have been spending a lot of money to attract talent, to retain talent, to kind of get these star traders and star deal makers from each other. They are setting more money aside for that. That increases their costs. So there's probably some caution seeping into the tone from that as well.
Well, Balazs Pence from Bloomberg there, sort of making us smarter on the U.S. Bank earnings. I'm sure we'll be speaking to you throughout the week as we get more from the United States and from Wall Street. So you get those blockbuster numbers out of U.S. banking. But coming up next, another blockbuster set of results from Europe's most valuable company as it lifts its full-year sales forecast again. We'll dig into ASML's numbers. That'll be next. And this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Now, ASML is moving higher on TradeGate ahead of the open. That comes after Europe's most valuable company has boosted its full-year sales forecast, not for the first time, but for the second time this year, after revenue comfortably beat estimates in the last quarter. For more, let's bring in Bloomberg's Charlotte Hughes Morgan in Amsterdam. So listen, let's get your takeaways on these earnings. Are we able to call this a blowout quarter in forecast?
Thanks, Oliver. Well, yeah, as you said, the main thing is that full-year guidance increase. Again, even after increasing it Q1, ASML is saying, look, now we're seeing total net sales for the full year, 43 to 45 billion euros. I mean, that is a big leap from what they were guiding for before, 36 to 40. So investors who are already expecting some kind of increase may be surprised by the scale of it. And what it tells us, essentially, is that demand for AI semiconductors, demand for this AI infrastructure rollout, it's really unrelenting. Now, remember, ASML is the only company in the world capable of making the most sophisticated lithography machines that make the most advanced semiconductor chips that basically power the AI boom. It works with all the major chip makers, TSMC, Samsung, Intel. And what we're seeing from this set of results with beats across the board is that demand from these customers continues unabated. They are ramping up their capex, and ASML is the beneficiary of that. And something investors were looking at very closely going into this set of results was whether ASML could ramp up capacity quickly enough to meet the soaring demand. And ASML, if you look at the statements and the CEO comments today, are being very explicit in trying to give reassurance to the market and saying, look, we understand that we need to ramp up supply, and we're looking ahead at 2027. We're looking at a 30% capacity increase in our EUV machines, and looking even into 2028, we're also investigating a 30% increase as well. So ASML being very clear, they're looking long-term, they're working with their customers long-term to ramp up output.
So obviously we're looking at some of these numbers, again, against the revenue, across the margins. These are the kind of numbers and the blunt instruments that are going to be very positive for investors. But investors are always also going to be looking for texture. And in terms of the conversations and when we have those conversations with the CEO, what texture will investors be looking at in the questions that they pose?
I think it's a really interesting time for the AI market overall. Generally, it's been a volatile last few trading sessions, kind of globally. Expectations are so high for these companies. So I guess the question that will be on the mind of the market, of investors, is this increase, is this capacity increase, this raise, is it enough really to meet the demand? Or were people actually expecting ASML to come out with more? So I think that's the question that we'll really be looking at as the stock opens and as we go into investor calls. Is this 30% capacity increase enough? Does ASML anticipate kind of further boost down the line? I think something that's also worth raising is obviously alongside results, we had a release saying Intel, a major customer, is now using a high NA EUV machine, one of ASML's most sophisticated products for production of their advanced chips. And the reason this is a win for ASML is because these most sophisticated machines were previously touted as being a bit too costly to run for mass production, criticized as being too expensive. I think TSMC said they'd wait to a future date to roll them out. So Intel coming out alongside this set of results and saying, we're using this advanced machine already. Now that's really important for ASML because these sophisticated machines are kind of integral to their growth story as we go into the next few years.
Well, Bloomberg Charlotte Hughes Morgan, thank you so much for that analysis on what I think we can probably call one of the most important, certainly the biggest company here in Europe. And terminal users can follow the developments on all these ASML earnings. We're running a live blog right now. Just go to TLIV Go to get that information, the very latest from ASML. Now to some other stories that we're watching this morning. Uber is in advanced negotiations to buy German fast delivery company, a Delivery Hero, in a deal that would allow the ride-hailing giant to better compete with rival DoorDash outside the United States. Delivery Hero has confirmed that discussions are in progress, while Uber offering a potential bid of about 40 euros per share, valuing the company at more than 12 billion euros. And Spain are into their first FIFA World Cup since winning the tournament in 2010 after a comfortable 2-0 victory over France. It was obviously a disappointing performance for the favorites France, whose star attacking lineup managed just 3 shots on target. Spain will now meet either England or Argentina on Sunday's final. We got plenty more coming up. In the rest of the show, we'll be talking a little bit more about that growth figure out of China that came in slightly weaker at 4.3%. We'll have some final analysis, obviously, on the Federal Reserve and everything we're watching there. And this is Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
William Chesney Martin used to say that the Fed's job is to take away the punch bowl when the party just starts getting good. And I would say the party is getting really good right now. So this is the flip side of financial conditions being very accommodative. And so I think that argues for the Fed raising rates a little bit.
The perspective there of Bloomberg opinion columnist and former New York Fed President Bill Dudley. And that is, of course, exactly where we're going to take it here in some of the charts that we're watching here as we close out the show. The Fed, the repricing we've seen across the board after that CPI print that came in lower than anticipated, the first decline in monthly consumer price index in the United States in a number of years. And as you can see there, there's been a real repricing in terms of what to expect from the Federal Reserve, despite a more hawkish tone from what we heard from the Fed chair speaking before the House. We're expecting him to speak a little bit later before the Senate there. But you saw there was potentially a chance of a hike this month. That seems to have completely dissipated after those comments and that print that we got yesterday. We're also watching very closely China, or I should say bank earnings. We'll get to China in just a moment there. We've been talking about Goldman Sachs. We've been talking about the outperformance in terms of the retail trading desk. But you can really see it there illustrated in the stock price of Goldman Sachs, moving 9% yesterday in a single session after blowout numbers, setting a record in terms of equity trading for any bank in any quarter. And you can see it there really pulling ahead of the S&P 500 financials by a fairly large margin. Of course, going to China, an important story this morning. Growth out of China disappointing, 4.3%, which is significant because it is below the range that we expect from China. They put out 4.5 to 5%, so coming in lower. But of course, also paying some attention to the deflator, which turning positive for the first time in years out of China. We'll be watching a number of risk events ahead. We'll be talking about Kevin Wersch, who will speak before the Senate a little bit later today. And of course, the Beige Book from the Federal Reserve at 7 p.m. And this is Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the trend, the technology trend, and the investment is real.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning. It is Wednesday, July the 15th. Here's what's on the agenda. Oil gains for a third day as Trump threatens to ramp up attacks on Iran. But U-turns on Hormuz tolls again. Traders trim bets on rate hikes as US inflation eases, but Fed Chair Warsh says it is not mission accomplished on inflation. And AI demand powers another upgrade for chip equipment maker ASML after IBM said it's being left out of the AI party. Let's get to the markets then. A turnaround in terms of sentiment when it comes to the semiconductor story. You saw that overnight in the US with the Nasdaq 100 closing high by more than 1%. The Kospi then in focus for us today, gaining 7%. We know the volatility is there, of course. SK Hynix having a strong session in the US, and that's filtered through into the Asian session today. In terms of the futures story, after modest gains, very modest gains for European stocks at the close yesterday, you're looking to add so far 9 points, up about 0.2%. Some strong earnings stories in the US when it comes to banks. Of course, the equity trading teams performing very strongly for the likes of Goldman Sachs and JP Morgan, and some earnings strength as well coming through for Europe with Richemont coming out with a beat and ASML as we mentioned. Brent crude though remains higher, and that is a continuing concern for investors, of course. $85 a barrel and remaining above that level right now, up 0.7% so far in the session. The countdown to the opening trade starts right now. So let's kick things off with tech then. ASML lifting its annual sales forecast for the second time this year, as a surge in artificial intelligence spending drives demand for the Dutch company's chip-making machines. Let's bring in Bloomberg senior strategist Neil Campling. Neil, we want to get to what's happening with SK Hynix as well, but let's start with the ASML story. The numbers breaking at 6 a.m. UK time, so a little over an hour ago, and it looks pretty strong. It looks like they are benefiting from this build-out in capacity, the build-out of foundries, and the demand coming through for their kit.
I think, Tom, the way we would frame it is that there were great expectations into the results, and crucially, in the guidance, they still beat those great expectations because they raised the guidance for the full year, expected, but they raised it above not just consensus, but all street estimates. So even the most bullish on Wall Street, they managed to beat those expectations. So that's a great print. And actually, for a step back quickly, if we look at kind of the AI winners baskets, if we look at the SOX index, the semis index benchmark, ASML's actually underperformed this year versus the chip peers in Europe and against the SOX index in the US. So that's perhaps time for a catch-up trade for Europe's biggest company. It is definitely a key enabler of AI globally, and this is encouraging. The key now will be the 2 p.m. London conference call, and analysts will be looking about longer-term insight into the guide and whether they had the capacity available to meet the demand that's being fueled, as you mentioned.
Yeah, it seems like they have plans to ramp up capacity because there had been some concern from some in the sector that maybe they would end up being a bottleneck. So we'll listen into that. One of their customers, one of their clients, amongst many, is SK Hynix. A very strong session in the US yesterday. I know you have real insight in terms of the linkages from a market's perspective in terms of how we should be thinking about whether this is healthy or unhealthy, how investors should be thinking about the dynamics now we see between the Nasdaq 100 and the Kospi with the SK Hynix and those two listings. What are the takeaways? If we step back from the last couple of days of trading when it comes to SK Hynix, what have we learned?
If you take the glass half full idea, then you look at Hynix and say the earnings are very supportive. It's very cheap in terms of the valuation. In that perspective, that's encouraging. It enables international investors to look for an alternative to, say, Micron in the memory space by investing in another pure play in terms of Hynix. If you want to take the glass half empty approach, then you would say that this has been, for the last 40 years, a very cyclical part of the chip market. and that those the power of earnings looks great today. But if you look at it on a price book basis, it's very expensive relative to history, about 7 times versus to history. So there's that. Then you have dynamics around there's a European listing on the Hynix, and the US list trades at about a 30% premium to the European list. So there's definitely dynamics going around in terms of the ETF positions, passive funds, the leveraged ETFs, etc., which have had a lot of headlines out in Asia in the last couple of sessions. So there is a sense in terms of volatility around the stock is unlikely to change anytime soon because of those other dynamics. But I'd like to look at what we see in terms of a longer-term environment as to where investors look at the option around sort of the alternatives in the memory space and other chips on a longer-term horizon, rather than looking at the minutiae of individual one-day moves or even within a session sometimes there's high volatility.
Okay, helpful context. Neil, thank you very much indeed, breaking the numbers down for us in terms of ASML and the context around what we're seeing again with SK Hynix, with the Kospi right now, and that major index, of course, in Korea up 7% right now. Bloomberg's Neil Campling. Meanwhile, on the macro front, traders have cut their bets. They've cut their bets on a July Fed rate hike after a softer than expected CPI print out of the US. They now see an under 20% chance of a move higher this month, down from almost 50% just yesterday, while a September hike remains in the balance. The repricing coming after Kevin Warsh delivered his first congressional testimony as chairman, warning against complacency on inflation.
It's one data point. The reason I created a task force on data is I don't want to overread or cherry pick data. There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Let's bring in Bloomberg senior editor Alistair Bull for some context around what we heard from the Fed chair and that inflation data out of the US. What did the data, if we put the data together, Alistair, and what we heard from Kevin Warsh in terms of his commentary, reluctant as he is to give that forward guidance, how does that inform our view about the outlook for rates?
Morning, Tom. So the cool CPI print definitely furnished Kevin Warsh with a soft landing for his first congressional testimony. I mean, those things can be real ordeals of fire. But he said, I think, what we expected him to say. It's only one print. We're going to need to see a series of numbers going in the right direction before we can draw any kind of firm conclusion about the next policy move. But he continued also to talk very sternly about the necessity to get inflation back to the Fed's 2% target. We know from the last meeting that there's a lot of concern that it's been above goal for about 5 years. And I mean, while he continues to talk tough, there's always, the thought in the market's mind that he's going to have to at some point back words with deeds. So it's really going to depend on the data. Now, if the data does continue to come in on the soft side, that could well take a rate hike off the table completely and start the conversation about a cut perhaps into next year. But we need to see how those numbers come out. And the longer Warsh waits, given this print now gives him time to wait, but the longer Warsh waits, the closer he gets to the midterm elections. Does he go in September? Does he go in October? If he thinks he does really need to take out some insurance against inflation. So I think that provided that the numbers don't really send a very clear signal, this idea of an insurance hike is going to kind of re-enter the conversation, Tom.
Okay, and it is the data that Kevin Warsh says we should be focused on rather than the communication. And so we've talked about the fact he doesn't want to do this forward guidance. He wants to change that dynamic for the Fed. He's got his task force as well, 5, I believe, of those task force. What did we learn, Alistair, about Warsh's plans to adjust and moderate Fed communications?
Not a lot, to be honest. I mean, he continues to say that he'll be transparent, that the task forces will provide regular updates, and he'll have some conclusions by the end of the year. But he didn't commit, and he specifically didn't commit to holding a press conference after every FOMC meeting, which has been the tradition for a number of years at the Fed. And he, I think he's going to continue to play his cards close to his chest. He doesn't want to forerun the outcome of the task forces. He said he's given them an open page, that they're in a discovery period, and so he's going to continue to sort of keep keep a little bit, sort of keep those views to himself until we learn more from the task forces.
OK, Bloomberg senior editor Alistair Bull on what we've been hearing from Kevin Walsh. He'll be speaking again, of course, today, giving further testimony. Alistair, thank you. Here's what else we should be thinking about throughout the day then. Today, US earnings, Morgan Stanley and United Airlines. We'll see if Morgan Stanley can match the haul, particularly when it comes to the equity trading business at Goldman Sachs. What a stellar day for US bank earnings yesterday. So Morgan Stanley is on the docket today. At 10 a.m. UK time, we're going to get the OECD economic survey of the UK. So a gauge there on the health of the UK economy with all its struggles and challenges ahead of a change in leadership, of course. And at 1:30 p.m. UK time, after that softer than expected CPI print out of the US, we get producer prices. So PPI dropping 1:30 p.m. UK time for the month of June. We'll see if that confirms the more benign picture for inflation out of the US. And at 3 p.m, talking of Kevin Walsh, the Fed chair, Kevin Walsh will continue his semi-annual monetary policy report to Congress, this time to the Senate Banking Committee. And at 7 p.m, the Fed will be releasing its beige book. So further details there in terms of how the Fed is thinking, what they're seeing on the ground in the US economy. Coming up, China's GDP, meanwhile, the growth unexpectedly slowing below the official target range. We're going to break down the numbers out of China. Plus, we will look at the stocks to watch at the open, including delivery hero Uber confirming it is in advanced talks to acquire the German food delivery company. Up next, we're going to be joined by Anika Gupta, Macroeconomic Research Director at Wisdom Tree. If you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Do you anticipate that the strikes we're seen this week against Iran will expand? Are you considering hitting energy targets or other locations inside of Iran?
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them because next week comes the power plants. Next week comes the bridges.
US President Donald Trump speaking yesterday evening on Fox News. His comments following a fresh wave of strikes by American forces against Iran. Oil prices climbing for a third straight day this morning as President Trump climbed down after just one day on his call for vessels transiting through the Strait of Hormuz to pay the US a toll. Let's bring in Bloomberg's Abir Abu Omar in Dubai for the latest. Abir, how seriously should we take these threats from President Trump that he will look to infrastructure in Iran, that he'll look to energy, he'll look to bridges and roads? He's made these threats before, but is this time and this moment different?
Good morning, Tom. That's a really good question. What we've been seeing is that the United States has been attacking Iran over the past few days consecutively every single night. The latest round of strikes happened in the early hours of this morning, or was finalized in the early hours of this morning here in the Middle East. 7 hours of waves of attacks on some weapon launchers, some military targets. President Trump, as you just heard, saying that next week the U.S. will start hitting bridges, some infrastructure in Iran as well. So threats that, you're right, have been made before. I guess the real answer here is we'll have to wait and see. But when it comes to President Trump making claims and then backtracking on them, we saw a glimpse of that just yesterday. Within about 24 hours, President Trump made this very big claim that the U.S. will start imposing a 20% fee on ships making their way through the Strait of Hormuz. Those are cargo ships that are not Iranian, because when it comes to Iran specifically, the U.S. has reinstated a blockade on Iranian ports and ships. And then he backtracked quite quickly in the aftermath of that, saying that actually he's not going to do that after getting urging from Gulf nations here in the region, telling him to not do it and telling him that they will pledge investments, or should I say further investments in the United States. He said that he actually does not like that fee and he would much rather get investments from the Gulf into the United States. He was calling them massive investments in the United States. Now, Tom, our own sourcing suggests that at least one government in the region has not agreed to actually making those investments. But we see a return to this notion by markets that has been put through at the beginning of the year of the taco trade or President Trump going back on claims that he makes quite quickly. So for the time being, it's still wait and see. We still await to see whether more attacks are going to happen into the end of the week, into the weekend, and whether those attacks on key civilian infrastructure are going to happen in Iran next week. In the meantime, the Strait of Hormuz continues to see traffic at a near standstill. We're seeing a trickle of movement. We're seeing ships either go dark, turning off their transponders to be able to go through, but then a lot of ship owners are deciding to just hold still. But you mentioned oil prices earlier at around $85 on the barrel for Brent crude, a steadying motion from yesterday when we saw it arrive at $87 on the barrel. And this is again as we await and see if those technical negotiations come back to the table. We still have no clarity, by the way, on whether we're going to see a return to the technical talks mediated by the likes of Qatar and Pakistan. Countries in the region continue to be attacked. Kuwait this morning reporting that 4 naval personnel were injured as a result of those Iranian attacks that are happening as a retaliation of those U.S. strikes. Tom.
OK, Bloomberg's Abir Abu Omar in Dubai with the latest out of the region. Abir, thank you. Let's bring in this point Anika Gupta, Macroeconomic Research Director at Wisdom Tree. Anika, good morning. We have the here and now of higher oil prices, above $85 a barrel, 3 straight days of gains for oil. And then we have the backward-looking CPI inflation print out of the US and comments coming through from Kevin Walsh. Are the markets right to once again look through oil up at this point and the potential inflationary impacts of that, Anika?
Yeah, I think it's too early to say right now, Tom. I think the markets are overlooking a very important risk, and that is, yes, the July CPI numbers have delivered this decisive relief. But if we, pass through some of the details of the Walsh's testimony, it does tell us that, he made a very important statement, stating that obviously this today's data has cleared and removed the possibility of a July rate hike. But looking ahead and given the turbulence, given the fact that we still aren't out of the woods when it comes to the US-Iran war, we could see that persistent elevated inflation having a very big impact for the probability of a September rate hike, which, is very much a live meeting at this point in time.
Okay, so you think September is possible? You think the Fed could go once this year? And if that is the case, Anika, how do you think the equity markets respond to that?
Yeah, so for now, as you mentioned, the equity markets are very narrow-sighted. They're just focused on the fact that we've got the July rate hike off the table, and in response, we've had this AI, we've had this rotation back into AI, back into growth-oriented names. But the reality is, if this war ends up being a little bit more protracted in nature, then more of the defensive segments of the market, such as value and more high dividend segments of the market, are likely to gain a bit more dominance within equities.
On the AI story, we have the strength coming through with it from ASML, so an upgrade there from that company, and we'll see to what extent investors welcome that news. But we have these dynamics that I wonder if they're causing you any concerns in terms of the linkages between the Nasdaq right now and the KOSPI because of the role of SK Hynix. Are there some structural market tensions there? Does that dynamic, does the leverage story, the ETF story, and the greater interlinkages between those two markets cause any concern for you, Anika?
Absolutely. We are seeing the structural nature of these markets, especially with the leveraged ETFs having to take into account so much of churn when we are having these very strong moves within the KOSPI index, have ramifications globally, because it does bring into play a more negative sentiment echoing from the Asian markets, and then that trickles down into global equity markets as well. And it is a bit concerning because the volatility has been very high, and that is clearly translating. Globally, we've seen this change in sentiment within the AI tech space.
Are investors overlooking dividend opportunities, high dividend stocks?
I think for now, yes, because when the global growth outlook tends to be of a moderate to medium term growth, then growth as a factor tends to trade as on a premium. And so what we have seen is this surge of inflows into growth and low duration equities. But the reality is, if we are entering a world of higher geopolitical risks, higher interest rates, and inflation being higher than it was a decade ago, then the factors that history has shown us, the factors that tend to be the best performing would be the dividend and the value oriented sector.
And you're also making the case, as we think about Europe and we think about the continuing tensions between Ukraine and Russia, and in fact daily attacks by both sides, that European defence is still an opportunity because it's been rather unloved in recent months.
Absolutely. We have seen a change in sentiment towards defense as a whole, and European defense stocks have also taken a hit on the downside. But the reality is we're just coming out of a NATO summit, where we had seen some very important deals being signed. Nearly over $50 billion in new defense industry contracts were announced at NATO. We also received the Patriot production license that was granted to Ukraine to create long duration, demand pipeline covering production facilities, supply chain expansion. And we're seeing more integration within the European allies. That all tells us that, we are seeing a translation of these political commitments into being translated into actual order backlogs. And I think the story for 2026 is really to see that transformation from those rising order backlogs into execution on ground.
Anika, thank you very much indeed. We're starting to see that execution then when it comes to those orders for defence. There's making the case as well for high yield stocks, high dividend stocks, and the take there in terms of potential rate hike from the Fed in September. Anika Gupta, Macroeconomic Research Director at Wisdom Tree. Here's what else you need to know this morning. China's economy slowing more than expected last quarter, growing 4.3% from a year ago. That is the weakest growth in more than 3 years and below the country's official target range. The extent of the slowdown will likely dominate the agenda when the ruling Communist Party's decision-making Politburo meets later this month. Payment processing firms Stripe and Advent International have offered to buy PayPal in a deal valuing the company at more than $53 billion. That is according to a report from Reuters. The offer represents a 28% premium on PayPal's closing price on Tuesday. The report says the pair would jointly own PayPal with equal stakes and do not plan to break up the company. And Spain are into their first FIFA World Cup final since winning the tournament in 2010 after a comfortable 2-0 victory over France. A first-half penalty put Spain into the lead before Pedro Porro sealed the win just before the hour mark. It was a disappointing performance from favourites France, whose star attacking lineup managed just 3 shots on target. Spain will now meet either England or Argentina in Sunday's final. Let's check in on the European markets right now. European futures pointing to very modest gains of 0.1%. US futures in a slightly brighter spot. Nasdaq 100 futures pointing to gains of 0.8%. But that's a picture across European markets. FTSE 100 is actually called a little lower right now by 0.3%. Coming up, Fed Chair Kevin Warsh downplaying lower than forecast US inflation. We discuss fixed income with Andrew Bulls from PIMCO, the CIO. That is next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
We are 30 minutes from the start of the opening trade this Wednesday. Futures are looking largely particularly uninteresting at the headline level, just pointing higher by 0.1%. That's despite the fact you've had some solid earnings coming through in Europe out of Richemont and ASML. So we'll look at tech as a sector and see if it gets a lift from that second upgrade for the year from that maker of lithography machines over in the Netherlands. The banking earnings really strong in the US, of course. Yesterday, you have Morgan Stanley on the docket later today. So we'll continue to watch the earnings impact. Again, European futures on the benchmark pointing up by 0.1%. Here in the UK, though, the FTSE 100 is looking to drop 40 points at around 10,490. CAC current as well, down by about 4 points currently for the French futures, probably unlinked from the football result last night. US futures pointing higher on the Nasdaq 100 by 0.8%. Let's check in on sovereign debt bonds. A little bit more action yesterday. Today, a little bit more calm. You had the inflation data out of the US, the CPI print coming in a little bit more benign, a little softer than expected, at least on the month-on-month basis. The German 10-year is currently yielding 3.12, yields up just 1 basis point. So marginal selling coming through for the sovereign debt of Europe right now, but nothing too extreme. Treasuries are largely unchanged, and you're seeing BTP's yields up just 1 basis point over in Italy, just at 3.89. Of course, gilts opening at 8 a.m. UK time. We've been hearing from Federal Reserve Chair, of course, Kevin Warsh, downplaying the cooler than expected CPI data. Warsh spoke on the US inflation print at his first congressional hearing, where he said he remained committed to the Fed targets.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability. Productivity growth has been strong, predating gains from AI adoption. America's labor force appears stable. Job creation has, in fact, kept pace with the workforce. We want economic growth to be more broad-based. This committee had long committed to a 2% inflation target. That is our resolution. That's what I'm here to say and double down on.
So, committed to that 2% target, prepared to double down on that 2% target. Andrew Bulls, Global Fixed Income CIO at PIMCO, joins us for a view on these fixed income markets in light of what we've been hearing from the Fed Chair and other dynamics, of course, macroeconomic events, inflation, oil prices higher. Andrew, thank you for your time. Let's start on Kevin Warsh then. Do you and the team at PIMCO have a clear steer on which Warsh and which Kevin has turned up? Is this commitment to the 2% target suggesting that he is open to hikes at some point this year?
I think you have a very clear message on commitment to the inflation target. It's what we would have expected given Kevin Warsh's history, because, of course, he served as a governor at the Federal Reserve. And I thought that was the main takeaway yesterday. The latest inflation print was certainly a good one. You wouldn't expect him to overreact to one piece of data, but that was certainly favourable. I think that he is being pretty deliberate in not providing a lot of guidance. We know that. This means, some more uncertainty. We may have a little bit more volatility at the front end of curves. I think that's fine. But overall, I think, in the baseline, the Federal Reserve is probably on hold this year. But clearly, and you see this from the rest of the committee, not just from Warsh, if they feel they need to act, they will. OK, you think they are on hold this year? Expectations for a July hike have been phased and faded by the markets. September is still very much live. You don't think they move this year, despite the strength that we're seeing in the US economy, and an assumption that maybe that inflation story reverses?
in July?
So I think our baseline would be they're probably on hold.
Yeah.
Policy rates compared with conventional measures of neutral, a little bit restrictive. So they, by not cutting rates this year as the market had previously been expecting, you get a tightening overall in terms of the monetary policy stance. But I think it's pretty open, data dependent, and compared with the past, we'll get less forward guidance from Walsh. So, wouldn't expect them to go in July, but I'm sure September will be in focus.
Does that move away from forward guidance make your job harder or easier?
I think it's just like the weather. There's no point complaining about it. Just adapt. And so, from my point of view, not providing a lot of forward guidance is perfectly sensible. Just look at events in the last week or two. Why be providing a lot of forward guidance in a very uncertain environment? Let the market react to the data rather than dots or commentary. So I think that is fine. You may have a little bit more volatility in the front end of the curve. I don't think that's a big problem. Now let's see if they'll stick to it over time. But from my point of view, being clear in terms of the reaction function, but letting markets react to the data is a very sensible thing to do.
Given the volatility you expect to see at the front end, do you want to steer away from the front end? Where are you seeing opportunities across the curve when it comes to US Treasuries?
I think when you look at US Treasuries, I mean, to keep it simple, there's an awful lot of uncertainty. There's Fed meetings, there's wars in Iran, there's data, et cetera, but when you step back, the level of yields looks pretty attractive. I think the 5 to 10 year part of the curve looks fine, and yield as an indication of return is a pretty good guide over time. So as a trade, there's lots to talk about in the short term, but just as an investment matter, the level of nominal yields, real yields, is very attractive, I'd say, across the curve. And 5 to 10 year part of the curve looks pretty good. Do you think if we get a step up in the conflict between Iran and the US, do you think we start to get a 10-year closing in on 5%? Is 5%? We've been in a range, kind of 475 is at the top of the range for the last couple of years. For now, that seems pretty reasonable to me. So we're at the higher end of that range. It's perfectly possible. Uncertainty in terms of the Iran outlook. The markets, in the first instance, focus on the inflationary impact, not least because we just went through 2022. But in the tail cases where this is a more significant shock, oil prices above the current levels over time, then markets should price the growth impacts, not just the inflationary impacts. So you could certainly move higher in terms of the yield. We've tended to think 475 as the top of the range has, withstood the last couple of years. So for now, that seems pretty reasonable. OK. Switching focus to the UK, we're going to have a change of government come Monday of next week. Is the gilt market more sensitive to the energy shock or to political uncertainty? Where do things stand? What is priced in right now? Well, I'd say that in terms of recent price action, the gilt market's more sensitive to the energy price shocks, and we've seen the moves in the last week. When you look at the shape of the curve, there's some risk premium for political risk, but not a great deal. If you look at the shape of 10s versus 30s in terms of the yield curve. From our point of view, we think the Bank of England in the baseline is not going to hike monetary policy, as we discussed with the Fed, by maintaining rates above neutral. Conventional estimates of neutral, they're maintaining a restrictive stance. And so I think there's risk premium to earn in the front end of the curve. In terms of the political risk, it's there. We're going to get more information in the next weeks. Would you sell gilts if they appoint Ed Miliband as Chancellor? No, I mean I think Ed Miliband. So I think Ed Miliband is less popular. You see the kind of the polls of the city. I think Ed Miliband is less popular with financial markets, maybe owing to his time as Energy Secretary. Against that, Ed Miliband knows the Treasury and economic policy making better than any of the other candidates. And so there's a number of things you would look for in a chancellor. There would be economic policy competence, knowledge of the institution, the ability to lead the Treasury, and then the market perception. And two of those three, I would think he scores quite strongly. So let's see. Certainly briefing this week, it's not going to be him.
OK. Away from the UK, you're making the case that investors should be exposed not just to DM fixed income, but emerging market fixed income as well. What is underscoring that view, underpinning that view?
Well, I think, so if you just start with global, it makes sense to have a global exposure, not just a single country exposure. So we just talked about idiosyncratic risk in the UK. We talked about the US. Across markets, there's always the domestic drivers. A diversified approach makes sense at the global level, and you can see over time your return per unit of volatility is better in global strategies compared with single country strategies, and the UK in recent years would be a great example of that. And then when you expand to high quality emerging markets, again, you get the benefits of global diversification. And you get the opportunity to earn attractive yields on the local currency side. On the hard currency side, you have a number of emerging markets where inflation, the picture is coming down. You have a number of emerging markets where levels of real yields are high. You've had basically fairly good economic management in a number of countries.
Is there a country that stands out to you right now as a screaming opportunity?
I think we have South Africa, we have Peru on the local rate side. I think the Middle East, Eastern Europe on the external debt side. FX, have a broad, diversified approach. We run currency strategies as well. I think it complements the G10 exposure. Again, the return per unit to vol over time looks attractive, but you want to have an active approach. You want to be very careful where you are investing across countries and do it based upon the fundamentals.
OK, really interesting. Thank you for coming in and joining us on set, of course, with those insights across the global fixed income markets. Andrew Bulls, Global Fixed Income CIO at PIMCO. Now, Wall Street's banking heavyweights kicked off earnings season by posting record quarterly profits amid an AI-fueled frenzy and, of course, geopolitical uncertainty. The industry had a particularly strong showing in equity trading. At Goldman Sachs, traders broke their own Wall Street stock trading records. CEO David Solomon pointed to artificial intelligence as a key driver of future growth.
The build-out of AI infrastructure remains in its early stages, and we believe this multi-year investment cycle will continue to drive elevated levels of strategic activity, financing, and capital formation across markets. The more expansive and complex this opportunity becomes, the more it plays to our firm's strength.
OK, we're going to break down those numbers later in the show and look ahead to Morgan Stanley results today. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market. Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Looking forward, we know that things rarely move in a straight line. While we continue to see a largely resilient economic backdrop in the U.S., risks can emerge quickly and drive periods of disruption and volatility across markets. Keen focus on risk management remains paramount as we support clients across a range of market conditions. But it's also clear that we are seeing broad-based momentum across the franchise and a very strong environment for client activity.
I can't tell you that it's impossible that we will exceed the 11%. We're just not going to box ourselves into that, given that we see opportunity to take actions on the offense, which are accretive to shareholders and support our path to our medium-term targets.
I just think we're in a very healthy, active, exuberant market with very high prices and very high volumes, and we benefit from that. We just don't know how long it will continue. Could it get a lot better than this? It can get better, but how much better, I don't know.
The chiefs of some of the biggest US banks on record second quarter results from their stock trading divisions. We also heard from the CFO of Wells Fargo. Take a listen to what he had to say about the firm's growth plans and deal activity.
We're mostly focused, Katie, on organic growth. I think the opportunity we have across each one of the businesses is just, big, to grow organically. And that's what you've seen us really do now the last number of quarters. And I think, when you think about, opportunities for M&A, there could be some, product capabilities or other, payments related stuff that could be interesting. But it would be very much just adding capabilities to what we do. Our main focus is really growing sort of organically across each of the businesses.
Understood there with the focus on organic growth. But I do want to talk a little bit about the pipeline, because you did say when it comes to the M&A pipeline for Wells Fargo, it looks robust here. And I'd love to dig into that a little bit more. Are there any industries which particularly stand out to Wells Fargo at this moment, or that you're, pursuing more aggressively than others?
Well, across the investment banking space, we've been adding, people in equity and debt capital markets, our M&A practice, and all the coverage groups, just sector by sector over the last, few years. And the pipelines are quite healthy, now, and they've been that way for a while across really all the product set there, including M&A. And you're certainly seeing, across a number of different industries, sort of, deals that may not have been, totally possible, a couple of years ago. And so I think that idea of pursuing those strategic goals across really, in a pretty broad way is definitely alive. And the conversations the team's having, it really spans everything from healthcare to tech to media to, a whole different, all industrial sectors as well. And so I think you're seeing it in a pretty broad-based way. Now, we'll have to see what actually happens in terms of deals getting announced and done, but I think the activity level is quite high, and I think people see this as an opportunity to think broadly about their strategic goals, and M&A is definitely part of it.
Okay, Wells Fargo CFO Mike Santomassimo speaking to our team in the US. Let's turn now to today's markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cudmore joining us on set this morning. Mark, let's start with the earnings story then. We've had earnings as well in Europe out of ASML and Richemont, but the bank story is telling us a lot. It tells us about geopolitics, it tells us about the capital markets and the opening there of things like IPOs and the underwriting, and it tells us just about the broader macroeconomic sentiment as well in the US. What stood out to you? Does this set us up for a solid earnings season? What stands out from these numbers?
So obviously very strong earnings, and we're expecting this to be a very positive earnings session overall. I think up until quite recently, expectations were kind of going a little bit more subdued, and therefore they're easy to beat. But I think their earnings are now likely to be very strong. The AI capex bubble is continuing. We knew financials will always be strong, leading it. I think what's interesting is that 10 years ago, you would have said financials were kind of the leading edge of giving us the direction. But I don't think that's the case anymore. So are you saying, is this setting us up? I think we are going to have a strong earnings season, but I don't think it's because financials are providing the guiding light. I think it's all about AI still. And I think that this earnings season will be positive until or unless an hyperscaler says they're cutting their capex plans. And if that happens, that's a complete game changer, like just massive game changer. You do not fight that signal. But I don't think that's going to happen this earnings season. I think that we're probably still, a couple of quarters away. But however, every single hyperscaler earnings call, I will be listening very attentively. And if they ever say we're actually going to significantly scale back on our capex plans, that's the AI trade over.
Okay, and that's the timeline. And certainly ASML's numbers suggesting that we're not there yet, to your point. You're seeing not herd in the markets, herding in AI trades, but not just in equities. You're seeing also in FX and bonds as well.
Yeah, I don't know whether it's because, I don't know why this seems to be more extreme than before, but it was really notable what happened in rates. So last Thursday, there was about 6 basis points priced in for July. By the time we got to the CPI meeting, it was about 50% priced. And that was an amazing move between Friday and Monday. And everyone I spoke to over the last couple of days in the hedge fund community was paid rates going into CPI. Warsh obviously regrets it a bit now. They know not everyone was doing July, but they're kind of paying at the front end. And what was interesting is basically all of them are saying, look, the price action says someone got the nod that Warsh was going to be hawkish or was looking to hike rates. And so everyone was kind of hopping on the same trade. But no one seemed to have the source information of why this was the case. But I think we're really seeing extreme herding in all markets at the moment.
Okay, extreme herding in all markets. Does the inflation story leave you more or less concerned about that dynamic? Or is it very backward-looking, given what we're seeing right now, today, in the Strait?
Yeah, I think exactly. I think what's the development over the Strait over the last week has kind of changed the game. I think we talked about this a bit yesterday, about how the tit-for-tat is now seen as adding a structural premium to oil prices. And so even though people have realised from the Strait of Hormuz it wasn't as terrible as we all worried about, and that there is a massive amount of fossil fuels in the world, I think that the supply of them is going to continue to be disrupted and be more expensive than hoped. We've also got what's happening in Russia-Ukraine as well. We're kind of focusing on the Strait, but the Russia-Ukraine thing is almost as problematic. So I think higher oil prices means, yesterday's CPI is too backward-looking and it's old news. It's not solved the inflation problem.
And we've got producer prices later today as well. We'll see if that adds further detail. Mark Cudmore, thank you very much indeed. Bloomberg Markets Live Executive Editor, of course. Let's get your stocks to watch this Wednesday and bring in Chloe Melly, who is looking at ASML. Chloe.
Good morning, Tom. Indeed, ASML is going to be the big story of the day after the company upgraded its sales guidance for the second time this year, thanks, of course, to this AI boom, which is boosting demand for chip-making equipment. This could see this rally over the last few years get extended this morning for ASML. And not only that, but ASML has also said that Intel had started using one of its most advanced machines, and Intel has called this a milestone in saying that this shows that this machine can be integrated into this semiconductor manufacturing manufacturing at scale. So that's also another win for ASML to keep in mind. Moving on to Swedish banks, and we've got two different stories this morning. We've got SEBI actually beating their interest income expectations thanks to strong loan growth, while Handelsbanken missed net interest income expectations because of high funding costs. And of course, the reduction in borrowing costs in Sweden is affecting all of the Swedish banks, but it seems in different ways, and there's different levels of resilience there. So we'll be watching out for that as well. And finally, in luxury, Richemont has had a great latest quarter with these sales coming in way above expectations, and that is thanks in particular to wealthy Americans buying a lot of Cartier bracelets and rings. We've seen Richemont outperform the broader luxury index by quite a lot because the jewelry tends to be a bit more resilient to downturns than things like handbags and clothes, and so we could see this outperformance get even widened this morning on the back of these very strong results from Richemont.
Yeah, it also tells you something about the K-shaped economy in the US, doesn't it? With Pepsi warning about the consumer, but Richemont powering ahead with those US sales. Chloe Melee on the stocks to watch. Thank you. We are looking at European futures pointing higher by about 0.1%. The AEX over in Netherlands is the standout right now, pointing the gains of 0.5%. And of course, they can thank ASML for that. But again, across the benchmark, gains cool higher by 0.1%. Here in the UK, FTSE 100, though, pointing lower by 45 points. The opening trade starts in the next couple of minutes. This is Bloomberg.
Up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
A few minutes to go until the opening trade. Let's check in Before we get the pricing today on what happened yesterday, what transpired on the S&P 500, which ended with a modest gain of 0.4%. The sentiment did return more positive yesterday. The yellow line indicating where the Stock 600 closed, and you saw gains of just 0.2% for European stocks by the end of the session yesterday. Then the S&P, of course, took over. The Nasdaq 100 had a decent session as well, gains of 1.1%. And what we saw in Europe was basic resources and energy at the top of the list across your sectors, with media and travel leading to the downside. But again, across the benchmark, gains of 0.2%. Today, futures looking to build on that, very modest. The inflation story is looking more benign now. The US, we've been hearing from Kevin Walsh, still sticking to that 2% target. The earnings story and that strength has come through with the likes of Richemont and ASML. We'll dig into the details shortly. Futures pointing up by 0.1%. Then FTSE 100, though, lagging, pointing low by 49 points. But it's the AEX in focus with those earnings from ASML, pointing higher by 0.5%. Talking of which, let's check in on the stocks to watch. ASML then, with a second upgrade for its full year sales coming through, and pointing to that demand picture for its lithography machines as its customers continue to build out to meet that demand picture. So capacity is being expanded at ASML, and it's a solid upgrade to the outlook for that company. So watch ASML and the AEX called higher. Richemont, stellar set of earnings from this jewelry company. Cartier sales very strong in the US. Sales numbers coming in almost double the estimates. And bank stocks after a very solid set of numbers from US banks. We're watching banks as well. Morgan Stanley's up on the docket later today. We're counting down now to the open, 3 seconds away, with European futures pointing higher by 0.2%. Worth noting, of course, oil is up for a third straight day. You've got Brent at $85 a barrel, up 1.2%. So the energy story, the inflation story remains, of course, in the background at the very least. President Trump suggesting that he could ramp up attacks on Iran, of course, next week. We had another set of strikes, 7 hours of strikes overnight last night. So there you have it. Stock 600 right now pointing low by 0.1%, but only the FTSE 100 currently giving us a print down 0.5%, in line with what the future story was telling us. The CAC growing over in France currently largely unchanged. We're waiting for that to reflect a clearer picture on the pricing. And it's the AEX, of course. We're counting down to that, given the strength from ASML. It's worth noting as well that GDP out of China very weak, and that of course is going to have a read across, particularly to those European corporates that sell into the Chinese economy. Just a reminder of the continued weakness there. The CAC currently up 0.1%. The FTSE 100 is the laggard at the moment, down 0.5%. The IBEX in Spain down 0.7%, despite the Spanish footballing victory, of course, yesterday, not reflecting in the equity markets. Across your sectors, it's consumer that is currently at the top of the list, and of course the luxury story, and Richemont will be part of that story, up 1.5%. Energy also gaining 0.2%. Just 2 sectors in positive territory so far. Every other sector in negative territory. Media is under pressure again, down 0.7%. Basic resources, which has shown a bit of strength yesterday, is down 0.6%. Tech is currently flat as a sector, but we'll see if that adjusts around the ASML story. ASML is halted, by the way, worth noting. ASML shares are halted after they raised their full year guidance. So the moment we get a pricing on ASML, we will, of course, bring that to you. Let's check in on the individual movers as well. This is the picture as we kind of go a little bit more granular. So on the luxury space, luxury, which has been under pressure as a result of the geopolitics and high oil prices, Hermes up 3.3%. You're seeing Hermes up 3.3%. You're seeing LVMH gaining as well. This is all thanks to very, very strong numbers coming through from Richemont. And it's really the US consumer at the high end that is playing its part. So an expectation that other parts of this luxury space will benefit from that spending strength stateside. Process in the tech space also up 2%. Novo Nordisk posting gains of 0.6%. On the downside, software, SAP weaker by 2%. Rio in the mining space softer by 1.6%. BASF in the chemical space currently down 1.5%. And Airbus and British American Tobacco also slightly weaker. Let's zoom out and bring in Madison Fuller right now, global investment strategist over at JP Morgan Private Bank. Madison, always great to get your insights on these markets. Maybe if we take a step back and think about the earnings that have come through so far, stateside and in Europe. And of course, we're only in the early stages of the earnings story. What are the signals are you getting? What are you zooming in on? Where do you think things stand so far? What stands out to you from the earnings story?
Sure. So I think what the market's really trying to discern is whether or not it's priced to perfection. And so I think that there's been an exceptional amount of earnings strength. And I think now, the forward-looking guidance will be as important as the prints themselves. So that's, I think, predominantly what we are focused on. But I think we would also push back on some of the, wider spread thoughts that concentration and broadness can't coexist when it comes to earnings strength. I don't think the two things are mutually exclusive. I do think that AI and tech, broadly speaking, is leading a lot of the strength, is doing more of the heavy lifting. Tech alone is supposed to grow earnings 60% year over year this quarter. But at the same time, we are seeing more sectors participate within that, with 10 of 11 S&P 500 sectors expected to produce profit growth this quarter.
OK, that's interesting in terms of the broadening when it comes to the earnings story. Worth noting that ASML is coming through huge gains in the context of a company, of course, that has this significant weighting, the most valuable stock, of course, in Europe, and it's jumping 7.7% right now. Almost 8% is the jump for ASML. You do not see moves of this size and scale for this company very often. So we'll get the historical context for that move, but that is a really significant jump higher for ASML on the back of this upgrade to its full year outlook. And so investors are certainly cheering that, which takes me to a question to you, Madison, about where we stand in this AI trade and the kind of numbers we're getting from companies like ASML, confirming that the demand story is there. How are you thinking about how traders, investors should be getting exposure more broadly to the AI story at this point?
Yeah, so I think that the market's really focused on not just excitement around the future potential of AI, but are we really starting to see the execution of that start to come through? So I think there's a really profound focus on return on investment, on what does that CapEx story look like moving forward? Can that demand be sustained to fuel that spending? And then at the same time, what does that then flow through into corporate profit margins? And how are they facilitating all of that spending? And so I think all of those are dynamics that investors are watching, and it's not just a rising tide lifting all boats, which is certainly, I think, evident in the fragmentation that we've seen within the AI trade itself. And so I think that AI is not just a one sector story. It's very much one that we think that needs to be invested across the entirety of the AI value chain. And there we're really focused on assets that I think are, more capital intensive, harder to replace. So there's a degree of, I think, staying power and earnings durability to them. So that spans everything from semiconductors within the hardware space towards infrastructure and power. So you can think of even utilities, you can think of industrials. And so I think that, it's not just a one sector story when it comes to playing AI.
The valuations in those companies and providers of that infrastructure on energy, the utility story, the connectors, the fibers, everything that goes into data centers and supporting the infrastructure. How comfortable are you with valuations in that space? The door is still open for investors to get exposure. The valuations are not looking to stretch within that part of the AI story for you. Is that how you're thinking about this?
Yes, and I think for a few different reasons. Yes, you've certainly seen a lot of these names participate very strongly within, the AI, tech rally. But I think at the same time, and for many, you've actually seen valuations cool while earnings have actually grown stronger. So that rally has actually been more fundamentally driven rather than, valuation expansion driven. And then the last thing I would say is that when we think about valuations, it's not just on a 1 year forward earnings expectations basis, but what do earnings look like, 2, 3, 5 years down the line? And do we think that's, demand has staying power? And I think that we do believe that's the case.
Do you think executives, and maybe we'll put this question to them when we speak to them on the back of these earnings, do you think they'll come under more pressure to explain and give more colour and detail about the cost of tokens versus the ROI? How much patience do investors have? And do they need to be clearer on that link between the spend on AI solutions and the ROI that they are achieving or not achieving?
I think the further along we get in terms of the AI story and how that, continues to proliferate, not just through the market, but through the economy, I think transparency that investors will ask for in terms of, what does that return on investment look like is something that's going to persist, and I think is only going to continue to drive how investors, determine, where to place their bets when it comes to allocating to specific stocks, which I think is why, again, you can be looking at the Magnificent Seven, you can be looking at, a broader array of AI-related stocks, and you are not seeing uniform trading across the board within this theme. It's very fragmented.
I want to go back to your original point near the top of the segment where you talked about the broadening in terms of the earnings story. What assumptions then are you making about rates? What assumptions are you making about where the Fed goes as you think about that broadening story?
So I think what underlies a lot of the broadening and the strength in the fundamental story is also this, continued solid state that we're seeing from the U.S. economy, where you are, I think, seeing a recovery within the jobs market. You're seeing yesterday, for instance, this inflation deceleration. Of course, I think there's going to be more volatility around inflation, and you probably settle at a higher floor than you have, in past cycles. But I do think our call has been for, I think, far more stability within future central bank policy expectations than perhaps with the market's pricing. I think it's gone from being really overly dovish at the start of the year to almost a rubber band snap towards being overly hawkish throughout the course of the geopolitical conflict. And we, I think, have stayed a little bit more in the middle, where we think the Fed is likely to remain on hold this year. But I think certainly as we watch the data, it's the probability is more weighted towards a potential hike. But even then, I wouldn't want to lose the plot when it comes to central banks. I think debating one hike, debating two hikes, it's very different than a sustained hiking cycle like we saw in 2022. So I think that's fundamentally different, and we shouldn't lose sight of that as investors.
Do you still want to be overweighted to the US versus Europe?
I think that we continue to see more of the growth and upside potential within U.S. markets over the course of the next year. Our total return expectations signify close to 10% upside for the S&P 500, more mid-single digits if you're to look at European large cap. But again, for us, it very much comes down to what are the underlying stories within each of these markets, and we absolutely do see opportunities within Europe. We can talk about banks alongside U.S. banks as well, but banks in Europe I think are a really interesting focus given the improvement we've seen from a fundamental perspective, but also the shareholder return that I think from a dividend perspective and also buyback perspective, which is I think important.
So that's interesting, because we've had someone else on the show this week also making the case for European banks, despite this weak kind of macroeconomic backdrop for Europe, particularly versus the US. But there is a case there to get further exposure to European banks. Some of those the positive catalysts, you would argue, are not yet priced in.
I think we continue to see more upside potential, especially when we're looking at, what that earnings staying power could be. And when we're also looking, I think, at some of the underlying drivers in terms of, loan growth, credit quality. And then I think, on top of that, of course, you are talking about a higher for longer rate environment, even if it is a hold or even if it is one hike and not a sustained cycle. Again, that higher for longer environment, I think, is a positive one for banks. And within the European story, I would also add, of course, this focus on security, and I'd also, highlight again technology within Europe as well.
What would you avoid right now? Which sectors, whether it's Europe or the US, is there a sector that stands out to you that's either looking too richly priced or fundamentals are looking fragile? Is there anything that you would steer clear of?
I think that, again, it comes down to the individual, company stories, but there are areas of the market that we see, less promising opportunity. For instance, staples is one of those when we're in more of a, volatile inflation environment, and, the read through into what that means for raw materials and what that might mean for consumer staples and durable goods. That's probably one area that we would highlight as being a little bit more, hesitant on.
How do you think about the UK right now, UK stocks? I mean, there's the FTSE 100 or the more domestic stocks. Is there a role to play? Is there once we get more political certainty after Monday, do you re-look at allocations around the UK, or is the growth story just not conducive to wanting to have exposure?
So I think the market's not the economy for any of the markets that we're discussing, as you know, and so certainly you might see the UK market trade in a way that might feel counterintuitive to what the economy is also signifying. But I think given the degree of uncertainty that we continue to face, we would take a very, I think, selective approach to investing within the UK market.
Okay, very interesting. Madison, thank you as ever for your time, for your insights. Madison Fuller, Global Investment Strategist at JP Morgan. private bank. Let's check in on the core 6 right now, and ASML is going to be the standout as we bring up the chart for you. There you go, the pop of 5.5%. You had seen gains of 7%, which had been, I believe, the strongest gain off an earnings picture for ASML since January of 2024. The gain's now 5.4%. So still decent for ASML. On the downside, you're seeing pressure on Rheinmetall, speaking of the defence space, down 3% right now. Rheinmetall taking a knock then. Nestle also a bit weaker by 1.2%. Schneider Electric just down by 0.3%. LVMH in the luxury space, that is the other upside story coming through on the back of decent numbers, very strong numbers for Richemont. So LVMH is up 10 points, up 2%. Let's get more in terms of some of the individual stocks on the move this Wednesday and bring in Chloe Mele. Chloe.
Good morning, Tom. Indeed, you were just talking about luxury, and we are seeing green across the screen for that sector this morning after Richemont came out with very strong sales numbers that were driven in particular by strong demand in the US for Cartier jewelry. And so this is the first big luxury company to report this season. And as we can see, this is injecting some optimism into that sector and driving up the rest of that industry this morning, with LVMH, Hermes and Kering also in the green. We are seeing a very similar story for ASML, which is also driving up the rest of that sector, with the exception of ST Micro. So ASML came out with an upgrade on sales guidance and essentially the fact that this AI boom is really boosting demand for chip making equipment. And so we are seeing that read across in ASM and B Semiconductor this morning. Moving on to the banking sector, and specifically in Sweden, well, we have two different stories there. We have SEBI beating in their interest income and therefore seeing that boost in the shares, and Handelsbanken missing their interest income estimates and therefore seeing that bit of a drop in the shares. It seems that those two companies, those two banks, have reacted very differently to this change in the interest rate environment in Sweden and have different levels of resilience to that. Moving on to the house building sector over here in the UK, and Barratt Redrow is up quite strongly this morning, more than 4% after announcing a buyback and saying as well that profit will come in line with expectations. This was seen as quite reassuring given the very worrying updates that we've heard from different house builders over the last few weeks. It's worth noting that those rising building costs and that lower demand are still challenges for that sector. And finally, let's end on Evotec, which is the pharmaceutical company that yesterday saw a huge drop in the shares after cutting its full-year sales guidance. And today it got downgraded by TD Cowen analysts. And so we're seeing further weakness in those shares this morning, down more than 6% for the pharmaceutical company.
Chloe Mele, thank you very much indeed with some of the stocks on the move this Wednesday. Coming up, more on ASML as the firm boosts its full-year outlook, riding the global AI investment wave. We have the details and a view on what could be next for this company. That's coming up. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Welcome back to the opening trade. We are 18, almost 19 minutes into today's session. Across the European benchmark, you are seeing now modest losses of 0.1%. Here in the UK, the FTSE 100 is down 60 points, as you can see. The CAC 40 is over in France, currently down 0.2%. The DAX also weaker by almost a full 1 percentage point. This is despite the fact that we have strength coming through for earnings from ASML and in the luxury space as well. And luxury as a sector is one of the best performers, is the top performer right now, up 2%. Tech is also gaining 1.6%. Shares of ASML higher. That is the positive story in the tech space, and higher by 6%. Look at that, after the firm lifted its annual sales forecast for the second time this year and laid out plans to increase production as the surge in AI spending drives demand for the Dutch company's chip-making machines. Let's bring in Bloomberg's Amsterdam Bureau Chief, Dasha Afanasieva, now for the details. Dasha, talk us through the earnings then. Where is that demand coming from for ASML?
So for the quarter, ASML beat on both sales and net income, but what we really care about is the forward-looking indicators. And for the full year, you got quite a significant increase in the outlook, as you said, for the second time. Of course, that's driven by AI capex spending. ASML's customers are scrambling to get more capacity, and then therefore, at least for logic and DRAM, their own customers are putting in longer-term agreements. So that's why ASML has given this much more detailed update with greater visibility for 27 and 28.
That's really interesting. Those long-term agreements are starting to benefit ASML, so we get a bit more clarity. What have executives been saying about how the company can ensure that it delivers on this high demand then?
Well, that's right. Sort of the demand has been less of a concern recently, and it's been the question of whether ASML can actually meet that with supply. And I think ASML sought to reassure markets on that today. It's increasing capacity by 30% next year for EUV and investigating whether to do so in 2028 for EUV. And of course, EUV, which is the second most advanced machine that ASML has, drives demand in DUV because each chip is made with both. So they're looking to increase capacity for that by 30% in both years too.
What are the order plans then for, as you talk about EUVs, what do we know about their order plans for their EUVs, whether it's the low or the high NA? Do we have more details on that?
Yeah, we do. So for the EUV, what's underpinning those capacity expansions is that they're already close to receiving all of the EUV orders they need for 2027, and they're increasing they're also getting a large number of orders for 2028 as well. On the high NA, there's a major milestone for ASML in that Intel, one of its biggest clients, has said that it's actually properly using the most advanced high-NA machines, which means that the new Intel chips will actually be using this machine, which is important because there's been question marks over the adoption of this most expensive machine with TSMC for example, saying it costs too much for now.
Yeah, no, that's interesting. What we've been hearing from Intel, because they took I believe the first high NA EUV, but were kind of using it to test, and now they're actually using it for production. So that's an important marker, isn't it, as you say, for ASML. Dasha, thank you very much indeed for that update on of course, a company that is currently Europe's most valuable, with the stock up close to 6%. Dasha Afanasieva with the details there. Let's turn to the luxury space, because Swiss luxury retailer Richemont, their shares are jumping as well, and lifting the broader luxury sector after its first quarter sales expand nearly twice as strongly as expected, supported by robust demand among wealthy Americans. Richemont's jewellery division, which accounts for 3/4 of its business, posted growth of 24% in a sign of resilience against a broader luxury sector slowdown. Is that still what we're seeing? Let's bring in Bloomberg opinion columnist Andrea Felsted. Andrea, what is driving this US demand? The US story is really strong.
It is, and it tends to be correlated with wealth creation and stock market. And as we know, the stock market has been on a tear. When Americans see their stock portfolio go up, they treat themselves to luxury goods, and that's what's happening.
Okay, so it's partly linked to the stock story,
Absolutely.
the equity story.
Absolutely.
Okay,
yes.
That's really interesting. We wrote there in the intro then that this is on the backdrop of a slower picture when it comes to the luxury story. Is that the right way to frame it at this point?
Well, this is undoubtedly good news. US spending is still going strong. There were worries it would slow. China does seem to be recovering, albeit slowly. China is going in the right. So you've got those two engines of growth are going in the right direction. But we shouldn't get too excited. There is limited read across. Jewellery has been a very strong sector. As the price of handbags has gone up, jewellery's looked better value for money. So many customers have switched to jewellery. Richemont has some fantastic brands, namely Cartier. And although it's jewellery that's driving it, Cartier watches is counted in jewellery. So the strong growth in Cartier watches, the Panthère has been a real standout, the Bangle watches, the switch from those big chunky steel sports watches to smaller gold watches. Richemont is at the forefront of that.
So the point you're making is that the gains that we're seeing in the luxury space today, the read across from Richemont maybe isn't justified. This is to some extent an idiosyncratic Richemont story. At least Richemont has a particular story to tell.
Absolutely. I mean, it's no doubt good news. This shows luxury isn't falling off a cliff, but it's perhaps no one else will perhaps be as good as Richemont.
Okay. What else? What other trends are you going to be watching for in the earnings story when these companies report? Is it China? Is it that K-shaped economy in the US? Is it production costs? Is it input costs? Is it metal costs? What else is going to be?
I think one of the other things to watch is we've had this great luxury reset, lots of designers. So we're going to get all their collections sort of came in, probably from the start of this year, the new designers' collections will be coming in. We need to see if they're working. So this is going to be the first sign of whether that great reset is encouraging customers to buy.
How is things like AI changing luxury in terms of how consumers access these products, the marketing for some of these, how designers are thinking about using AI tools? Is that something you hear about? Are these companies starting to think about that?
Yes, I mean AI is starting to change the way we perhaps search for goods. The search is different, so you maybe get different kind of search results. I don't think we're going to buy luxury through a bot. We might buy something, functional, but I think luxury, you still want that personal touch, and you want that, you want that feeling when you buy luxury.
Before you drop thousands of dollars.
Exactly, yeah.
Okay, Bloomberg opinion columnist Andrea Felsted, thank you very much indeed on those Richemont earnings and the read across for the broader luxury sector. Coming up, we're going to move from luxury to what is happening in tech. IBM, very different story when it comes to AI. The wipeout in IBM's shares yesterday after disappointing earnings was quite remarkable. Reigniting concerns about software disruption, of course. IBM has lent into software in recent years. We're going to discuss those concerns for the sector with Andrea Urbach from Cambridge Associates. That view and that context is coming up next. This is Bloomberg.
Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop. I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
This is the opening trade. We're 30 minutes into the Wednesday session. This is the picture. Europe not really benefiting so far across the benchmarks from the gains that we're seeing in terms of the likes of ASML, the luxury space from Richemont as well, with some really solid numbers coming through for both companies. Across the benchmark then, you're down 0.3% after modest gains of 0.2 yesterday. DAX now down more than 1% over in Germany. You're also seeing losses here in the UK. The FTSE 100 back below 10,500, dropping 82 points, down 0.8%. Let's talk about tech away from ASML. ASML showing the strength, the picture around demand. IBM yesterday, wow, what a shocker. The stock's suffering its biggest single-day drop since at least 1968. Even Neil Campling wasn't around in 1968. After its prelim second quarter revenue fell short of Wall Street's expectations. The CEO, I'll give some context there, Arvind Krishna, said IBM was caught off guard as customers shifted spending towards servers, storage, and memory. Let's bring in senior strategist, not that senior, Neil Campling. Neil, explain for us what is going on and going wrong for IBM then.
A bit of context is that where the stock is now trading is only back to where it was in May of this year, before we heard about the US government investing in the company, in the space, in the area it's involved in. Now, I think the big concern from left field in yesterday's update was the fact that they were effectively saying that it's not just like sort of capital being deployed across everything. It's that to invest in the AI infrastructure side, clients were putting other projects and other investments on hold. So the concern is then, is this an IBM thing or is this an industry situation? And that, for the time being, is an unknown. We're going to hear from other mega-cap tech stocks like Microsoft later this month, who will give their first sort of full guidance for their following fiscal year to see, again, whether there is software issues or whether it's just AI investment is coming at the expense of other spending. So I think it's the unexpected nature, and also if you look at the actual letter that was written by the CEO yesterday, there were concerns because we've been talking about sort of software being disrupted?
Yeah.
Does it then impact big IT service companies in terms of future bookings guidance from companies like Accenture, for example? Is this more signs of AI victims, as in companies that are losing out to the capital being deployed in a very sort of unique set of properties?
Yeah,
so it leaves more questions in some respects.
It was quite the mea culpa, wasn't it, from the CEO in terms of how the team had missed the ball. It is a reminder, the wrinkles and maybe distortions that are coming about as a result of this, of the money piling into different parts of the AI space, and then what is then left exposed. IBM have lent into software. How much has that been a challenge for them? Does it bring this? A number of software names were underwater yesterday, or at least under pressure and selling off yesterday. Does it bring that SaaS apocalypse fear back to the forefront?
It will bring that fear back, although, for some context, if you look at the start of this quarter, the start of this month, there's been a massive shift, actually, into software, hugely outperformed. There's a couple of baskets. Software had outperformed chips by more than 20% in the first sort of 10 sessions that we'd had this month. So there's a little bit of a reset there. And if you looked at what happened at the start of the US session yesterday, the software ETFs were down significantly, chips were significantly higher, and that did actually trail off in terms of that disconnect during the session. So it will certainly bring that back to the fear for sure in terms of the SaaS apocalypse, and whether the whole idea that companies like Anthropic, in terms of the key frontier technologies, are able to do what software hasn't been able to do, or taken many years or decades even to perform certain functions. Anthropic has managed to do in mere hours. So those kind of questions will definitely remain.
Now, Neil, in the break, you mentioned to me that you're watching credit, and particularly credit linked to hyperscalers, and a Goldman Sachs index at that. What are you watching on that front?
Yeah, so we're doing some analysis at the moment. There are this particular basket that Goldman's have created is looking at these perceived very high quality AI tech stocks. But in terms of the spreads themselves, they're really kind of giving a sign that the cost of this debt is really blowing out. And it's something that I think you've mentioned on this program a number of times in the past, in Oracle in particular, which doesn't have the balance sheet or the free cash flow that some of the other big tech stocks do have. But now this basket is kind of suggesting that there's some potential stress underneath the hood, perhaps, that's moving in other parts of the market. So we're going to do some more work on this. But it's something that, I'm a markets-focused, equity-focused, so on. Yeah. But I'm also well aware that in terms of the bond markets are kind of really like the big brother to equities in terms of they'll determine the long-term outcomes for these kind of situations. So we need to keep an eye on this for sure.
Neil, thank you very much indeed. Neil Campling, of course, with a view there on what is happening across IBM and the credit story as well when it comes to these big names and some of the hyperscalers, some of the spend around AI. Let's get more analysis now and bring in Andrea Albach, who is Global Head of Private Investments and Partner at Cambridge Associates. Andrea, thanks for coming to the studio from SF, from San Francisco. Yeah. What is your take in what's happening with software and the SaaS apocalypse? Do you have much exposure to these names? Where do things stand?
Well, when you think about it from a private markets perspective, so in the private markets, we're investing in companies that haven't yet gone public, right, or may not have issued debt in a public context. And so within the private markets context, about 37% of all capital is deployed into enterprise software. And Tom, I'm not talking about venture capital, which is below the private equity side. It's within the control investing in the private markets. So enterprise software and investor exposure to enterprise software is very real. And the SaaS apocalypse definitely reverberated around the private markets today.
But was the baby thrown out with the bathwater to some extent?
I would argue yes. If you look at the average, the median enterprise software multiple is now around 3.7 times revenue. I do not believe that every private enterprise software company is worth 3.7 times revenue, nor do I believe that every
sales. We know that everyone wants ASML's machines. They are very, very complicated to make. They are made in a modular fashion. So actually a really important part of the results this morning was ASML saying we are going to be able to make more machines over the next couple of years. So it's about meeting demand, not simply seeing rising demand.
How significant is it that Intel is using some of their most advanced chips?
Yes.
Or chip-making machines.
Exactly. Yes, so that the top of the line, very cutting-edge machines that ASML is producing cost $400 million a piece. So that is very, very expensive for context. It's a lot of money. And Intel announced this morning that they're actually using one of these machines in production. That's positive news because, as I say, the chip makers are ASML's biggest customers. Intel isn't actually the biggest, but it's significant. It's a significant player, clearly. So announcing that these machines are not just about use in research, but about the actual day-to-day production of chips is a very positive sign that there'll be future demand for these very expensive machines. By contrast, ASML's biggest customer hasn't said that. It said these machines are too expensive for us to use right now. So it would be even better news if TSMC sort of said something similar, but it's pretty positive news that Intel is saying this.
So interesting. Shona, thank you so much for joining us. Shona Ghosh there, REMEA tech editor. Now, as the AI trade gathers fresh momentum this morning, my next guest says AI is following the classic position unwind cycle. I'm joined by Mohit Kumar, Chief European Economist and Strategist at Jefferies. Mohit, as always, thank you so much for joining us. I mean, there's many questions on AI. If we start with valuation, I mean, they seem to be more and more supported because we're seeing use case. Is that fair, or do you still have many question marks about the valuations?
The valuation part I'm comfortable with because earnings are still strong, capex is still ongoing. I think the part where we start getting a bit uncomfortable is expectations, because expectations are very high. And that's why, for us, one of the most important things to watch, purely from a market perspective, is looking at positioning. AI trade is a very crowded trade. And that's why I mentioned it's a classic position unwind, because positioning was very heavy in June. And what we have seen in the last few weeks is an unwind of those positioning. So medium term, still positive on AI, still positive on the picks and shovels trade. But we have to bear in mind that expectations are really high.
And so what does that mean in terms of your positioning? What are you buying or selling right now?
So we took a step back from tech. Early June, we took a step back thinking positioning is too heavy. Now, if I look at the positioning, is much cleaner today. So I think we're getting to the levels where we are ready to go back into the picks and shovels trade. Because medium term, we are still positive.
Mohit, I mean, overall, what's driving equities right now? So I know there's a lot of questions about geopolitics. I mean, oil actually didn't really behave like the majority of investors thought it would, or certainly of analysts. Maybe investors knew something that the others didn't. And then you have, of course, Kevin Warsh, and we're still trying to figure out what happens next with the Fed.
Well, like you said, these are the two things driving. So, well, oil, I would say more it's central banks, whether it be the Fed or BOE or ECB, and AI. But to me, it's central banks and AI which is driving. And when I read Warsh, everyone tries to say, is he hawkish, is he dovish? I actually have a slightly different take. I think Warsh is positioning himself into the credibility camp. He wants to say that he's credible. Inflation is not something that the Fed wants to tolerate. But the key word is sustained inflation. And in our view, when we look at medium-term inflation forecast, inflation is still likely to move lower. Of course, it depends on how long oil prices stay at these levels. Do they go higher? So a lot of uncertainty. No. Fully agree. But you look at inflation break-evens, which is the medium-term expectation of inflation, they're very well contained. So as long as medium-term inflation is contained, I don't think the Fed needs to hike rates.
Yeah, I mean, for me, Chair Warsh, and you're really right on the credibility part, but he also had a great reputation, right? He's been Fed governor before during the financial crisis. And for me, what was interesting is when they were talking about the fact that, he didn't need to raise rates, and that was appealing to President Trump, he was looking at it from an AI perspective. When do we have to actually start looking at AI impacting our economies instead of the valuation question?
So when we think about AI, actually, paradoxically, initially AI is inflationary. The first few months, first few quarters.
Because of the spending.
Because of the spending, also commodity prices. Electricity prices, or you look at copper or commodities, they will go up. Medium term, it should be deflationary. So it leads to improved productivity, but lower inflation. But medium term, we are talking of 2 to 3 years. So the question for Chair Walsh or any other central banker is, do we look through that initial impulse of higher inflation and focus on the medium term, or we focus on the near term? I think oil adds a lot of complication to that picture. So end of the day, it's about credibility. The Fed has to respond to whatever data it is. I think Chair Walsh is genuinely one of the best candidates. I don't think he is going to be politically driven, but he has to respond to data. And if medium-term inflation is anchored, they don't need to hike rates.
Okay, Mo, don't go anywhere because we're going to talk about the Middle East in a second. Mo Kumar, Chief European Economist and Strategist at Jefferies. Now, the U.S. has carried out another round of strikes against Iran after reimposing its naval blockade. Well, President Trump has backed down from his plan to charge a fee on cargo shipments through the Strait of Hormuz, but continues to threaten more military action. Let's bring in Paul Wallace, Managing Editor for the Middle East and Africa. Paul, how significant was the president's climb down on the idea of a Hormuz toll, and what does it reveal about U.S. strategy?
Hi, Francine. It was significant. I think not because people in the world of shipping or here in the Persian Gulf, where I am in Dubai, literally thought that the U.S. was going to charge 20% on all cargo or all ships passing through Hormuz, because this was something that was announced out of the blue by Trump. It's a huge fee. It would have meant roughly $35 million for the biggest oil tankers. I mean, these were fees that were way above what even Iran itself was saying it wanted to charge for ships going through Hormuz. But the fact that Trump reversed or did a U-turn so quickly within 24 hours, I think it underscores just how frustrated he is with Iran right now over Hormuz, and how he's struggling to come up with a strategy to get the waterway open and then to eventually end this conflict once and for all. So it shows once again how the US president is sort of vacillating between different tactics and different moves because of the fact that he's stuck in a bind over Hormuz and, by extension, the war itself.
Paul, what impact are the strikes actually having? Is there any suggestion that it could have more of an impact than before?
This is hard to tell. I mean, in markets, we've obviously seen oil shoot back up to about $85 a barrel. You know, it's up 13% this week. Still way below its highs from late April, but, you know, still up significantly over the past week. In terms of the damage it's doing to Iran, that's difficult to tell. The U.S. says it's striking a lot of things like radar sites and missile and drone sites, but Iran is not backing down, and it itself is, if anything, escalating its counter-strikes on the likes of Bahrain and Kuwait. Kuwait saw heavy attacks from Iran in the early hours of this morning. So at the moment, both sides are being very stubborn. They're not bending. However, we have been here many times before in this war that's, you know, now more than 4 months old, almost 5 months old. And it is at times like this when the US and Iran have actually got back to the negotiation table and worked out some kind of temporary easing of tensions. And it's something we could possibly see again in the coming week or so. Trump, it's just worth noting, he says he's going to escalate US strikes on Iran until the Islamic Republic comes back to the negotiating table.
Paul, thank you so much. Paul Wallace, our Middle East and Africa Managing Editor. So let's get back to Mohit Kumar from Jefferies. Mohit, I mean, the big problem I see is that it changes all the time because it's unclear actually what the real U.S. strategy is here. So how much does it complicate things for investors?
Well, I think no one really knows what the U.S. strategy is. And I think what Paul was mentioning, and I fully agree, there is midterms coming. Trump cannot afford oil prices significantly higher because Senate, he could lose the Senate. So he is worried about oil prices. He wants to get out, but the question is who controls the strait? Iran wants to have control over the strait, and for US, it's totally unacceptable. So I think what could happen, and this is one of the theories I have, we could get some form of fudge in the near term. So we get a deal, make sure oil prices are $80 or below $80. But I do believe that Middle East is fundamentally unstable today compared to pre-war. So post-midterms, when Trump doesn't have these concerns, it is possible that we could escalate even further. So I fundamentally think we are in an unstable situation.
And of course, if the price of oil goes higher from here or even stays at these levels, it feels like it's, the UK and the Asian economies that will suffer the most.
Absolutely. So if you look at the 20 million barrels that comes out of the Strait, actually US gets less than 500,000 barrels.
Yeah, they're fine.
They're fine. It's Asia which is the most impacted. And it's not just about oil, it's also about gas. You look at a lot of South Asian economies, they're very dependent on gas. Europe is next, which gets impacted, and of course UK gets impacted as well. So purely from a growth perspective, it's Asia, Europe, UK, which are much more impacted than US.
So what does it mean for investment strategy? Are are there question marks about emerging markets that frankly so far have had a great year? And is that a question for next year or mid-2026?
But emerging markets, there is a divide. So the way we are seeing it is the divide between commodity producers versus commodity importers. So if oil stays at these levels or goes towards 100, it's the commodities importers that get impacted, which basically means if you think about Asia, the South Asia belt is the most impacted. But if you're talking of markets like Korea, Taiwan, or even China, China does get impacted, but there is a big tech sector as well. So the Far East Asia tech continues to do well. Europe gets negative on the growth, which means the consumer sectors get impacted. No. But the tech sector doesn't. Tech sector does not care what the growth is over the next 6 months. So I think it's about winners and losers. And as oil price goes up, I don't think it's fundamentally definitely bad because there is a big AI and tech boom that's going on. So it's about winners and losers and identifying even within the emerging markets.
Mohit, what's your take on the UK? So again, this is a small open economy. We also have a change of prime minister in the next couple of days and on the cusp of the World Cup. No, I don't want to jinx it, but the UK has its own set of problems if you're the Bank of England governor.
Massive. And I think what Bailey has been focusing a lot on is growth. And when we think about oil price impact, there is the growth dynamics and inflation dynamics. A lot of academic papers suggest it's almost equal and opposite. Mm-hmm. Bank of England has a dual mandate. They need to look at growth and inflation. So yes, inflation can be high, but as Governor Bailey has told us, growth picture is not great. Mm-hmm. In that scenario, we think Bank of England just does nothing. They don't hike rates, they don't probably cut rates, but they just stay the course and see how data evolves.
That's so interesting. So you expect also the same from the Fed. For the moment, wait and see. Mohit, thank you so much for joining us. Mohit Kumar, Chief European Economist and Strategist at Jefferies. Coming up, our exclusive interview with the boss of the consulting firm McKinsey on the impact of AI and geopolitics on business. That's coming up next, and this is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, the boss of consulting giant McKinsey says the firm is on the edge of a possible golden age as companies seek help with issues such as artificial intelligence. Well, McKinsey has cut staff from its support teams on the back of the AI wave, but he says they're also hiring more consultants and is set to grow headcount overall. In an exclusive interview, we also asked Bob Sturfnels about the impact of geopolitical stability.
I think there's a potential that this is a golden age for us. A truly golden age. And the reason is the world has some really existential challenges and opportunities facing it. And you've had many people come on and talk about this, but you think about this AI moment, you think about complicated geopolitics, you think about a whole reset in the energy climate nexus, you think about changing demographics. These are all world-class problems to solve, and what we try and do is we try and work with CEOs on their most complicated problems. And at least we see over the next 5 years the complexity of those problems going up, not going down.
No. But so what's the biggest disruptor to any business? AI or geopolitics? Do you have to choose whether you're an ally of the US or China?
AI or it's like trying to pick, well, which kid do you like better? Like, these are two massive. You know, I would honestly, I think they're the twin biggest issues facing us today. And but by the way, I would say challenges, but equally opportunities. And this is one of the things that you know, I always talk to if ever I meet a CEO, I say, okay, draw a line down the center of the page, and let's write challenges and opportunities from each of these topics. And it's easy to talk about the challenges. Will AI disrupt jobs? Yeah. Will it dominate the energy stack? Is it going to take everybody's water? But equally, you know, could it create and unleash a wave of growth that solves many of the other crises that we face?
So how do you use AI within the firm?
You know, it's like you talk to every leader, this is changing so fast. And, you know, what I would say is we're doing two things. One, the first is we're trying to help our clients. This is about half the work that we're doing today with clients around the world. And large enterprises struggling with, how do I really reinvent myself with AI? My costs are going up. You've talked about, you know, token costs going through the roof. We've seen many companies blow their budgets in the first 3 or 4 months of a year. Mass experimentation doesn't necessarily yield enterprise impact. So we're focusing in on how do you really get value from AI with clients? That's a client lens.
And so how do you get value?
You know,
because it's also difficult to integrate, right? It can't be sitting outside if you're looking at AI and tech.
It's hard, right? And there are, I think, a couple principles that are emerging. You know, the first is you got to focus. If you just let 1,000 flowers bloom, you will have waste in an enterprise. And, you know, our work tends to indicate that 4 to 6 end-to-end processes in any organization, and those vary based on the industry, can drive 80% of the value from AI. So first is, are you focused? And I often ask, do you know how to double your market cap through AI? Right? If you can't do the math, good old-fashioned strategy, you're going to be inefficient, part one. Part two is you have to change the organization model. Right. And so my other simple answer to or question to a CEO is, do you know what your org chart looks like in 3 years' time? So if you can't link the value to the org change, you're not going to get the value, right? And then the last part is, how do you bring everybody along? Right? Change is hard. And if you have a large workforce, you need to create the incentives for people to want to drive adoption. You can't force folks. And so those are some of the principles that are, I think, emerging right now.
And so, Bob, what does that mean for McKinsey?
Yeah.
Right,
so,
because you've also announced job cuts, quite significant ones.
Well, you know, it's interesting. People love to latch on to half the headlines.
Not us, sure.
No, of course not. But we're hiring in record numbers, our client-facing consultants. McKinsey has 2 workforces, and the workforce that most of our clients understand are the people who live and breathe with the client, and we're growing that workforce quite aggressively. And we're arming that workforce with agents. So on average right now, every client deployed consultant has about 3 agents. And the joke I was just with some new business analysts, the joke was, if your agents don't work all night, you will.
like that
loved,
tagline.
right? I loved it, right? Because it was a little bit of like, hey, right, you got to step up.
But give me a sense of, so how much of the workforce are you reducing that you can replace by agents, and how many consultants are you hiring? Is it like net?
In total, I think you will see our workforce now start to rise. So we've done, look, like all of our clients, we've really looked for efficiencies in our indirect processes. And there is value in that in AI, and we're trying to liberate the folks who come out of that to then be redeployed to do new things, and also natural attrition. But we've kind of done a lot of that restructuring, and now we're actually focused on how do we grow the consulting base. I think it's an exciting time because, also there are a lot of folks who aren't really hiring a lot of young folks. And so we're like, hey, come, right? This is a great place to be for a couple of years.
And you think face-to-face consultants are AI-proof?
Yeah.
This is what we're all trying to figure out, right?
Well, and this is for all of us. I look at what can the models do and what can the models not do. And, one of the things that starts to really rise is, I think, what's uniquely human in this. And so what we're starting to focus on is, okay, you're freeing up a bunch of time. You'll use that time to spend more of it with the client. What do you do with that time? And what we're finding are a couple things. The models don't set a goal. They don't set an aspiration. It's a uniquely human thing to say, hey, should we go to the moon? Should we go to Mars? And do we both believe in that? And so there's a uniquely human thing of how do we aspire? We're focused on building that skill. The other is judgment, right? The models don't know right and wrong. You have to train them. And so how do you work with a client to say, look, you should be the custodian of judgment in your own company. By the way, you can reference your own values.
Yep. To
have the models reinforce the values of the company. That's a human thing. The humans have to impart what are the values of this institution. And the last one is working with other humans, the human-to-human interaction skills. And so we're focused on a couple of those things with our folks. And I do think those are AI-proof. I think maybe they're even AI-enabled as we think about it.
That was Bob Snurfnells, McKinsey's global managing partner, speaking to me a little bit earlier. Now, Stripe and Advent have offered to buy PayPal at a valuation topping $53 billion. That's according to Reuters. And you can see pre-market PayPal gaining almost 15%. Now, this is a picture for U.S. futures. A lot going on, of course, when it comes to tech. We had that ASML blowout. Now, the stocks rally in tech seems to be continuing. I guess as ASML earnings offered fresh evidence of strong demand for chips that are powering the global artificial intelligence build-out. Now, coming up, Ukraine is expanding its naval attacks against Russia in the Black Sea, including oil and gas tankers. We discuss all of this with Claudia Major from the German Marshall Fund. That's coming up next, and this is Bloomberg. The other thing we're watching out for is, of course, the price of oil. Oil prices rising for a third straight day after the U.S. military also carried out another wave of strikes against dozens of targets near the Strait of Hormuz.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football. And you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacquet here in London, and these are your top stories. The U.S. carries out more military strikes against Iran, but President Trump backs away from his plan to impose a cargo fee in the Strait of Hormuz. ASML tops expectations as Europe's most valuable company rides the wave of booming AI demand. Plus, traders cut bets on rate hikes as U.S. inflation eases, but the Fed Chair Kevin Warsh says inflation is not mission accomplished. Now let's get more on that story now. Kevin Warsh has delivered his first congressional testimony as chairman, warning against complacency on inflation.
Well, it's one data point. The reason I created a task force on data is I don't want to overread or cherry pick data. There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Well, let's bring in Alistair Bull, one of our senior editors. Alistair, what did the data and Chairman Warsh's commentary tell us actually about the outlook for rates in the U.S.?
It tells us that Kevin Warsh is a pretty lucky guy. He couldn't have scripted it better. He had a softer than expected CPI print on his first day in front of Congress. That can be a grueling experience. It turned into a pretty comfortable performance from him. And the downturn, which was was stronger than expected, is sort of hardening views among smart people, including Bloomberg Economics, that inflation peaked in May. And if that's true, if that turns out to be the case, Kevin Warsh, while continuing to talk tough on inflation, can probably just sit on his hands, keep rates on hold, and as inflation gets closer to the Fed's 2% target, the conversation will start to turn to rate cuts next year. But he's not going to let up on the hawkish rhetoric because there's a lot of data to come. We have PPI coming. There's the PC, which is what the Fed actually targets, coming after their next meeting in July. And if it doesn't go in the way he needs it to go, then a rate hike is going to certainly be back in the conversation, Francine.
Alistair, I mean, what are the meanings of these Warsh task forces? And we know at the time that he's planning to change Fed communications. So is this about changing the Fed, or is it just about building his credibility?
No, it's both. I mean, he's come in saying he wants regime change, and he certainly needs to build his credibility as a new Fed chair who's arrived under enormous scrutiny on whether he can hold out against the president who wants lower interest rates and will indeed be independent. But he's not given much away. I mean, he was asked about the task forces. He said that they will report, they will give updates, and he hopes to have some conclusions by the end of this year, but he's not going to prejudge. He's not going to front run. They are in a discovery phase, and he's playing his cards pretty close to his chest. One thing we can say, though, and he was asked about this yesterday by the House Financial Services Committee, is that he's not going to pre-commit to holding a press conference after every FOMC meeting. Francine.
Alistair, thank you so much. Alistair Bull there with the very latest. Of course, on Kevin Warsh. Now, the Bank of England Governor Andrew Bailey has called on the incoming government to prioritise economic growth and maintain fiscal discipline. Also speaking at what's likely to be her last Mansion House address yesterday, the UK Chancellor Rachel Reeves had this warning about the economic outlook.
The resumption of hostilities in the Middle East in the last few days has shown that our economic resilience will continue to be tested. And the market response to those changes shows that there is still work to do to ensure that our economy and our country is protected against a volatile global economic landscape.
Lower productivity growth means lower growth in incomes and lower growth in living standards. It means fewer resources are available for households, businesses and public services. So reversing this trend and continuing to reverse this trend must be a national priority. I strongly agree with the Chancellor on this and on what she has been doing.
Let's get more on all of this with Rosa Prince, Bloomberg opinion columnist, Catherine Griffiths, Bloomberg's city editor, and Philip Aldrich, Bloomberg senior reporter for UK economics. I love it. We have like the city, the politics, and of course the economics. So what did we learn in this Mansion House speech? Catherine, you were also there last night.
Yes. So in many ways, we didn't learn that much new from Rachel Reeves because the Treasury team has briefed out this speech like nobody's business. I think she chose to sort of give really quite a political speech, which was quite unusual in this environment of sort of the city audience. I think people felt it was a weird event because likely Rachel Reeves won't be Chancellor for that many more days. There had been a hope that the Mansion House huge event that it is in the city would be delayed until the new Chancellor, who will probably not be Rachel Reeves, could give a speech and give a real sense of what is to come in the Andy Burnham government. That's what people really want to know. They want to know on the economic front what he and whoever the Chancellor is going to do, and they're not looking forward to a summer of uncertainty.
Yeah, and it's very difficult, or it's proving very difficult to have a name for a Chancellor. So we'll get on to Rose in a second. I mean, we're expecting Andy Burnham to be Prime Minister on Monday, and we're hearing that there's still, advisors are fighting about who to pick for Chancellor.
Yeah, it's hardly the easy run-in that you would want from the new Prime Minister. It's kind of shades of the chaos we've had of the past in this final run-up. You've got Rachel Reeves, who is the Chancellor. You've got Wes Streeting, who clearly wanted to be the Chancellor but has not been given an opportunity. You've got Ed Miliband, who's the front runner, and now suddenly Shabana Mahmood is sort of suddenly the main name in the frame. And there's only a couple of days left. Really, you'd have thought this all has to be sorted out before the weekend. So, when Burnham takes over, he's kind of off to a flying start, so that his administration is clear about what they want to do. So, I'd say this is a little bit disturbing to have this kind of chaos so close for such an important appointment.
So, Rosa, how does it work? I know from, foreigners, especially Americans that watch us, they're always surprised that literally the Prime Minister, goes to see the monarch, the king, and then that's it. They move into number 10, like, there and then. So, Monday, what do we know the series of events? The football may also complicate things if England makes it to the final on Sunday.
Yeah, that's right. So, as you say, Britain does not have a transition period, but there is a little mini one, because on Friday, Andy Burnham will formally become leader of the Labour Party. He is the only candidate. It became something of a coronation. All the other rivals fell away, so we know that's going to happen. And then he'll have the weekend to finalise his plans. Usually, it would be expected that Keir Starmer would resign, say, early on Monday morning. But with the World Cup, England potentially being in that final, if that happens, he will go to New York and then he'll have to hop on a plane and fly back, and then he will probably more likely be handing in his resignation around noon to King Charles, and then Andy Burnham makes his drive to Buckingham Palace we call it kissing hands with the king. These days they don't literally kiss his hand, but they will have a formal handshake, and then he will become Prime Minister. And only then, probably, will we begin to get the names of his cabinet and that all-important Chancellor pick.
Yeah, and that's when the real work starts. I mean, you were saying that the City of London and a lot of, the grandees here, of course, are waiting for Chancellor on economics. Do we know any, of these names, like where they stand on banks, on ring fencing, on taxes for banks?
So we don't know where they stand on those things. But so I suppose what the city's operating on the basis of is Ed Miliband, the current Energy Secretary, is on the left side of the candidates, where Streeting is sort of on the right side of the candidates. Quite a lot of the city obviously like that about Wes Streeting, though they don't like his lack of economics experience. Shabana Mahmood, I think they have really no idea where she might land on these issues. The name in the room last night was Pat McFadden, who is the Work and Pensions Secretary. He has been an MP for a good 2 decades. He has worked in the Treasury. He doesn't want to be Prime Minister. I think they would favour Pat McFadden.
No. I mean, Yvette Cooper also kind of emerged as one of the contenders.
Yeah.
I mean, is it just every name? Are you, Phil, up for Chancellor? Of course you can't, because we'd have to change the Constitution. But are we just going to have a lot of names the next couple of days before they settle on something?
It does seem so. I mean, again, I don't think even sort of senior city figures, I don't think, have an in the way that some of the sort of deeply immersed political people do. But their view, for what it's worth, is that Burnham has still probably not chosen.
Right. And this is, just so that everybody understands, is this because the Labour Party is still so diverse that they're trying to find a candidate that appeases all factions? Or is it just that they don't have a name that would be, the markets would be happy with?
Yeah, I mean, it seems like there has been this infighting within the Labour Party, and again, the difficulty Burnham is having in deciding on who. I mean, if it is the case that there is a difficulty here to decide who's going to be his chancellor, would reflect that, as you said, the different factions in the party. Pat McFadden, months ago, he was the name that was being talked about, and he was talking to his team was talking to all the other potential leadership contenders, because they were expecting to be at least a front runner. So his name has been sort of absent quite a lot from this.
What do you think Andy Burnham's biggest challenge will be? Because again, we don't really know where he stands on Ukraine. I mean, he's just untested also on foreign policy, so he has domestic economics and then foreign policy that could be wide open.
Yeah, I think it is that kind of everything all at once aspect of being Prime Minister. You're there in this 19th century building. It's not got a great infrastructure to support the leader of a G8 economy. So I think that will be a massive change for him. He's only been back in Parliament a week or so. He was running a big city, but that's very different from running a country. Just to return to the question of the Chancellor pick, I think what's going on here, my reading of it is that he would quite like Ed Miliband, who is his old friend, probably got quite similar politics. But, as you were picking up, Catherine, not very popular in the city, probably not the first message he wants to send in that important few hours. So I think he's kind of been going to and fro about whether to pick someone who's a bit more friendly to the markets, like a Pat McFadden figure, or perhaps Yvette Cooper or Shabana Mahmood. So I think that's the dilemma haunting him at the moment.
And yes, another name to the many, John Healey, who was until recently the Defence Secretary. Again, there was this intriguing bit of information going around at the dinner last night that he's been out there in the city talking, so we shall see.
I mean, the other thing which I find, maybe a little bit surprising was the Bank of England governor basically urging, UK growth and maintaining fiscal discipline. I mean, this was really speaking to Andy Burnham, wasn't it?
Get your growth strategy lined up, mate. Yeah, it was. If you think about it, the productivity collapse came after the 2008 financial crisis. So somebody born that year is now an adult, and we've basically had sort of very, very weak productivity growth, much weaker than we had in the previous decades since then. And it has been the Achilles heel of the UK, and that has seeped into politics and the grievance and the issues that we've faced since then. So, Andrew Bailey's absolutely right that is the big issue. There seems to be no easy solution, and Burnham's way of addressing it appears to be devolution. He wants to get regional growth to be lifted, but it's a slow process, devolution, and it's certainly no sort of magic bullet to restore growth
Rosa, do we know who he'll, surround himself with in terms of advisors? We know Jim O'Neill's very close to Andy Burnham. I mean, any sense of what kind of, number 10 kind of working processes will be like?
Yeah, well, one of the picks we know came out a couple of weeks ago was James Purnell, who's going to be his chief of staff. He's another throwback to the Tony Blair era. I think that was a good choice. He's very smart. He's run institutions in the past. He's been head of a university, so he kind of knows how to get things done. We think he'll have his two close advisors, MP colleagues Louise Hay and Annalise Midgley, and the deputy Labour leader, Lucy Powell. She might be, we've been talking about that Downing Street in the north. She might be running that as Deputy Prime Minister.
OK, so interesting. Between the football and Andy Burnham, we're going to have a really big, 5 days ahead. Catherine Griffiths, Phil Aldrich and Rosa Prince from Bloomberg Opinion, thank you all for joining us. I have a feeling we're going to see a lot more of each other in the coming days. Now, Ukraine says it hit 20 Russian tankers in the Black Sea overnight, nearly all of which were carrying oil or gas. Kyiv has been targeting energy infrastructure to try and weaken Putin's ability to fund the invasion. Now, of course, this escalation comes as European allies prepare to play a larger role within NATO. Well, let's discuss all of this with Claudia Major, Senior Vice President for Transatlantic Security at the German Marshall Fund, who used to work at the NATO Department of the German Foreign Office. So, Claudia, thank you so much for joining us. I mean, it does seem like Ukraine, President Zelensky and Kyiv has really they've upped the attacks. Does that mean they feel stronger, or are they desperate? Claudia, I think we're having just a couple of difficulty. There may be a mute button or something like that. We'll get back to Claudia in just a second to hear. I think I can hear you. Claudia, yes. Can I hear you?
I can hear you.
Wonderful. It works. If I can hear, it's 50% of the job done. So I was asking whether Ukraine, do they feel stronger? And is this why we're seeing more stepping up of attacks?
Yes, Ukraine has been extremely successful over the last weeks and months in hitting Russian strategic targets on Crimea, in the Azov Sea, and also in the Russian mainland. That's the good news. The bad news is that this pressure, together with the economic pressure and also political pressure in Russia, has not yet translated in a Russian willingness to negotiate or even to accept a sectoral ceasefire. So yes, the pressure on Russia is mounting. Ukraine is successful, but so far it has not yet changed the Russian calculus. It has not yet changed the Russian willingness to really end the war or to enter meaningful negotiations.
Yeah. Claudia, were you expecting more from the NATO summit, but also what happened in Paris in the last 2 days, or was it anyway as good as it was ever going to be?
I mean, we have several elements where Europeans try to signal that their support for Ukraine is long and sustainable. At the NATO summit, NATO allies agreed to spend for the next 2 years, each year 70 billion euros to support Ukraine. So the signal is there is a long-term support, not just some months, but 2 years. Then we had the meeting of the coalition of the willing in Paris yesterday, where Europeans confirmed again that they will support Ukraine, and the French president announced that they were doing exercises of the coalition of the willing in neighboring countries. Ukrainian soldiers participated in the military parade in Paris. You had co-crews, French and Ukrainian pilots flying over the Champs-Élysées. So you had a very strong political and military signal. And today you have Commission and President von der Leyen going to Kiev, also to underlining that the EU support is very big. So you have in the moment Europeans trying to signal, not trying, they're actually signaling that there is a long-term sustainable support for Kiev, even if there are increasing doubts about the US role with regard to Ukraine.
Do we, Claudia, overall, is there, we worry about U.S. commitment? I mean, U.S. money and arms have been really far between and slow in the last couple of months. So does it really make a massive difference? I mean, do you really worry about this also because the U.S. is clearly focused on the Middle East?
I didn't hear the last element of the question. My apologies. We seem to have some technical problems. Can you maybe just repeat the last element?
Yeah, so the U.S. is so focused on the Middle East. Does it really make them a less reliable partner for Ukraine?
It's not so much the focus on the Middle East. From a European perspective, many European allies worry or wonder where the U.S. is really in its position with regard to the war Ukraine and Russia. And if you look back, the US president tried to negotiate, tried to broker a ceasefire and a peace since he entered office, which Europeans really supported. But over the last year, we have seen many rounds of negotiations in Istanbul and Anchorage and in other places. But so far, they have not convinced the Russian president to really stop the war. In the moment, we see lots of air attacks in the nights in Kiev, and they don't only target civilian infrastructure, they also target cultural places, so the very identity of Ukraine. So from a European point of view, there is the question, where does the US stand on this war? Are they a supporter of Ukraine? Are they a moderator between Russia and Ukraine? Or might they be more on the Russian side? So from a European point, the impression is that it's up to the Europeans to assure the political, military, and economic support of Ukraine, which is in the end justified because it's happening in Europe. The Iran war is taking away attention, that's true. But I think the questions of the Europeans is far more general. It is the question, how does the US government seize Russia? If you look at the national security and defense strategy, they don't seem to see Russia as a main threat. So the question for the Europeans is more, where does the US stand on Russia? Where do they stand on Ukraine? And there are many question marks.
Many question marks. Claudia, thank you so much for your time today. Claudia Major, Senior Vice President for Transatlantic Security at the German Marshall Fund. Coming up, exuberance across equity trading drives records on Wall Street. We'll, of course, unpack a bumper set of bank earnings next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Well, Wall Street's biggest banks have shattered equity trading records in the second quarter. We're now joined by Tom Metcalf, our managing editor for EMEA Finance. So what we learned, Tom, is that they are fine.
Yeah, I mean, what we learned is this is a huge bar for any other quarter now. You know, I think you had Diamond yesterday going, you know, he was asked, is this as good as it gets? And he was like, it was pretty damn close to as good as it gets. I mean, some of those numbers you're seeing crossing the headlines. JP Morgan came out first with some huge equities trade numbers, but then Goldman just absolutely blew them away with, I think it was 7 billion, north of 7 billion, second quarter. First time anyone's ever done that. So really interesting. I think it speaks to just how strong, you know, all the markets, businesses are right now. But there was still sort of within the results some cause for, you know, at least caution among some investors, principally around costs among some, you know, specific kind of warnings the banks were giving.
Yeah, and I guess costs, it's tied to AI or some digital tokens. But what are we expecting from Morgan Stanley today?
Well, I'm expecting, again, a very strong performance, and I think the big question is, you know, with this bar now being so stratospheric, can they actually, you know, whatever they do, is it going to kind of impress the market? Because they'll all have yesterday's numbers in mind. I mean, my sense is that you look at, you know, both JP Morgan and Goldman did well. I expect Morgan Stanley will also, you know, blow past at least its estimates.
Very quickly, costs, is it digital tokens or is it just costs in general are rising?
It depends on the bank, right? So Citi's shares are actually down because Jane Fraser was sort of signalling, hey, we might have some more investment coming in the next few quarters. And, you know, again, everyone just takes fright at that bottom line sort of hit. And then JP Morgan as well, moving away from this, you know, absolutely blockbuster sort of markets trading. They were saying, hey, our full year costs are actually going to be slightly higher than we expect. And again, that certainly, at least at the start of the trading session, seemed to sort of dismay some investors.
Tom, thank you so much. Tom Metcalf there, Bloomberg's managing editor for EMEA Finance. Now, Swiss luxury retailer Richemont has impressed investors, lifting the wider luxury sector. First quarter sales have grown nearly twice as much as expected. So let's get more from Bloomberg opinion columnist Andrea Felsted. Andrea, is this all about U.S. demand?
Yes, US demand is a lot of it, but Asia seems to be doing, you know, Asia's going in the right direction. China particularly seems to be going in the right direction. South Korea's been good because of the AI boom, but yes, it is principally US.
And so what does it mean for the luxury sector at all? Is it because Richemont has great products, or is there just a revival for luxury in general?
I think for luxury, it shows luxury hasn't fallen off a cliff. Obviously, with the Iran war, there was a worry that that would, you know, hurt demand, not only in the Middle East, but more broadly. We tend to buy luxury when we feel happy, wealthy, confident, and that wasn't really helpful to sentiment. So not falling off a cliff, but I'm not sure anyone else will be as good as Richemont. Richemont is in the right place. It has jewellery, which has been a really great area. It has Cartier, fantastic brands. And in the jewellery numbers, we have Cartier watches. We know Cartier watches have been doing very well. That shift from big sporty steel watches to smaller gold watches, the Panthère, the bangle watches are becoming more popular. So it's definitely in the right place.
I mean, if you look at, so the watches are doing great, I guess, especially for female.
Yes.
How does it compare with, for example, high-end, you know, beauty products or the bags?
Well, the bags have been a problem. Leather goods have been an issue for the luxury brands because they put up prices so much. Plus, there wasn't much innovation. They relied on their older styles, so there was little reason to buy. But we've seen, you know, with the incredible success of Chanel, we have seen that when a brand gets it right, when there's innovation, when there's excitement, customers will buy.
Thank you so much. As always, Andrea Felsted there, Bloomberg Opinion, of course, focused on luxury. Now, this is the picture overall for U.S. futures. Again, yesterday was a big day. Today we have a lot of tech stocks, you know, that rallying, or tech stocks in general, leading equity markets higher after ASML earnings offered some pretty fresh evidence of the relentless demand for chips enabling this global AI build-out. The other thing I would say is, of course, we had Kevin Warsh yesterday, and, you know, consumer price data on Tuesday delivered pretty strong downside surprise, and that really prompted traders also to dial down expectations for near-term interest rate hikes, and that's giving another boost to equities. Up next, Bloomberg Brief. We'll have, of course, a full roundup, a little bit of football, but also markets. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Everybody has a moment where they put into action all they've practiced.
where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. AI momentum, ASML reports leading equities higher today after showing fresh evidence of strong chip demand. Mission not quite accomplished. Inflation eases, but Fed Chair Kevin Warsh says the job isn't done. And an exclusive interview this hour with Zoom CFO Michelle Chang on the growth of the 15-year-old company. All right, it is all kicking off again with the chip space. We'll take it over to Asia and see what's been happening over in Asia with Winnie Su in Hong Kong. Hey, Winnie.
Good morning, Bonnie. We are seeing Korean stocks leading broader Asia higher again today, with the Kospi up more than 6%, led by the surge in SK Hynix. Now, that's coming after better sentiment with the U.S. ADRs up more than 27% the day before, and that is driven by how options were made available, as well as a target price set, a pretty bullish target price set for how the SK Hynix will be narrowing its valuation gap with Micron, as well as how the memory chip, the rally in the memory chip will continue going forward. Now, flip the board, we take a look at the broader Asia market, because overall we are seeing further strength on the tech rally, also supported by the softer U.S. CPI numbers, as well as those earnings from ASML. Now, when it comes to the mainland Chinese market, we are seeing a bit more softness after the quarterly GDPs coming slower than expected, while we are seeing a bit more strength when it comes to currency following a stronger fixing.
Yeah, interesting. 4.3% for the second quarter, below the official target. Winnie, thank you so much. Winnie Su there in Hong Kong. Now let's get over to London for a look at the European session with Justina Lee.
Good morning, Bonnie. Now, it's generally a pretty quiet day in Europe, with the Stocks Europe 600 unchanged, even though we had some pretty good beats from Richmond and from ASML. But generally, of course, an up day for oil is a bad day for European stocks, and we can see a bit of that in German stocks today. Now, when it comes to the bond market, yesterday, obviously, we all got some relief from those U.S. CPI numbers, but on the long end, German bond yields are still up. And now if we flip the board here and we look at natural gas, And, we always talk about oil, but gas is also being affected by tensions in the Middle East and, of course, demand for energy with this heat wave in Europe we're going through. And you can see that it's reached the highest in a few months. And I think this is what we also need to watch out for when it comes to inflation and energy costs, especially with kind of Europe already starting to refill those inventories of natural gas ahead of next winter, Bonnie.
Absolutely. Justina, thank you so much, Justina Lee, and I'll take the baton and show you the price of oil, because it's been a fourth consecutive night of strikes on the US part when it comes to Iran, and President Trump is threatening to increase and escalate those attacks until Iran relents on the Strait of Hormuz. That said, oil, while it's holding on to its gains, it's not gaining even further. We have Brent crude trading just below 85 and WTI just below 80. And interestingly, further out the curve, we're not seeing that much of a premium either, so it's pretty flat, the 6-month curve on oil, even though the outlook for the Strait is pretty cloudy at the moment. Let's take a look at bonds, because wow, did we see that bear steepening move. Well, we'll take a look at futures first. We have ASML setting the tone here, basically saying all is well in demand for massive machines that make specialized chips, and that's setting the tone around the world really for equities. That, and of course the CPI data yesterday, which was way more benign than the market expected. And to that effect, let's move it to yields, because we did see the 2-year yield come right back down. We're still, relatively elevated, but the market hasn't priced out a 1 month decrease in rates as quickly after a CPI report since 2008. So that was a pretty big statistic that I saw. 30-year yield still pretty elevated, though, at 5.10. All right, let's get to some individual market movers now. We'll go back over to London and Chloe Melly.
Good morning, Bonnie. PayPal is soaring this morning in pre-market after a report from Reuters that Stripe and Advent International are considering a $53 billion takeover for the company. This comes at a time of a lot of weakness, actually, for PayPal. And so we are seeing investors quite keen about this potential deal there. So up very strongly for PayPal. Moving on to Europe, where we've got ASML, which you've just mentioned, Bonnie, which has upgraded its guidance and really confirmed that there is this continued demand for chip-making equipment thanks to this AI boom, this AI spending spree. And so this reassured investors across that tech sector this morning, and we're up 4% for ASML. And finally, over in Switzerland, the watchmaker Richemont is up this morning very strongly as well, after sales came in way ahead of expectations, driven by the US demand for Cartier jewelry in particular. And we saw that driving the rest of that luxury sector as well this morning, with LVMH and Hermes also in the green in Europe.
Chloe, thank you so much. Chloe Melly there in London. She'll be back a little later this hour. Also coming up in this hour, Kayla Sader of State Street on investor risk appetite. Let's kick things off, though, with ASML's strong results. Bloomberg EMEA tech editor Shona Ghosh joins us now. So ASML giving us a read on demand as far out as 2028. That's pretty unusual. It's almost becoming like a Boeing at this point, Shona, with these massive machines and, trying to build them as quickly as possible.
Yes, so the question around ASML is not so much demand. We know there's demand. As mentioned, there's a big artificial intelligence spending boom going on. Lots of ASML customers are building fabrication plants. For ASML, the question has often been about supply. Can it build its complicated modular chip-making machines quickly enough to meet the demand? So here, ASML is showing confidence, saying actually we can ramp up production and increase capacity, which is good news. In a market where we've got memory chip shortages, we've got a lot of demand, people saying more. So it's a good sign, it's a positive sign that ASML is saying yes, we can ramp up capacity. It's just a question of whether investors across the board will see it as enough capacity to sort of unlock some of those bottlenecks.
China's contribution to system sales was down to 14% from 19%. Shona, I'm curious, is China actively dialing back its AI investment, or is it just that other countries are ramping up so much?
So ASML is impacted by the US export controls, so it's not allowed to sell its absolutely most advanced machines to China, and its most advanced machines cost 400 million euros, so $400 million, sorry. So it's a big chunk of change at the top. And so it simply can't ship its top machines. And it's even limited in terms of the repairs and the maintenance it can do in existing machines. So actually, it's not unexpected that you would see a slowdown in business from China and an uptick from the US and other Asian markets, particularly Korea, where most of its largest, and Taiwan, where its largest customers are located. So I think you'd probably expect to see the China business slow down a little further over time.
Shona, thank you so much. Certainly a halo effect on global equity markets today. That is Bloomberg's Shona Ghosh. Fed Chair Kevin Warsh will be on Capitol Hill again today to testify before the Senate Banking Committee this time. That's at 10 a.m. New York time. He spoke before House lawmakers yesterday for his first semi-annual testimony before Congress.
If we get policy right, and I can assure you we will, the inflation surge of the last 5 years will be a thing of the past. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability.
Joining us now is Bloomberg senior editor Alistair Bull. So we got the testimony and we also got the CPI data. Alistair, do we have now any inclination as to what the next move will be? Is it back to, well, could be up, could be down?
Not quite. Good morning. So first and foremost, Kevin Warsh had a good day yesterday. He got pretty lucky with the CPI print, which was much better than expected. It takes the pressure off him to hike in July. He didn't take it off the table. He continued to talk tough on inflation. But the truth is that the numbers are going in his direction. There's smart people, including Bloomberg Economics, who think that inflation has now peaked in May. If that proves to be the case, Warsh can continue to talk tough, but sit on his hands, keep rates on hold. And as the data continues to come out and we get several more months going in the right direction, they will stay on hold and the narrative will turn to cuts. But it's premature to do that, as he said. We've got PPI coming up. We've got a lot of other data to come. There's renewed tension in the Straits of Hormuz. The oil price is up. And those things could easily push in the other direction. And I'm sure that the market, which is still priced for a rate hike this year, is going to keep the thought of an insurance hike in the back of its mind in case the numbers do start to turn up again. Bonnie.
Yeah, just curious. You know, we may see inflation data reversing. It's likely, in fact, but can we at least say that maybe tariff pass-through is out of the way now if oil pass-through isn't?
I think that's probably true. I think the Fed's own research shows that to be the case. There was a speech, I guess it was on Tuesday, by Governor Chris Waller, who made that very point, that the bulk of the tariff inflation has passed through. Now, that doesn't mean other tariffs can't come into play and create another shock, but from what they can see now, that is mainly passing through. Now, Waller's speech was important because it laid out two scenarios. One scenario where inflation continues to trend down and the Fed can stay on hold, and another scenario where the widening of price pressures out to core and to services and goods inflation means they may have to tighten again. Now, he pinned a lot on the CPI print, and if he said it came in hot, they probably have to consider a near-term hike. It didn't. That takes the near-term hike off the table. But that peril still remains as the data comes in, which the Fed will watch very carefully and expect Warsh to remain hawkish. He has every incentive to persuade markets that if he has to raise rates, he will. And I think they've taken him at his word.
Alistair, moving to China, we got Q2 growth coming in at 4.3%, lower than, you know, even the low rung of the target that officials had set. Does it mean we'll see stimulus or will they hold back?
I think that there's a strong expectation that they will enact more stimulus to push back into that 4.5 to 5% range. Let's not forget that for the first half overall, growth is still running at 4.7%, which is comfortably within that range. But the expectation is that they will do more, but probably on projects, infrastructure projects, which are already in train. So they're kind of more shovel ready. Bonnie.
Alistair, thank you so much. Global central bank and monetary policy outlook there with Alistair Bull. Now to other top stories trending on the terminal this morning. President Trump backtracked on his plan to impose a 20% charge on cargo shipments going through the Strait of Hormuz, saying Gulf allies urged him to drop it. Trump says the expected revenue will be replaced by direct investments in the US from Gulf states. Stripe and Advent have offered to buy PayPal at a valuation of more than $53 billion, according to a Reuters report. The firms are offering $60.50 a share. Stripe and Advent have not received a response from PayPal. It's surging, though, in the pre-market. And Richemont shares are surging too after sales grew almost twice as much as expected in the 3 months through June. The 20% growth was spurred by a high demand among wealthy Americans for Cartier rings and bracelets. Richemont sales are thriving despite a broader slowdown in the luxury sector. Coming up, a conversation with Zoom CFO Michelle Chang. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. It is time now for our CFO briefing, where we speak to leaders on what investors should be watching. Joining us, I'm pleased to say, is Michelle Chang, CFO of Zoom. We also have with us Bloomberg Senior Editor Nina Trentman. So, Michelle, let me get to you first. The company is turning 15 years old, which is sort of difficult to believe. What happens at this point with growth? We obviously saw the massive COVID boom and then maybe a little bit of a drop-off. Yeah. Where do you go to from here?
So first, we're here, celebrating the 15-year anniversary of Zoom. And, what has remained throughout those 15 years is just a deep respect and love for our customers and really making sure that we're focused on the value. But the company, to your point, has been reinventing itself since the pandemic. So focusing a lot on product diversification, on infusing AI in everything we do. And a lot of where we're headed is all about a concept we like to talk about called system of action. So how do you go from conversation, which Zoom has always been known for, our meetings business, and move that into action? So it's something we're really excited about because of what it can mean to our customers. So,
just to follow up on that, actually, I'm curious, could you talk a little bit about that new product enhancement that you talked about and how AI comes into the fore?
Yeah. So, when we think about going from conversation into action, there's so many products then that can go into. So Zoom has built not only the meetings business that we were obviously known for in the pandemic, but a phone business, a contact center business. So a lot of the same red thread being that conversation into action. And to your point, AI is what enables that action. So picture a day where we can be in a meeting and it's no longer just about the conversation. AI is listening, is taking the notes. If you can't make it, it informs you after. And you don't have to wait till the end of the day to get to action. You can just be having those moments in the meeting, whether it's updating another system of record like Salesforce. So super excited about what that means, again, to our customers.
How exposed are you to costs? AI costs, of course, is a huge topic, I think, for executives, specifically for CFOs. How does the company manage that part of the AI story?
Yeah, I think there's not a tech CFO alive that isn't very focused on tokens, and frankly, it's not even just in tech. So look, it starts with visibility and making sure you've got kind of a handle on those expenses, making sure with any expense that you're forcing the trade-off. But to be honest, where we're more, making sure that we're pushing things is what's the true value to the company? It's no longer just that world where it's AI for AI's sake. You've got to have a concept of what it's doing, for the company.
Well, because investors will sell your stock if you don't, right? That's something. That's one of the imperatives here. Yeah. Let me ask you. You did do something very wise. You bought a stake in Anthropic. It's now worth $1 billion. What are you going to do with that billion?
Well, we're not seeing what we're going to do about it. Look, Anthropic has been a great investment for us, as you know, and also a great partner. So the concept of what we did with Anthropic is something we do with many different companies, which is we try and invest early stage in technology that we think will be important to kind of our AI future, primarily these days. And so Anthropic is a great example of that. And those early stage investments allow us to understand where the tech is going and to build that in. And ultimately what it does for us at Zoom is make sure that we have the best quality and also that we're able to kind of, monitor costs and having different providers, not just our own SLM, but other LLMs like Anthropic, like OpenAI, is really, again, in service of our customers.
You've been CFO for about 2 years, coming up in October, I think. I'm curious, you made a few changes when you took over as CFO, including tweaking the company's buyback strategy. Can you talk a little bit about that?
Yeah. So look, I say before I get into the buyback, my focus as CFO was really to come in and make sure that we were inflecting our revenue growth. That's the best thing that we can do for our shareholders, was to get that growth. And we've made great progress going from 2 to 5%. But as you can imagine, lots of other changes in terms of maintaining profitability and shareholder return. And so one of the things that I thought was important, investors were giving us feedback about capital return to shareholders. And since then, we've issued $4.6 billion of buybacks and executed against 3. So it's something that I'm very proud of, that we've made that more of a predictable measure for our investors.
Speaking of career history, you spent 25 years at Microsoft before moving to Zoom, and you were responsible for Teams. That was your division.
In the pandemic,
Yeah, crazy. So I'm curious, what did you bring with you to Zoom from that role? And also, is it a little chilling seeing what's been happening to that sector?
Yeah, look, I had the pleasure of working under 2 amazing women CFO at Microsoft, so, many great learnings there. I think probably my biggest learning from Microsoft that is so relevant to where Zoom is about how to work through transformation. And look, tech delivers, endless streams of transformation from cloud to AI. So it was, how do you keep a focus internally, and how do you tell that message externally about where you're going, and make sure that people aren't confused on the biggest priorities?
Give us the secret.
Look, for Zoom, what we've talked about is, hey, there's 3 priorities. There's 3 business priorities. We're going to be about infusing core AI into our core products. We're going to be about scaling contact center. One of the product diversifications that Zoom is really seeing success in is our contact center business. So we're going to be about scaling that. And then we're going to be working to bring new forms of AI monetization on. And so it's that 3 priorities. Every dollar we invest, every conversation we have to show progress to our investors, all centers around those 3 priorities. So it's not different inside the walls of Zoom than it is out. So.
Maybe one quick follow-up before we have to wrap up. I'm curious, in the past, of course, organic development was one of the hallmarks of Zoom. How do you think about deal making and adding to that? products?
Look, our CFO, or our CEO, excuse me, Eric, has had such a great history of building amazing products. But in an AI world, there's a different time, and I think you see it reflected in a lot of what Zoom has even done in the last 6 to 9 months. We've acquired now 3 companies, so I think it is a different era as things speed up in an AI world, and so it's something that, you know, we're both embracing sort of our traditional build model as well as acquisitions.
Well, congratulations on Zoom's 15 years, and it was lovely to have you in studio. Typically, we have guests on Zoom at this hour, so very nice to meet you in person. Michelle Chang, CFO of Zoom, and of course, Bloomberg's Nina Trentman. And do check out Nina's CFO briefing newsletter by using the QR code on your screen right now.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Time now for your front page news. And first up, the New York Times reporting China's economic growth of 4.3% in Q2, reflecting a broad slump outside of the country's export-oriented manufacturing might. It was the slowest quarterly growth rate in 3 years. Next up, the Financial Times reporting Ukraine will be allowed to spend funds from an EU defense loan on Chinese drone components. And finally, the Washington Post reporting officials are investigating whether Taco Bell restaurants played a role in the illness outbreak caused by that parasite that contaminates fresh produce. Coming up, we're going to be speaking to Kayla Sater of State Street.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. AI momentum, ASML results lead equities higher after showing fresh evidence of strong chip demand. Mission not quite accomplished. Inflation eases, but Fed Chair Kevin Warsh says the job is definitely not done. And oil rising for a third straight day after another wave of strikes by the U.S. military near the Strait of Hormuz. And that's where we'll start with a look at oil, because we're staying with that 85 handle on Brent, just below 80 on New York crude. Now, it is maybe a little consoling that further out the curve, we're still relatively flat. So the president reversing course on that 20% reimbursement, talking about trade deals instead, might be impacting this market. The future of the Strait, though, still pretty cloudy. And we did have a fourth consecutive day of strikes against Iran, and President Trump saying he is going to escalate attacks until Iran relents on Hormuz. Let's get to the rest of the market, because CPI data, the Fed's, Kevin Warsh's testimony, all impacting the equity market yesterday and today. But ASML is also casting a nice glow over this market, talking up demand for their huge machines right through 2028, and that helped in Korea, up more than 6% there on the Kospi, and that's bleeding as well into U.S. equity index futures. Take a look at the yield curve, though, because that's where we're seeing really the most movement in the last couple of days. The two-year yield back down to 420.39, massive bear steepening move after Kevin Warsh's testimony, but particularly the CPI data, which was much more benign than the market was anticipating. And it was a pretty steep drop in the expectation. We had been pricing in a rate hike in July, and now we definitely are not going to be looking for a rate hike in July. The 2-10 spread there back below 40 basis points. Let's get to some individual movers now. London calling with Chloe Melly. Chloe.
Good morning, Bonnie. PayPal is soaring in pre-market trading this morning after a report from Reuters that Stripe and the private equity firm Advent International were looking for a $53 billion takeover of that company. And so we are seeing that really drive the shares very strongly this morning, up more than 16% for PayPal. Moving on to ASML, which has upgraded its guidance and also laid out plans to increase production. This really confirms this AI momentum, this AI spend spending on this chip-making equipment, and this is something that has reassured investors across that tech sector this morning. And we're seeing ASML up almost 4% this morning in the Netherlands. And finally, going over to Switzerland, where Richemont has reported sales that were way ahead of expectations, thanks to wealthy Americans buying a lot of Cartier jewelry, and then every region actually having very positive sales as well for Richemont. So this is the first big luxury company in Europe to report, and this might be boding quite well for the rest of that sector, with earnings reports expected from LVMH, Hermes and Kering over the next few weeks as well.
Yeah, the upper part of the K for the consumer definitely working this quarter. Chloe, thank you so much. Chloe Melly there in London. June's CPI print showed inflation easing, but Fed Chair Kevin Warsh says there's more work to do.
It's one data point. The reason I create a task force on data is I don't want to overread or cherry pick data. There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view.
Kayla Sader, macro multi-asset strategist at State Street, joins us now. Kayla, the market obviously priced out the July rate hike, but is it pricing in a victory maybe too quickly?
Yeah, that is the concern, that the market will get so excited that inflation is coming down and, the Fed can claim success. And as we just heard from Chairman Warsh, that's not the case. I think there's a couple factors to think through. First, the Fed has been off target for 63 months now. So I think, the market should be skeptical that we won't see reversal. Part of that, too, is that when we look at what's happened just over the past couple weeks, we've started to see upside in commodity prices again. And even when we look under the surface, something that we're paying attention to a lot at State Street is the whole influence AI could have on inflation. So this time last year, folks were saying AI could decrease R-star because of the impact on the labor market. What we've learned over the past year is the labor market is still strong. There's actually tightness on the supply side. Simultaneously, you have AI influencing inflation to the upside, creating more productivity. And so I think when we look at some of our daily measures of inflation and price stats, what we see is very, very high electronics prices. And so that's one example of something that's in core that could still lead inflation higher. And so even though yesterday's print was, let's say, very benign, you have geopolitical factors and you also have structural factors.
Well, that's the thing. I mean, the market was so relieved yesterday, right, that you have to wonder if there's a bit of a reversal next time around. And there's likely to be at some point soon, because of these oil prices that went right back up. Does the market basically freak out again?
I think freak out is a good word to use here. One thing I look at when we look at nominal yields, breaking it down into real yields and break-evens. And when we look at break-evens yesterday, the move was quite large, and we saw this big drop in break-evens. And so I think when we think about mechanically what would increase rates here, I think there is room for reversal on that break-even side, and so we should see yields move a little higher over the next couple weeks.
What happens if we get a weaker employment report than we'd like to see?
I think it depends on what's driving that weakness. So at this point, I would focus more on the unemployment side and also pay attention to what's going on in the participation rate. If the participation rate fluctuates, that's an important signal. So looking within the data there, but also, the market does tend to overreact, I think, to these NFP prints. When we get a low NFP print, that's not necessarily a bearish signal for the overall economy, because that could be reflecting supply, where we just don't have enough folks to increase that NFP number. And when we think about the break-even rate within the employment picture, we really don't need very strong NFP prints to keep unemployment stable at this point. So I really think, looking through low NFP numbers, focusing on employment, as well as focusing on wage growth. If we're in an environment where inflation has come down, actually, and we're starting to see wage growth accelerate or stay strong, that's a signal that demand could still be very strong, and ultimately that could also prove inflationary moving forward.
It seems like we've been waiting for so many factors to appear. So the influence of, immigration, for example, the influence of the World Cup. I mean, are some of these behind us? Are some of these baked into the data at this point, and we can sort of put them behind us as concerns in the sense that at least we know the outcome? Or are we still waiting? I mean, even tariff-induced inflation.
Right. there's a lot of factors, and I think that's one thing that's interesting with the current administration that is actually an inflation risk is, for example, with tariffs, if you just saw a one-time price increase, that wouldn't be inflationary because ultimately that would ease out of the numbers. But if we start to see tariff policy shift, that could be inflationary. Also on the commodity front, we're living in this example where we had the good news on the MOU. That has since been reversed. And so you see these fluctuations. These fluctuations can be much more inflationary than just a one-time hit. Also on that structural employment front, one thing we're looking at is what parts of the economy or what parts of the labor market are seeing less job growth, and how does that compare to wage growth? And when we look at that wage growth, it's actually sectors that have seen job contraction see wages increase the most. And so to us, that's a sign that employers are struggling to find the workers they need and are having to pay more to attract those workers. So that's a supply side issue on the labor market.
One-year inflation swaps did drop below 2% at one point. Are we going to see a continual repricing, over the next few months? And what is State Street expecting for, the next Fed move and when?
That is the question. I don't think it's out of the question to expect at least one hike at this point. Certainly not in July, probably more so Q4, just to see where the data do shake out. The message we got from Chairman Warsh yesterday is, he needs to see consistent prints essentially. Otherwise, he'll stay more hawkish. And when we think about, what is an ideal world for the Fed right now, it's lower inflation at this point. When we think through some of the policies Chairman Warsh has talked about, a smaller balance sheet, for example, less need for communication. Both of those things are much easier when inflation is not an issue. And so I think that's why it makes sense for him to be very persistent in more of his hawkish speak, because he doesn't want to overcommit to anything too early.
Speaking of the balance sheet, he said, we are not going back to the 2006 balance sheet. That ship has sailed.
Yes.
Where do we go, though? I mean, it has shrunk a little bit, but, how much more can it shrink?
That's a great question because, we're not quite where we were pre-COVID. It would probably take a little more than $1 trillion of shrinkage there, which still is quite a bit. I think really what it comes down to is, what can the economy do with fewer reserves? And so we hear a lot of discussion around decreasing banks' demand for reserves. And some of that can happen through regulation. So we've heard a lot of discussion about that. But ultimately, what we would need to see is, banks being able to do more with fewer reserves, become more efficient. So far, what we've seen is the central bank's the economy rather, is not able to handle that at this point. There's a reason why just this week, Roberto Perli, who runs SOMA, announced that the Fed is going to continue their reserve management purchases at the current pace. Part of this is because we still see increased issuance. And so as we see more issuance on the fiscal side, it's very challenging for the Fed to shrink their balance sheet.
All right, well, we'll see what we hear from Mr. Warsh today. Kayla, thank you so much for all of your thoughts post CPI and the Fed Chair's first day of testimony. That's Kayla Sader of State Street. Now to other top stories trending on the terminal this morning. Stripe and Advent have offered to buy PayPal at a valuation of more than $53 billion, according to a Reuters report. The firms are offering $60.50 a share. Stripe and Advent have not received a response from PayPal. Richemont shares are surging after sales grew almost twice as much as expected in the 3 months through June. The 20% growth was spurred by high demand among wealthy Americans for Cartier rings and bracelets. Richemont sales are thriving despite a broader slowdown in the luxury sector. Spain advanced to the FIFA World Cup final after a 2-0 victory over France. They were able to shut down an impressive French attacking trio led by star Kylian Mbappe. Spain will face the winner of Argentina versus England. And that'll happen this Sunday at MetLife Stadium in New Jersey. Coming up, President Trump vows to intensify strikes on Iran until it stops attacking ships in the Strait of Hormuz. Details next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Burrow.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them because next week comes the power plants. Next week comes the bridges.
President Trump keeping military pressure on Iran for a fourth day and continuing. U.S. forces hit Iranian military targets overnight again. Kate Ackley of Bloomberg Government joins us from Washington. So, you know, he's threatened so many things, but we are now back into a fourth day of strikes on Iran. We're hearing of, you know, hundreds of people injured at this point. Kate, does this continue? Will he strike power stations? And, you know, he's threatened desalination plants and so on. Will he do it, Kate?
Well, we have seen this before where there was, you know, sort of using this to get closer to a deal, but that memorandum of understanding with Iran obviously seems to have not held up. So, you know, just it's a very volatile and uncertain situation. And as you know, it has this ripple effects in the oil prices and all this stuff that has to get through the Strait of Hormuz. So it's something that, you know, people are watching obviously very, very carefully. There has been, like you said, 4 days of more bombing. If you look at the situation, you know, back here at home in the United States, this conflict in Iran has hurt President Trump's polling numbers. It's hurting, you know, then Republicans who support it, hurting their poll numbers as we're, you know, really about 4 months out from these pivotal midterm elections, which will decide control of the House and the Senate. So you know that that's also top of mind for the White House team and for the Republicans on Capitol Hill. And we've seen Democrats this week, you know, lawmakers have come back to Capitol Hill, and Democrats are talking about the situation in Iran, and they are, you know, using it as a messaging point, if you will, that to go against Republicans.
Yeah, and I mean, nothing is getting any better. The Strait of Hormuz at one point was way more open than it is now. I mean, the UN maritime chief actually told Bloomberg just in the last few hours, it is not safe. And we know that ships are just dribbling through, if at all, at this point. So the carrot approach didn't work, I guess, if there was maybe a carrot. The stick approach is not working. Is Iran just going to wait this out for a lot longer?
Well, and then there was this idea floated. President Trump floated the idea of charging, 20% on shipments going through the Strait of Hormuz, and backed off of that after, U.S. allies in the region pushed back on that. So, you see these kind of ideas be floated, how to deal with the situation in the Strait of Hormuz, which is this very important thoroughfare, especially for oil and gas, but also other things, helium, many things sort of go through that strait. So I expect you will see other ideas floated, and the administration will be seeing what might stick, while they also, sort of have this back channel negotiations going on to resolve the conflict.
All right, Kate, we will obviously continue to monitor the situation. Thank you so much. Kate Ackley of Bloomberg Government. Let's turn to what's driving equities higher today. It's ASML lifting its annual sales forecast for the second time this year. A surge in AI spending driving demand for the Dutch company's chip-making machines. Joining me now is Bloomberg senior strategist Neil Campling. So we know that there's going to be huge demand until 2028. Neil, are these clients locked in, or at some point could that demand, drop off? I mean, it's a bit like Boeing at this point. You're looking at deliveries as opposed to, anything else. Any other metrics?
Yeah, we're looking obviously at the long term here rather than the single individual quarter numbers, Bonnie. As you mentioned, because if we look at it, we know the AI narrative is very strong in the short instance from all of the sort of anecdotes that we're seeing. The key coming into this was clearly about how high they'd be able to raise guidance. And crucially, short term for the stock and momentum, they managed to raise guidance for this year for revenues above all street expectations. So even the most bullish estimates were bettered in terms of the guide. The conference call, which will come at 9 o'clock New York time, is definitely going to focus on what happens in the long term in terms of are they able to create enough supply and the equipment to meet that huge AI demand. There's clearly going to be no real color yet on what happens longer terms in terms of the demand dynamics, but certainly given the fact that demand is so high, the key is going to be that they can match in terms of the supply. And that's been the concern going into the print. And there's a bit of a catch-up trade here because ASML has actually underperformed their peers and the SOX index year to date into today's numbers.
Yeah, it's only up something like 60+%, right, Neil? Speaking of, crazy pricing, SK Hynix all over the place. The ADRs are trading at a 51% premium now to the stock in Korea. Who's right? I mean, is it trading at a discount in Korea, or are we way overpaying here in the US?
It's, I think one of the attractions of the listing in the US was certainly that when investors want to play the memory trade in AI, then it's been somewhat limited in terms of these kind of HBM chips to just playing Micron. So now you have another alternative. There are technical factors going on here between the listings of the different stocks. So I think we're going to, an options market started trading yesterday as well. And so for the time being, there are factors at play in terms of options, in terms of short sellers positioning, in terms of index positioning. There's a whole range of factors which will probably narrow that in the course of the next few weeks. But volatility will remain. Keep an eye on that.
Yeah, that does not surprise me, Neil. At this point, Neil Campling, thank you so much for joining. Morgan Stanley releasing results before the opening bell, rounding out big bank earnings already for the second quarter. Joining us now is Bloomberg Managing Editor of EMEA Finance, Tom Metcalf. So, Tom, if yesterday is anything to go by, really everything is green and golden and there are no problems out there. Is that what we'll hear from Morgan Stanley?
Well, I think they better deliver on that line, right? Like the bar has now been set so high, particularly by Goldman Sachs on the equity side. So, I think that's probably the new challenge Morgan Stanley's just been set is can they meet, those expectations, which presumably after yesterday have just been pulled even higher. Certainly, as you look across the 5 banks that reported yesterday, it was just like, wall-to-wall strength really in the trading business. Obviously, that's a big part of Morgan Stanley's world as well. And for me as well, the other interesting thing will be, with a huge wealth business, what are they seeing, investors doing? Presumably piling in to equities, piling into investments still. But sometimes you kind of extract some sense of, is there a little bit more, perhaps from a certain subset of those wealthy investors, a certain set of kind of more caution perhaps?
Yeah, I mean, really only Citi, maybe disappointed yesterday, not even talking about the stock price movements really, but the actual results, and still their trading quarter was phenomenal. Have we put to bed all of the concerns that might have been out there, the so-called cockroaches and so on?
Yeah, it was interesting to watch yesterday. So, Citi and JP Morgan both sort of maybe slightly spooked the market as well. Funny as obviously because of that bottom line they were looking at, right? So your JP Morgan effectively saying, hey, our year-end costs will probably be somewhat higher. That is obviously the last thing shareholders want to hear. And then on the Citi side, they started strongly out the gate, but then you had the CEO, Jane Fraser, just sort of flagging, hey, we might be investing more in the kind of coming months. And again, shareholders took that and thought, ooh, what kind of costs are we going to have coming up down the pipe? And that's partly why you saw the Citi shares drop.
Yeah, but definitely investors prefer costs than they prefer problems, I'm sure. Tom, thank you so much. Bloomberg's Tom Metcalf. This is Bloomberg.
The latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Now look at what is ahead today for your trading day. Another read on U.S. inflation. We get PPI data out at 8:30 a.m. New York time. And then, of course, Morgan Stanley reporting before the bell. We also get United Airlines, though, after the close. And it is day 2 of Fed Chair Kevin Warsh on Capitol Hill. He testifies before the Senate Banking Committee at 10 a.m. This is your macro picture for the day. The Nasdaq looks to be about to open higher in a few hours. This on ASML, talking up chip demand right through 2028. Brent crude, as we've got 4 consecutive days of strikes now, and that 2-year yield back to 421.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in this space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
The power of earnings is too strong.
Earnings revisions breadth is still surging.
At some point, valuations will become an issue for investors.
We've been warning our investors that a correction was coming across the board.
It's premature to get too worked up or too bearish.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, wrapping up big bank earnings. Morgan Stanley, BNY set to report following blowout numbers across Wall Street. PPI, the next data point to drop after CPI comes in much cooler than expected. Heading into day two on Capitol Hill for Fed Chair Kevin Warsh. Warsh facing down the Senate.
Yesterday, the message coming from Kevin Warsh was mission not accomplished. We'll probably hear more of that today, even if we get another softer than expected print on PPI. Question is, which mission is he talking about? Because when it comes to mission transformation or mission information, he seems to be winning. If you take a look at the two-year inflation expectations, they're near the lowest since October 2024, even with oil prices rising. So even though Kevin Warsh did not lay out his plan going forward for exactly how he planned to anchor inflation expectations, he has done so with remarkable care.
That's the issue. We know what he doesn't like. We don't know what he wants to do about it. Is this just a communication exercise, or is there some real intent? Is this about hiking interest rates at some point, or just holding rates at this level for a whole lot longer? They're the questions we've got to ask. I think today in the Senate, if you have an opportunity, good morning, senators, just ask him whether he believes we are sufficiently restrictive or not, based on the policy rate where it is right now and the economy that we have. Are we sufficiently restrictive or not?
Yeah. Do you think that right now, by doing nothing, we could still get inflation down to that path? He probably will say there's a task force to analyze inflation, which he did discuss and go into in terms of a default. But this really is going to be the key question. When you take a look at where investors are positioned, the Bank of America Fund Manager Survey came out for the month of July.
Punchy.
83% believe that the Fed will not hike rates before the midterm elections. And increasingly in notes, I see the expectation for a rate cut come in 2027 and being on hold this year. So despite market pricing, the sentiment from Wall Street analysts seems very different.
Looking at the same survey this morning from BofA, US equity overweight is the biggest since 2024. Cash levels fall to an uber low 3.6%. That's a pretty bullish setup coming into this month. Check out crude, WTI and Brent. We've added about $10 back to the price of crude. 85 on Brent this morning. WTI at around 80 and up by 0.8%. The stress in the Middle East continues and the flip-flopping around policy does as well.
Yep, we're flip-flopping in terms of potentially this 20% reimbursement. The president wanted to charge vessels for transiting the Strait of Hormuz. He now says it could be done in trade deals. So if you're a Gulf country, invest more in the United States. There's really no details on exactly how this would work, but clearly he's been advised that the United States charging a toll is not going to work the same way the Iranians are trying to charge a toll. However we want to slice it, though, the strikes continue. And the president in a Fox News interview last night not only said they were going to happen last night, but they're going to happen again this evening. And then he foreshadowed energy targets in Iran will be left, quote, for last.
How much comfort can you have in the inflation story? We just had the biggest decline in gasoline prices since 2022. How much comfort can you have with CPI yesterday, PPI later this morning, when this story can flip again, Bramo, over the next month?
You know, I don't really understand why two-year inflation expectations are as low as they are, why they are continuing to come down, why the disinflation belief seems to be prevailing on Wall Street, even though we do have rising oil prices. This is a tension that needs to get resolved.
Should we check out ASML as well, reporting over in Europe? The good news, that stock is doing well. That's the AI trade. In many ways, it's the capex trade. ASML this morning up in Europe by close to 4%. It's capex for the few, not for the many, and I think they're getting that capex. IBM certainly is not getting the spend right now.
Yeah, and arguably the two stories are highly intertwined, with people investing in the hardware of ASML and not in the software of IBM, really front-running some of these orders. The idea that their guidance for total revenue for this year came in almost $9 billion above the low point in previous expectations for the full year gives you a sense of just how much of a beat you're getting on the hardware side of things.
IBM just getting absolutely hammered in the last 24 hours. Coming up this hour, we'll catch up with Steve Chevron of Federated, wrapping up earnings on Wall Street, Anna Rosenberg of Amundi as President Trump walks back plans for a Hormuz toll, and Stefan Slavinsky of BNP Paribas as IBM loses a quarter of its value in a single day. We begin this hour with stocks pushing higher, heading into earnings from Morgan Stanley and BNY. Steve Chevron of Federated writing, despite all of the headline risk and volatility, the relentless march of earnings growth continues to drive the market higher. Steve joins us now for more. Steve, good morning. Good to see you.
Good morning.
How high is that earnings bar going into earnings season?
It's the highest in a while. I mean, expectations are that earnings are going to grow 22% on a year-over-year basis. That would be the strongest quarter since Q4 of 2021, coming right out of COVID. We generally beat 5 to 8%. And so, is it impossible to see a 30% year-over-year earnings growth number? I think it is. I don't know if it's likely, but it's possible. And it's broad-based. I mean, certainly tech and energy are playing a big part here, but 10 of the 11 sectors are likely to see positive growth. Healthcare is the only one that's not joining the party. What we're seeing is margin expansion at a rate equal to or better than any other period we've seen in our careers. And I can say that safely for all of us around the table. That's the big story. That's what's driving markets higher.
The story's great. It just depends how well priced it is right now. I know it's really, really early days, but it was touch and go just yesterday morning, where it felt like the beats weren't really being rewarded, but the misses were being absolutely obliterated. Those stocks got punished. IBM a great example of that. Is that an early lesson, or is it too premature?
I don't think it's just about beats and misses. I think one of the things that's happening is that the nature of risk is changing. It used to be that it was a growth or a value story or a factor story. It's who are AI winners and losers right now. And you're funding your AI capex by not spending on mainframes. And I think as the market looks at that, they're asking, well, is this something that's going to continue for an extended period of time? Because you can't really start to ask if AI capex is going to peak until the hyperscalers stop raising capital to increase even more on the capex side. So when you look at things like the chip trade, I think they have room to go because the demand continues to outstrip. I also think that it's going to get more volatile because the first leg of this was earnings moving higher. You could see these chip stocks and you can see their earnings jumping. Now the question the market's wrestling with is, via long-term contracts and the sustainability of this play, should the multiple revalue? And anytime you're in a multiple revaluation story, it tends to be a little bit more volatile.
This has been an incredibly complicated year because it's both a micro story and a macro story. On the micro level, yesterday when we got the earnings reports, we did see pretty tremendous beats, and then we saw some of them with pretty paltry gains. Goldman Sachs is a perfect example. As the session grew older, those shares gained more and more. Yes, it was the commentary, but also it was this idea that a disinflationary print on CPI would give the Fed more room not to hike rates. How much is this a rate hiking story as much as it is a micro story and a story of AI?
So if I were to rank them in priority order, I think the big story is earnings. That's really the underpinning of what's going on here. I think as it relates to the Fed, I agree with that survey. I think what you can misread from Chairman Warsh is, I don't think he's actually being hawkish or pivoting in a hawkish direction. I think what we're doing is we're going back to a different kind of Fed guidance, and that is I'm going to be staunch in my defense of price stability in my comments, and I'm not going to tell you what I'm going to do. I remember being a young analyst on Wall Street once and hearing Greenspan speak, and he was about to do an interview, and he said, please don't ask me about monetary policy. I might be forced to launch a 30-minute answer where I tell you nothing. And I think that that's what you're going to see from Warsh today in front of the Senate. I think he's trying to break the market's dependency on being spoon-fed guidance. And I think that that can be misinterpreted by some as hawkish. I think what Wall Street is looking at is, just as it would have been ridiculous to cut rates in the face of rising oil prices earlier this year, it's equally ridiculous to really be considering hiking rates until we see how all this plays out.
Putting aside Kevin Warsh and what his actual decision of what he's going to do is, it seems like the longer they remain on hold, the more the punch bowl is available to all the investors on Wall Street. The more you can get these earnings that continue to outperform in a massive way from the big banks. Why is that not how you see it, essentially?
Yeah, because I think when you look at the bulk of this earnings growth, it's not coming from rate-sensitive companies, right? It's not coming from smaller cap companies. Even the banks, while their numbers are good and they were terrific and very good for the banks, they're not really driving the kind of 30% year-over-year growth. That's really coming from tech. That's really coming from places like material. That's really coming from places like industrials. The companies that are spending on chips have more money than the Lord himself. They don't need to borrow at the federal funds rate. And so I think that earnings growth is, in a lot of ways, at this point, really independent of rates. What you see, though, is that there's large swaths of the economy, middle-income Americans, lower-income Americans, smaller businesses, that do care about rates, and they've been under pressure for 3 or 4 years. And look, we can quibble about this, but the inflation rate's 2.6%, and the federal funds rate is 3.75%. Those are real rates that are high relative to history, and I think they probably don't need to be there. We just need to get through some of this noise for that to become apparent.
Do you think it's that cohort that's being affected by those higher rates that's going to hold the Fed back from having a potential hike?
Yeah, look, I think that's right, because I think what you would do by hiking rates is punish those that are already being punished. You're not going to slow down AI CapEx spend, which is pushing up memory prices. You're not going to slow down the high-end consumer, where higher rates mean more money from their kind of money market account or their savings, and they all have fixed-rate 30-year 3% mortgages. So I think it would be counterproductive, quite frankly.
Steve, you alluded to it. Do you think the multiple's going to go up?
So that's been the thing that I think we've gotten right over the last couple of years, is that if you're in an environment where margins are growing, and the S&P is getting more profitable because of mix shift, because of more subscription-based models, then it's unreasonable to think that the multiple doesn't follow. And that's really been correct. If you look at where margins have gone, so too has the multiple followed. And until that stops, I think that's right. So what used to be a kind of 16 times, fair value, we think is somewhere right now between 20 and 22. That doesn't mean that lasts forever, but until these margins stop going higher, there's really no reason to think that the market would pay less for a higher margin
investors
profile.
right now obsessed with potential downside. What I'm hearing from you is potential upside. What kind of upside are you thinking about?
So we're at 9,000 by the end of next year on the S&P. We think that's, if you look at what that really represents, sounds like a big number.
Sounds like a massive number.
It does, but it's a year and a half of average equity returns. Kind of high single-digit, low double-digit returns. That's on average what the S&P does. But we think that that's the direction of travel. The CapEx continues to be there. The bottlenecks continue to be there. The pricing power continues to be there. This is the largest infrastructure build since the railroads. And the capacity that can come online that would derail these are hard assets. This isn't like a software upgrade. It's 3 to 5 years to build that chip capacity that then makes these prices go the other way. So we think that this has legs.
Steve, it's good to see you. Always is. Thank you, buddy. Steve Chevron there of Federated. Nasdaq futures this morning up by 0.5 on the S&P. We're positive as well. The earnings keep coming through. Speaking of big beats on Wall Street, BlackRock delivers another one.
As Steve is talking about how maybe we're underestimating how much the margins can keep increasing, Take a look at this. The second quarter adjusted earnings per share for BlackRock, $13.91 versus the estimate of $12.66. This is a massive upside beat. Net inflows of $191.7 billion versus the estimate of $175 billion. When you take a look at the total assets under management at BlackRock, $15.3 trillion. I'm just trying to get my head around that number. It was expected to be below 15.2. The shares are up almost 2%, but it gives you a sense of the magnitude of beats that are coming out, surpassing already elevated expectations. Will it be the same for tech? ASML giving a sense of that. Nonetheless, you have to give credit to just how much this is blowing expectations out of the water.
BlackRock, the stock up by 1.7%, a series of upside surprises over the last 24 hours, and another one to start this morning. Let's get you an update on news elsewhere with your Bloomberg Brief. Vonnie Quinn joins us for more. Hey, Vonnie.
Good morning, John. Fed Chair Kevin Warsh returning to Capitol Hill today after telling policymakers that slowing inflation in June doesn't mean the central bank has accomplished its mission.
The members of our committee have no tolerance persistently elevated inflation, and we share a resolute commitment to ensure price stability.
Warsh testifying before the Senate Banking Committee this morning. ASML shares rising in European trading. The Dutch chip maker lifting its annual sales forecast for the second time this year and laying out plans to increase production. The company saying a surge in AI spending is driving demand for its chip-making machines. In sports, Spain is headed to their first World Cup final since winning the tournament in 2010. They beat France 2-0 after the favourites only managed 3 shots on goal. Spain will meet either England or Argentina in Sunday's final. And that is your Bloomberg Brief. John.
Vonnie Quinn, thank you. Looking forward to later this afternoon. Up next on the programme, dropping the tax on Hormuz.
Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, they would love to invest more money in the United States at record amounts, and this way, there's no fee.
Up next, Anna Rosenberg of Amundi, live from New York City this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Earnings season on Wall Street in full swing. 2 more to go. BNY at about 6:30 Eastern Time. Look out for numbers from them. At 7:30 Eastern Time, we'll hear from Morgan Stanley. Looking forward to that over the next 60 minutes or so. Later this morning at 8:30, PPI data. And then after that, 90 minutes later, The Fed Chair, Kevin Warsh, testifying before the Senate Banking Committee. Looking forward to that. Equity futures right now into all of those risk events. Equity futures this morning positive by 0.2. On the Nasdaq 100 higher by 0.5. In the bond market, a bit of a reset following softer than expected CPI data yesterday. Twos back to about 420. They were pushing up to, say, 430. Yields are higher this morning by 2 basis points. 10's up a single basis point, still around 460. This is not a massive game changer. We talked about this yesterday. This maybe removes the urgency to hike, but does not settle the debate, especially with these numbers in the commodity market. Crude, WTI and Brent. Brent right now around 85, WTI Bramo around 80.
It is notable, though, to see that inflation expectations over the next 2 years keeps falling, even as oil prices start to climb once again. So, again, this goes to the question of credibility gap for both what we see at the Federal Reserve as well as just how quickly we can bring oil prices down. People seem to believe that this is temporary and that this is just yet another blip on the path to disinflation.
Crude this morning higher by 0.8%. Under Savannah's this morning, dropping the tax on Hormuz.
I don't like the concept of a fee, but at the same time, it's not fair that we're protecting this strait for the entire world. Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, they would love to invest more money in the United States at record amounts, and this way, there's no fee.
So here's the latest this morning. The president reversing course on a charge for Hormuz cargo, vowing to escalate attacks on Iran and threatening the nation's energy infrastructure. With the latest, Tyler Kendall has more. Hey, Tyler.
Hey, John, good morning. Well, it feels like while President Trump is dropping one threat, he is expanding another, saying that the U.S. could hit Iranian power plants and bridges by next week if the country doesn't come to the negotiating table. But at this point, we've gotten very little indication that Iran is willing to back down, with the IRGC saying in a new statement on Iranian state TV overnight that the Strait of Hormuz will remain closed until further notice, and adding, in part, quote, the region's oil and gas exports are either available to all or available to none. Now, we know regional allies are urging for a solution. You heard President Trump outline there that he spoke directly with officials from these countries like Saudi Arabia, Qatar, the UAE, and Kuwait about dropping that 20% reimbursement fee in favor of trade and investment deals, though at this point it's unclear if there are any new commitments. What is clear, though, is that the U.S. is opting for that economic pressure to try to put the pressure on Iran when it comes to the Strait by renewing this U.S. naval blockade. Our analysts at Bloomberg Economics estimate that it costs the U.S. military between $31 and $45 million per day to keep that blockade intact. And, John, that is renewing the spotlight on U.S. resources and stockpiles, which President Trump is actually set to address today when he comes here to Pennsylvania for a speech focused solely on bolstering the U.S. defense industrial base, just made even more urgent amid this conflict with Iran.
Looking forward to your coverage. Tyler Kendall from the Defense Summit in Pennsylvania. Joining us now to discuss, Anna Rosenberg of Amundi. Anna, welcome to the program. We're obsessed and focused on one thing, and that's policy and changes to policy. Is this a new policy or not from the president?
The new policy to drop the tolls, I think that is a rather surprising development to the degree that the U.S. has benefited from free waterways, from the freedom of navigation, really, for the last 80 years. And to actually drop the principle and introducing a tax for the waterway would undermine that core U.S. principle. So it was never really realistic in the first place. So I was skeptical when I heard the plan in the first place. I am not surprised that he ended up dropping it.
Okay, but now he's saying that Gulf states will be making deals into the United States. Is he just trying to squeeze some of these rich economies to make more investments in the U.S., or will there actually be some sort of carrot and stick approach where you would actually see these deals materialize?
I mean, we know that this administration is very keen on getting more investments into the U.S., and we have heard about many deals and many investment promises in the past, but not all of these have materialized. And I think to this degree, the situation in the Strait of Hormuz is, of course, costing the global economy quite a lot, and the U.S. is trying to guarantee its security. You can argue that this is not necessarily fair, but nevertheless, this is the situation it is. The U.S. is a guarantor of global security to many countries, of its allies, etc. And ultimately, the U.S. also started this escalation alongside Israel. So, of course, we may see some of the deals materialize, but many may not. And ultimately, you'll see other kinds of collaborations to try and get more ships passing through Hormuz. I think the Trump administration is hoping that its new campaign, its new military campaign, is weakening Iranian military abilities to the degree that they can help escort more ships through. But that is quite difficult at this point.
The president also said that potentially energy targets would be left for last. Do you take him at his word, or do you think this is a way potentially he could try to push the Iranians into either stopping going after some of these vessels or potentially back at the negotiating table?
So firstly, this is not just in Trump's control. We have seen forces unleashed that are outside anyone's control, really. Even in Iran, there are competing forces at place. You have, on the one hand, the RCG, which is much more ideologically motivated, and they think that the only way to get more resources in is to control the Strait of Hormuz. And then you have within Iran also those that are still interested in negotiating. So those are not on the same page. And if anything, the last week has made the IRCG argument much stronger. If you want to get any kind of income, you need to control the Strait of Hormuz because you don't trust the US in delivering on sanctions release and assets unfreezing, etc. So that argument is pretty strong. So there are forces out there that the US administration cannot control, firstly. Secondly, the Iranians still have the upper hand. They can attack regional oil and gas infrastructure and cause much bigger economic chaos right now. So we are in a situation where things have changed since the MOU was signed. The Trump administration is a little bit more confident that they can escort ships through the Omani route, but the Iranians have become a lot more hardline. So this entire situation is moving up the escalation ladder pretty fast.
Anna, why do you think the market hasn't really come around to this? Yes, on one hand, you've seen a creeping up of oil prices, but still below where they were just last month. And there's a sense among a lot of investors this is already passed in terms of the risk of the extreme $120 a barrel types of situations. Do you agree?
Well, to some degree, yes, because a lot of the oil has been rerouted already. And we have seen some still passing through Hormuz. So that has eased the pressure on the oil prices. And actually, the focus should probably be more on gas because rerouting is a little bit more difficult to that degree. And other critical things that are passing through the Strait of Hormuz, like helium, for example, as well. But in terms of oil price, we have seen successful rerouting. And as a result, this is emboldening Trump as well to be a little bit more aggressive and to take more risks because the oil price is what impacts the US voter the most. Gas prices is more something that concerns the European consumer that are obviously not as important for the midterm elections. So the oil price will likely go up if the Strait of Hormuz stays closed, but it's not what moves the needle here. It is the other things that are passing through Hormuz and have a bigger impact on other regions of the world.
Anna, it's good to hear from you. Anna Rosenberg there over Monday. As we're having this conversation, some headlines dropping from US Central Command at 6 a.m. Eastern Time today. US Central Command forces began launching a wave of strikes against Iran. These strikes are designed to further degrade military capabilities Iranian forces have used to attack commercial shipping in the Strait of Hormuz. The latest from US Central Command. Crude off the back of those headlines, just a little bit higher, $80 on WTI. Brent crude around 86.
Well, the market was expecting this from everything we've heard from the president and other leaders in the administration. 6 a.m. Eastern, so just 25 minutes ago. That's 1:30 p.m. in Iran. Probably likely going after those assets that are along the coast.
Tension simmering across the Middle East. Coming up on the programme, we'll catch up with Stefan Stavinsky of BNP Paribas as IBM suffers its worst one-day drop in nearly 60 years.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Stocks are positive this morning, higher by 0.1% on the S&P 500, up by 1/3 on the Nasdaq. As Lisa mentioned, fantastic numbers out of BlackRock, stellar numbers across Wall Street over the last 24 hours. More still to come. BNY in a few minutes' time. In the next hour, we'll hear from Morgan Stanley. Looking forward to all of that with the bond market poised like this going into PPI later this morning. We've got yields higher by 2 or 3 basis points now, back to 422 on twos, 10 still north of 460, 30 still around 5.1%. You haven't seen a massive change, even with softer than expected CPI data yesterday. The debate hasn't changed that much.
Well, ultimately, a lot of the softness and the first drop going back in 6 years really came from the idea that we've seen oil prices come down. If you've got oil prices rising once again and inputs like those related to artificial intelligence, how much comfort can you get? Mission not accomplished. Those were the words that really rang true to Wall Street yesterday.
Well, let's turn to crude and let's look at the price of energy together. WTI and Brent pushing higher by more than 1% this morning. Close to 86 on Brent, through 80 on WTI. Took a very small leg higher in the last 5 or 10 minutes off the back of these headlines from US Central Command that at 6 a.m. Eastern Time, so 30 minutes ago, US Central Command forces began launching another wave of strikes against Iran.
And CENTCOM is saying this is to further degrade military capabilities they've been using to attack commercial shipping in the Strait of Hormuz. We understand the kinetic warfare of all of this, what exactly the United States is going to be striking. The president even put energy targets potentially that could happen later this week. He said, or that would be the last we would go for. What is a little bit more unclear, and you've been talking about this, Jonathan, is what actually is the policy now? We went from a 20% reimbursement to the United States if you were able to traverse the strait, and now it's just invest in the United States and we'll have some deals.
Yeah, I don't think we've got much of a policy right now. And we talked about the new normal. The new normal at the moment is a messy set of negotiations, some unworkable proposals. That defines the last 24 hours, punctuated by a series of strikes, more strikes again this morning, and it keeps energy prices elevated. And that's the story in the energy market. As we count you down to the opening bell, 3 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with PayPal. Shares are soaring nearly 19% in the pre-market on takeover reports. Reuters is reporting that another fintech, Stripe, and a private equity firm, Advent, have made a roughly $53 billion deal for the company, which they will jointly own if the deal goes through. It comes as PayPal, the original fintech darling, has been struggling to turn around its business as new entrants enter the field. Meanwhile, we are seeing SK Hynix ADRs falling 6.7%, giving back some of yesterday's massive gains. The stock closed the day up about 27%. And what's notable is that at that point, the ADRs traded more than 50% above the Korean share price, an unusually wide gap. And the reason is because of strong investor demand here in the U.S., plus temporary restrictions that have prevented arbitrage traders from closing that gap. And we end on Lucid. Shares are sinking another 4.4%. 1% after a roller coaster session yesterday. That's because the company had to come out and clarify that it was working with restructuring advisors to turn around the business, not because it was considering bankruptcy. It called those claims completely false, but not before shares plunged as much as 57%, its worst intraday drop on record. John.
Yahara, thank you. Thanks for the update. More earnings still to come. Morgan Stanley in the next hour. BlackRock, Lisa went through the BlackRock numbers. Just fantastic results across Wall Street. BNY just dropping just moments ago. It's back-to-back quarterly revenue records for BNY. Lisa, one number that catches my eye. Assets under custody and or administration, 62.6 trillion. That is more than the estimate, and that is a record for this company.
Yeah, and it's versus the estimate of $61.3 trillion. I'm losing conception of the numbers here that we're talking about, but BNY is one of the biggest asset management companies and custody holders. Interesting to see that, again, they beat across the board with respect to net interest margin at 1.45% versus the estimate of 1.4%. Net interest income also beating. You just have to wonder how much people are already seeing these and then expecting even more. I am curious to see how the shares respond. Nonetheless, across the board, beat. That's what we've seen all of this quarter.
Stock is up by 1.2% so far this morning. On the session, on the year, it's higher by more than 30%. Later this morning, around 8:15 Eastern Time, we'll catch up with the CFO, Dermot McDonough, on the latest results. But Bramo, to your point, the weather's been fantastic, the backdrop is great, and execution across a number of banks in the last 24 hours appears to be tremendous.
Yeah, you can see that people are looking for things to worry about, and even the CFO of JP Morgan said, you know, look, of course we're going to look for things to worry about, but maybe we should also worry about being too worried, because ultimately we've seen these upside beats after upside beats. You know, people are trying to wring their hands and find holes in the story of capital markets prowess. They can't find them just yet.
This is all I can find. Jamie Dimon, it's getting as close as it is to as good as it gets, maybe, right? Like, that's the question right now on Wall Street. Is that it? Can it get any better than what we've just seen at some of these banks?
And then he goes on to say, we just don't know how long it's going to last, because nobody knows. So this is the place that we're all left in. Can this really remain the case for a long period of time?
That's as bad as it gets this morning. Is this as good as it gets? Things are pretty decent right now. BNY higher by 1.2%. Looking forward to catching up with the CFO later this morning. Morgan Stanley, those numbers drop in about an hour from now. On our radar this morning, President Donald Trump pledging to escalate attacks on Iran.
We're going to hit him very hard tonight. We're going to hit him very hard tomorrow night. We're going to hit him very hard the night after. And then next week it gets really bad for them, because next week comes the power plants. Next week comes the bridges.
The US launching a fifth day of strikes on Iranian targets this morning after resuming the naval blockade in the Strait of Hormuz. Elsewhere, Fed Chair Kevin Warsh saying cooling inflation data doesn't mean it's time to declare victory.
There might be some that look at this morning's data and say, oh, mission accomplished, everything is swell. That is not my view. The Federal Reserve can and will deliver price stability. We have the tools to deliver that.
The Fed chair facing the Senate Banking Committee later on this morning. And finally, ASML boosting its sales forecast for the second time this year. Surging demand for AI chips pushing Europe's largest company to aggressively scale up machine capacity.
Yeah, ultimately, it all is about hardware, and that is a story, the ASML versus the IBM. IBM highlighting the concern among a lot of software companies that money is going to be diverted away from their services toward the hardware of the world. ASML's beat, though, just to give you a sense, net sales will grow between 43 billion euros and 45 billion euros. That's up from the 39 to 43 billion or 40 billion that was previously expected. So just incredible beats as people continue to hoard some of this hardware technology.
And of course, this all comes as their customers just continue to line up. They say that their customers continue to, quote, accelerate their capacity expansion plans. So for them, that means ASML was also having to expand their capacity, and yet they were able to do it.
And this is a theme already, and it's an expected one, and it's capex for the few, not for the many. There's a lot of spending, a lot of capital raising right now, but the beneficiaries of that are a small group of companies. IBM's a fantastic example of this, and we talked about this 30 minutes ago. The phrase they use, capex reprioritization. That's the issue right now for everybody else. versus this handful of companies. Yes, there's a lot of money being spent, but only a few are receiving it.
It feels like it's a rolling ball of choke points, because on one hand, you see a prioritization of the hyperscalers and who has the best model. Then it was running to the large language models that could potentially disrupt them, the Anthropics, the OpenAIs. Then it was moving to the hardware and to the energy sector. Where is it going to go next? And that anxiety, I think, is underpinning some of the massive moves that we're seeing after these releases.
XML this morning higher by close to 4% in European trading. Let's talk about IBM losing a quarter of its value in its biggest one-day loss going back decades. Stefan Slavinsky of BNP Paribas keeping an underperform rating on the stock with a price target of 195, writing, "We believe IBM was not a canary in the coal mine for software, but more of a capex casualty, where its mainframe business suffered from capex crowd-out." Stefan joins us now for more. Stefan, welcome to the programme. Do you believe that's a one-off or an ongoing durable story for the time being?
Yeah, good morning. I think that was the confusion yesterday around IBM. I think we can understand the CapEx crowd-out justification, customers looking to spend on servers and memory ahead of even more price increases. But then IBM also did say that there were issues around cybersecurity. We assume that relates to the Mythos model from Anthropic and the Glasswing episode in Q2, where banks in particular, which are big customers for IBM, may have been distracted, may have prioritized more cybersecurity spending. And so that looks like it had an impact as well. And then IBM also called out execution, their own execution, which led to numerous deal slippages. So I think that caused a bit of confusion and nervousness. And as you point out, with the stock down 25% yesterday, there are a lot of nerves. And of course, even if there are justifications, investors also jump right to, is this something deeper around AI disruption? Is this finally the AI disruption of the mainframe coming? And you get those nerves coming through in the share price performances.
Stefan, even if you don't have some sort of bigger overriding existential thesis here, there is a question about the reprioritization and how long it will last. It isn't going away anytime soon, the investment in hardware and the investment in cybersecurity with new models coming out every single day. What's your sense of the timeline for when capital will get reprioritized back to the software names?
Yeah, that's the tricky question for this quarter in software. As you point out, we're spending on CapEx, we're spending on cybersecurity. When does it come back to maybe more traditional horizontal software? We saw the cybersecurity software stocks up mid-single digits, so they potentially are benefiting from this. We don't think this is the quarter that we see that reprioritization back to traditional platform software. We just published this morning our BNP Paribas global software reseller channel checks. They actually took a bit of a step back from April. The trend is still better than 24 and 25, but slightly weak. And I think that when you now have kind of a rekindling of the war in Iran, you're probably going to see companies continue to be cautious about the outlooks for Q3 and the rest of the year. So it's hard to see that reprioritization near term happening. And that's why investors are staying on the sideline for the most part for a lot of your traditional software stocks.
How much paralysis is there to get some of these bigger deals done just more broadly in the software space? Because a lot of companies are wondering, can we do this with our own staff, given some of the new advancements in large language models?
Yeah, so that continues to be a debate, which is the DIY AI, the do-it-yourself AI. Of course, you've had more recent discussion around pushback around token maxing, moving to token optimization, token capping, as we've discussed before. And so potentially some pushback on the OpenAI and the Anthropics and what they're charging. And so, you're seeing Microsoft, you're seeing Amazon, you're seeing some of the more traditional software and platform providers trying to step in and say, look, this is not something that you can just do yourself working directly with these models. That's complicated. There's lots of risks, right? We saw Satya Nadella over the weekend, with his essay around the risks of working with these AI models. We saw Demis Hassabis yesterday talking about the need for regulatory framework around AI. And so, all of that is certainly some of the big players talking their own book and trying to push their customers back into their ecosystems to do this work.
Well, IBM was pushing the money elsewhere. CrowdStrike yesterday rallied by 12%. Closed at a record high, on the line out of IBM that customers were distracted by cybersecurity. Stefan, my issue with IBM yesterday, and my issue with a lot of companies when they report earnings, was trying to work out what's real, what's an excuse. Was that real? Is that what you see too?
In our survey we published this morning, cybersecurity was #1 in terms of prioritizations last quarter, but it usually is. Most people usually say cybersecurity is our #1 priority. So that's really the first that we've heard of this in the quarter. Again, it may be skewed for IBM because they are dealing with the banks. That's a big customer base, and that's where you probably had the most of those concerns. But we do think that certainly was an issue in Q2, will continue to be an issue, as you said. Today, we've highlighted companies like Microsoft, which is actually the largest cybersecurity company in the world, and also a ServiceNow, where they perform quite well in our results. In our survey, they just closed the Armis deal back in April, so they now have more of their own cyber and more security business, and they're starting to hit some easier comps in terms of U.S. federal, where last year you had the Doge effect and the government shutdown effect, and of course those ease. So we do think cybersecurity is a durable growth driver for the pure plays, but also some of those other companies I just mentioned.
Stefan, it's good to see you. Thank you, sir. Stefan Slavinsky there of BNP Paribas. Thank you. CrowdStrike don't report until the end of August, so we'll wait for those results to see just what happened last quarter.
Yeah, and whether it really is as a result of the big banks getting incredibly spooked by what they saw from Mythos. And just anecdotally talking to bank executives, there were weekly meetings with the top bank executives of the biggest banks for the first time since the financial crisis about this. I mean, it was really a major issue. So clearly there is something real. How much of this is also execution also is a key question.
Nasdaq futures this morning higher by 0.4%. Equities doing OK. Let's give you an update on news worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. BNY reporting second quarter earnings that beat Wall Street estimates across the board, boosted by record sales and revenue. And coming up at 8:15 Eastern, we'll be speaking with BNY CFO Dermot McDonough. BlackRock shares rising in the pre-market, second quarter earnings beating estimates with assets under management topping the $15 trillion mark. BlackRock also seeing record net inflows in the first half of the year. Bank of America releasing its fund manager survey for July, finding investor sentiment remains more bullish on a macro boom, AI capex, and they have dovish Fed expectations in the main. More than 80% of investors surveyed find going long global semiconductors is the world's most crowded trade. And that is your Bloomberg Brief. John.
I'm shocked. Bonnie, thank you. Appreciate the update. Seriously bullish one out of the fund manager survey from Bank of America this morning.
Nobody thinks there's going to be a recession. 2% of the people surveyed believe that there would be a hard landing, though most people on record believed that there was going to be no landing. Welcome to the recessionless nirvana that we're all living in, evidently.
It's crazy low, isn't it? Those expectations, just crazy. Up next on the program, mission not accomplished.
I reviewed the data on CPI, and I'm not going to show up here and say mission accomplished. The reason I create a task force on data is I don't want to overread or cherry pick data.
Up next, we'll catch up with Krishna Gua of Evercore, live from New York City. You're watching Bloomberg Surveillance.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, the network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Stocks are doing okay. Busy morning already. Equity futures positive by 0.1% on the S&P 500. Very bullish fund manager survey out of Bank of America. More bullish on the so-called macro boom on the Nasdaq high this morning by 0.4. Let's talk about some earnings. Numbers out of BlackRock that started our morning. AUM was at 15 trillion. Crazy numbers out of BlackRock this morning. The stock is up by 2.5%. BNY, more records there too. Back-to-back quarterly records for revenue, profit great as well. The outlook better. Beating a raise from them. They're looking for total revenue up by 10 to 11% for the year. They had seen it at about 5%. So again, Brammer, it's another morning of it, kind of like yesterday.
Just to give some perspective on the assets under management for BlackRock, 2 years ago, in the second quarter of 2024, the assets under management were $10.6 trillion. They have increased to Microsoft in that period of time in terms of their assets under management, about $5 trillion of assets added, just to give you a sense of the momentum underpinning some of these numbers.
BlackRock this morning higher by 2.5%. Need to turn to what's happening elsewhere in the energy market. Brent and WTI pushing a little bit higher so far this morning. This came from US Central Command earlier on, that at 6 a.m. today, so 50 minutes ago, US Central Command forces began launching a wave of strikes against Iran, another wave, and that's just this morning.
That's just this morning. The president said yesterday in an interview that we'll also have more strikes this evening, potentially, and then he even said it can go on to things like power plants and energy at some point. That'll be the last that get hit, maybe even bridges. So potentially more civilian infrastructure, which would be very controversial. CENTCOM just told us that at 6 o'clock they're doing this, but later today, hopefully we'll get a list of the targets.
Brent crude right now at 1%. The pressure still building on this Federal Reserve. Under surveillance this morning, mission not accomplished.
I reviewed the data on CPI, and it was positive relative to expectations. I'm not going to show up here and say mission accomplished. There's plenty of work to do. The reason I created a task force on data is I don't want to overread or cherry pick data.
So here's the latest this morning. The Fed Chair, Kevin Warsh, preparing for a second day of testimony on Capitol Hill. Warsh vowing before Congress to curb inflation. Krishna Gua of Evercore writing, Warsh's comments plus June CPI make us more confident in our base case call that the Warsh Fed will narrowly avoid raising interest rates this year before cutting once next year. Krishna joins us now for more. Krishna, you're a very well-followed Fed watcher. What did you learn yesterday?
A few things. First, I thought Kevin Warsh was extremely accomplished and effective in dealing with Congress, reassured in particular on Fed independence, was not seen in any way as partisan. Second, I think it's what he didn't do. He didn't start to prepare the ground for a near-term rate hike, but he certainly didn't rule anything out as we look further out. Third, he drew attention back to the balance sheet, and I think that's a reminder that there's still a lot to come, not immediately, but a lot to come over time on the Fed balance sheet from Warsh.
Krishna, how much power do words have after a while if there is no action? And this is something increasingly people are asking as they are trying to glean whether or not there'll be a rate hike or just a rate hold, yet seem to have faith that they're going to bring inflation down.
Yeah, so I think Kevin Walsh has come out the gates making very strong statements about credibility, about the Fed's commitment to bringing inflation lower. Whether he has to then operationalize that by raising rates is a close call. My hunch is that he is at least putting some space between these two. Assert the credibility first, observe the inflation data over the summer, see if it's starting to move the right way. But I think if it's not, he's going to get called at the September meeting and we'll have to go through with a hike. We don't see that in our base case. Why? Because we think the inflation outlook is starting to turn, but it's very close. And I certainly don't think that you can rely on statements of credibility only without action if the data doesn't cooperate.
Even if he doesn't want to give guidance, we are hearing from the Fed's Williams, Cook, and Musalem today. We have continued to hear rosters of Fed officials speak. How do you understand their words? Are they as relevant? Are they more relevant? Are they less relevant?
I think the unfortunate reality is that when the Fed chair refuses to discuss his strategy in any detail at all, then that creates a void. And that void is inevitably filled by comments from other Fed officials. But there's a higher ratio of noise to signal because you can't be clear exactly who is speaking with authority for the committee. I don't think this is helpful, and I do hope that over time, Walsh will be willing to flesh out his strategy some more.
Krishna, yesterday he said his commitment and the entire committee's commitment is to take sticky prices and unstick them. How can he do that without a hike?
Yeah, that was not a phrase that I thought was particularly well unpacked, let's say. Look, I actually don't think that the US does have a sticky inflation problem right now. If it did, I would be calling for rate hikes. I think the reason inflation is continuing to run several clicks above 3% on core PCE is because you have 3 one-time waves rolling through on top of underlying inflation. That's tariffs, oil, and the peak AI capex cost spillovers. That's keeping inflation high. It's the very opposite of sticky inflation because, of course, these are different things, rolling in, peaking, rolling off. But let's take Walsh's formula. Suppose they are sticky. How do you unstick them? Well, I guess in theory, you could have some shock to expectations, reassurance about the Fed, so powerful that people no longer anticipate and factor in somewhat higher inflation. But as you indicated earlier, I think the idea that you can shock expectations to unstick sticky prices without moving rates and potentially, not just once by any means, I think that seems a bit far-fetched.
Krishna, it's good to catch up. As always, thank you, sir. Looking forward to day 2. Krishna Guha there of Evercore. It sounds more and more like an argument to hold rates and not hike. When they say that inflation is above target and we won't tolerate it, I guess at that point, it means we're not going to cut. Doesn't mean we're going to hike.
Right. Well, that's essentially what people are interpreting this as. At a certain point, though, you're not going to tolerate it, but it's been there.
Right, for 5 years.
For 5 years.
You have been tolerating it.
And you're continuing to tolerate it. So, again, lots of questions.
Looking forward to day 2. Are you? Yeah.
Oh, very much so.
In front of the Senate Banking Committee later this morning. That kicks off at 10 a.m. Eastern time.
Argentina versus England.
That kicks off a little bit later, unfortunately.
You can make both.
If it was at the same time, I don't think there'd be much of a side-by-side there, Bram.
Exactly.
I think it would just be one screen. Kevin, of course.
Yeah, exactly.
Up next, Cam Dawson of New Edge Wealth, General Robert Walsh of Academy Securities, Joe Cassidy of RBC, Jill Ford of Wells Fargo.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
We think inflation actually is coming down.
Overall, we don't have an underlying inflation problem.
This print does suggest that there's reason to believe that cools down in the second half of the year.
The Fed should act with even more force in order to reinstate that level back to 2%.
I don't think that the Fed chair has a lot of power to limit the ability of people to talk about their outlook for monetary policy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures on the S&P 500 firmer by about 0.1%, up by 0.5 on the Nasdaq 100. The earnings coming out already this morning. BlackRock, record AUM. BNY, record assets under administration. BNY this morning down about 1%. BlackRock higher by 4.3%. The AUM, $15 trillion for the first time. Crazy numbers coming out of that bank. A little bit later, we'll be talking about PPI. That drops later this morning. Your bond market set up as follows. 2s, 10s and 30s. Yields still elevated in the bond market. Your 2-year at about 421. 10s at 460. When PPI drops at 830, that should set the stage for Chair Walsh, day 2 on Capitol Hill, going in front of the Senate Banking Committee.
Or will it? Because yesterday we got that CPI that came in weaker than expected, a bigger decline than expected, and he said mission not accomplished. Essentially, 1 month of data isn't going to change our view that we will not tolerate above 2% inflation. Of course, they have tolerated it, and they are going to continue tolerating it, considering the fact that July is not going to be a rate hike. Nonetheless, we are expecting to hear maybe some questioning that gets him to elaborate a little bit. I don't know. I wasn't that excited about these because I didn't think that anything would actually come out of them. And so far, I mean, essentially, there's a task force for what he's going to talk about.
Well, what did the heavy lifting for him yesterday was actually the softer CPI. And what helped CPI was, of course, that gasoline prices are down some 10% on the month. The issue potentially the Fed is going to have now going into the summer is that we have fresh strikes. Last night, the U.S. military ended at 10 p.m. Again this morning, 6 a.m., they started strikes again on Iran. All of this is going to continuously add to the geopolitical risk premium you're seeing in oil prices.
Well, let's talk about what the strikes were for. So this came from U.S. Central Command about 1 hour ago. They said the strikes are designed to further degrade military capabilities Iranian forces have used to attack commercial shipping in the Strait of Hormuz. This is the issue for me. Whether you pay for it, whether you invest in America or not, do we have the capability right now to help that energy flow through that strait?
Well, at the moment, what the IRGC has been able to prove is that they can go after some vessels that are going along the U.S.-supported protected route. Last night, when CENTCOM came out and said they finished some of their strikes, they went after things like fighter aircraft drones and naval vessels that launch precision munitions against Iranian missile and drone sites, naval capabilities, coastal defense system. So they are trying to degrade all of these assets Iran has at their hands that go after those vessels. How long is it going to take? We don't know.
You know, there's an interesting divergence right now. On one hand, you're having oil traverse through the Strait of Hormuz and traverse through pipelines that have been created. You're not seeing natural gas. Some of the refined products also getting hit much harder. If you take a look at diesel prices, they've continued to inflect a lot higher than, say, just gasoline or Brent. And you start to wonder, what about helium? What about these other assets? For gasoline, it seems like that is getting through, or at least for oil, that is getting through enough to ameliorate some of the bigger concerns that were present earlier this year.
Brent crude around 85 so far this morning. Coming up this hour, we'll catch up with Cam Dawson of New Edge Wealth on the sky-high bar for earnings. We'll speak to General Robert Walsh of Academy Securities, warning that the war has reached its most dangerous phase yet. And finally, we'll speak to Gerald Cassidy of RBC as Morgan Stanley aims to cap off a record-shattering week for the big banks. Morgan Stanley reports in the next 30 minutes. We begin this out with stocks adding to gains following strong results from ASML, reigniting confidence in the AI trade. Cam Dawson of New Edge Wealth writing, given high expectations, there is no room for error in 2Q26 results. Cam joins us now for more. Cameron, good morning.
Good morning.
What's the lesson of the last 24 hours with regards to these earnings stories?
Yeah, if you beat, you get rewarded maybe a little bit. If you miss, you get punished a lot. And I think that we'll continue to see that outsized punishment of misses simply because the bar is higher. We have to appreciate that 2Q earnings bar is so much higher than what we had in 1Q. 1Q, you went into the quarter expecting 9% growth and you got 29%. This quarter, we're going in expecting 23% growth. And importantly, you've seen that number for 2Q earnings move up through the quarter. Typically, you see estimates get cut through the quarter, but instead, estimates have gone from 18% to start 2Q and now sitting at 23%, which just means, again, you have this higher bar that companies will have to jump over, and if they don't, they will get outsized punished.
When I hear things like that, I think the right question is to say, typically I'd ask you, what do I want to own? Sounds like I need to ask you, what should I avoid this earnings season?
Yeah, I mean, it seems to be that you want to avoid places that have not had good earnings momentum, and you want to continue to be in places where there is potential for further upside. The challenge or further upside to earnings expectations, the challenge is you've raised forecasts so much for those areas. The SOX earnings forecasts for 2027 are up 72% this year. 72%. How much more upside is there to those estimates? And what we think is most important coming out of 2Q is not what happens in 2Q, but what does that mean for 26 and 27 estimates? 27 estimates and 26 estimates are up about 14%. That's why this market's been resilient. That's why we've been able to throw so much negative headlines at the market and have it continue to trend higher. So for this bull market to continue, we think we need to continue to see that uplift to 26 and 27.
One of the confusions has been how concentrated this has been completely in the AI trade versus a broader-based type of expansion. What we heard from the banks yesterday was that consumers are doing really well, that you're not seeing any deterioration. If anything, it's a reacceleration. Then you also are seeing the tech side of things, at least in the hardware, continue to outperform. Are both performing well, or is it more isolated to AI?
66% of the names in the S&P 500 are above their 50-day moving average. You have an advanced decline line, which is just a way to capture how many stocks are participating in the bull market versus not participating in the bull market. That's hitting new highs. So that suggests that it is not just an AI story. Now, because the gains and returns have been so powerful within AI infrastructure specifically, that has been the bulk of the earnings growth and the bulk of the upside surprise. But that does not mean that you're not seeing other areas of the market see earnings revisions move higher. You've seen about a 10% increase to earnings revisions for the equal weight S&P 500 this year. So again, it's not just the cap weighted index benefiting from these AI names, but you're starting to see it in the average stock as well.
So how do you explain Pepsi? Because Pepsi's sort of the outlier in all this. And John came back to me yesterday. They said, what about Pepsi? And it's cherry picking season. You could talk about Pepsi and the fact that consumers are pushing back and that they're much more discretionary when it comes to how much they're willing to spend. Which side of that story potentially is one to watch more?
Yeah, consumer discretionary and consumer staples are two sectors that have seen negative earnings revisions as we move through 2Q. But I think what's fascinating is that if you add up both of those sectors within the S&P 500, it's still smaller as a weight than the semiconductor industry group. So the industry group of semiconductors is a 19% weight in the S&P 500. You put staples and discretionary together, it's just 18%. So that's why this market is just so bifurcated, that yes, there is pain within the consumer because you still have elevated gasoline prices. They're still 80 cents higher than they were prior to the war. However, on a weighted basis, it doesn't matter as much as the absolute boom in earnings you're seeing within semiconductors.
How long is this going to last? Jamie Dimon's question yesterday.
Well, I think that is the ultimate question when we think about the semiconductor trade. It's not whether or not the earnings are strong today. Look at ASML. The earnings are incredibly powerful. It's how long it can last. And the thing about these businesses is that there's so much operating leverage in them. Earnings or overall revenue growth for semiconductors will be up 35% this year, but earnings will be up 135%. Last year, you had EBIT margins of 16% for the semiconductor group. Now they're going to be 44% this year. So yes, it's great when you have top-line revenue growth, but the warning story is that if you see top-line wobble even a little bit, you go from having incredibly powerful incremental margins to really painful decremental margins. So the question is whether or not you see a peak in revenue anytime soon and you see that deleveraging.
26 years ago, if we were doing the program then together, we were all much younger, we'd be asking the question whether there was a bubble in price. 26 years later, Liz Ann Saunders at Charles Schwab is asking the question whether there is a bubble in earnings expectations.
Yeah.
Do you think there is?
Well, I think that the definition of bubble is really fascinating because what we see it as a pull forward of either price action or earnings power capacity, which means that right now you're seeing so much earnings growth within these semiconductor names that it's a question of how sustainable they will be. And I think the biggest challenge that you have is that the prices of the stocks will peak before the earnings. If you go back to that time in 2000 when we all were a lot younger, what you saw is that the prices peaked 12 months before earnings peaked. So you're going to have a 12-month period potentially of cognitive dissonance where the earnings are going to be incredibly powerful, but the prices will be flat to down. An understanding of whether or not you should be selling rips or buying dips is going to be the ultimate question as we move through that period. And I think that's where we have to use the technicals to be our guide. If we start seeing things like lower highs, unable to take out prior highs, that could be a sign that the market is thinking that we're nearing a peak.
I've got to ask you the impossible question then. Are we there right now? Do you see that in any way, shape or form?
I don't think that we can make that call yet. I think it is an innocent until proven guilty. If you look in the last 3.5 years, you've seen 6 corrections of 15% or more. And each of those corrections have been great buying opportunities because people have been underestimating the earnings power. Just look at 2026. Earnings estimates were 50% too low for the stocks at the start of this year. So it is very possible that you start to see some more churn. People start thinking that 27 is the peak, but the question is there any evidence that we're seeing that? And I don't think that there is yet.
Cam, it's good to see you. Thank you. Cameron Dawson there of New Edge Wealth on the earnings and the price of the earnings right now.
Yeah, you know, there's a question of who's going to pay for this, right? We talked about the transfer of wealth from the hyperscalers to the semiconductors. Well, the transfer of wealth has gone so far that people are starting to push back. Who is going to prove that they have enough return on investment from deploying some of these large language models to pay the high price versus, say, being cost constrained, which you're hearing on a lot of calls from earnings, particularly from companies in the banking sector.
Heard it from the banks yesterday,
exactly,
yeah.
JP Morgan.
Rationing use.
Exactly.
Don't use it for the easy stuff.
Yeah, just try to be mindful of exactly where you use and which models you use. And you hear this more and more, even cutbacks to their overall budgets because they're not necessarily able to cut staff or create other efficiencies elsewhere.
Humans are cheap, Bramo. There you go.
God,
right?
That makes me feel great.
Ask for a raise.
They are, yes, especially if you work in some of these industries. That's the reason why people are worried about expenses.
Sales and trading in the last quarter, without a doubt, right? I mean, come on.
They're feeling their worth right now.
Huge bonus coming at the end of the year.
I mean, that's the reason why also Richemont's doing so well.
Oh, because they're spending already.
Cartier.
Going to the watch store straight afterwards.
Actually, a lot of the jewelry in Cartier is doing very well.
Futures this morning up 1/10% on the S&P. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. U.S. Central Command saying it began a 5th day of strikes against Iran at 6 a.m. Eastern this morning. President Donald Trump saying the strikes will intensify until Iran agrees to open the Strait of Hormuz. Iran retaliating against the U.S. overnight, hitting bases in Gulf Arab states. OpenAI is developing its first device. Sources telling us here at Bloomberg it is a screenless, mobile smart speaker with integrated AI capabilities. Plans for the device have been complicated after Apple filed a lawsuit accusing the AI developer of stealing trade secrets. SpaceX shares are on the verge of falling below their IPO price. Shares of Elon Musk's company closing $1 above their $135 a share IPO price yesterday. The stock has plunged a third from its post-listing peak, raising nearly $850 billion in value. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next on the programme, threatening escalation.
I'll save the energy targets for last, but ultimately we'll hit energy targets. Next week it gets really bad for them because next week comes the power plants, next week comes the bridges.
Up next, General Robert Walsh of Academy Securities, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Futures positive by a tenth on the Nasdaq. We're up by about 0.5. In about 15 minutes' time, we'll hear from Morgan Stanley. The numbers so far, fantastic for the financials. BlackRock early this morning, record AUM north of $15 trillion over at Larry Fink's shop. Robin Vince of BNY doing well as well. Record quarterly revenue for a second consecutive quarter. The stock is down by about 0.75% on the session. It's higher by more than 30% on the year. We'll catch up with the CFO, Dermot McDonough, a little bit later this morning, in about 60 minutes from now.
Yeah, just to give you a sense of how good the big bank earnings have been so far, total trading revenue generated by the 6 largest banks in 2019, or actually last year, was $13.5 billion. With Morgan Stanley, it's expected to surpass $25 billion so far. Just to give you a sense of how much they have expanded. And BNY is no stranger to that kind of dynamic, also expanding their assets under management. It truly has been a blockbuster quarter.
The numbers have been absolutely fantastic. More still to come. Morgan Stanley in about 15 minutes' time. Let's turn to crude. Energy this morning, Brent's higher by 0.9, 85 on Brent, WTI at 80. Under surveillance this morning, threatening escalation.
I'll save the energy targets for last, but ultimately we'll hit energy targets, yeah. But we're going to hit them very hard tonight. We're going to hit them very hard tomorrow night. We're going to hit them very hard the night after. And then next week it gets really bad for them because next week comes the power plants. Next week comes the bridges.
So here's the latest this morning. U.S. Central Command saying the U.S. launched a fresh wave of strikes against Iran at 6 a.m. this morning. The president vowing to continue the attacks if Tehran doesn't come to the negotiating table. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, CENTCOM confirmed that this latest wave of strikes launched within the last hour are focused on degrading Iran's ability to target commercial shipping amid very little indication that Iran is willing to back down at this point, as the IRGC said in a statement overnight to Iranian state TV that the Strait of Hormuz will remain closed for now. Now, we did get an update from the International Maritime Organization, a UN body that helps to oversee the traffic in the strait, speaking to our colleagues on Bloomberg Radio earlier today, saying that they have deemed the strait too dangerous to transit, including the fact that we have seen some of those ships that have turned their transponders off even be hit by Iran in recent days. Now, today marks the 5th straight day of U.S. attacks against Iranian assets as President Trump renews his threat to hit critical infrastructure if Iran doesn't come to the negotiating table by next week. He mentioned power plants and bridges, but as you heard, he said that the U.S. would save energy targets for last. What is clear is that the U.S. is trying to prioritize that economic pressure at the moment when it comes to reimposing that U.S. naval blockade, even if it moves forward without that plan for that 20% reimbursement fee. But John, our analysts at Bloomberg Economics estimate that it costs the U.S. military between $31 and $45 million per day to keep that blockade intact, which is raising questions about U.S. resources and stockpiles, which President Trump is expected to address in remarks later today here in Pennsylvania.
Tyler Kendall with the latest. Tyler, thank you. Appreciate it, and looking forward to your coverage later on today in Pennsylvania. The words of the president: next week, it gets really bad for them. General Robert Walsh of Academy Securities writing the conflict has entered a more dangerous phase than at any point since the initial outbreak earlier this year. This is becoming an economic contest as much as a military one. General Walsh joins us now for more. General, some people might be surprised by that statement, that this is worse than what we saw through March into April. For you, sir, what makes it worse?
Hey, good morning, John, and thanks for having me today. I think what makes it worse is we went into a period of negotiations where we thought there would be an agreement. We had a memorandum of understanding. The key pieces to that was the U.S. would stop the blockade, which we did, and Iran would open up the Straits of Hormuz, and that didn't happen. And Trump really was trying to get to negotiations, to get to a deal, and now that's all broken down, and you saw now that he's escalating the U.S. reaction to this, taking it to a much higher level. And I think that the challenge really right now, which makes it more risky, is that there really is no signs that the negotiation is going to start. He's going to put the economic pressure, as you see with the blockade restarting. The sanctions are now reinstituted, and now just much more military power going at strategic sites now to kind of open up, number one, open up the straits by not allowing Iran to hit commercial shipping. And the other one is to hit the ballistic missile sites that cause the ability of Iran to retaliate against U.S. bases in the region and also our Gulf state partners.
General, you heard the president, though, also talk about potentially going after civilian infrastructure, energy, bridges. Do you think that's a credible threat?
Anne-Marie, I think, sometimes when you get to this point, I mean, obviously we're trying to open up the Straits of Hormuz. That's the military tactical problem. But you also see that Iran is willing, the IRGC leaders are willing to take a lot of pain. So now you have to ratchet up, you have to escalate to bring more pain to them. And one of the ways to do that is start going after the infrastructure targets. Things like the president mentioned, bridges that are dual use, bridges that can supply the military bases. If you look at Iran's terrain, it's a lot of mountains and gorges. They have a lot of bridges that resupplies them. By cutting that off, it not only causes problems for their military, but it also causes problem for their infrastructure, civilian infrastructure, and it just starts to get so painful. The infrastructure grid and hitting their oil capacity at Cargill Island, which President Trump said he would hold off on for now, those are type of targets that he wants to get to the point where if there was a regime change, we would like to be able to go in there and help Iran rebuild and not have lots of massive damage caused by some of the attacks we would do. So I think he's starting there, ratcheting up this escalation, trying to bring pressure on the IRGC. And this right now is turning into an endurance campaign. This is now, can we extend this, this campaign? How long can it go? The president just told Congress that he was going to extend this now for 60 more days, start that clock on July 10th. Iran would like to take this and extend it right through the midterms and cause the president lots of political problems. So I think that's the endurance situation we've got going on right now. Iran wanting to continue, Trump wanting to really put the pressure on them to bring them back to the negotiating tables, to negotiate in fairness, to open up the straits and have the discussions on the nuclear capabilities.
How would you characterize this moment we're in? Because it's certainly not a ceasefire, but the president will stop short from calling it all-out war.
It's certainly the continuing of the conflict. It's not in the same heightened phase where we were earlier in the first phase, that ended back on April 8th when we were hitting targets all across the country. This is now much more focused on, hitting the targets that would cause the straits to close or put risk on commercial shipping. So it's a very focused phase on the Straits of Hormuz. But now the president is starting to open that up a little bit more with this escalation of now being able to hit infrastructure targets, he said, starting next week. That would start taking it now from the phase of just focusing on the Straits of Hormuz and opening it up to more of a strategic campaign to bring pressure to the Iranian government by hitting some of those more strategic infrastructure targets.
General, how unified are the Iranian leaders, given the fact that it seems like the U.S. is struggling to negotiate with one voice? It seems like that was one of the sticking points, and the flipping and the flopping. In other words, can negotiations be a solution to this when it's unclear who the parties are doing the negotiating?
Yeah, Lisa, it's a great question. We're trying to really see how that is all playing out, but it's obviously the political leaders that are making these deals have no control really of what the IRGC is doing. So it almost seems to be the point you have to deal with the IRGC, because whenever you come to any type of agreement with the political or diplomatic negotiators, it unravels very, very quickly, and none of the negotiations have stayed intact. So I think the key thing here is now trying to bring pressure on the IRGC, taking away their power, their tools, the things they use to be the predator of the region that they've been so long, not only attacking the Gulf states, but also resupplying their proxies throughout the region. That's what's allowed them to be the predator. That allows them to intimidate and coerce other nations. That's what they want to do, and that's where they see the strategic capability of closing the straits now allows them to be even more of a predator in the region. And that's why I think the key thing now is to bring pressure on them to see if you can get that. This is going to be very difficult, and it's going to be hard to see whether, President Trump can do this in the 2 months, because he's got about 2 months, not only the 60 days he's told Congress, but he's probably got about 2 months till we start getting close to the midterms, and the IRGC knows that. So now it's how much will he ratchet it up, how much pain can he bring to them to see if he can bring them to the negotiating table.
General, we appreciate your insights, sir. As always, thank you. General Robert Walsh there of Academy Securities. Bramo, you nailed it, and that's what makes this so messy right now.
How do you get to a solution if negotiation's your ultimate goal, if there isn't a reliable person you're negotiating with? And we've heard reports about how one deal is struck, then the IRGC doesn't agree with it, then it gets revoked. People internally trying to struggle for power. It's a very difficult moment. How does this get resolved? There isn't an easy pathway in sight.
The attention turns to Wall Street. More earnings, this time from Morgan Stanley. So far this morning, BlackRock, record AUM, BNY, record revenue. Numbers from Morgan Stanley up next.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ola, Saudi Arabia, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
So the story so far this morning for bank earnings. BlackRock, Wall Street, record AUM for them north of $15 trillion. BNY, record revenue. We saw this yesterday as well. JP Morgan, record revenue. Bank of America, record stock trading. Goldman Sachs smashing Wall Street records. So when you get to Morgan Stanley, you're not expecting anything different. This is what we got. Wealth management for the second quarter, net revenue $8.86 billion. The estimate, $8.68 billion. The B, equity trading revenue, $6.3 billion. The estimate, $4.47 billion. They smashed it too. The stock is higher by 1.5% on the session, on the year, up by about 30%.
Yeah, so right now, all the trading volumes coming in well north of $25 billion for all the major banks, led by equities trading. All of that rotation under the surface, the paddling duck that Amy Wu Silverman of RBC talks about, has been a complete boon for the banks, particularly those that have been on the underwriting side of a lot of these IPOs and share sales in general. Morgan Stanley and Goldman Sachs together have generated some almost $14 billion of just equities trading revenue for this quarter. The number is absolutely shocking. Record across the board.
Notable equity trading strength in Asia. Was that South Korea? No, I'm just guessing here.
The instability that will never stop giving. It seems like that would be a likely candidate.
I think it's the right kind of volatility for some of these businesses right now. What a backdrop for those particular firms. Beats across the board on Wall Street. That name Morgan Stanley just a little bit softer. But that was the story yesterday as well. A bit touch and go. That some of these beats weren't really rewarded in the way you'd expect them to be. But the gains we've had so far this year, the bar was already very, very high. Goldman did get rewarded later on the day, so we'll see if this move sticks this morning.
Yeah, Goldman had one of its best post-earnings trading days in years, up 9% at the end of the day. A question, though, a couple of questions that Ted Pick will be answering this morning, I'm sure. Provisions for credit losses actually came in a little bit above. Expectations still below $100 million, so nothing to write home about. And fixed sales and trading, we had seen a couple of underperformances there at other banks, also coming in just a little bit light at $2.46 billion versus $2.56 billion. These numbers are massive, so it's not exactly as if, this is some sort of miss or loss. The forward look about the pipeline, is there the same kind of resilience and confidence that this could continue for a longer period of time?
I think it's fair to say that Ted Pick won't lose any sleep over that move this morning in the pre-market. We're down by about 0.1%. To your point on the pipeline, we heard this from Brian Moynihan at Bank of America. The pipelines remain strong. We heard this from David Solomon. Our backlog increased to its highest level in 5 years. So there's a lot more business still to execute for the year ahead.
Yeah, and that wasn't just Bank of America. Also, we heard that over at Goldman Sachs from David Solomon, over at JP Morgan, a similar kind of tone. And that's the reason why even Jamie Dimon, who's looking for all of the potential risks on the horizon, saying we have no idea when they'll arrive. But it seems like this can't last forever. Nonetheless, right now, as far as they can see, things look pretty good.
Futures this morning positive by about 0.1 on the S&P 500, on the Nasdaq 100 higher by, let's call it, 0.5. Let's get you a wrap of the morning movers. Some single names. Yahira has more. Hey, Yahira.
Hi, John. Well, we'll stick with the financials because we are seeing BlackRock shares rising 4% after it delivered a blockbuster quarter. It attracted $192 billion in client assets, pushing its assets under management to $15 trillion for the first time ever. Earnings also beat expectations, helped by strong demand for ETFs, active strategies, and private markets. Meanwhile, just like we saw yesterday with some of the big banks and today with Morgan Stanley, banks are not necessarily getting rewarded for beating earnings. BNY shares are down nearly 1% in the pre-market despite posting a profit beat and record revenue. But the stock, like many of the others, had already been on a huge run. Just yesterday, it hit a record high, so expectations were clearly high for this name and have been for the rest of the financials. And we end on PayPal, those shares soaring 20% in the pre-market on takeover reports. Reuters reporting that Stripe, another fintech, and the private equity firm Advent have offered to buy the company in a $53 billion deal. If it closes, the two would own it jointly. It has been, as PayPal has been struggling as other fintechs enter the market and take over this, the darling, the original fintech. John?
Yahara, thank you. Stock is higher by 20%. Let's turn back to our top story on Wall Street. Wrapping up bank earnings, Morgan Stanley adding to a record-shattering week for the big financials. Jared Cassidy of RBC joins us now for more. Jared, welcome back. It's good to cover this stuff with you. Let's start with the good stuff. Let's start with equities trading revenue at $6.3 billion against an estimate of $4.5. Jared, why has the backdrop been so good for that particular part of the business, not just at Morgan Stanley, but across Wall Street?
You're absolutely right, John. Across Wall Street, the trading revenues in equities has been extraordinarily strong. And there's a couple of factors there. First and foremost, the volatility in the markets, obviously coming out of February with the conflict in the Middle East and what has happened with the price of oil. That is one factor. But the other factor, too, and you guys have talked about it on the program, is the strength in the tech sector, especially linked to AI. And when you think about the semiconductor stocks, what they did in the second quarter in performance was extraordinary. And this all showed up in the equity trading numbers. Volatility is good for equity trading. And what we saw with the tech sector was another contributing factor why you're seeing such strong numbers.
Ted Pick, no doubt, can speak for himself a little bit later this morning on the call. But this is what we heard from Jamie Dimon of JP Morgan. It's getting as close to as good as it gets. Jared, is it fair to say this might be as good as it gets for some of these names?
John, you're absolutely right. The numbers are very, very strong, and this is probably as good as it gets. We won't know for certain, of course. We'll look back 2 years from now, if you and I are chatting on the program 2 years from now, and we might say, my gosh, the SpaceX deal, the IPO was the top of the market for equities. We just don't know, but it is still strong. We're not expecting it to drop off, but seasonally it will slow down, of course, in the third quarter, but it's still a very robust market.
So how much can you take forward in terms of forward pricing, given the fact that we're seeing share buybacks across the board, dividend increases, and just, yes, maybe we'll see a bit of a deceleration. But just to throw this at you, the 5 biggest U.S. banks reported a combined $50 billion just from their trading revenues in one quarter. That's more than a third of all trading revenues last year from these banks. I mean, is that enough to get you excited about these names, even if there is a slight drop-off in acceleration?
Lisa, it's a very good point, and we have to look through the valuations relative to expectations. And you're right, the stocks have had very good moves, and they're trading at very rich valuations. Morgan Stanley's over 4 times tangible book value. Goldman and JP Morgan are over 3 times tangible book value. So you really have to expect for these stocks to really work going forward like they have in the past 18 months. You have to expect that these activity levels are going to continue, and that could be a big ask.
At this point, there seems to be a little bit of nervousness, and I stress a little bit of nervousness on the part of investors that there is an overbuild going on in the AI space and that maybe they don't want to back anything and everything related to a data center, at least not without some pretty strict terms. Is there any sense of how much that could potentially crimp activity heading into the remainder of the year?
It's a good question, and I've been asking that question on the earnings calls that we had yesterday. We'll likely ask that question today. How do we frame out the impact that AI is having on not just the markets, but the economy? And I don't mean just the building of data centers, but the whole ecosystem of AI. How is it impacting? It's enormous. And I haven't received a a good quantifiable number to say it's a third of the business or anything like that. But that we have to keep in mind because we know it's a boom cycle for AI, and eventually it will slow down. Not over the near term, but eventually it will, and will have an impact on the capital markets businesses.
Well, in just a moment, we'll be talking about the amount of equity supply, Jared, that we've had in this market. Coming to market, Alphabet with a monster equity capital raise. We had one from SpaceX with a record IPO, SK Hynix, the biggest ever first-time issuer from a foreign company. All of that in the last month. Jared, there is a question, still an open one, as to whether we will see the likes of OpenAI follow anytime soon, or whether we started to see some crowding out appear that would push these deals back a little bit. Jared, what are your thoughts on that?
It's interesting, John, because if you look at the wealth of the United States, for example, back at the bottom of 08-09 during the financial crisis, this country's household wealth was about $61 trillion. Today, it's $183 trillion. The Fed's balance sheet back then was $700 billion. It peaked at $9 trillion at the peak of the pandemic. It's now about $6.5 trillion. There's enormous amounts of liquidity left over from the pandemic. And so we'll see. It's hard to really gauge whether there's a crowding out. It doesn't appear that way. The demand seems to be strong. And as long as the market's moving higher, I think that's going to continue to, the supply will continue to satisfy the demand.
And Joe, can I just say we will be here in 2 years. You'll be here in 2 years too, unless we're replaced by robots, and I hope that's not the case. Before you go, favourite pick until we next speak, next quarter when we cover all these names together, what's the favourite pick through the summer?
I think through the summer, Bank of America would be the pick to gear to.
Jared, thank you. Jared Cassidy there of RBC, with Bank of America remaining a favourite for him and the team over at RBC. Let's talk about some of these capital raises. They've been so oversubscribed. The amount of wealth in this country, clearly there's an opening, and we'll talk about it with Jill Ford in just a moment, for more still to come.
Yeah, and this is the reason why you've seen such incredible earnings, because not only is it the trading side, it's also the underwriting side, and the fact that there's a whole lot of market making that comes along with this. You asked a really important question. How much more is to come with the likes of OpenAI, with some real questions about the competition between OpenAI and Anthropic? And are people getting exhausted? You know, right now it doesn't seem like anyone's getting exhausted. It seems like they're just getting started. And based on these results, you know, some really good bonuses coming.
The numbers are crazy. What was that number for trading across 5 big names?
$50.53 billion from their trading units in the second quarter.
More than $10 billion than what was expected.
Yeah, correct. And it compares to $145 billion total for the entirety of 2025. That is more than a third. These numbers are absolutely astronomical. Record after record after record in every single unit. And that is what all of these CEOs keep talking about.
I saw a stat from the team here at Bloomberg that the equity business over at Goldman, Q2 was bigger than all of 2019. 1 quarter. Q2 bigger than all of 2019. I
saw that as well. It gives you a sense of just how big this beat was. They combined with fixed income and their equities trading made north of $13 billion, maybe $14 billion in terms of revenues. I mean, it's just incredible numbers. You start to see $15.3 trillion over at BlackRock, and you start to talk about real money.
This market, the bar will creep higher, right?
It's
true. And it starts to demand a repeat again and again, and that's the issue.
Yeah.
That's why we're asking the question, is this as good as it gets for some of these names?
And is that enough, right? If it's as good as it gets, if it lasts for a couple of years, it's just hard to feel really optimistic when you start getting surprised again and again and again to such upside, and you start wondering, you know, at some point the music's going to stop. It starts to make people feel uncomfortable.
Still playing right now. We're up by 1/10% on the S&P 500. What do they say? Keep dancing, right? Chuck Prince, something like that.
Monkey.
All right. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Morgan Stanley, as you've been saying, shares rising in the pre-market. The bank's second quarter earnings topping estimates. Trading revenue coming in well over expectations at $6.3 billion. The bank's assets across wealth and investment management topping the $10 trillion mark. New York issuing the first statewide moratorium on new hyperscale data centers.
I want to make sure that we take the time to have a community investment framework to give to localities. But also, you have to be able to power yourselves. You either bring your own power source or you have to pay a premium to use our grid. And those are the basic foundations of what we're doing with this moratorium.
Governor Kathy Hochul emphasizing the pause is, quote, not a ban. Americans may be keeping their clocks fixed on summertime. The House passing a bill that would make daylight savings time permanent. The bill now heads to the Senate. Even if it passes, states could opt out in favor of permanent standard time. That is your Bloomberg Brief. John.
Ivani, thank you. Up next on the programme, we'll talk to Jill Ford of Wells Fargo on why she believes this equity market is still wide open for supply. That conversation up next.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Equity futures this morning positive by 0.1% on the S&P 500. On the Nasdaq, shaping up as follows, higher by 0.4%. Earnings from Wall Street's biggest names in the last 24 hours, printing record after record after record, and this morning no different. BlackRock with record AUM, BNY with record assets under administration, Morgan Stanley setting another quarterly record for stock traders. Morgan Stanley higher by 1.5%, reporting just 20 minutes ago.
Yeah, north of $6 billion for their equity trading revenues. Also saying that they had records in each three of the geographic segments. Again, it's almost getting exhausting. Record, record, record. Who isn't having a record? At the same time, it really is the sustainability. And so far, we have seen ongoing resilience, at least in the commentary coming from the big banks. The pipeline is big, and there's a lot that still needs to get financed.
The backdrop is good right now. The weather's been absolutely fantastic.
Lovely.
The sun is shining brightly.
Sunny squalls.
So the only thing you can ask is, does it get any better than this, right? Peak bank. Peak bank was something that we spoke to Eric Najarian of UBS about earlier this week. Looking ahead to these earnings, is this as good as it gets.
Yeah, and are people going to get penalized for not necessarily highlighting just how much further it can go? Is it enough, though? If this is as good as it gets, but it keeps going for a while longer, that's enough. What? Keep dancing? So this is sort of the question that a lot of people have. It seems like CEOs don't have visibility into when it potentially will stop. So that's the one kind of silver lining for investors and the reason why you aren't seeing them being punished.
Morgan Stanley this morning higher by 1.3%. That's the story for the big banks. They've been leveraging this under surveillance this morning, sustaining AI spending. Here's the latest. Big tech racing to raise capital following Alphabet's monster equity capital raise, SpaceX's record IPO, and the biggest ever first-time issue from a foreign company from SK Hynix. Jill Ford, the co-head of equity capital markets at Wells Fargo, writing, markets are wide open. If you hit on the right theme, which is everything within what the market perceives as the golden halo of AI, that's where things land. Jill joins us now for more. Jill, good morning. Good to see you.
Good morning.
So I think you've got to an important point. Yes, the equity market's wide open, but is it wide open for only the companies that tick certain boxes?
Look, it's been an incredible first half of the year with respect to the equity capital markets. And as you rightly point out, you know, the AI super cycle is taking hold. They're using all of the tools in the toolkit across the AI ecosystem, from the hyperscalers to the neoclouds to the semiconductor companies, all the way down to the real infrastructure, the data centers and the power behind that. But as they use all the tools in their toolkit, the equity capital markets are a meaningful part of that. So it's not just structured privates, it's not just the bond markets, but it's also the equity markets. And you're seeing it, obviously, what you just mentioned in terms of follow-ons and converts, but in the private markets and then ultimately in the IPOs as well.
We've seen some massive issuance from certain kind of companies, which is what I'm trying to dig into here. Software. Is the path available for those names too? IBM got hammered yesterday. Can you walk us through the kind of contagion effect, the chilling effect that might have for the potential for some companies like that to come to market?
Well, look, I will tell you that the flavor of the month, the flavor of, let's call it the year, is AI. No question. All eyes are on that as it relates to tech. But there are definitely software companies sitting in the private realm who can and should be public. I'm thinking cybersecurity type names. I'm thinking those software companies that are owning the data horizontally and vertically. But there are also many who I think will have to sit it out and may, in fact, have to consolidate with others or not exist. If you look at some of the public mutual funds who have to mark their private positions, and as you know, those mutual funds have been investing in the private realm for some time now, they're marking those positions down 20% plus. So there is definitely a re-rating in valuation. There will be some that will be made obsolete by AI, and there are others that will have a tailwind and will be able to exist in this world, and those eventually will come public. But all eyes, make no mistake, right now within tech are on AI and everything within that ecosystem.
Those eyes are not indiscriminate, and they're not necessarily just buying blindly. And we saw that with Amazon. We've seen this with other issuances where there's been a little bit of pushback on the edges. At least that was on the debt side of things. We also have seen SK Hynix with an incredible amount of volatility in the ADRs and, frankly, in Korea as well. I just wonder if we're starting to see the beginning of a bit of pushback, if there is a little bit of supply indigestion that's coming down the pike as some of these other issues prepare to go to the market.
Well, look, I'll take your attention back to SpaceX. SpaceX was an incredible exhibit, reminder that the U.S. public markets are incredibly deep. For a deal that was 3 times the size of the largest IPO to ever come, and to have multiple times of oversubscription, to be able to garner demand from all corners of the world, all different types of investors with different lenses, and still be able to not only absorb that supply, but to keep on trucking in terms of additional supply that has come since and before, as you point out with Alphabet, is really a testament to the fact that there are deep pockets within active money management. And I don't think that we have exhausted the amount of that demand because people are making money. You know, you talk about SK Hynix, it's been incredibly volatile, but people made money on that. And the average IPO cohort, if you look at right now, it's close to 15%. So I don't think the music stops because of supply. I think the music stops if we don't have the incredible backdrop that we're enjoying right now.
What would cause the incredible backdrop to be less incredible? I mean, is it something macro, or is it something where suddenly people realize who's going to pay the bill for all of these big hyperscalers and for these large language models that are being levered at pretty significant rates, even though a lot of companies are pulling back on their expenses or actually rationalizing their token use?
Look, I think we have a long way to go with respect to AI and figuring out where all the chips are going to fall. That being said, I still think we're on the precipice of changing the way the world does business, changing the way that we all live, and the capital formation that has to accompany that is incredible. Right now, what could derail things, I think, are more macro. You know, we've got increased tensions in the Middle East. Right now, the market is shaking it off. The consumer still appears very healthy. If that changes, right now, inflation appears relatively under control. If that changes, all of those macro indications that, we can't be priced to perfection. Right now, we're priced to perfection because earnings have been great, because the backdrop has been relatively calm. The VIX is sitting at 16. If that were to change, particularly in the back half of the year where the calendar starts to shrink in terms of your windows to be able to go public, then you could start to see some around the edges, some marginal people putting off or perhaps a rationalization on valuation as well.
There's also a midterm election towards the end of the year. And
no question.
We saw yesterday this moratorium on AI data centers. Do you think policy potentially could have individuals thinking, I'm going to wait and want to see how all this shakes out?
I think investors are worried about it. And I think as we speak to issuers, many people want to get ahead of it because they don't want to have to be in that maelstrom of headlines and people wondering what that means. So I do think it's on people's minds, and we'll see what comes up.
So you think before the end of the year, more people are going to want to go maybe before that date in November?
I think so. What you're dealing with, though, is, you'll have the August doldrums. The Labor Day is a week later than usual. Then you've got the Jewish holidays. Then you've got Thanksgiving. You've got the midterms. You've got Christmas. I also think investors may close their books early because they've done so well. They won't want to risk it going into year end. So there's a lot that's going on the technical side of it that may make people want to accelerate their plans and come earlier in the last quarter versus what they normally would. And then many may wait until 27 and things calm down.
I'm right there with them. Shut it down. Take the year off.
I was going to say.
You're right there too?
I was just going to say, is it too soon to close the books
had a great year already. Just shut it down. Long vacation.
We're just getting started.
The rest of the year. Oh, yeah?
Jill Ford of Wells Fargo. Jill, thank you.
Appreciate it.
Just getting more details of another round of strikes across the Middle East, across Iran from U.S. Central Command. Those details drop in just moments ago.
Right, so they wrapped up the latest strikes, the morning round this morning at 7:30 a.m. Eastern. And CENTCOM is saying that the U.S. launched precision munitions against coastal defense systems, cruise missile storage, launch sites, basically going after anything that Iran has in capability to attack vessels that are trying to transit the Strait of Hormuz.
It's keeping crude elevated. It's not adding to the rally. Crude this morning higher by about 1/10%, 79 on WTI. Brent crude around 85. If you turn to the bond market, yields have been higher throughout much of this morning, up by a couple of basis points, up by 2 on 2s to 421, on 10s just north of 460. The next stop for that bond market, not just energy, but PPI data. That data drops in about 35 minutes' time. Up next on the programme, we'll catch up with Ed Yardeni of Yardeni Research. We'll speak to the BNY CFO, Dermot McDonough. We'll catch up with Stephen Stanley of Santander, plus the former US Commerce Secretary Gina Raimondo. All of that in the third hour of Bloomberg Surveillance, just around the corner.
Anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market. You can get that from a bank. You can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The power of earnings is too strong.
Earnings revisions breadth is still surging.
At some point, valuations will become an issue for investors.
We've been warning our investors that a correction was coming across the board.
It's premature to get too worked up or too bearish.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equities higher by 1/10% on the S&P, on the Nasdaq up by 0.4. The bank earnings roll in. Earnings season completed on Wall Street. There we go. In just 24 hours. Not bad, eh? BlackRock this morning, record AUM. That stock is up by 4%. BNY, record assets under administration. That stock is down 1% this morning, up on the year by more than 30. Morgan Stanley also higher on the year, around 30%. Morgan Stanley this morning up by 1.8%. Another record, this time again, for the stock traders over at Morgan Stanley. We've seen that on repeat over the last day.
And they're not small beats. These are massive beats. And you can see that the collective beat across Wall Street is up by some $10 billion just in the trading revenues overall when you combine the top 5 banks. Question is, how good is it going to get? Can this be something that can be repeated again and again? And how big is the pipeline going forward? So far, the commentary is the visibility that we have is all systems to go into the end of the year. For people who want to be nervous, that kind of positivity makes them nervous. You see this in the Bank of America Fund Manager Survey as well. Nonetheless, the data seems to be backing it up and at least disinflating enough to keep it on the rails.
You said this early this morning. I'm right there with you. It was a bit touch and go yesterday morning, where these beats weren't really being rewarded and the misses were getting massively punished. And that changed at about 8:30 when CPI came in a bit softer than expected. Rate hike expectations, at least in the immediate term, the very near term around July, started to soften up a little bit. It allowed the equity market just to go a little bit more. I don't think we would have had the moves we had by the end of the day without that happening at 8:30 Eastern Time.
I couldn't agree with you more. This is both a micro story and a macro story. The micro story has to do with AI, although that's turning into a macro story, and how much it's fueling some of the capital markets activity. On the macro, the Fed needs to not get in the way for a lot of these multiples to sustain themselves. And that's what a lot of people have been saying. If the Fed takes away the punch bowl, and they can if they hike enough, then potentially that brings the end to the party. Right now, it seems like the CPI report we got yesterday does not create urgency to raise rates in any material way in the near term, thus allowing the party to keep going and allowing people to get enthusiastic.
Twos this morning up 2 basis points. The next stop for that debate is PPI in 27 minutes' time. Your 2-year at 421, 10's up 2 to 461. Off the back of this move in crude, crude is still elevated this morning, up about 0.5%, around 80 on WTI. Brent crude around 85. As U.S. Central Command indicates, they've wrapped up another round of strikes.
Right, 90-minute wave of strikes this morning, and we're getting a little bit more details on what actually the U.S. forces were targeting. They were going after coastal defense systems that the Iranians have, cruise missile storage, launch sites. All of this is to try to degrade Iran's capability to go after commercial vessels in the Strait of Hormuz. I was very impressed with what General Walsh said this last hour. And he made the point that when it comes to Iran, the objective is disruption, not necessarily denial. If it's only disruption, there's only a little bit amount the IRGC needs to do to disrupt waterways and stop vessels and having them second guess if they should go through, which is why the United States, it might take a lot longer to go after a lot of these sites and almost scare them back from doing even a little bit amount of disruption.
It doesn't cost them much to do it either.
Nope.
It's part of the problem. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research on reduced urgency to hike interest rates. We'll catch up with the BNY CFO, Dermot McDonough, as Wall Street crushes estimates, and the former U.S. Commerce Secretary, Gina Raimondo, on what's ahead for the American AI build-out. We begin this hour with stocks little changed as investors count down to fresh inflation data and day 2 of Fed Chair Kevin Warsh's testimony on Capitol Hill. Ed Yardeni of Yardeni Research writing the Fed Chair's core message was that the Fed must stay focused on inflation while recognizing AI's potential to support stronger, less inflationary growth. In other words, he endorsed our roaring 2020s narrative. Ed joins us now for more. Ed, welcome. To get your roaring 2020s, and we're more than halfway through at this point, do you need this Fed to stay on hold?
Yeah, well, this is actually the 7th year of the roaring 2020. So if we make it through this one, I think we got 3 more years, and then we can look back and say that turned out to be an amazing decade, and then we can start talking about the roaring 2030s. But I'm very pleased to see that Fed Chair Kevin Warsh shares our optimism about the outlook for technology-driven productivity. And that may explain why we're getting lower than expected inflation, because unit labor costs, which is hourly compensation offset by productivity, that's only up 0.5% on a year-over-year basis during the first quarter. And it does correlate with the CPI, and the CPI came in, as you all said, remarkably cool.
Ed, I'm pleased you've got visibility into the 30s because I can't see beyond next week, at this point anyway. Let's talk about the here and now. The positive earnings shock that we witnessed at the start of the year that took a lot of people by surprise. How well priced is that positive earnings shock now?
Well, that's really the issue for the next few weeks, is we're now in the second quarter earnings season. And the problem is that the market may already be discounting remarkably strong earnings. As a matter of fact, on a year-over-year basis, analysts are predicting something like 20 to 25% increase in second quarter earnings on a year-over-year basis. So how much better could it possibly be? And so the answer, I think, if it turns out that the answer is that they're only as great as everybody expected, you might have some profit taking, but then watch the dip buyers come right back in. We see that over and over again because the reality is the earnings prospect remains very positive. Second, third, and fourth quarters, analysts are looking for 20 to 25% increases in earnings.
It seems like, Ed, a lot of how long this can continue really does hinge on the inflationary backdrop and the policy response to it. Something we saw yesterday, a disinflationary print really did unleash an even bigger rally in equities. I'm just wondering how much you actually took from yesterday's CPI print. Max Kettner of HSBC just came out and said the downside surprise was pretty broad-based and they think is the first sign of U.S. exceptionalism unwinding, unlocking lower yields. Do you agree with that?
I do, actually. Going into the CPI numbers, we thought that we did expect the pivot from easing back in April to tightening in June. We also thought that there was a rate hike possibility in July at the end of this month. And now I think the CPI took that right off the table. Interestingly, the 2-year and the 10-year treasuries are still anticipating that nonetheless there will be at least one, if not two, rate increases over the next 6 to 12 months. And that's still possible. I mean, we still have the war is not over. We still have potential upside in oil prices, though that's also been a remarkable surprise. And then we've got the AI situation that, at least in the short term, is turning out to be inflationary. But all in all, you have to say there may be some real magic here in productivity.
Are you nervous that people are so optimistic, including yourself? And I know I sound like the ultimate bear looking for something to be bearish about, but I'm looking right now at these surveys that show that just 2% of people in the Bank of America Fund Manager Survey see a hard landing as possible in the near future. Does that give you pause?
Yeah, I do tend to have a contrary streak, but I don't go contrary unless, the fundamentals really suggest to me that the crowd is missing something here. And look, I'm not dismissing the possibility of a significant pullback. We had one during March when the war was red hot. We could have another pullback in the current earnings season if suddenly one of the hyperscalers says, you know what, we're finding it difficult to build the data centers. Maybe we've got more capacity than we need. I mean, all those things are possible. And so there's still a lot of nervousness about the whole AI situation for sure. Obviously, less nervousness about inflation, less nervousness about what the Fed's going to do. But between the ongoing war in the Middle East, the potential for higher oil prices, the fact that inflation isn't back down to 2%, and Warsh has pledged that he will get it down to 2%. The question is, will he actually have to raise interest rates to do that, or will productivity do the job for him? So I think everybody knows the bear case, and it wouldn't take much to bring it to the fore. But I'm going to stick with a story we've been telling since the beginning of the decade, and that is that the economy is resilient and the consumer is resilient, and therefore earnings are resilient.
Ed, you're dubbing this phase of the conflict as Iran War 2.0. What does the market need to know about this version and place where we are with the conflict versus when it first started?
Well, this version seems to be more focused on trying to get Iran to finally give in. The problem with Iran is it's not clear who's in charge. There seems to be some sort of government, but there's also the Revolutionary Guards, and the end of the recent ceasefire seemed to have been triggered by the Revolutionary Guards kind of unilaterally disagreeing with the government, saying we're not on board here with any peace treaty whatsoever, any understanding whatsoever. So I think right now the war situation is really kind of focused on once again shutting down the ports of Iran in order to really immiserate their economy. The problem is the Revolutionary Guards don't care if their people suffer. So it could be a protracted situation where the United States really does have to provide military escorts to get ships out. But meanwhile, everybody's scrambling to find other sources of oil, to get oil distributed through other means. And it seems to be working. And in addition to that, it looks like China's economy is fundamentally weak, and that's depressing their demand for oil. So the oil market just has actually been far less troublesome than widely anticipated.
GDP a bit weaker out of China than expected a little bit earlier. Ed, final question before we go. You coined the phrase, bond vigilantes. Did they stay on vacation through the summer?
Seems so. I've been thinking that the bond yield is pretty much where it should be. We're back to normal in the bond market. I think normal is about 4.5%, plus minus maybe 50 basis points, so a range of 4 to 5%. I don't think is a problem for the economy. Quite the opposite. I think it's a signal that the economy is back to its old shape, that it can not only handle these rates, but can do business quite readily at these rates.
Close to the middle of that range this morning. Ed, good to catch up. Good to see you. Ed Yardeni
Thank
there
you.
of Yardeni Research. Thank you, sir. Yields up by 2 basis points. 461. We're doing OK in the equity market off the back of this. Looking ahead to PPI data in about 20 minutes' time. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thanks. U.S. Central Command saying it began a 5th day of strikes against Iran at 6 a.m. Eastern this morning, and those strikes lasted for 90 minutes. President Donald Trump saying the strikes will intensify until Iran agrees to open the Strait of Hormuz. Iran had been retaliating against the U.S., hitting bases in Gulf Arab states. NVIDIA CEO Jensen Huang saying the company's next-gen AI accelerator systems are on track, following reports that the rollout could be delayed due to manufacturing issues. Huang said Vera Rubin is already in production and on pace for giant production volumes. The fossilized skeleton of a Tyrannosaurus Rex sold for a record $50 million at a Sotheby's auction. The T-Rex, named Gus, is described as one of the largest and most complete dinosaur skeletons ever recovered. The buyer unknown at this point. And that is your Bloomberg Brief. John.
There's one guy I thought of. Funny, thank you.
Me too.
Kenny G.
He already did it.
But we don't know if it's him this time. But, like, you know, because he already did it.
Maybe he's
did
building
he do
a
it again?
collection, which, to be honest, is so cool.
How cool would that? 8-year-old dream, right?
I was just gonna say.
I mean, it's a dream
if you
now.
asked an 8-year-old kid,
It's a dream now.
if I gave you $1 billion, what would you do? They'd be like, buy dinosaurs.
Absolutely. And then recreate Jurassic Park.
Yes.
For the record, I've got no idea if it's Ken or not, but
But there we go.
people are wondering. Up next, the Morning Calls Plus, we'll catch up with the BNY CFO, Dermot McDonough, as America's oldest bank delivers another record quarter. That conversation up next.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Across Wall Street, the trading revenues in equities has been extraordinarily strong. The numbers are very, very strong, and this is probably as good as it gets. So you really have to expect for these stocks to really work going forward like they have in the past 18 months, and that could be a big ask.
That was Jared Cassidy of RBC weighing in on the financials a little bit earlier this morning. Equity futures at the moment up by 1/10, on the Nasdaq up by 1/3. That's the price action. Let's get you some morning calls. The big banks in focus. First up, Morgan Stanley raising its price target on JP Morgan, citing better than expected guidance for net interest income. Your second call from Barclays raising its price target on Goldman, highlighting better than expected trading and investment banking fees. And finally, Wells Fargo raising its price target on B of A, citing strong underlying financial trends. That stock is up again this morning. We're higher by 0.5%. Let's stick with our top story. Wall Street delivering a blowout earnings season. America's oldest bank, BNY, adding to those results, posting back-to-back quarters of record revenue and sales. Joining us now to discuss is the BNY CFO, Dermot McDonogh. Dermot, welcome to the programme, buddy. It's good to see you. Record performance in Q1, again in Q2. What's behind the activity, Dermot? And the question I think that applies to your bank and so many others this morning is, can this continue?
Thanks for having me, Jonathan, and great to be with you. When I was getting ready for the show this morning, I wasn't too sure whether to put the tie on or put the England shirt on. So I put the tie on, but hopefully you'll bring it home today and enjoy the match this afternoon. Listen, BNY today, great results. We're really pleased with the performance. We feel like the firm is humming at the moment. We've built the company for durability and to take advantage of opportunities like this that the market has presented over the last quarter. The U.S. economy is strong. We continue to be positive on the U.S. economy. There's a lot to be optimistic about in terms of what's happening. Full employment, the yield curve is behaving well, flows are strong. And when you have a company like ours who has built a broad set of durable businesses and has been in this for a long time, with 20% of the world's investable assets flowing through your pipes every day, this shows up in kind of record net revenues, which we're just posting this morning, of $5.7 billion. So as a company, we're very pleased, but we feel like we've more white space to go and more opportunity, and we're going to keep pushing on into the second half of the year.
And Dermot, record assets under custody as well, north of 60 trillion. That's a record for the firm as well. You talked about it, you just alluded to it there. Help us draw a distinction between the backdrop and execution, the environment, and how the bank actually performed. What's happening there?
So look, we started on this journey 4 years ago, and I can say confidently under Robin's leadership that BNY today is a materially different company than it was a few short years ago. And I'll give you a couple of examples of that. We will talk this morning about this being our 14th quarter of consecutive year-on-year sales growth. This year alone, first half, we've had 2 record sales quarters. Our mandates are growing in size. 10% of our sales this year have been with new logos. So that points to the fact that clients are seeing what we're doing. They see the reimagination of the firm. They want to partner with us more in many different ways, and that's showing up in the numbers.
One thing that we saw, Dermot, was a sense of a real upgrade in terms of full-year revenue guidance that you put, up about 10 to 11% year-over-year versus the 5% previously. What gives you confidence heading into the second half that the momentum can continue to the degree that we saw earlier this year?
So look, I live and breathe BNY. I see the 47,000 people around the world working together as one, delivering for clients. And that results in strong pipeline, strong backlog. We're a better firm today than we were a year ago. And so, look, I think 4 years ago, if we had this backdrop that we're experiencing over the last quarter, we wouldn't have performed as well as we have this quarter. So we're making that 1% better, the firm, every day. And that compounded over a long period of time is going to give us the confidence that we can deliver for our shareholders, for our clients, and for our employees over a long period of time. So we're very bullish at the U.S. economy. We're very bullish BNY and our strategy. We feel like it's working, and we kind of feel like that we have a lot of opportunity ahead of us. There's no shortage of work to do to make this company better.
Dermot, one thing that we've seen pretty much across all the banks is that expenses came in heavier than a lot of people had expected. I wonder how much of this is structural, that there is a sense that everything is getting more expensive, whether it's the personnel that potentially can drive the change in the performance, as well as some of the technological advancements that you need to be investing in.
So look, I obsess about expenses every day, as you would imagine me to do. The expense growth that we've seen this quarter, and we updated our guide for the full year to 6 to 7%, it's largely revenue-related plus investments. Over the last 3 years, we've roughly invested about $500 million in the firm in strategic growth initiatives, and that's largely been offset by our efficiency and transition to the platform operating model. So you can see that the investments that we've made over the last 3 years, you see that proof in today's results. And we're going to continue to invest in a thoughtful and prudent manner, and that will deliver durable results over the long term. I'll say this on the call today. We've developed new products, whether it's buy-side trading, Collateral One, Borrow Plus, products that weren't that meaningful to the overall revenue pie a couple of years ago are now delivering meaningful contributions to the revenue mix. So BNY is innovating as well and partnering with clients and stitching the firm together to deliver integrated solutions that we believe will allow us to grow revenue in the future.
I think, to be fair to you, Dermot, 10 consecutive quarters of positive operating leverage speaks to some of the things you just said there, that balance between cost discipline and investment. When it comes to investment, the focus right now is firmly on AI. Some companies seem to be rationing spending right now, Dermot. What comes out in the release from you and the team this morning is that your spend and the investment you've made on AI is translating into real business impact. Can you share with us where specifically and how this is trending?
So look, we talked a lot about, and we had a slide in our disclosure in Q1 about what we're doing on AI. Like in the context of BNY and a $4 billion engineering budget, our investment in AI is modest in the context of the overall budget. We've got a good strategy at BNY. We're very proud of it. We've been at it right since the start, since the launch of ChatGPT. And we're very proud of the platform that we've built, ELIZA. It's LLM agnostic. And so we feel like we have the right structure in place. We've had broad adoption with our people around the firm. We've upskilled people. Pretty much 100% of people at BNY now know how to use AI and are doing it in their daily work. And we think about enterprise productivity and individual productivity. And Robin says this lots of times, AI for everyone, for everywhere, for everything. And it's all about creating capacity and productivity so that we can allow the firm to grow and use AI to enable that. So we're AI optimists at BNY. We believe it can upskill our people, allow them to do more interesting work, and at the same time partner with clients to grow the firm.
Another record quarter. Dermot, appreciate your time. You've been generous with your time on a busy morning for you and the team. Thank you, sir. The BNY CFO, Dermot McDonogh, following another record quarter, following another record quarter.
Yeah, and talking about how it's both the backdrop, the weather, but also about some of the changes that they've made to the institution over the past 3-4 years. I'm interested about some of the names, ELIZA, Claude. I'm wondering
where did they come from?
Yeah, well, I mean, this one actually comes after Elizabeth Hamilton, who was one of the people who was involved in creating this. So evidently it has to come from something, but, you know, will there be any children named Eliza and Claude in this next generation?
Hamilton founded the bank, of course.
Yes, exactly.
Yes.
So
right.
this makes perfect sense.
You know, just a little nod towards history.
Thank you, rather than like founding the AI.
Right. Got it? Okay.
Thank you. I appreciate it.
Anytime.
That was graceful.
That's what I'm here for. Okay. Coming up, we'll get some breaking inflation data, PPI, in about 5 minutes' time. We'll catch up with Stephen Stanley of Santander. He'll break it down for you in just a moment. Equities doing OK on the S&P 500, just about unchanged. In the bond market, yields have been higher through much of this morning. We're off the highs. We're up a single basis point. Your 2-year this morning at 420, 10s at 460, up by a couple of basis points. And crude still elevated, WTI higher by 0.7%. WTI 80, Brent crude at 85. PPI is up next.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
It's going to be a hot one later on. We're going to get into the 90s here in New York City. It's going to be very hot where England are playing as well.
Yeah, well, that's...
So you were staying down there for the game anyway?
I was going to, and then I just was compelled. I couldn't stay away, especially bank earnings.
Did Bastian have the tickets?
He did, but not for me.
Oh, did he?
Yes,
is he taking a team over at Delta?
I don't know who he's taking, but, I tried to throw out. I'd be interested. Wasn't interested.
Yeah, it's going to be hot across the East Coast, that's for sure. Equity futures right now in the S&P positive by 1/10. On the Nasdaq, we're up by about 1/3. PPI data just crossing. Mike McKee has the numbers. Hey, Mike.
Good morning, John. Well, we had good news for the CPI yesterday, and today we have good news in the PPI, at least for the Federal Reserve, and the inflation fight at the moment. PPI for final demand down 0.3% on the month. Ex-food and energy is up 0.2. That's a tick lower than was anticipated. And food, energy, and trade is up just 0.1%. So that leaves the year-over-year numbers at this point. Final demand headline 5.5. That's down a full percentage point from last month's 6.5. The food and energy core 4.7, down from 4.9, and the PPI ex food, energy, and trade at 5.1%. The index for final demand goods moving down 1.4% in June. That's the largest decrease since July of 2022. And of course, leading the decline, prices for final demand energy. 2/3 of the index, they say, for final demand goods can be traced to prices for gasoline, which were down 12%. And then the index for services rose 0.2%. 60% of that is for final demand trade services, which is, of course, the profit margins for warehouses and retailers. They were up only 0.4%. Half the index is also for on the service side margins for people who sell fuels and lubricants. So the suspension of the war playing a big difference in what's happening in the PPI this month, as well as the CPI. One other number quickly we got for you is the Empire Manufacturing Index rebounds nicely to 15.6 from 5.7, and we saw a big drop in the prices paid index. It falls to 52.3 from 61.0. So we're really seeing that impact of slowdown in prices during the month of June. Now the question is, can we keep it?
Mike, Anne-Marie thinks you look like a park ranger and wants to know where you are. Where are you?
I'm at the Rocky Mountain Economic Summit in Victor, Idaho, and I will go out and see if I can find her a bear.
Okay.
What's on your shirt?
Stay safe, Mike. Thank you. Michael McKee. And Kevin Walsh doesn't think mission's accomplished, but based on that, it was like Mike's phoning it in.
Exactly.
Taking the rest of the year off.
Well, you might be right. I mean, you could just, head over, get another job as a park ranger.
Clearly, PPI is not a problem. All right, equity futures positive by 0.2 on the S&P, on the Nasdaq high. Taking a team over at Delta.
I'd be interested.
The index for final demand goods moving down 1.4% in June. That's the largest decrease since July of 2022. And of course, leading the decline, prices for final demand energy. 2/3 of the index, they say, for final demand goods can be traced to prices for gasoline, which were down 12%. And then the index for services rose 0.2%. 60% of that is for final demand trade services, which is, of course, the profit margins for warehouses and retailers. They were up only 0.4%. Half the index is also for on the service side margins for people who sell fuels and lubricants. So the suspension of the war playing a big difference in what's happening in the PPI this month, as well as the CPI. One other number quickly we got for you is the Empire Manufacturing Index rebounds nicely to 15.6 from 5.7, and we saw a big drop in the prices paid index. It falls to 52.3 from 61.0. So we're really seeing that impact of slowdown in prices during the month of June. Now the question is, can we keep it?
Mike Amory thinks you look like a park ranger and wants to know where you are. Where are you?
I'm at the Rocky Mountain Economic Summit in Victor, Idaho, and I will go out and see if I can find her a bear.
Okay.
What's on your shirt?
Stay safe, Mike. Thank you. Michael McKee. And Kevin Walsh doesn't think mission's accomplished, but based on that, it was like Mike's phoning it in.
Exactly.
Taking the rest of the year off.
Well, you might be right. I mean, you could just, head over, get another job as a park ranger.
Clearly, PPI is not a problem. All right, equity futures positive by 0.2 on the S&P, on the Nasdaq high.
So I think that...
Is the ambiguity strategic?
Oh, for sure. I think...
What's the strategy?
Here's what I think is happening. So I think Chairman Warsh would argue strongly, and I think most of the people in the committee would agree, that the Fed was using too much forward guidance, basically leading the markets around by the nose. If you think to the Powell regime, and more than likely, if the Fed were thinking about hiking in September, let's say, they would have already been trying to signal it in June. He wants to do away with that. At the same time, he's moved to the polar opposite extreme of, I'm not going to tell you anything. I'm not going to tell you whether I think the economy is strong. I'm not going to tell you what my reaction function is, what I'm paying attention to. Just all I'm going to tell you is we're meeting again in 6 weeks, basically. There's a happy medium somewhere in between. I think my sense is that what he's doing now is he's trying to wean the financial markets off of this steady diet of forward guidance. So we're going cold turkey for a while, and ultimately, whenever, maybe it's after we get the working group results back or whatever, hopefully we'll get to something in the middle.
He has the luxury of going cold turkey because right now the Fed's not in the driver's seat and they don't have more visibility than the market does. So right now it's a great time to go cold turkey because they're not on the hot seat to actually take immediate action. That said, I'm struggling with the cognitive dissonance of the disinflation that we're seeing in these numbers. Earnings coming from the biggest banks showing absolute boon time types of profitability. Also, a separate report from the New York Fed from their general business conditions coming and showing that the employment component rising to the highest level since December of 2022. All of these signs of reacceleration of the consumer and the commentary from some of these executives. How do you square that with disinflation ongoing?
Right. Well, I guess it's disinflation from where? Again, if we're moving, we were in the high 2s for most of last year on year-over-year for core inflation. We're currently at 3.4. If we disinflate back to the high 2s, that's good, but it's still not mission accomplished, right? It's still above the target. I think there are a couple of things that I would say from trying to look at it from Warsh's lens to the narrative that you just explained. The first one is we know the employment situation is a lot better now than it was perceived to be late last year. So when the Fed was easing last year, they were easing because they thought the labor market was soft. And that's off the table now, which allows the Fed to focus entirely on inflation. I think another point that Warsh has been eager to make is he's not a Phillips curve guy. So the Fed as an institution has always been of the view that inflation always and everywhere comes from the labor market. And clearly, the inflation that we're getting now is not coming from the labor market, right? Wage growth is not accelerating, and yet inflation has moved up into the mid-3s. So I think what Warsh would say is, firstly, and this was why people thought he was going to be super dovish before he took office, good growth is not a problem necessarily from an inflation standpoint, particularly when it's being driven by investment. AI should raise productivity over the long run. In and of itself, it's not inherently bad. But if it leads the economy to overheat, then you do get inflation. And so I think he's willing to sit back and see how things play out. But the way that things seem to be playing out, in my view, is we are getting inflation, and the Fed does have to respond to that.
One of the pushbacks that we get from people is that if the Fed were to raise rates by 25 or 50 basis points, it wouldn't constrain some of the main nodes of inflation, which is the AI investment, which is a sort of secular overlay, not exactly monetary driven. That said, whenever we see the prospect of tightening, we see stocks sell off, which is essentially monetary conditions, or, financial conditions doing the work for them. So which is it? Does it have an effect or not if they were to hike 25 or 50 basis points?
Well, I mean, it clearly has some effect at the margin, right? It affects kind of the environment. And right now, I think by any measure, you would say financial conditions appear to be extremely easy. So I think it's hard to make the argument as a policymaker that the funds rate at its current stance is restrictive. I think the consensus view on the committee prior to Warsh coming in was that the Fed was modestly restrictive, and if they could just hold at that level for a long enough period of time, it would bring inflation down. And I think what we're seeing is, certainly financial conditions would suggest the Fed isn't really easy right now. I think that's a reason why they're ultimately going to have to nudge rates higher.
Well, when it comes to when this could potentially happen, do you think they would really make a move before the midterm election?
That's a good question. I think that would actually be exhibit one in Warsh's argument for, hey, we're independent, right? So in some ways, hiking in September, which, would be kind of something that the Fed typically has avoided moving right before the election. But I think moving in September actually bolsters his credibility in a way, especially if there's a strong case for the move. I think where the Fed gets in trouble is when they get really aggressive at a point in time where the case for doing so isn't so great. And that's what happened in 2024, right? The Fed goes 50 basis points right before the election, and after the fact, Trump is saying, "Oh, you were being political," right? If the case for moving 50 basis points had been cut and dried, nobody would be saying that. So it depends on the circumstances and whether it's justified. But I think going in September actually would be something that would be good for the Fed's credibility.
What would they need to see?
I think for me, the number one thing that's important in terms of inflation going forward is this issue of whether the energy costs are getting passed through. When the first couple of months of the energy price shock, the trucking freight line item in the PPI over 2 months went up by more than 10%. Not annualized, just up more than 10% in 2 months. Everybody assumed that was immediately going to show through into food prices and pretty much anything that has to be shipped. And we haven't seen that yet. Food prices were up 0.2 in May. They were up 0.2 in June, pretty normal type numbers. So I think the jury's out. We're still waiting. But I think for me, as a Fed official, what I'm trying to ascertain at this point is how much pass-through is there going to be. And that's something that the data we'll be looking at the data, of course, but also anecdotes, talking to businesses in the district and kind of figuring out what's really going on behind the scenes.
Stephen, it's good to see you. Thank you, sir. Thanks for being here. Thank you. Stephen Stanley there of Santander on this Federal Reserve. As a softer PPI print follows a softer CPI print and takes some heat off this Fed chair on day 2 of testimony down on Capitol Hill. Equity futures positive. Near session highs up 0.25% with an update on news worldwide. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Recapping the data we just got, U.S. producer price inflation unexpectedly decelerating in June, falling 0.3% month over month. PPI, excluding food and energy, increased 4.7% from the year before. The data suggesting the fallout from the Iran war did remain somewhat contained so far. SpaceX shares are on the verge of falling below their IPO price. Shares of Elon Musk's company closing $1 above their $135 a share IPO price yesterday. The stock has plunged 1/3 from its post-listing peak, erasing nearly $850 billion in value. In sports, Spain are into their first World Cup final since winning the tournament back in 2010. They beat France 2-0 after the favourites, who only managed 3 shots on goal. Spain will meet either England or Argentina in Sunday's final. And that's your Bloomberg Brief. John.
Looking forward to the game later this afternoon. Vonnie, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with the former US Commerce Secretary, Gina Raimondo, on the massive push to shape the nation's AI future.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
The U.S. economy is strong. We continue to be positive on the U.S. economy. There's a lot to be optimistic about. We're very bullish the U.S. economy. We're very bullish BNY and our strategy. We feel like it's working, and we kind of feel like that we have a lot of opportunity ahead of us.
Back-to-back record quarterly revenue from BNY. That was the CFO, Dermot McDonogh, following a fantastic roundup of Wall Street earnings. Equity futures so far this morning just about positive going into the opening bell. Stocks up by 0.2%, up by 0.5 on the Nasdaq 100. With your morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. Well, Morgan Stanley is bucking the trend that we've seen with some of the other big banks. Actually, not anymore. Shares are down 0.3%, even after the company had posted a strong quarter. Equities trading still to show. That jumped 69% to a record $6.3 billion. Investment banking also got a boost after the bank co-led the SpaceX IPO. So this wraps up what's been an exceptionally strong quarter for the banks, and yet a lot of them not seeing the jumps that you would think given these strong results. Meanwhile, BlackRock, we are seeing those shares moving higher, up 5% after the firm delivered a blowout quarter. It attracted $192 billion of new client money. That brings its assets under management to more than $15 trillion for the first time ever. It was helped by strong demand for its ETFs, active strategies, and private markets, all areas that attract juicier fees. And we are seeing BNY shares also slipping this morning, down 1% in the pre-market, despite posting a profit beat. And as you said, another record quarter for revenue. But the stock had already been on a huge run. Just yesterday, it closed at a record high. So it seems a lot of the good news had been priced in. John?
We've seen that movie a few times in the last 24 hours, that's for sure. Yahara, thank you. Appreciate it. Let's turn to this. The AI build-out growing as a political flashpoint. New York State leading the pushback, becoming the first in the nation to issue a moratorium on new hyperscaler data centers. PJM, the largest grid operator in the country, saying data centers have increased supply costs by more than 60%. The former U.S. Commerce Secretary, Gina Raimondo, is leading Raise US, a nonpartisan organization designed to help the American labor force adapt to AI. The Secretary joins us now for more. Madam Secretary, welcome to the program. Let's just start the conversation with the kind of work you're doing and what we need to know this morning.
Good morning. Good morning. So Raise Us is the new organization that I am leading, and our mission is very simple. You know, we want the U.S. to lead the global AI competition, but to have a strategy so that every American worker gets brought along. And right now we're not headed down that path, and it's something I'm deeply worried about. We have extremely outdated infrastructure, social insurance, support for workers, incentives for companies to retrain and redeploy instead of just laying people off. And so I think it's time that we get to work. We're working with governors of both parties. This is a nonpartisan, non-political effort with companies and just trying to find some creative, innovative solutions. Because I will tell you, one of my greatest worries is even if America has the best chips, the best models, the most data centers, but doesn't have an intentional plan to manage this transition and falls into a period of very high unemployment, we will lose the AI race because that will be too destabilizing.
What's your reaction, though, to what New York Governor Kathy Hochul is doing in terms of the moratorium? Because this potentially can slow down how quickly the U.S. can advance in the AI space.
Right. So I think this is a perfect example of what we're trying to do, which is to say Americans are worried, right? They're worried about when the average American hears AI, what they hear is, I'm going to lose my job, my electricity prices are going up, my kids won't have a job, I've just spent money for college. Those are real, legitimate, valid anxieties, and we have to find solutions to address them. So while I don't think, like, no one is happier than the president of China that we are slowing down data center construction. That being said, it's not okay if people's electricity bills are going up, or people's water bills are going up, or people's economic security is going down because of, you know, AI companies. So we must find a way to do both. Steam ahead with data centers and technology and make sure, you know, these companies pay their fair share so other folks' electricity bills don't go up and people have, frankly, a job, a meaningful job in an AI economy.
You recently wrote an opinion piece where you said what we need is a new grand bargain between the public and private sectors. When it comes to AI, what do you make of the Trump administration looking at taking equity stakes, another version of industrial policy that some of which started under the Biden administration?
Yes. So listen, I do think it is a good idea for the American people and the American government to share in the extreme profit and commercial benefit of AI. That being said, I personally have always been a bit of a critic on the government taking big equity shares of companies. You know, I'm still a believer in capitalism, however many flaws it has right now in the way it's playing out in America. And I just, you know, the government owning the means of production is, you know, the definition of socialism. I think it's creates a lot of potential for corruption. So I think the intention is a good intention. Personally, I just get very nervous if we're stepping down a path of like a state-owned enterprise, et cetera. So I'd like to find another way.
How do you balance the idea of trying to create some sort of pact with the U.S. Worker, with the U.S. average citizen, while also maintaining a U.S. edge versus China, right? I mean, do you want to sort of create this sense that there is isolation between the two stacks? I just wonder what the ultimate goal is, what the approach you're hearing from some of the folks you're speaking with.
You know, I think if you talk to the tech companies in AI, many of whom are partners with us and Raise Us, they feel that they're in a global arms race to, get ahead of each other and also get ahead of China and other technologies. And I understand that. But I will say this. If we as a nation put our blinders on, and if every company just moves forward at pace to implement AI, to increase profits without a people strategy. And if we wake up in a couple of years with millions or tens of millions of Americans put out of work because of AI, we will lose the global AI race because there will be massive regulatory backlash. It will be massively destabilizing to our economy. It'll be recessionary. It'll be massively destabilizing for our politics. So what I'm trying to say to business leaders, to governors, to Congress, to everyone in America is let's get together and find solutions. Let us be intentional about how we transition to an AI economy, because quite frankly, every American deserves to see themselves productive and having a good job in that economy. And until we convince the people of America that there's a good future for them in an AI economy, you're going to continue to see what you just asked me about, moratoriums on data centers, other kinds of uprising. And that's bad for America. That's bad for everyone in America.
No doubt that debate is going to continue. We look forward to covering it with you. The former US Commerce Secretary, Gina Raimondo there. Madam Secretary, thank you. Unfortunately, that debate, at least for the short term, has been hijacked by the political cycle, with the midterms very much top of mind.
Yeah, and a real question of how much you prioritize trying to win in the race versus understanding how to create a more sustainable path going forward. And you feel this tension, frankly, from some of the earnings and from some of the CEOs that are talking about retraining people. Yes, you have seen cannibalization from certain units, but they've retrained people to go elsewhere. So you're hearing this from the executives as well.
That wraps up earnings season on Wall Street. Take the rest of the summer off. Right? No?
All right, ciao.
No? Okay.
World Cup.
Kevin Walsh coming up in about an hour from now. Look out for that full coverage right here on Bloomberg TV. Coming up tomorrow, fantastic lineup of guests, including the United Airlines CEO, Scott Kirby, from New York City this morning. Good morning to you all. This was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions.
a poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Back to within 1% of all-time highs. 30 minutes to go until the start of your equity trade. I'm Danny Berger.
And why would you be surprised, Danny? I'm Bonnie Quinn. Open interest starts right now.
Coming up on the show, Wall Street's winning streak continues. Morgan Stanley delivers another record quarter.
Tech stocks advance as ASML offers fresh proof the AI boom is still going strong.
And we've got yet another tame inflation reading. Producer prices cool again as Fed Chair Warsh returns to Capitol Hill.
All right, let's take a look at some of those stocks to watch. Just mentioned it, ASML driving broader tech stocks higher after an earnings beat and raise. It also plans to boost production to meet demand. It essentially gave us an outlook right as far as 2028, Danny.
So that's driving tech stocks. And to everybody else, congratulations, you survived all of the bank earnings. You did it, and it was rounded out by Morgan Stanley this morning. They reported record stock trading revenue alongside all the other big banks. They say that the deal-making pipelines are full. We also heard from asset manager BlackRock. Total assets are now above $15 trillion. For the first time as industry-wide earnings top estimates. The animal spirits and financials are alive and well, Bonnie.
Well, let's get more on that, Danny. Indeed, from Bloomberg Intelligence financials analyst Neil Sipes. Neil, Morgan Stanley, the final one, bringing us to a close, really, for this earnings season, at least for the big brokerages. What about this $148 billion in net new assets in wealth management? What did they do to attract all of that money?
Yeah, so that's a meaningful number. And I think especially when we look at Morgan Stanley going after all of the larger banks yesterday, the wealth management franchise is the bread and butter of Morgan Stanley. They've been building that out for, over a decade now. And I think you're seeing some of the fruits of that sort of integrated wealth model that's attached to the institutional franchise, the capital markets unit that has been producing the eye-popping numbers that we've seen so far this earnings season. And when you look at that $148 billion in net new assets, that's about 8% organic growth. So that's pretty good within, the wealth complex. But interestingly, this quarter, and something that people have been focused on is, with these sizable private companies coming public, there's a lot of wealth tied up in that with the employees there. And so about half of those flows actually came from IPOs in the second quarter. Presumably a lot of that from SpaceX. And so with more mega IPOs on the horizon, whether it's in the second half or pushes into 27, it seems like that sort of flywheel of institutional and wealth can sort of propel this franchise.
It's remarkable to look at the equity trading. Also based off that, the results of having SpaceX come in, it's a perfect storm because not only that, just the size of SpaceX caused a lot of managers to rebalance, which creates more equity market volatility. Equity market volatility already alive and well because of AI. Those specific conditions, is that repeatable or even beatable for these big banks?
Yeah, I think that's where we stand today is the question of, okay, is this repeatable or is this the one-off quarter? I think that remains to be seen. I mean, there's nothing on the near-term horizon that suggests markets just shut off and turn dim. But that is sort of the idea around the trading businesses, and why analysts and investors tend to assign lower multiples to that revenue is because, okay, the second quarter was incredible. We had multi-billion-dollar beats in numbers that we haven't seen either ever or in a decade plus for the equities franchise. So what does the second half bring? What we can see on the investment bank side is, pipelines are full. Goldman Sachs posted the best investment banking fee quarter since 2021, which was a record when they reported yesterday. But they also said the banking backlog is at a 5-year high and increased sequentially. So despite all the conversion, despite all the fees and IPOs that came through, the second half looks potentially even better.
And Morgan Stanley shares are down now, but we saw the same with Goldman and JP Morgan, that they maybe wobbled in the pre-market and ended up, at least in the case of Goldman, much higher. It wasn't the same for Citi. And I wonder if there's some read-through between both Morgan Stanley and Citi. Morgan Stanley reported higher expenses than expected. And Citi especially is talking about this idea that they're going to lay off more people and make more investments into their business. And that's going to cost more. Is that enough to spook this market, just hearing of higher expenses despite other parts of the business being extremely strong?
Yeah, and I think that's the tough position where you are today, where I think a lot of that capital markets windfall that we're talking about today and sort of expecting in the second half, some of that may sort of fund the investments going forward, which of course brings into question operating leverage and how much that actually flows into earnings. So, obviously Citigroup has a longer-term transformation that they're undergoing right now, whereas for some of those capital markets-oriented franchises, I mean, you look at Goldman Sachs, you look at Morgan Stanley today, I mean, significant compensation ratio relief. So effectively, the revenue windfall from the capital markets business that's firing is flowing to earnings, and that's what you typically want to see from an investor base. Obviously, lots of ideas swirling around AI. Most of them have framed it as a productivity increase and sort of maybe absorbed through hiring rather than slashing heads and replacing humans with robots. That doesn't seem the base case today.
At least if they are, they don't want to talk about it because it's
right.
Bad PR. Neil, thank you so much for joining. Really great to have you on. Neil Sipes of Bloomberg Intelligence. Elsewhere in this market, tech stocks are leading the broader market higher today. ASML, which is key in the AI pipeline, reporting an earnings beat and raised its forecast. Bloomberg Tech's Ed Ludlow joins us in San Francisco. And Ed, maybe today's a good case study for SK Hynix of how it helps to have ADRs trading, because the ADRs of ASML are doing extremely well in the pre-market too. Some of these companies, even when they beat earnings, it's been disappointment. Samsung among them. Just how strong were ASML that despite a 75% rally year to date, we can still get a nudge higher on strong earnings?
Strong short-term and long-term. And SK Hynix is linked in there as well, because Korea is a really important end market for ASML. There's a lot of focus on the raise and beat, right? I think now sales for the year, 43 to 45 billion euros. What's happening behind that is not just that they are seeing demand accelerate on a longer time horizon. They talk about customers, both on the logic side, compute and memory, placing longer term agreements for the latest chip making equipment, but also they're servicing existing customers. The installed base is upgrading its technology, it's servicing its technology. Why did SK Hynix sell the ADRs? In part, they're going to buy ASML machines. So that's a big part of it. I would say look at the sell side summary. The analysts are very focused on how big a signal ASML's capital expenditure growth is, its commitment to improve capacity or boost capacity. But yeah, that certainly would seem to have cleared a high bar in the context of this year's performance.
Ed, what do you think about the Reuters report that Stripe and Advent are teaming up to buy PayPal? I mean, there's a lot of detail in this report, and PayPal is up 18%, so there's something going on out there.
I've been thinking about it a lot, Vonnie. I try to think at this time in the morning. I mean, we reported in February, right, that Stripe had expressed interest in part or all of PayPal. $60.50 a share in what's really interesting, by the way, in the context of deals, like Stripe, as Reuters reported, coming with private equity in Advent and saying, this is the premium, 28% to Tuesday's closing price, with no intention of breaking it up. And, a lot of people have seen logic in the idea for Stripe. Stripe is a juggernaut, but PayPal just has the consumer wallet. It instantly gives you access to a different market and makes Stripe a more holistic financial services platform. merchant, peer-to-peer through Venmo if they go ahead with this, right through to checkout. So it's an interesting one. I think we wait for a response, right, from PayPal's board. They have a new CEO at PayPal. They're trying to cut costs. What's really interesting, again, the analysts look at this and say, it's probably a sign that PayPal shares have been a little bit undervalued, and that, whether this goes through or not, there's a lot of opportunity in future for PayPal.
And you'd have to wonder about regulatory concerns as well. I'm sure we'll be revisiting this soon. Ed, thank you so much. That is Bloomberg Tech's Ed Ludlow. We also have our eye on the healthcare sector this morning. Johnson & Johnson shares dipping just a little bit after the company reported revenue for its medtech segment that fell short of expectations. The firm also posting mixed sales for its drugs. Joining us with more is Bloomberg's Madison Muller. What's the read across, Madison? Is this purely a J&J story? Is it a consumer story? Why the maybe slight underperformance?
Yeah, thank you for having me on. I mean, J&J is interesting because it is a really diversified company. The company has both drugs, they also have med tech devices, they make surgical tools, and typically that can be a boon for them. But when one of the units misses, like we saw today, came in a little bit below expectations on the med tech side, that can hurt their shares and hurt the sentiment among investors. So one of the reasons that their med tech business is coming in a bit below expectations is because of this company Abiomed that they acquired, and they make devices like heart pumps and things like that. And there have been some recalls there. There was also a recent study that didn't do as well as people had hoped, and that sort of hurt demand as well. So what we're seeing right now is pretty isolated to J&J, but J&J is typically one of the first pharmaceutical companies to report earnings, and so it can be a little bit of a bellwether for the rest of the sector. Although as of right now, it seems like this is maybe a bit isolated to a J&J situation.
We did see some maybe of the smaller healthcare players report earnings. Yesterday, Madison, the whole entire sector took a slump after HCA reported earnings, and they're talking about people losing their access to insurance via Obamacare. What exactly is happening there?
Yeah, so there were some changes and some shifting payment trends earlier this year, and that prompted millions of people to drop coverage this year. There are even more changes looming with some new eligibility rules for Medicaid taking effect next year. And so that's something that could also affect this sector, as we're seeing that could have come into play a bit with J&J as people potentially delay surgical procedures as they're unable to afford them. So that's something to definitely continue watching in this sector over the next year or so.
All right, Madison, thank you very much. Bloomberg's Madison Muller, the latest on healthcare. A check on your equity market this morning. We got fuel from yesterday's CPI report that put us within striking distance, less than 1% away from all-time highs. We gained this morning. It's being led by tech, up 0.5% for the NASDAQ versus the S&P's 0.25% gain, thanks to strong earnings out of the Netherlands, ASML, helping to carry us further. 10-year yields, those continue to come in. We saw a huge rally yesterday after CPI that was somewhat muted post-testimony from Kevin Warsh when he continues the Fed chair to talk about commitment to taming inflation. Brent crude still higher, though under $86 a barrel, Vani.
Let's get a look at some individual movers on our radar now, Danny. BNY Mellon profit beating estimates as revenue hit a record due to higher fees.
Meanwhile, some other bank earnings. PNC topped second quarter profit estimates. Higher net interest income and fee revenue helped offset a rise in credit costs.
Intel shares higher after ASML said that Intel had begun to use its most advanced machine for chip production, up more than 2% now.
Coming up, we talk more about inflation, another key gauge coming in tamer ahead of Fed Chair Warsh's Senate testimony. We're going to take a look at PPI numbers. That's coming up next. This is Bloomberg Open Interest.
say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Now to high interest now, a look at what's making headlines around the world. The US launched more airstrikes on Iran today, with President Trump pledging to intensify the bombardment until Tehran stops attacking ships in the Strait of Hormuz and agrees to open the waterway. Meanwhile, Iran insists the strait will remain closed until American attacks and the naval blockade end. The House has passed the Sunshine Protection Act, which would make daylight savings time permanent and end the twice-yearly clock changes. The bill passed 308 to 117, now heads to the Senate. Supporters cite brighter evenings and safety benefits, while critics say the permanent standard time is healthier. Over 400 CLO deals could see ratings upgrades after Fitch Ratings and Moody's proposed methodology changes. Now, the firms say they're updating outdated assumptions. Critics, though, warn the changes could revive pre-2008 concerns about ratings competition, while supporters say they better reflect how CLOs have performed. Danny.
Let's get more on the inflation data that was out this morning. Producer prices rose less than expected in June, suggesting the fallout from the Iran war remains somewhat contained. It also comes alongside Fed Chair Kevin Warsh returning to Capitol Hill today. Joining us now is Stuart Paul of Bloomberg Economics. 2 days in a row, softer readings when it comes to inflation. How much comfort can you take in these figures?
Well, it's at least favorable for the June PCE reading. That's really what I'm looking at the PPI report for. We get a lot of the inputs to the PCE from today's PPI report. And what we really saw is a major downside surprise in portfolio management fees. That's one of the major swing factors every month that goes into the core PCE. And it matters a lot for fine-tuning that PCE reading. Also, a lot of medical care services that feed from the PPI into the PCE came in pretty tame. One factor that is nudging up core PPI services that caught my attention was the margins charged by fuel retailers, right? Of course, you have the cost of fuel itself, but the margin that is collected by fuel retailers is an indication of the value of the service that's being provided by those retailers to firms, and so that counts as a separate category. About half of the monthly increase in core PPI services is that margin being collected by retailers. And now, what that matters is that the president has been really attentive to gasoline prices, because gasoline prices have not come down from where we saw commensurate with peak oil prices. That margin is creating a buffer. It's creating a little bit of a dislocation between what we see in retail fuel prices and global energy prices. And so the volatility that we're seeing in global energy prices is being buffered. It's being a little bit dislocated from what we're seeing at the retail level. And so just as we're seeing an uptick in global energy prices over the last couple of days with escalation in the Middle East, we probably will not see a commensurate increase, because that margin is creating a buffer. It's creating a little bit of a loose
Why not, though?
joint.
I mean, the margin goes up when the prices go up. So 2 questions. A, are we going to see this become a problem, or is it just too small in the PPI to, rear its head? And B, could the president go after the retailers as opposed to big oil?
It's interesting. So that margin widens when you have increased volatility and uncertainty in the outlook. And so while we have seen a little bit of additional escalation over the last several days, I'll say even major escalation over the last several days, even global energy prices have not risen in line with what we would expect with, let's say, the extent of the bombing campaign. So even global energy prices are not as reactive. That margin is not going to be widening as much as, let's say, we saw in March and April, given the fact that everybody is more fine-tuning their expectations for the outcome of the war and ultimately the flow of energy through the strait.
So we also had Kevin Warsh speak yesterday. The data originally led us to our biggest decline in 2-year yields since May. 10-year yields, they somewhat cap some of that decline. They still decline after Kevin Warsh basically says CPI data doesn't mean that we have reached mission accomplished. What do you make of that? Because he's someone that has been more reserved in commenting off data directly. Yet he gave us that nugget of information yesterday.
Yeah, so I think that Kevin Warsh has a few different jobs that he needs to accomplish in his 2 days of testimony. First, yesterday before the House Financial Services Committee, and today before the Senate Banking Committee. That first job is that he has to at least assert his independence from the administration. He has to appear to be willing to take on a president who has been advocating for lower interest rates. By asserting his independence, he's going to sound incrementally more hawkish. The second item, and it's related, is that by being a little bit incrementally more hawkish, he gets to talk down the long end of the curve, which is really what matters both for the federal government and ultimately for consumers, who a lot of their financing costs are tied to rates further out the curve, not the Fed's policy rate. And that's really what I think he was trying to do. In addition to buying a little bit of time, the CPI buys him some time to build a coalition on the FOMC.
Well,
and
he said that would be
decision.
his ideal scenario, right? Bring down longer end rates, and that would help the housing market as well, which is really the only way the Fed can do that. Stuart, thank you so much. Stuart Paul of Bloomberg Economics. Coming up, Victoria Fernandez talks about the signs she's watching for a peak in this bull market. This is Bloomberg Open Interest.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
strategists looking for signs that the bull rally is near the top. Crossmark's Victoria Fernandez says if profit margins are peaking, we would anticipate the labor market to begin to show cracks 6 to 12 months out. Keep an eye on consumption if earnings start to disappoint lofty expectations. Let's bring in Victoria. Victoria Fernandez, Crossmark Chief Market Strategist. And Victoria, you put it really well. Expectations are incredibly high, something like an upgrade of 20% on earnings year over year. Do you think that bar, is it troubling to you, or is this one that you think corporate America can easily meet?
It's troubling in the sense that we don't know how long we're going to be able to meet these types of expectations. So can we meet it this quarter? Probably yes. We have really strong profit margins. Revenue growth is strong. So it seems like we would be able to meet the numbers that are out there. The concern is this the peak? Is this as good as it gets for us? And it's downhill from here. And if so, then I think we're setting ourselves up for some disappointment. We'll have to see the market start to consolidate or pull back if earnings can't continue the levels that we're expecting.
Victoria, you say a market top is typically associated with, financials underperforming, credit spreads widening, money leaving the market, right? Credit spreads are not widening and financials didn't underperform. So is that proof enough that we haven't hit peak yet?
Well, at least it tells us that for right now, the market is pretty confident and we have these strong tailwinds. So you're right. When we look at credit spreads are about where they were a year ago. They've tightened in from earlier this year. So that's a support for the economy. We actually have some decent liquidity in the market right now. That's supportive of the economy. And you're right. When we look at money in this market, at a market top, money tends to leave and go to the sidelines. We're not seeing that. The conversation, as you guys know, over the last few weeks has been all about the rotation. So people are still wanting to be invested. They're still putting money to work. This tells us the tailwinds are there for now. But again, it's looking forward over the next few quarters. Are we going to continue to see that? Or do investors start to get really concerned that the profit margins are not going to stay where they are?
I was listening on Surveillance. They had on with them the Wells Fargo head of equity capital markets, and she made a really interesting point that one of the risks for year end is just the fact that this year has been so strong. And given all the volatility and uncertainty, maybe you just have more people taking profits and less willing to participate in this market. Is that a risk, Victoria?
It is a risk, Danny, and I don't think that's necessarily a bad thing. I mean, we tell our clients all the time, when we've made, really good profits on a certain name, we feel like it's gotten maybe a little bit overbought. There's nothing wrong taking a bow, trimming some positions, taking that money and putting it to work somewhere else. And I think we could see people start to do that, especially as we get more and more concerned around CapEx. Obviously, IBM yesterday made a lot of people concerned around, are we going to see that CapEx? I think the phrase they used was reprioritization, going more to hardware than to software. We could start to see some profit taking, and that would be supportive again of the rotation as long as people see positive earnings and profit growth going forward.
All right, Victoria, you're going to stick around with us through the opening bell. Victoria Fernandez, as stocks rally, again, just minutes to go until your cash trade.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back. It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Just seconds until we start your trading day. This is Bloomberg Open Interest. I'm Danny Berger. And it might not feel like it, but we're not too far away from all-time highs. We just need to gain less than 1% to get there. We're up 0.25%, not quite there at this moment. The NASDAQ outperforming. That is up 0.5%. Some good earnings in the Netherlands for ASML, helping to revive some of the AI trade, though some of the chip stocks are selling off again. The Dow, that is up 0.2%. Down at the New York Stock Exchange, we have the hosting committee for the New York, New Jersey FIFA World Cup tournament. Do not try to contact me at 3 p.m. I will be rooting on England. Don't give me your bullish predictions on Argentina. I don't want to hear it until after that game is over. Okay, maybe more importantly, Mike, I'm just going to ask you if you can come in and just zoom in on these adorable faces. I'm going to step out. You don't want to see me. You want to see these adorable little doggos down at the NASDAQ. This is the North Shore Animal League America. They are apparently the largest no-kill rescue shelter in all the United States, and that is important. And I don't know why they're at the NASDAQ, but I'm so happy they are because it's so cute. I love it. Okay, back to these markets. ASML, again, that's driving some of this tech trade higher. It's up by nearly 2% in the U.S. trade for their ADRs, and earnings beat and raised. It also plans to boost production to meet demand. Again, the chip makers selling off, Vonnie, this morning. SanDisk down 3%. It might just be because, I don't know, they had a good day yesterday, and it's a ping-pong narrative, and they move not necessarily on any news these days.
Yeah, I mean, SK Hynix itself, the ADRs were up 27% yesterday, Danny, so I think there's a lot of churn going on in this market. Meanwhile, Morgan Stanley reporting record stock trading revenue and a huge inflow of assets for its wealth management business. BlackRock total assets are above $15 trillion for the first time as industry-wide earnings top estimates.
Let's bring in Crossmark Chief Market Strategist Victoria Fernandez. And Victoria, let's start on those bank earnings. Incredibly strong. The reaction wasn't even across the board, but for most of them, huge gains like Goldman Sachs posting in not just record trading when it came to their equities business, but also its best day in terms of the trading of the stock itself since we had Liberation Day. What do you take away from these bank earnings? Is it something to give you cheer, or is it something that looks less repeatable, just given SpaceX's IPO and the market volatility they were able to capitalize off of?
Well, we do know, Danny, that the IPOs gave a lot of lift to them, especially when you look at Morgan Stanley and at Goldman. I think the numbers for Morgan Stanley was 148 billion in new assets coming in that were tied to the SpaceX IPO. So I'm not sure we can repeat with those same types of numbers, but I do think it supports the idea that financials are doing better. They're in that uptrend. They're continuing to produce new highs. We had 50% of the banks in the sector yesterday in the S&P finance sector actually hit 3-month highs. So there is a trend there, and I think it's an area we're investing in, and I think it's an area that you can look at going forward to maybe rotate some of those funds out of tech into the financials for the coming months.
It's interesting, though, Victoria, isn't it, that, at a time when we've seen record volumes, we are now seeing actually pretty low volume. Have people started to step away from their desks for the rest of the summer, or what exactly is going on?
Maybe so. Maybe they're all going to the game today like Danny wants to do, right? I don't know. Maybe World Cup is getting people moving around. And it is the end of the summer. You do start to see some thinning and trading as we come, and you start to see seasonalities change as you go into the end of July and the beginning of August. So there is an element of that that's coming to fruition here. But I also think you're looking at new escalation in the U.S.-Iran war. You're looking at an earnings season, and so people might be sitting a little bit here and waiting to make their moves until they get earnings numbers or until they get better clarity as what things are going to look like in terms of energy and commodities.
You've also noted, Victoria, that much of this earnings season rests on the shoulders of the consumer. We haven't gone full force into consumer earnings yet. We maybe got a sneak from Pepsi last week, and it wasn't fantastic. I wonder, is that very specific to consumer staples and discretionary, or is it enough to upset this overall equity market, just given at the moment gains have been incredibly narrow surrounding AI-related companies?
Yeah, I don't think it's just the consumer sector that we have to worry about because it's a much broader issue. The concern around the consumer is going to come from the fact that if we do see profit margins start to weaken, if we do see layoffs start to pick up, then that's going to affect consumers and all of their spending, right? Not just that discretionary spending, but across the board. So I do think consumers right now are supporting a lot of what we're seeing in the economy. Obviously, they've had boost from the One Big Beautiful Bill, from tax refunds. They've been spending down their savings, but that can't continue to go on for very long. So we have to be mindful of what it looks like, especially when consumption is growing faster than incomes. And obviously, World Cup and Prime Day probably helped those numbers over the last few weeks. I can say I was part of the Prime Day buying frenzy that there was, but I do think going forward, we might see that pull back, and that's going to be a concern across the board.
Victoria, what was the fallout from the SpaceX IPO? Will we see Anthropic and OpenAI delay their IPOs because of this? Or, I mean, are conditions so good that why would you delay?
You know, Lonnie, it's true. We have seen, I think, already some narrative around those getting pushed further out. We were expecting them to be, I think, before September, and now it looks maybe they might be later in the year or even going into 2027. I do think there might be a little bit of hesitancy, and some of that related to cost of capital that we're seeing, yields moving higher, more concern on the geopolitical side. So perhaps there's some other reasons that are feeding into having a delay, but I would expect them to come to market over the next 6 months or so. And I would expect them to be oversubscribed, just like we've seen on SpaceX.
How is that still the case, Victoria, with just the amount of supply that's come to market, be it SpaceX, some of these other IPOs, a cross-listing, the biggest ever from a foreign company in the way of SK Hynix? I know a really big bullish thesis for not just the equity market, but credit markets too. It's just there's a lot of money on the sidelines that needs to get put to work. Is there a level, or is it just so far away at which there's enough supply that starts to tip that supply-demand balance?
Look, demand is there. I mean, it doesn't matter, it seems like, what's coming to market. The demand is there and it's soaking it up. Even if you see it in the credit markets, like you mentioned, we've seen a lot of the hyperscalers come to the credit markets. Those are oversubscribed. We see it in the SpaceX IPO and then SK Hynix, like you mentioned. There does not seem to be a lack of demand from investors that are wanting to put money to work. And I know there was a lot of discussion around maybe that's part of the rotation trade that we saw, people getting money to have kind of arrows in their quiver for these elements that are coming into the market. But it seems like, you know, investors are ready to put money to work in these areas. They see long-term growth potential there, and they're not worried about balance sheets as of yet. That could become an issue further on as we see free cash flow continue to decline in some of these big tech names. But for right now, investors are game and ready to go.
Victoria, so wonderful to have you on. Thank you so much for joining. That's Victoria Fernandez of Crossmark. About 8 minutes into your trading day, let's get a check on your equity markets. And again, we rise higher. We need to get to, I think it's 76.09 or thereabouts was the last record. So we need to surpass that in order to hit another record. We're not too far away. We're gaining about 0.5% so far this morning. What is leading us there? It is Mag 7 in the big cap tech. Apple, Amazon, Microsoft, Broadcom, Tesla, Alphabet, all leading the charge. Bank stocks continue to rally with JP Morgan and Bank of America. One of the interesting things, Vonnie and I were talking about this, the fact that chip makers are declining today and a lot of the memory stocks. It feels like this trade that you can't have both the Mag 7 and the chip makers gaining in the same day. One of them is up, the other one's going to be down, and that's still the case today with Micron and SanDisk leading the declines in terms of points moved to the S&P. A really bad day for healthcare too. Eli Lilly is down. Elevance Health is down because J&J had pretty poor earnings. I don't see J&J on the biggest decliners list, interestingly enough, but it is bringing down all of healthcare with it. And if you look at the sectors, healthcare is the worst performing. That safety stock index, or now it's energy, actually. It was healthcare just a moment ago. But both of them are pretty evenly tied, down about 1/3 of 1%. And then at the top, you have consumer discretionary, communication services with the big Mag 7. And again, financials having a very strong day yet again, Vani.
Yeah, we didn't get quite the bump from the PPI that we got from the CPI, that's for sure, Danny.
Yep, already priced in.
Yeah, exactly. Coming up, Goldman's global co-head of Capital Solutions shares his outlook following a blockbuster quarter for the bank. This is Bloomberg Open Interest.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the 3rd floor or the lobby. You actually have to start in the basement.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
All right, let's get a little check on markets now. As you can see, we are higher on all of the major averages, but not by as much as we were earlier. That PPI boost not holding, right? So we got the CPI yesterday and markets really rallied. And today, just a little bit more trepidation. I would say as well, the ASML call is about to start. And so investors have actually erased gains in ASML. They had been higher earlier after we got basically a 3-year outlook for those chips. But as you can see, all of the major averages are higher. Time now for top calls. Some of the analyst action in focus this morning. First up, Oppenheimer is cutting IBM in the wake of its negative pre-announcement that spurred an historic sell-off in the stock. The firm says the miss makes it harder for IBM to hit its full-year outlook or deliver on double-digit growth. Still higher, though. Next up, Allstate is getting downgraded at UBS. The firm says Allstate's underwriting margins are likely to deteriorate over the next 6 months, and that would lead to declining earnings and a higher risk of earnings misses. And finally, Raymond James downgrading Checkpoint Software, saying the cybersecurity company's comeback is taking longer than expected. The firm points to slowing demand and a weak second half sales pipeline. And that's interesting because the cybersecurity firms actually had a nice little bump off the IBM CEO's comments yesterday, Danny.
Let's get back to bank earnings, though. And Goldman Sachs delivered a blockbuster second quarter with debt underwriting hitting a fresh record. Equity underwriting more than doubled. I spoke with Mahesh Reddy, who runs the business that oversees all of that. He is global co-head of the Capital Solutions Group at Goldman Sachs. I asked him about those results.
If you take a step back and look at what's driving this, right? There's three different themes that are driving this. The first one really is what's happening with AI and CapEx globally, right? It's again, the numbers keep going up every day, but let's call it like 7 to 9 trillion of CapEx that has to happen into AI over the next 3 to 5 years. Theme number one. Second theme is what's happening with our merger franchise. You look at M&A activity, year to date, we are already at 3 trillion, probably end up with another record in terms of total M&A volume. And then the third thing is the private capital that keeps coming into the market, right? So we have about 14 to 15 trillion of AUM sitting with the private capital. So if you combine all of this, it kind of plays right into our debt and equity businesses because all these things need capital, and we are sitting right in the middle of all of this. So to your specific question, I do feel that the momentum that we have, the tailwinds we have from all of these, I think are going to keep markets pretty active for the second half for sure.
Kind of a new baseline, would you say? This is the new normal, just considering all the trends you're talking about?
Now, obviously, as with everything, right, it will never be a straight line, right? So as we're just talking about, the markets always will have some volatility, right? So we will see these phases, but if I take like a longer horizon and look at kind of these themes that are there, I think these themes are here to persist. I don't think these themes are going to go away anytime soon. So I would think of this as like we're in a market where everything is bigger and there's going to be more activity.
Let's pick through some of those themes, and starting with AI, because the amount of supply that has come to market for AI has been quite remarkable, and you've kind of been at the forefront of all of them, whether it be SpaceX, whether it be SK Hynix. On the debt side, we've also had huge issuings too. I think Amazon alone has offered about $100 billion so far this year in debt markets. What happens when that much supply comes to market and it continues at pace, considering you have a lot of the same capital competing for it?
Yeah, so let's look at some of the data, right? Like, this year to date, there's already about 1.4 trillion in IG issuance in the US. 20% of that is something related to AI. But I think the more important thing, Danny, there is this year alone, there's 10 deals that got done, which are 20 plus billion. And to contextualize that, over the last 7 years, that number is about 11. So we are seeing a lot more deals which are much larger in size. And even with all of that, now again, obviously spreads widened out a little bit over the past week, especially, right? Like the IG universe overall still is largely unchanged, whereas the hyperscaler spreads are widening probably at around 30 basis points over the last week. So I think the supply absorption capacity is there. I think it's just a question of like what is the pricing at which it gets absorbed. That might change depending on kind of where we are in the cycle and asset allocation. But big picture, though, we feel there is a lot of capital that's available to kind of fund these things. So, but we will have gyrations in the market. That's pretty normal for any.
How do you distinguish between a gyration and what we're seeing now with the spreads widening versus saying, okay, this is a market that has become more discerning. It's not just going to buy every debt. It's not going to buy every single equity offering that comes to market. Is this a market that's getting more selective?
Yeah, I would say there's a stat that we spend a lot of time looking at, which is kind of the single name equity wall versus index wall. So if you look at kind of like, so index is kind of a representation of what the market thinks about broadly how is the economy going to evolve. So index wall is actually as low as it's been. Whereas single name wall is the difference between single name and index wall is as high it's been. So that goes exactly to the point that you're making, which is markets are very discerning about each and every name. Like pricing a single name actually is a much more of a premium right now because we're in a very uncertain world. We're in a world where the impact of AI and how it's going to evolve is very uncertain. So there is going to be name-by-name analysis that has to get done.
Do you think that makes more companies who have yet to come to market? I'm thinking of an OpenAI. I know there's some rumors about Samsung doing an ADR. They've since denied that. But do you think it makes companies more hesitant to come to market than maybe they were in the first half, just given the volatility that we've seen erupt?
I think what we really find is like the companies which have a good underlying story, especially again, anything around AI theme, I think there is still so much appetite from the market that I don't think this is going to change anything. Now, again, the timing might be different. If some macro thing changes, that could kind of postpone some of the things. But bigger picture, though, I do think this momentum that's there in the AI theme, that would mean more of the companies will be tapping both equity and debt markets.
Well, let's go to private capital, where I know you spent a large chunk of your time as well.
Of course.
Private capital has seen this backlog. Your colleague David Solomon was talking about it on the earnings call, basically saying that, yes, M&A markets are really robust, but we have seen sponsor activity lag below its 10-year averages. What brings back private capital and private equity specifically? Yeah, so if you kind of, again, private capital itself obviously is a much larger space. If you break it down between private equity and private credit, we can come back to private credit, but private equity is really where there's been a little bit of a jam, right? If you look at the numbers again, there is about $4 trillion of assets that have to kind of get disposed of by private equity. But the stat that I'm very focused on is the average time it takes for an asset to get disposed. And that's at 7 years right now. And that's an all-time high, right? So, and the other stat that we spend a lot of time thinking about is the return of capital, which is what LPs are very focused on. And that's kind of been around the 10 to 12% range over the last 3 years versus averages of 16 to 17. So I think there is some work to be done there. The kind of the software hiccup that has happened is not helping that too. So private equity overall, I do think will have a little bit more time before kind of it gets back to its normal run rate in terms of capital return, etc. But having said that, I think one of the things that all of us tend to do is when these trends emerge, we tend to kind of, go in two different directions of like, oh, is this the end of, what's happening with private equity? And in a world where if you look at the overall equity capitalization, it's about 150 trillion now, globally, right? So that needs private capital. So on a 3 to 5 year horizon basis, I think this backlog will get cleaned up. But does the backlog get cleaned up by capitulation? That's something Scott Kleinman of Apollo has said. Do you think that's what these funds are going to need to do to clear it up?
I think it'll be a combination of things. Again, we are seeing that obviously in terms of like valuation discounts that companies are comfortable taking versus historical. So there will be some valuation reset for sure. I mean, some companies will obviously benefit from the AI tailwind and they'll probably perform well. And some will actually come to the public markets, but I think it's going to take some time.
That was Mahesh Saireddy of Goldman Sachs off the back of record earnings from Goldman Sachs. Coming up on the show, Palantir Chief Technology Officer joins us to discuss the future of defense technology. Right after this break, you're watching Open Interest.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ula, Saudi Arabia, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins.
We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Let's head to the U.S. Army War College, where defense and technology leaders are gathering this week to discuss the future of America's defense industrial base. Bloomberg Washington correspondent Tyler Kendall is there with Palantir's Chief Technology Officer. Tyler.
Hey, Danny, thanks so much. As you mentioned, I'm pleased to say I'm joined now by the Chief Technology Officer of Palantir, Shyam Sankar. Shyam, it's so nice to see you here on a day where we are talking about bolstering the U.S. defense industrial base, made perhaps even more urgent by the fact that we are seeing the conflict in Iran. The Pentagon keeps asking defense tech to move faster. Can you give us a status update on what the relationship is right now between innovative companies and the Pentagon, and what hurdles still remain?
Well, I don't want to sound too Pollyannish, but I really think this team at the Pentagon has dismantled almost every hurdle that exists and has sent a clear signal that they want to hear about the remaining hurdles that people do confront. They've sent a clear message that this team should meet the urgency of the moment here. And while we can look at the conflict in Iran and look at the rate at which we're expending munitions, really this is a challenge that's grown over the last 30 or 40 years of how we've managed and thought about our defense industrial base.
I'm not sure if everyone would agree with the fact that the Pentagon has dismantled the hurdles. What about when it comes to defense spending, for example? I'm curious how you're tracking that. The Trump administration has requested $1.5 trillion, seeming to indicate that there is a big need from the administration's view to help bolster our own capabilities, including when it comes to replenishing our stockpiles.
Well, I think it's going to be very clear that we need both more of our existing exquisite weapons, and we need capital to invest in a whole new class of weapons to meet the asymmetry of the moment here. And the side that moves faster is going to win. And our exquisite weapons are amazing, but most of them we really built in the 80s. And they've been designed in a way that meets the manufacturing of the 80s. And we're starting to see enormous success with a whole new generation of weapon systems. We look at the Saronics kinetic strikes in Iran just a couple days ago. We look at the success that these new platforms are happening in conflicts in Ukraine. We need to be moving capital there. If you look at the 27 budget, there's a huge amount of resource that's made available to these autonomous systems and to AI, which really, I'd say the Pentagon has actually been one of the fastest places to adopt AI in the American economy. Given the stakes, they're existential, it's a binary win-lose. Nonetheless, they've done all of that by essentially cobbling together budgets from various line items. 27 will be the first time they put a real stake in the ground, real capital that's committed to accelerate the pace-setting projects that will drive us to an entire revolution in how we fight.
So part of this is about keeping the U.S. competitive, and we saw the other week the French government actually decide to end its relationship with Palantir, in part because of a need to bolster their own domestic capabilities. And we're seeing this play out among some other European allies. Talk about this concern about being too reliant on U.S. tech. Are you concerned at all about Palantir losing a foothold in Europe, or that this could expand to other international markets that you're part of?
The product really stands for itself. I think serious people, the Germans have looked at it, they've examined the software, they know there's no backdoors in it. There's a huge part of this that really comes down to almost an economic argument of we really want to spend our money on our own companies, and I don't begrudge them that. I think the kind of vicious, underhanded campaign of lies and rumors is probably beyond the line of what's fair there. But every country should make a decision based on what's going to give them the most amount of deterrence. And clearly the U.S. has carried the load there. We have the most experience, the most reps, the most innovation stimulus here. And I think it's going to take an entire allied Western force to really confront the challenges across the axis of authoritarianism that's clearly present and creating chaos in the world.
Well, I'll keep on the international theme, if you will, because we're seeing U.S. companies start to use Chinese open source LLMs. From your view, does this pose national security risks?
Well, I think it poses, my view is that national security is not an end unto itself. It's a means to an end. And the actual end is American prosperity. And so I think it poses a threat to American prosperity. These Chinese open source models are really the result of distillation attacks. Most of this is just stolen American IP from Frontier Labs. And I think the Frontier Labs should do more to protect that IP, and that's in their own economic interest. But I'm less worried about it in the present moment because the gravest threat to us is not homicide, it's suicide. It's an inability to turn these tokens into economic value and generate American prosperity for it. You see that with the proposed moratorium in New York on data centers. Like, turning our back on AI would be as consequential a mistake as turning our back on the atom in the 70s. And we're starting to see a burgeoning, it's just the beginning, but a burgeoning US open model ecosystem forming. NVIDIA's Nemotron models are very good. I think you're going to see in the next month a slate of announcements of other American companies, non-Frontier Labs, sometimes called Neo Labs, who are putting out open weight models that companies are going to be able to cheaply fine-tune and capture their own alpha in weights they control.
In the final minute that I have you, part of the U.S.'s strategy when it comes to national security has been to have the government take equity stakes in companies that are deemed critical to national security. We know the idea has been floated when it comes to some of these Frontier Labs. I'm wondering what you make of this strategy. Is this the right way for the U.S. to go about it?
Well, I think it's very case dependent. I'm glad it's an option on the table. I think for some companies where they need a huge equity injection, it could make a lot of sense. For other companies, based on where they are in the mix of business they do between the commercial and government world, I'm not sure it makes as much sense. But I'm glad it's an option that's on the table. It should be a consideration.
All right, Shyam Sankar, the Palantir Chief Technology Officer, thank you so much for joining us here on Bloomberg Television and Radio. This has been a conversation on the sidelines of the Defense Summit here in Pennsylvania, and I'll toss it back to you.
All right, Tyler Kendall, thank you so much. That is Tyler Kendall there with Palantir's CTO. Just want to point out that we erased all of our gains in the NASDAQ 100, but we've actually just put on a couple of points again, so we're still in the green, barely. We are much
From ABC News, I'm Chuck Sievertson. Right now in Capitol Hill, Acting Attorney General Todd Blanche will face questioning by members of the Senate Judiciary Committee, who will decide whether he gets the job permanently. They're all making opening comments. Senator Chuck Grassley is the chair.
The Senate has already judged your fitness for high office and confirmed you as the department's second in command.
The top Democrat on the committee, Illinois Senator Dick Durbin.
The Attorney General is the chief law enforcement officer of the United States of America. Since you were confirmed, the Department of Justice has literally violated dozens of court orders to advance the president's agenda.
Blanche had his opening statement, too.
In recent years, we watched the Justice Department turned against many of you and a former president, and it damaged the public's faith in justice. We are fixing that.
Questions could range from the handling of the Epstein files to the so-called anti-weaponization fund. The U.S. military says it fired missiles at Iranian missile launch and storage sites in the first daytime attack since the first 5 months and a half of the war. A new threat from President Trump today, setting a next Wednesday deadline.
We're going to knock out all their power plants. We're going to knock out all their bridges unless they get to the table and negotiate.
Iran's threatening to stop all energy exports from the region. New numbers about the cost of living this morning. The Producer Price Index, tracking prices at the wholesale level. Declining energy costs in June helped to drive down the index 0.3%, but prices were still 5.5% higher than a year ago. President Trump posts on social media that vehicle stops by immigration police cannot be suspended, as was announced by an ICE official hours ago in an email after recent deaths during traffic stops in Maine and Texas. Unclear if the stops will be paused. You're listening to ABC News.
Wireless companies in America, only one has 5 stars in every category from Consumer Reports, and that company is Pure Talk. Coverage, support, value, data. 5 stars across the board. Plus, no service contracts and no cancellation fees. Just phenomenal U.S. customer service on a crazy fast 5G network. Dial pound 250, say micro, and switch to a 5-star American wireless company that won't let you down. Pure Talk.
Ever wonder why you have insurance for your car or home, but not your digital life? Meet WebRoot Total Protection, your digital bodyguard that includes antivirus, identity protection, VPN, cloud backup, and more. With plans for individuals and families, WebRoot takes the guessing game out of cybersecurity so you can get back to living your best life online. Go to webroot.com/protect and get 60% off today. That's webroot.com/protect to get 60% off today. Live a better digital life with WebRoot, because peace of mind shouldn't be optional.
Some of the same parts of Texas devastated by flash flooding last year could get hit again today, west of San Antonio, says ABC's Jim Ryan.
Among the 59 counties covered by Governor Greg Abbott's disaster declaration is Kerr County. Catastrophic flooding of July 4th, 2025. The current threat provides the first real-world test of warning systems, including audible sirens that have been installed throughout the Texas Hill Country in the 12 months since the disaster.
ABC's Jim Ryan in Dallas-Fort Worth. Confirmed cases of Ebola in the Democratic Republic of Congo have reached over 2,000, including over 750 deaths, says government data. Today's the second semifinal in the World Cup. Defending champs Argentina facing England, this after Spain beat France. Games in Atlanta at 3 p.m. Eastern. A normal workday for tree trimmers Isaac and Andrew Reyes in Ponca City, Oklahoma, turning into a long road to recovery. A cable snapped. They both fell 45 feet to the ground. Isaac.
Both knew it was going to happen. He blew right through his bucket on the ground, and my legs absorbed all the force. And, yeah, it's pretty much the last thing we remember.
Isaac has a broken leg and 2 broken ankles. His brother Andrew has a fractured jaw and a broken nose.
It's definitely a blessing. Shocking for sure. Blessing. A lot of good people in the city.
That comment noting how friends and family set up a GoFundMe online, and a local restaurant is hosting a fundraiser. Chuck Sievertson, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're streaming live on YouTube. We are streaming live on Bloomberg.com/video. Coming up today, Fed Chairman Kevin Warsh testifies before the Senate Banking Committee. We will start and carry that Q&A when that starts later this hour. We're going to talk to Neil Sipes, Bloomberg Intelligence U.S. financial analyst, on earnings from Morgan Stanley and BlackRock. Some strong numbers again coming out of Global Wall Street. Carol Schlief, Chief Market Strategist at BMO Wealth Management, will come on and give us her thoughts on these markets. But again, most of this Bloomberg Intelligence program will be for the Kevin Warsh testimony in front of the Senate Banking Committee. It's Scarlett Fu and Paul Sweeney live here with you. Let's start off with a Bloomberg Business Flash. We go to Alexis Christophers. Alexis.
All right, thanks a lot, Paul. And this Bloomberg Business Flash is brought to you by IBKR. For the past 3 years, Interactive Brokers' individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170-plus global markets matter. Visit ibkr.com/performance. We have got an up picture here in the early going on Wall Street. All 3 major indexes higher across the board, with the S&P 500 up about 31 points. Dow Jones Industrial Average up 168 points, or 1/3%. NASDAQ Composite up about 0.7%, or 180 points. This is after back-to-back days of tame inflation. Many traders now betting the Federal Reserve may not have to raise interest rates possibly at all this year. We've also got crude oil on the rise once again. Brent crude actually is now down 0.1% at 84.56 a barrel, but WTI crude is up 1/3% at 79.57 a barrel. Shares of Nexstar Media Group up about 7% on news the FCC is expected to repeal a nationwide audience cap that has limited the number of TV viewing households that a single broadcaster could reach. So the deregulation is key for Nexstar's acquisition of Tegna, which would roughly reach 80% of U.S. households. Also, quick check of IBM up 1.5%, trying to make up some ground after plunging 25% yesterday after that rare earnings warning. And that is your Bloomberg Business Flash. Back to Paul and Scarlett.
In a prior life, I was banking, covering the TV radio station industry, and they had a lot of radio ownership restrictions loosens, so you got really big radio companies and TV companies.
Exactly.
But the last one to fall is this one, which just says you have a cap on how many you can cover around the country. And the FCC just threw that out. We've been pushing for that for like 25 years.
You missed the boat on that one, Paul.
Don't worry. The Telecom Act of 1996 was about 1,000 pages.
Yeah.
10 pages were for deregulating the radio industry. I made a career off of those 10 pages.
I'm sure you did. Well, they rolled that back today, or it
Yep.
looks like they're going to. It's not official
even
yet.
Better. So anyway, they can close that deal. All right, so a lot going on out there. Alexis Christophers, Scarlett Fu, and Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. As Alexis was reporting, some green on the screen out there, but let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Avalon Purnell. Avalon, what are you looking at?
We have to start off with PayPal. That's ticker PYPL. It's currently surging about 16%, most intraday on record. And that's after Reuters reports that Stripe and a private equity firm named Advent International have made a joint offer to buy the company for about $60 per share. That deal would value the company at more than $53 billion. And analysts are definitely quite bullish about it. KeyBank saying that while a PayPal mega deal wasn't expected this year, it remains interesting and kind of unclear to see how willing the PayPal board will be to pursue the takeover offer. And also worth noting that Bloomberg Intelligence analysts write that the bid could leave room for a higher offer.
Okay, so we'll keep an eye on that one. And of course, if anything does come out of it, we will be covering it on Bloomberg Deals, which airs every Wednesday at 12 p.m., hosted by Danny Berger and myself. Just a shameless plug there. Let's move on to the second stock you're watching, Elevance Health, which is a weird name because you don't know what companies it owns.
Yes, that is ticker ELV. It is a managed care or health insurer. It's currently dropping about 8.8% most intraday since March. And that's after the insurer's full year profit guidance boost was just a little bit lower than its second quarter beat. Jefferies analyst writing that the small beat and raise was very unlikely to satisfy the market after a recent rally in managed care stocks since the first quarter. And this is driving their peers like Humana, Molina, and Bellwether United Health lower this morning, which we will be getting United Health's results tomorrow as well. So it will be interesting to see how that changes the sector.
Absolutely. And Elevance Health, by the way, is the owner of Anthem, along with a bunch of other brand names that you probably have heard of, like WellPoint and Amerigroup. Paul?
And Anthem is our insurance.
Yes, it is.
Right?
Yes, it is.
Full disclosure there. Okay, one more here.
Yes, ASML, ticker ASML. Those ADRs are currently edging up about 0.4 of a percentage point, and that's after the chip equipment firm raised its full year guidance. Analysts say that the outlook for tools generally exceeds estimates, which should ease investor concerns about the supply constraints. Morgan Stanley specifically noting that while the company no longer reports on bookings, the company did talk about very strong order intake continuing across the first half, and also customers looking to accelerate capacity expansions, which obviously will be good news for the stock.
All right. Thank you so much, Avalon Purnell. Avalon is one of our equity reporters here at Bloomberg News. And for more conversations like this, be sure to subscribe to our Stock Movers Reports, where we offer 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. It is all about the big bank earnings. Yesterday, we got a bonanza, 5 of them. Today, we get the last of the big 6 banks, and that is Morgan Stanley. BlackRock also reported as well. So let's bring in Neil Sipes. He is Bloomberg Intelligence U.S. financials analyst. And Neil, the takeaway from the big banks results yesterday was that trading revenue has gone gangbusters. And I think we got more proof of that today from Morgan Stanley.
Yeah, we sure did. And I think you've seen it across all the names that have reported so far. I think a lot of people have been using eye-popping numbers, right? I mean, beats that are in the billions of dollars in beats, not numbers we're used to seeing. We'll put it that way. And I think, again, the trading business, I think where we stand today, we've seen really strong equity markets, particularly in the second quarter where you had sort of a V-shaped recovery really at the beginning, around the Middle East tensions sort of easing off of a cliff. And then you had, of course, SpaceX IPO. There's rumors of more coming either in the second half. Maybe they get pushed into 2027. So there's tailwinds there that have been driving this activity. There's themes like Asia. There's themes like AI. All of this is sort of fueling particularly equities trading. Again, when you think about the trading business, it's kind of fickle, right? So the repetitiveness of something like the second quarter that we saw, I think that's what people are asking is there more to come? On the investment banking side, I think the answer is yes there, right? Because we see really strong pipelines. We see Goldman posting the best fees since 2021 and saying the pipeline's actually higher than it has been in the past 5 years, which, by the way, was 2021. So it feels like second half even better in that business.
How much can you count on the pipelines to deliver? I mean, it's stuff that's in progress but has not, been finalized or completed. So is that basically as good as it gets?
Yeah, and to be fair, the pipelines there's always optimism in the pipelines, even when things are not that great. So I think that's where we stand. Is you have to have the inputs to execute on that pipeline, and the biggest inputs are really the markets, broader sentiment,
makes sense,
macro conditions. All of that sort of feeds into, okay, are these deals actually going to come to market? Are capital issuers and capital providers all willing to meet at the same time? And the conditions have generally been there, aside from a couple brief moments in the past couple of years, and the expectation is for more of that to come. But you snap your fingers and markets go against you, all
True.
of that can sort of ice over for at least a couple weeks, if not longer.
When I think of Morgan Stanley, and I think a lot of investors, they want to get a sense of the private wealth business, and because it's such a big part of their business and they're so good at it. What are they saying about that business?
Yeah, so it's it's over half of earnings now for Morgan Stanley. So it is really the driver of the franchise. Again, the headlines are generated by capital markets because it can swing so much. The through the cycle ballast is wealth management, and I think that business, again, market dependent, it's firing, right? We got margins at 30%, which is the target, organic growth at 8%. I think an interesting component here in the second quarter was the sort of windfall of flows coming from the IPOs that we saw in the second quarter. So you think about all the wealth that's tied up, within employees and early investors in something like SpaceX. Almost half of the $150 billion of flows was derived from IPOs in the quarter that Morgan Stanley was involved in. So you think about that flywheel. I mean, that's Morgan Stanley in a nutshell.
That number is so big, it's kind of hard to believe.
Yeah, I never heard something like that.
$150 billion in net new assets in its wealth management business in a 3-month period. That's kind of nuts.
Yeah, I think the only one that comes to mind right off the hop is something like a BlackRock, who's producing numbers like that, who also reported this morning with also stellar results. So
now these are the dumb numbers. The BlackRock numbers are just dumb. The assets under management are what now?
15 trillion.
15.3.
Again,
isn't that incredible?
But so much of it is in passive investments, right? I mean, it's, put it there and forget about it.
It is, but I think the story with BlackRock now is a little bit of a shift underneath the surface. So yeah, we initially think of iShares, and that's been the powerhouse for BlackRock, but increasingly the growth is coming from the higher fee buckets. Now we have active ETFs that are really taking off. You have things like private markets. So impressively, the growth at BlackRock has started to shift a little bit more and be more consistent in those non-ultra low beta type funds and into things that are more lucrative, which is obviously positive to the business. So, they did a handful of alternatives transactions in the past couple of years. Those look like they're bearing fruit. And yeah, I mean, the growth remains pretty stellar, which, by the way, the growth tends to be harder to come by once you reach 15 trillion, but they keep putting up the numbers, and I think it's getting rewarded for that.
It is just amazing.
BlackRock has 25,000 employees as of March 31st.
Yeah. And think about it, and managing all the money. It's just one of the extraordinary stories. And we're not even talking about Blackstone. You got BlackRock, Blackstone. I mean, those two, just amazing out there. All right, Neil. You're like Mandeep Singh. The numbers he comes in with are so big.
I know. It's
like AI and asset management, investment banking. It's all what the numbers are just
and
amazing.
They keep getting bigger.
They keep getting bigger. All right, Neil Sipes, thanks so much. Appreciate that. Neil covers a lot of the banks for Bloomberg Intelligence, all the asset managers and all that kind of good stuff here. Markets moving higher again today here. Let's get a sense of kind of where we go with these markets as we plow into the second half of this year. Carol Schleif, she's the chief market strategist at BMO Wealth Management. Carol, what's the conversation you're having mid-year with your clients?
I think, good morning, thanks for having me. And I think a big piece of it has to do with the fact that there's a lot of continuity and a lot of stability, if you will, underneath the markets, because coming off the kinds of highs, the first half performance that we've got in most markets across the board, you'd expect those for full year numbers. But they're supported by earnings and revenues that we saw in the second, or when the first quarter was announced. And we're coming into this quarter with really solid expectations. And, the previous segment about the bank earnings, and it's a good time to be in financial services because all of that activity, the IPO activity, M&A activity, that stuff creates interest in markets and new liquidity and new capital flows.
Although we did have some bouts of volatility as well in the first half and in the second quarter. How does that set us up for how patient investors are likely to be in the second half of the year with little miniature bouts of volatility that we're probably going to get, given that this war in Iran is definitely not settled and looks like it will continue to be on and off for a while?
Yeah, it's interesting you bring that up because I had some interns run some numbers for me in the last day or two for a piece I'm writing this week, and we looked at the subsectors, and of the 25 subsectors we pulled in the S&P, all but one of them had a 10% correction in the last 12 months. Something like 14 of them had 15% or more. And so that sort of volatility means that under the surface, there's a lot of that repositioning going on, which shows up in the bank earnings because they benefit from the trading activity. But it also allows investors to be able to trim a little here. When something runs up, they trim here, they can buy here, the repositioning. And our long-term investors have us in front of them all the time explaining that volatility is something not to be feared, but it allows opportunity to be able to reposition portfolios, to keep readdressing those long-term objectives. And are we in line with where we want to go? Because it's been pretty easy to see pullbacks overall, but then also run-ups that dictate the need to take a little bit of profit.
Looks like we're getting a broadening out in this marketplace, the Russell 2000 outperforming the S&P pretty handily here. Is that kind of what you're seeing, and you think this thing has some legs here?
Yeah, definitely double. When I pulled the numbers last night, it looked like year to date, the Russell 2500, a SMID cap measure, was up almost 20% or a little over 20% year to date, while the S&P, the cap weighted S&P, is only up 10. But you're seeing that broadening, which actually in aggregate, given that you've got the duck paddling underneath the surface of individual sectors, is positive because we've had the exact opposite with this market where it was very narrow to begin with for years on the AI trade. And now we're seeing it broaden, and typically lasting bull markets start broad and then get narrow. So the fact that we're doing that transition and being able to do the handoff is actually pretty constructive for intermediate and longer term markets.
In the second half, we've got the midterm elections coming up, and I recognize that, we're still kind of far away from it. We're mid-July. The elections come around in early November. But are you anticipating any degree of not just volatility, but positioning or, I don't know, issues or just unexpected news that could, send everyone for cover because they get nervous about what kind of stuff comes up?
Yeah, it's interesting you mentioned that because I was on the road earlier this spring with our head of government affairs, and we just co-wrote a piece this week called Politics and Portfolios. And we talk about mixing the two typically doesn't work. But one of the most interesting things in talking to clients in a variety of key markets, one of the most interesting things in this election cycle is that you've got a lot of industry backing. It's not a Democrat versus Republican, it's industry backing in terms of crypto picking candidates. They want to support AI picking candidates. They want to support it. So there's a lot more interaction in individual markets. There's also obviously a lot of controversy around AI, those who are super supportive of it, those who are pushing back against the data centers, those who are in favor of nuclear. So there's a lot to talk about, but like my co-author said, it's a lifetime between here and the midterms, and a lot can happen in 4 or 5 months.
Carol, how do you guys think about U.S. versus rest of the world these days?
I think that broadening that you're seeing also is going on in the rest of the world. We're not necessarily thrilled with a lot of the developed markets, particularly in Europe, but there's opportunity in emerging markets. They handled the constriction, if you will, of what's gone on through the Strait of Hormuz very well. You've got a lot of activity going there. We need to be careful. You've got a lot of leveraged ETFs, moving indexes there. So investors need to know what they're doing. But it's a very interesting market, and we think both technologically and from a portfolio diversification standpoint that you'll see a lot of continued activity there.
Carol, is South Korea, and you talk about the leveraged single stock ETFs, and of course I'm thinking about Oh, you know what? We need to end our conversation now because Kevin Warsh, the Fed chair, has begun the Q&A session. Carol, thank you so much for joining us. Carol Schleif, of course, Chief Market Strategist at BMO Wealth Management. Let's go now to Washington, where we are going to be listening to Kevin Warsh, the Fed chair, answer questions from the Senate Finance Committee. Paul, he spoke with the the House Financial Services Committee yesterday.
Yes.
And it was a 3-hour ordeal,
Yes,
I believe?
it was.
Okay,
Yes, it
so
was.
this one's going to be shorter because there are fewer members. But we're looking right now at Senator Scott asking him a question. Let's listen in.
From my perspective, I think it lends itself to having more confidence in the Federal Reserve. I want to give you a minute to talk about one part of it, and then I want to move quickly to AI.
All right, let me be brief, Mr. Chairman, but you're highlighting something that's awfully important. All institutions, including the Federal Reserve, which I am so proud to lead, filled with great people.
Yeah.
On occasion, we need to bring new ideas to the fore. And after 63 months of inflation above the Fed's target, it struck me that any new leader should arrive at this organization and look to the very best minds that we could find. There's a lot of great ones at the Fed, but there's a lot of great ones that aren't even in the economics profession. And I reached out to 15 people who I have known and trusted with a diversity of views to see whether they would take the most important questions that are going to be the determinants of monetary policy and the determinants of the economy in the next 5 years and see if they could sharpen their pencils and do their best work. It's a move towards transparency and new ideas. I'll just give one example before turning it back to you. In the last couple of days, we've gotten data on the Consumer Price Index, today on the Producer Price Index. Any central bank would be happy to have the data going in the right direction. My view is these are all imperfect measures of the state of underlying inflation. So one of the task force is going to see whether we can do better, have better data from external sources, and even better ideas as to how important organizations like the Bureau of Labor Statistics, the Bureau of Economic Affairs, might think about how they could do a better job in an evolving economy.
Thank you. We met just a few weeks ago with Dr. Phelan, who's slated to be the head of the president's economic advisors, and we talked a lot about artificial intelligence and the impact it will have on our economy, and whether or not it will destroy jobs, create jobs, and ultimately, at the end of the day, his conclusion was it'll create more jobs. Artificial intelligence has an opportunity to change how we do so many things, and much of the debate for me can be bifurcated into automation, things go away, and augmentation. People make more money because production goes up, and you've argued that perhaps there's a way for us to see a reduction in interest rates because of the increase in productivity. One of the things standing in the way of that conversation is what's happening in South Carolina, where data centers are meeting real headwinds. New York has basically banned them. We have a moratorium in parts of South Carolina because of issues like electricity bills, water use, aesthetics. So getting to the future that we're talking about, and frankly, beating China in this AI race might come down to something as important as electricity bills and water usage, which could prevent us from having a serious conversation about productivity gains. Thoughts?
Yeah, I can't think, Mr. Chairman, of a more consequential change to the U.S. and global economy in my adult lifetime than the surge of investment and the potential in around AI. That's part of the reason why one of my task forces is to focus on what's the effect of this general purpose technology on both parts of the Fed's mandate, on ensuring stable prices, but also on full employment. You gave us both parts of that.
Yep.
We don't have any legislative orphans at the Fed. There's no disfavored part. I would say it is a huge opportunity, but it's not without challenges. I'll make two other brief points. I think the United States is extremely well positioned to be at the cutting edge and extract more productivity, which should be good for U.S. companies and U.S. workers, than any other country in the world. Any other country would exchange positions with us in a moment. Second thing is, I do want to make it clear that in the near term, I think this investment is probably quite good for jobs as we're building out the infrastructure. And over the long term, my best guess is that this will improve American productivity and will improve the real wages and will help us on full employment. But between the short term and the long term, it can have a disruptive effect. And we're attuned to that. And that's part of the reason why I wanted to shed some new light on it with some outsiders.
My time is up, but I will submit one question for the record around the issue of indexing our regulatory thresholds. We've seen so much growth in the since 2019 that our institutions might need to see a little recalibration on the thresholds that we have put upon them. Ranking Member Warren.
Thank you, Mr. Chairman. So the Federal Reserve has long been plagued by a culture
Elizabeth Warren,
of
Democrat, Massachusetts.
and coziness with Wall Street. Over the last 5 years, at least 6 senior Fed officials have been implicated in serious ethics scandals related to personal stock trading and self-dealing. But instead of trying to repair this broken culture, I'm concerned that you seem to be embracing it. At the time of your nomination, you owned more than $100 million worth of shares in private investment vehicles called the Juggernaut Funds and THSDFS LLC. And you refused to disclose the underlying assets to the Senate and to the public. You say now that you've sold those shares. In other words, somebody wrote you a check for more than $100 million days before you entered office. Chair Walsh, who wrote that check?
Senator Warren, this is a discussion you and I had in the public square 7 weeks ago, and I'm thrilled to tell you that I have fully honored the obligations I had under the agreement I had with the Office of Government Ethics.
Yeah,
and there is continued disclosure, which I'm happy to make as consistent with the agreement.
I asked you a very specific question. Who gave you $100 million right before you were sworn in? Was it a billionaire who has business with the Fed? Was it Stanley Druckenmiller, who's made billions of dollars betting on what the Fed does? Or was it a different billionaire? Who gave you the money?
I will fully comply with the Office of Government Ethics.
That's not an answer.
Well, it is an answer, actually, Senator, because there are obligations,
it's
and I will satisfy them completely.
$100 million that you got just before you were sworn in, and you won't tell the American people where it came from. Let's go to another incident. As you know, the Fed imposes a blackout period where senior Fed officials are prohibited from talking about economic issues with outsiders. The idea is to, quote, reinforce the public's confidence in the transparency and integrity of the monetary policy process. In other words, no one gets some special insider information from the Fed. But shortly after your first FOMC meeting as chair, right in the middle of the blackout period, the Fed's vice chair for supervision, Michelle Bowman, was reportedly the featured guest at a secret dinner hosted by Bank of America for its hedge fund and Wall Street clients. At this closed-door dinner, she reportedly spoke about both monetary policy topics and regulatory policy. Now, I've called on the Inspector General to review her conduct, but you're the guy in charge. As chair, you set the tone on culture. Did Vice Chair Bowman provide any non-public information to the attendees at that secret dinner or discuss any regulatory policy matters that are subject to open comment periods?
Senator, I agree with one of the premises of your question, which is I do set the culture.
Good.
After my very first week at the Fed, I sent a letter to the 21,000 people at the Fed outlining our culture.
I appreciate that, but we have very limited time and a very strict chairman. So can you just answer the question about the vice chair and her secret meeting?
Sure, I'm happy to the extent I can share it with you. The vice chair has been an excellent colleague in my first 7 weeks. I'm aware of the letter you sent to the Inspector General. Out of an enormous respect for him, his investigation, what he chooses to do with it, I'm going to leave to him to do without trying to micromanage that.
So you
and I'd be interested in the judgments that he comes to.
So you will support his investigation. Have you made your own investigation? Did you ask her if she spoke at a secret meeting during the blackout period?
I agree with the suggestion that the Inspector General is an independent actor, and I'd be very interested in his decision.
You just said you're the guy in charge. Did you ask her about the secret meeting that took place? Did you ask her?
I can answer a simple question, which is I wasn't at the meeting. I don't know the
that.
facts.
No one
but I'd
thinks
be
you were.
very
Did
interested
you
in the
ask
fact-finding
about the
being
facts?
done by an independent inspector
Did you care
general.
enough to ask, how can you be chair and not ask your own vice chair whether or not she violated the blackout period, violated the law?
I think it'd be inappropriate for me to prejudge facts that are being discovered
I
by
don't
an
know how you
independent actor.
prejudge them if you don't ask.
Well, I don't know how to prejudge them if I wasn't in the
So just
attendance
tell
of a
me,
meeting.
did you ask?
She's been an excellent colleague.
Did you ask?
I've asked her a lot of things
Did you
about
ask?
supervision and regulation
Yeah,
because we've
I
been
think
busy
that's one
doing
more
a lot of
question
real
you
work
don't
over
wanna
the last
answer.
7
I
weeks.
gotta say, I'm gonna take the same time you did. I just gotta say,
You hope so.
the tone that you are setting is one that seems to invite corruption, and that's going to be a real problem.
We've had 7 weeks, Senator Warren, and we've set a tone of performance, accountability, responsibility, and integrity.
Senator Rounds has the floor.
Thank you, Mr. Chairman. Mr. Warsh, welcome to your first meeting.
Thank you, Senator.
Let me give you an opportunity. I think I've got some questions that I think are important with regard to the Basel III and what we're going to do with it. But before we get into
We're listening to Mike Rounds. He's a senator, Republican from South Dakota.
Making accusations to you. Let me give you just a minute to perhaps respond in a just straightforward manner to some of this stuff. Anybody give you $100 million?
No, Senator. No one did any such thing.
Possible that you may have had assets that were sold based upon an agreement that you had as you became the nominee for the chairmanship?
Yes, I had earned assets over a long period of time and went over and above any ethics agreements and have sold or in the process of selling, have nearly completely sold everything that I had earned during that period and have rolled those into the equivalent of cash and T-bills.
So basically away from investments based upon the market and back to treasuries.
Yes, exactly right. I thought that was the prudent thing to do given the responsibilities and the importance of setting the tone at the top. Culture is the big driver of a lot of things, and in my first 7 weeks, Senator, we're doing our very best in the best of the Fed's traditions to get the culture right, to get the strategy right, and to get policy right. And if we can do those things, all of which are to the left of the decimal point, might not be of such great interest to people that are trading on Wall Street, then I think the decisions we make to the right of the decimal point can be better, so we can do a better job of fulfilling the mandate you gave us.
Yeah, the ranking member had asked a question with regard to another member on the committee, Nikki Bowman, and you indicated that if there was an accusation being made as to an inappropriate meeting, that if the inspector general was doing it, that you were going to be hands off on it. It seems to me that that's pretty appropriate because if you would have gotten involved in it, the accusation from some members on this committee would have been that you were trying to influence it.
Yes.
Can you talk a little bit about the logic? Am I on the right track with regard to the reasoning that you have for allowing the inspector general to do the job that they were asked to do in the first place by members on this committee?
Yes, Senator, you're exactly on the right track. I'll just say more broadly that my fellow governors, my Reserve Bank presidents, they've received me incredibly warmly. I admit that I show up with a lot of ideas for reform in monetary policy and supervision and regulation and payments. I've only been there a short while, for 7 weeks, but instead of an institution acting inert, what I've found is my colleagues are really open-minded to change. What I found is we're going to have a good family fight. I'm not imposing ideas. That's part of the idea of the task forces the chairman referenced. But we're going to try to be better at our jobs, fulfill our mission, be accountable, be responsible, and do it all with the utmost integrity. That's my intention. We're early into this. I don't want to prejudge outcomes. We made a lot of progress in a short period of time, and frankly, I'm proud of it.
I like the idea that you're putting together working groups. I think that will give an opportunity for a fresh look at a lot of things going on. As I shared with you in a phone call earlier, it's not a matter of being necessarily vindictive or angry with previous chairs or previous members. It's a matter of making things better for the American people, and that's really what we ought to be talking about today. So let me just, in the minute and 14 seconds that I've got left on mine, let me talk a little bit about Basel III in particular. I think you and Vice Chairman Bowman and the respective financial regulators, I think you've done a good job in terms of your roles with regard to the Basel III re-proposal that was issued this March. The 2023 proposal would have substantially increased common equity capital requirements for Category 1 and Category 2 banks by approximately 19%, failing to strike a balance between maintaining resiliency of our banking system and doing so without hampering lending. I think this is a really critical item, and next to what artificial intelligence is going to do in terms of our productivity, I think it's one of the biggest issues out there. With the June 18th comment deadline now behind us, are there any other categories of feedback that you're weighing more heavily than others, such as the adjustments to leverage ratios or anything along that line? And if I could, is there going to be a go-live date this year sometime? Any idea when you might actually be able to talk about when this thing is going to go public for us?
Senator, well, thank you for your question on supervision regulation. As I mentioned before, I've shown up with a lot of ideas for reform, not just in monetary policy, but in supervision and regulation too. When I was before this committee some 20 years ago, there was a debate about what the Basel process should be. Boy, we should get to the bottom of that 20 years later, and we should end up with a set of reforms in the United States that makes our financial system and our banks safer, sounder, and more competitive. It is that competition which provides better and more agile credit to the real economy. The Basel endgame, Senator, is not America's endgame. I am happy to work with international regulators to try to find common views, but we're going to do the right thing for the U.S. economy. As you mentioned, we're out for public comment. I'll be very interested in the comments before we go final with the proposed final rule.
Let me just say, this is already off to a good start. But we're going to stay around 5 minutes, period. Thank y'all. Senator Reid, the floor is yours.
Thank you, Mr. Chairman. Chairman Walsh, I want to see if I put a cap on this discussion between Senator
We're listening
Warren
to
and Senator
Jack
Rounds.
Reed, Democrat from Rhode Island.
When will you disclose who brought your assets? When?
I believe there's periodic requirements under the ethics laws, and I'll fully comply with them. I think the next reporting requirement is at some point in the next quarter or so.
And you will fully disclose who you sold your assets to?
I'll fully comply with the law and the ethics agreement.
Thank you. AI is making a huge impact on everything we do, particularly the banking system. And as you're aware, an interagency governmental group, Commerce, Treasury, Energy, et cetera, has authorized the major banks, the 8 major banks, to use Mythos to evaluate their security. Would you agree that it's important for all financial institutions to have access to these types of AI tools so that they could analyze their operations for cyber vulnerabilities?
Yes, I think the broad financial system has new vulnerabilities with these new technologies. I wouldn't want to just isolate Mythos, though. The other large language models have rival products. The efficient frontier has changed even in the last month. But as these new models find their way more broadly, our banking system and, frankly, the Federal Reserve needs to do all we can to patch any vulnerabilities that we have.
What are you doing to ensure that these mid-size and smaller banking institutions have access to whatever AI tool is appropriate as quickly as possible?
Yeah, so I share the sentiment, Senator Reid. We are not the deciders as to who has access, but I have not been shy in sharing my views with authorities across the government about the vulnerabilities and have been asking for access, not just for the Federal Reserve, but for other institutions, to a whole range of these new artificial intelligence models so that they can protect themselves. If you said to me what worries you over the course of the next several months, I want to make sure that we're as protected as we can be from foreign actors that want to do us harm.
Well, let me stay with AI, but change the focus a moment. Recently, Governor Waller and New York Fed President John Williams have warned that AI investments may be increasing inflation, and many economists have similar warnings. So are AI investments current drivers of inflation?
This is one of the good family fights. Let me give my own view on it, which might be somewhat nuanced from the way you just described it and some of my colleagues. The shock of AI, the supply shock of AI, has an effect on demand and supply. We see the effect on demand much more quickly. We see it in the capital investment I referenced. We see it in the prices of chips that are going up. We're inferring, which is just a fancy word for guessing, when the effects will happen on the supply side of the economy. I don't view a one-time change in prices as necessarily being inflationary, because I think there's a supply response. In that way, this is different from a foreign conflict and what it might do, which tends to reduce the supply side of the economy. Will it increase measured prices over the course of the next 12 months? I suspect it will be. But whether that's inflationary or not, that's up to the Federal Reserve, and we're going to have something to say about that.
Okay. Now, one of the interesting things about our economy is becoming more and more productive. But one of the disappointing things is that household pay is not rising relative to that productivity. And we're seeing less benefit from productivity gains. So what's driving this trend?
Yeah, it's a great question. I don't have a perfect answer to it. Like you, we think a lot about real take-home pay. The part that the Fed can do a lot about is the real part. If inflation were lower, real take-home pay would be higher. That's just the arithmetic. Your other question's a broader one, which is what are we going to see the productivity improvements lead to a surge in wages? Wages have moved up at a reasonable pace, but it's likely that as productivity moves up more, we should see wages move more. Getting that timing right, understanding when that happens, that's a puzzle, and it's a puzzle we're going to continue to work on.
In the last 10 seconds, will AI eliminate jobs at a catastrophic rate?
So you're asking me to prejudge the task force. My short answer is over the long term, absolutely not. I believe that this is a long-term job creator, but will it be disruptive? And will some people have their jobs at jeopardy because of the new technologies? On that, I can't offer any sort of guarantee or comfort.
Senator Britt.
Thank you, Mr. Chairman. Chair, thank you so much for being here with us today. Certainly appreciate the opportunity to have a conversation, and obviously so early in your tenure in this new role. In this year's
Katie
monetary
Britt,
policy,
Republican from Alabama.
one of the most encouraging themes is the increased in business investment that we're seeing across the country. In Alabama and many places, we're seeing companies expand, manufacturers grow, and communities are benefiting from that investment. I believe that these are good signs and that they're also important for the future because they help us determine whether America remains the most competitive economy in the world. My question for you is, as you look at the economy, what data tells you that today's investments are laying the groundwork and the foundation for a stronger long-term growth and greater American competitiveness?
So it's a great question, and thanks for highlighting the capital investment boom. This is what most countries are searching for. This is the seed corn for the next group of job creation and productivity. To be honest, over the last dozen or so years, we have been waiting for the surge in business investment. I know in some academic accounting sense, this is leading to a surge in prices in the next 12 months. I don't want to sound dismissive of it. The surge in prices is real. But I'd sure rather the most successful companies in the world investing in property, plant, and equipment than doing a share buyback. So I'm encouraged by it. The trend is our friend here, and this business capital investment is contributing massively to the GDP we've seen in the last 12 months. My colleagues know I'm not big for forward guidance, but I would guess that that trend continues. What gives me optimism about it? Well, when the private sector deploys this amount of capital, they must see something shiny at the other end of that rainbow. They must see a very good return on investment. That's why they're taking this capital and they're putting it to work. I tend to think that private investment has a multiplier way higher than one. I'll let you and others judge whether that's true of government spending too.
I'm going to go ahead and switch gears because I know we're on a tight time frame today, which I appreciate. And I'm going to follow up on a question that the chairman asked. I'd like to get you to kind of dig into this. Some banks are already approaching and crossing into new tailoring categories, and they're making staffing and compliance and long-term business decisions based on thresholds that haven't been updated since 2019. At the same time, the Federal Reserve continues to rely on those categories and other regulatory frameworks. So my question is, how are you thinking about updating these tailoring frameworks when it comes to what banks can expect to see and proposals in the future?
So it's a great question, one I take seriously. To be candid with you and the chairman and the other members of the committee, monetary policy has distracted me a bit in the first 7 weeks, but the Federal Reserve chairman is supposed to be the chairman of monetary policy and payments and consumer affairs and supervision regulation. But I can tell you this, Vice Chairman Bowman has been working on these initiatives. She has briefed me about them. And broadly, I'll step back and say modernizing our banking system, streamlining regulations so that the rules that apply to the systemically important financial institutions are not one size fits all for every other. The secret to the American economy is we have a few thousand banks and other providers of credit who know their smaller markets bigger. I'd rather have that system than what most of our G20 peers have, where they have a half a dozen institutions implicitly backed by their government. I think reform is coming to supervision and regulation. I have my own ideas that might be as dramatic as I've already shared on monetary policy here. And I think the sooner we can get to the bottom of it, the better. If I could say one more thing, the reforms we've been putting in place over the last 15 years coming out of Dodd-Frank, as we learned in the Silicon Valley Bank example and the First Republic example, they didn't work perfectly. My predecessors had very little choice but then to do another overall bailout. We don't want that to happen again. So we want to tailor the rules and the capital so they serve the best interests of the U.S. economy, which I describe as a system that is safe, sound, and competitive.
And I just hope, given what you've said, we double down on reviewing the framework. We know how important tailoring is, and also just the need for regulatory certainty. So thank you for that. In my last remaining seconds, I just want to say thank you for your commitment in the first 7 weeks, almost 2 months. You said it earlier, but to performance, to accountability, to responsibility, and to integrity. Appreciate what you're doing and look forward to continuing to work with you.
Thank you, Senator.
Senator Warner.
Thank you, Mr. Chairman. Chairman Warsh, it's good to see you again. 7 weeks in.
We're now listening to Senator Mark Warner. He is a Democrat from Virginia.
How you predict the president's chaotic foreign policy, wars in the Middle East. I'm going to come to an AI question, but let me be clear. As I said to you yesterday, I didn't vote for you. But we're going to find a lot of common ground to work together. I am going to hold you, and I've been appreciative of your comments about inflation, about the Fed's independence. But I think there are many, many common areas we can work together on and look forward to that. I want to hit, when one of the things that most impressed me in our first meeting was your recognition that probably the biggest issue you're going to face is AI. My 2 cents is I think it is going to have long-term, I agree with you, it's going to be job creation. Very short-term, I think you may see some upsurge in terms of, energy production and data center build-out. Years 2 through 5, 2 through 6, I think there could be massive economic disruption, particularly towards new college grads. It's policymakers' job, but if this is going to have the potential effect, I hope I'm wrong, but I'd take a bet with you that 3 years out, we could see 30% recent college grad unemployment. If we see that, what do you see as the Fed's role is in terms of urging your actions, but also helping us sort that out?
Senator, first of all, I appreciate it. I promised to...
Don't say nice things about me. He's got me on a clock. Answer my question.
All right, good. Well, let me just say...
I do indeed.
Let me just say this. I appreciate that you haven't given up on me. I haven't given up on you. I haven't given up on your colleagues. I'm the independent head of a central bank. No matter how people voted, I'm going to be serving all of you.
This doesn't count against my time.
AI. Let me get to the core of your question. I am more confident that there will be a surge in output because the U.S. is at the cutting edge of AI than any certainty about the effect on the labor market in the next few years. the United States will be a winner. That is my informed judgment. But this is a time filled with both challenges and risks. We take both parts of our dual mandate seriously. Do I believe that the productivity improvements over time will be structurally disinflationary? I do. I believe everything technology touches ultimately gets cheaper. Your background, I think, would be consistent with that. What are going to be the effect on the labor markets in years 2 through 5? It's a fair question. The way I would frame it to you on college graduates, if you're a new college graduate, AI is probably native to you. You've been playing with AI effectively since your high school years. I feel as though you likely have the skills and the intuitions the same way that people of my generation or younger were native to the internet. If you've already been in the workforce for a while and you're a little resistant to change, that's where the encouragement needs to be to think about how these skills can make you more productive. These are fair questions. I don't have easy answers, but I do have a task force that's going to be thinking about it.
We have to work together on it, because if we hit this bump, and I think it's going to come, we got to collaborate. Now, Senator Reid asked a very good question about Mythos, and I 100% agree. Mythos is already yesterday's news,
right?
Because these models are coming out so quickly and they pose such security risks. I think it's incumbent, because of the risk it provides to our financial system, that at some point you're going to be, and I'm asking you now, I think, personally, I believe we need some level of mandatory testing pre-release because of the potentially draconian and dramatic effects. Now, how long, who's on that panel is critical, but what do you think about pre-testing release regime going forward, more than just the voluntary willingness of a company to come forward?
Yeah, so two things. First, these models are in their capabilities are growing at an exponential rate. In technology, we would say hyper Moore's law. It wasn't long ago people sitting in my position thought that the U.S. was a time of secular stagnation. All the good stuff had been invented. Boy, that seems awfully anachronistic. We're moving fast. So what can we do? I don't have, as it currently structured, decision rights as to who has access. But I do have a bully pulpit, as you mentioned, and I'm unafraid to share my views with the Treasury Secretary and others. The cutting edge is moving very quickly. Key institutions are vulnerable. The sooner they can mitigate their vulnerabilities, the better. I'm looking forward to working with you.
I hope that you will be willing to advocate moving on beyond a voluntary regime, because the downside risk, 12 seconds, quickly address the role of all of the Federal Reserve banks and your vision of what the role they should play.
So very quickly, I'll just say this. We should be good stewards of taxpayer money. We should be consolidating functions where we can. But my mental model, Senator, as I mentioned to you yesterday, is we should have 12 centers of excellence. I've got more than 12 problems on my plate. And if each reserve bank were to develop an expertise on something that matters to our remit and the American economy, I'd encourage them to develop that advantage.
Senator Ricketts.
Thank you, Mr. Chairman. Chairman Warsh, great to see you. Thank you for being here, and congratulations on your first semi-annual report. It's good to see you here again. We got some good news this week. Inflation was down, and that's progress under this administration and under your new leadership at the Fed. During the Biden administration, we saw reckless spending that drove prices up and left Nebraska families
the Treasury Secretary. They chose an independent guy to do an independent job, and that's exactly what I plan on doing. Okay. And I'd like to think over the last 7 weeks, given the decisions we've made and the things we've done, that it's not just words, it's actions now to start to demonstrate that.
So Mr. Chairman, I mean, I think it's important. I take from your answer, you've had communications, you don't want to disclose the content. Will you commit to do what your predecessor did, which was to release your appointment schedule and conversations with President Trump?
I don't know what the past practice was. I will be in full compliance with the law. As I understand it, there's an ongoing FOIA request on my calendar, and I will share it consistent with the law. Well, I believe the first one's already come out. Actually.
I think this was this wasn't in response to any legal requirement forced by FOIA. It was a question of transparency, and I do think, given the president's past record of trying to influence Fed behavior via social media, with respect to your predecessor, if he's trying to influence Fed behavior through private conversations with you, I think that needs to be something the public is aware of. And I'm asking you whether you will commit to disclosing when you have conversations with the President of the United States.
Senator, I can offer you this assurance. The President has not, before I took this office, before I raised my right hand, he has not tried to influence the conduct of monetary policy. And if he tried to, I would continue to keep my head down and do the job. I don't have a long record, but I've got a 7-week record, and before that I had a 25-year record, and I think that should count for something.
I appreciate that. I hope you'll just follow the precedent your predecessor.
Senator Kennedy, the floor is yours.
Well, Senator Van Hollen's my buddy, so this is not meant toward him, but I always get a kick out of my Democratic friends talking about transparency. You know, toward the end, God bless him, you could bake a Thanksgiving turkey in the time that it took.
Listening
President
to
Biden
Senator
to
John
walk
Kennedy,
across the
Republican
stage.
from Louisiana.
And they kept it quiet till they couldn't. I'm sorry it was in that condition, but this transparency stuff cuts both ways. What's wrong with you talking to the President of the United States?
So, Senator, I've got a wide lens. I'm interested in hearing points of view from a whole range of people. We have a narrow remit. I'm interested in what's happening in the world, in the Middle East
But I mean,
and
is
elsewhere.
there anything wrong with it? Do you have to, when you do it, do you have to like go out and look for the last phone booth in Washington and put a bag over your head and sneak in there and call him? Or return his call? Is there anything wrong with that?
I certainly don't feel uncomfortable receiving a call from the chairman of this committee or the President of the United States.
Okay. Do you think Ben Bernanke ever talked to the President?
When I was a governor, I recall several conversations and
How
frequent
about Alan
meetings.
Greenspan?
When I was a young staffer in the White House, I remember being honored by him coming into the White House and meeting with the President and the President's advisors quite frequently.
Okay. I think what I would give me concern, and I think it's the basis for my colleagues' concern, is that you just do whatever the President says, but you're not going to do that, are you, or are you?
Senator, I'm going to call it the best I see it. The President never asked me to do anything inappropriate, and if he did, I wouldn't do it. I'm going to follow the law and do my best to follow the remit you gave us.
Okay, so in the last year or so, recent past, I'll say, the Fed cut rates 3 times because they were worried about the labor market. Is that a fair assessment?
That's my sense of what
And
they did before
it
my
worked.
arrival.
It worked, correct?
Well, that's a longer discussion. They did
Well, is
cut
the
rates.
labor market in a mess today?
The labor market's in good shape, but
Yeah,
I wouldn't want to
okay,
draw
so
that causal connection.
So I don't have much time, Mr. Chairman. I love you like a taco, but I'm on. Yeah, you don't filibuster on me. So it worked, okay? Now we have inflation, okay? What caused it in 20 seconds?
In 20 seconds, inflation is caused when a one-time change in price is broadened out.
I know what inflation is,
And the
Mr.
Federal
Chairman. Tell me what
Reserve,
caused it.
monetary policy, sir.
Okay, well, I would say what is causing it is AI, the conflict with Iran, and probably the residual effect of the fact that some imports have become more expensive. Okay? And I think any fair-minded person would conclude that. There was a lot of economists said, oh, you know, the impact of inflation on the rise in the cost of imports would be a one-shot deal. You know, you can teach that one round or flat. I don't know. I think it's probably had a residual effect. Okay, is it temporary or is it permanent, the inflation?
It's not going to be permanent under my watch, Senator.
Okay, what are you going to do about it?
So we're going to do 3 things. One is for those people in markets that think the Fed really was comfortable with a higher level of inflation, we're doing our best to disabuse them.
Okay, you're going to talk about it. What's the second thing you're going to do?
We're going to take ownership of it. We're going to say we have the power to do something.
Okay, you're going to own it.
That's
What's the third thing you're going to do?
We're going to look at our tools in the changing economy, both balance sheet and interest rate, and see whether we need to adjust policy to take it head on.
You're going to look at your tools. That's the third thing. I'm not asking you what action the Fed's going to take. That would be improper, Mr. Chairman. I wouldn't do that, and you wouldn't tell me anyway. Give specifically, like you're talking to a 10th grader, okay? Not. What are your options? Leave it alone, right? Leave rates alone. This is one option.
That is an option, Senator.
Raise rates.
Another option.
Cut rates.
A third option, a non-exclusive list of options, but yes.
Well, and a lot of it depends on whether it's temporary or permanent. So how do you decide whether it's temporary or permanent? I got that in with 6 seconds left.
Well done.
You use 5 task forces to get to the big and hard questions instead of trying to paper it over with policies that have not been proven as successful.
Senator Cortez Masto.
Thank you, Mr. Chairman. Chairman Warsh, good to see you again.
Nice
Thank you
to
for
see you,
meeting
sir.
with me.
Thank you.
You've talked about the task forces. What's the timeline for getting reports from the task forces?
So I'm not a very patient person. People have said that to do all this good work, you'll need years. I gave them 6 months.
Wonderful. Thank you. And that will be made public?
Yeah, the details, even much of the deliberations, I want to do that in the public square because we all own these decisions at the end of the day. Ultimately, decisions will be made by my FOMC colleagues. I think they'll start to get briefings on some of the early reports from the task force, early indications, hopefully as early as September, with my expectation, hope by year end, we're going to hear their conclusions and decide what to do with it.
Thank you. And then just for clarification, in January of 2025, do you recall the inflation rate? It was about 3%, correct?
I'm going to have to take your word for the precise number, but I knew
Tina Smith,
inflation was
Democrat
well
from Minnesota.
above target.
Yeah, it was about 3%, and that's when Joe Biden left office. And the current inflation rate right now is about 3.5%, is that correct?
There are various measures. I'm confident in telling you it's been above target for 63 months. It's
Is it
not where we
above
want it to be.
3%?
By some measures, by other measures, it's not. But I don't want to suggest I'm happy with any of those measures. I'm not.
Okay, I appreciate it. Let me talk a little bit about an area that is important for me, and I think many states that deal with a hospitality tourism industry. Unfortunately, under this administration, we've seen significant declines in the number of international visitors to the U.S. The current situation has actually led to our travel trade deficit in this country.
We're listening
going
to Senator
from a
Catherine
$51
Cortez
billion
Masto,
surplus
Democrat from Nevada.
in 2019 to a $72 billion deficit today. How does the Federal Reserve governors consider the specific impact of higher unemployment, lower wages, and reduced economic activities in communities with large tourism economies like Las Vegas?
So we are consumers of this information. We are keenly interested in the goods side of the economy and the services side of the economy. My view, which is not universally shared in the economics profession, is that there's no limit to what this economy can grow. Productivity-led growth can move higher, and that doesn't tell me it's inflationary. But we care about the services part of the economy, and we're trying to take that into account when we try to make decisions about the dual mandate.
Well, I appreciate that because you're right. Your dual mandate is maintain stable prices and full employment. Let me tell you what's happening in the hospitality industry because of the policies of this administration. When you talk about full employment, it is not happening. What I'm hearing from people in my state is that it's not necessarily full employment with good wages and livable wages. They're patching together multiple low-wage jobs because they are taking down from full employment to part-time employment. Do you consider that in your analysis, going from full-time employment to part-time and many individuals having several part-time jobs? How do you calculate that into your analysis?
So we think hard about it. You heard in my opening statement the clear judgment of my colleagues and me, which is the labor market broadly looks in balance, but I don't want to make that sound like it's easy for hardworking Americans in your state and other places. There's a lot of dynamism happening in the economy. There's a lot of structural change, and during periods of transition, it's often true that the labor markets in aggregate look better than people feel in different parts. And during disruption, they try to recreate a job they had before through the gig economy and other means. We take it into account. Overall, I would say the labor market part of our mandate looks pretty good. The price stability part of our mandate looks less good.
All right, and I am concerned because not just Las Vegas, but many tourism-based industries and hospitality, what we're seeing is lower full employment. And I would hope, and this is a conversation I've had with previous chairs as well, I would hope that you're considering that. It is a large sector of employment across the country. And I know you made a statement that rise in prices is not necessarily inflationary, correct? At what point do you consider it to be inflationary? Is there a timeline associated with that?
So when an increase in prices in a particular category like oil or like milk or eggs, when we see that broaden out and affect the generalized price level, that's something we can do something about. That's the way I think of inflation. When prices go up, I know it hits your constituents every day. I'm not trying to sound dismissive of it, but I also don't want to say that there's much that we can do about cattle prices or milk prices today. But there's a lot we can do to make sure that the entire grocery aisle doesn't have higher prices, and that's what we're committed to do.
Thank you.
Senator Haggerty.
Thank you, Mr. Chairman. Chairman Warsh, on July 18th, almost a year ago today,
Now listening to Senator Bill
President
Haggerty,
Trump signed my
Republican from
legislation,
Tennessee.
the Genius Act, into law. A thorough rulemaking process is absolutely vital to ensure that U.S. dollar dominance exists here in the digital age. And I look forward to seeing the Federal Reserve's ongoing work in this matter. I just want to make that point clear. It's important, it needs to be done, and very much appreciate the Fed's attention to it. I want to turn now, though, to a broader concern, and that has to do with the independence of monetary policy. You've had a number of conversations with my colleagues about this. I want to emphasize something that I think is quite important. The special insulation that the Fed receives with regard to monetary policy, I think as far as I'm concerned, it shouldn't extend to every other function of what the Fed does. I think it should be limited to monetary policy. For example, you think about bank regulations and supervision. That's entirely distinct from monetary policy. Regulation requires normative policy judgments about capital, about credit availability, about risk, economic growth, the structure of the banking system. All of these considerations need to roll into it. And you think about what's happened in recent years, regulation has even strayed far afield. You think about what's happened with respect to climate policy, or Michael Barr's failed Basel III proposal. These decisions are not the same as setting interest rates or managing the Fed's balance sheet. And quite simply, I think they're forms of executive regulatory power. The Supreme Court has clarified, for example, that the FDIC is subject to ordinary principles of executive accountability. Comparable regulatory functions at the Fed shouldn't be held to a different standard, in my view, simply because they sit within the central bank. So my question is this, Mr. Chairman, do you agree that the Federal Reserve's independence should be narrowly tied to its monetary mandate?
Senator, thank you for the question. Like you said, independence is at its peak in the conduct of monetary policy. I believe that when I showed up at the Fed in 2006. I believed at my confirmation hearing 7 or 8 weeks ago. I believe it now. In the conduct of bank and regulatory policy on things like the Genius Act, my general view is we should be working with our bank regulators, the other bank regulators, the OCC and the FDIC, see if we can't put out our rules together. What I don't think we want is any kind of regulatory arbitrage where firms are trying to game who's got the lightest regulation and race there. I don't think there's anything wrong with us working together with other bank regulators to try to figure out what's the best policy. I've got some extraordinary colleagues at the Fed. They've been able to think hard about these issues. I think those discussions should happen and do happen.
I don't disagree at all with that, and I like your approach in terms of coordination, but there's something deeper that I'm concerned about, Mr. Chairman, and that is, and just make an example. Let's suppose a future Congress decides to embed some sort of regulatory function inside the Fed, seeking to insulate it from our supervision, from our oversight. In some way, that could become a backdoor that I don't think any of us want to see. And what I'm trying to make clear is that beyond monetary policy, I'll ask you the question, do you think that this special insulation applies to other regulatory and supervisory types of functions?
So I spent 8 weeks as a summer associate at a law firm, so I'm probably not best positioned to opine on the Supreme Court. Senator Warren could do a better job than I. I do recall in the most recent opinion a footnote from the majority that says We are not suggesting that if other things went to the Federal Reserve, it would get any insulation. Beyond that, I'm on shaky ground in trying to opine on what the Supreme Court opinion means prospectively.
Yeah, I wasn't looking for your legal opinion, but I do just think as a matter of common sense, I wanted to get that on the record, that there is a real distinction here, and I appreciate that. I'm going to turn to another important matter, and that's the monetary policy report that you work with. The most recent monetary policy report added a new aggregate to the measurements, the M2 aggregate. And I just wanted to ask you to explain why this metric is useful and why it's been added.
Thank you, Senator. That was an Easter egg that we hid in there to see if anyone read these monetary policy reports. So I'm encouraged that you did. There is almost a page talking about M2 and monetary aggregates. That was done with a purpose. I do not show up here as a monetarist. I do not show up and say the secret to inflation is if we only knew M2, everything would be swell. But monetary aggregates had been taken out of the monetary policy report probably about a decade ago, maybe a bit longer. My view is that a modern central banker should have a mosaic of information and should not be allergic to any data that happens to be inconsistent with dogma that he or she might have been taught in Econ 1. I have this old-fashioned view that monetary policy has something to do with money. I remember an old professor of mine that said, who was a proper Keynesian economist, he said, well, I don't understand how to think about inflation in a place like Zimbabwe without talking about money. So I think money matters. What we witnessed when we looked at some of the monetary aggregates is they are not perfect. We don't measure money very well. We don't measure the velocity of money very well. But it's a pretty good cross-check. And had we seen the surge and paid attention to the surge in inflation and money in 21-22, we might have seen this problem sooner. I apologize, Mr.
Senator Smith.
Thank you, Mr. Chair and Ranking Member. Chair Warsh, welcome to the committee.
We're listening to Senator Tina Smith, a Democrat from Minnesota.
Senator Hubert Humphrey, who's once held the seat that I now occupy from Minnesota, led the charge in Congress to include maximum employment as part of the Fed's dual mandate. And we can probably agree that keeping these two goals of maximum employment and stable prices within the confines of the monetary policy power that the Fed wields, that just makes sense. Because it's a strategy that delivers stable prices, a strategy that delivers stable prices while working people can't find jobs or can't afford their lives. I mean, that's not a healthy economy. I expect you to agree with that.
And I do. Thank you.
So I was very interested in the task forces that you established last month to advise you on reform and modernization. And I want to just ask you about one of them in particular. You've created a task force looking at productivity and jobs. And that's really good, it seems to me. This task force should be able to get at the power of the Fed's dual mandate and ask also some of the big questions that everyone is asking about the power, the impact of AI on wages and people's income and employment. So let me just ask about this particular task force on productivity and jobs. So as I understand it, it is led by three people, venture capitalist and investor Mark Andreessen, who's made billions from AI and is a major Trump donor, another tech executive who recently laid off thousands of people, and then an academic economist from my alma mater, Stanford University, who is currently on leave to do research at Anthropic. So I want to ask about this. Is there anyone on the task force who has experience in the labor market, or somebody who can bring the perspective of an employer rather than an investor to the questions that are going to be asked and hopefully answered by this task force?
So if I could say two things. One is those three people you referenced are three of the smartest people that I know. And I've been...
I'm not disputing that. I'm wondering how you intend to bring into this work the perspective of people who are working people, bring in the perspective of labor and not just investors.
I think it's a fair question. I've got 18 colleagues who are going to join me and consume the deliberations they have in the report. And we're the ones that have the dual mandate. And as I said to your colleague, there is no disfavored part of our mandate, and we're awfully focused on full employment. So that's my commitment to you. We haven't outsourced this decision to 3 people. What we've outsourced to is a bunch of thinking about this massive technology shock. And I'll only note one other thing. Chad Jones, that professor that you mentioned, his academic work, he's an academic, I'll admit that. But
And I'm not opposed to that. I'm just trying to figure out.
But his academic work has been very, very focused on what is the effect of the labor markets of these technology shocks, both the good and the bad. And I think that history he can bring to bear to the work of the task force.
So can you understand why a task force that is led by people in large part who are likely to get richer by AI might not be the most credible people to folks on the ground who are doing the work, who are worried about what impact this AI is going to have on their jobs? And there's the concern, of course, is that the productivity that is expected to be delivered by AI, if that actually happens, that the benefits of that productivity are going to accrue to capital and not to labor. And that, it seems to me, the credibility of this task force rests on hearing the perspective of working folks in their deliberations.
I would expect before they come to their conclusions, they are going to hear from folks that will be affected. They are going to hear from employers that are getting struck with this technology shock and have disruption in their labor force. But I don't want to suggest to you that in any of these task forces that we have the 19 people of all different backgrounds. But what I want to tell you is if you think they have a credibility deficit, I don't. I think they're incredibly talented, and we will make sure to take both parts of our dual mandate in consideration of their output.
I think the issue, sir, is that when there are the big guys sitting at the table, is there anybody sitting at the table who's bringing the perspective of working people to those really important questions? There are labor leaders, there are labor economists, there are folks whose expertise is in issues around wage stagnation and how that impacts working people. And I would ask you to consider bringing that perspective, not to be heard on the side, but to be actually at the table with the big guys. I think that is a credibility issue that you could address very easily. Thank you, Mr. Chair.
Thank you, Senator.
Yeah. Senator Tillis.
Good morning.
Good morning.
I think you're doing a great job today. I appreciate your composure. Mr. Walsh, a quick question on just immigration. You know, some people are proudly discussing how we had almost
This is Senator Tom Tillis, Republican from North Carolina.
Immigration in the last quarter, but we're starting to look a little bit like China, Japan, European countries in terms of our replacement rate, in terms of natural replacement rate. So if net immigration were to remain near zero for an extended period, how would that change your estimates on GDP, the neutral interest rate, and the amount of non-inflationary job growth the economy can sustain? And in some ways, it touches on, I think, Senator Cortez Masto's question, too, about jobs unfilled, but just curious.
Thank you, Senator. You sure didn't toss up a softball there. The way I think about it is immigration policy is set by you and the administration, but we are...
Yeah, I mean, I don't want you to talk about policy. What I'm trying to do is communicate to the American people we can make the mistake of Western Europe, Japan, and other industrialized nations, or we can fix this population growth problem. If we don't, these are policies, then how does that make your job more difficult if we were to sustain the current trajectory?
The way those decisions affect us is it affects potential GDP. The biggest, hardest decision we make is what can this economy produce? How fast can we grow? Potential GDP is a function of two things. How many hours are we working? People in this country working.
So just in a word, because I want to ask a few other questions.
And then second, productivity.
Yeah. At the end of the day.
If the worker hours are constant, we need a productivity boom.
Just a real quick question. Would you be thrilled to know that we could guarantee zero net growth for the next decade because that would make your job easier?
We're going to take the number of hours the American people and your policies produce, and we're going to do with it the best we can.
We got a problem. You can't fix it. But what I'm saying is if we're trying to make your job easier, having this on the agenda is not going to make your job easier. And I understand the position you have to take, but I want to point to something that people are high-fiving and talking about net zero immigration growth as if it's a good thing. It's only a good thing if you want to repeat the mistakes of Western Europe, Japan, China, and other nations that didn't get their replacement rate right. You know, bringing in great people that may have been born in Colombia and aspired to become a senator, for example, those sorts of things. I mean, you didn't get it right every time, but no. Mr. Warsh, I told you also, and just for the American people, do you have a magic wand where you can just walk in and convince 7 people of the FOMC to vote exactly the way you want them to?
Perhaps I wish I do, but I do not have such a wand.
So you are one of a body where you have to gain consensus to make an interest rate move, right? Monetary policy move, right?
Yes, and it's a consensus-led organization.
And based on some of the comments from even Governor Waller, who we'd consider to be, you know, pretty hawkish just this week, he's not guaranteeing that we're going to be able to lower interest rates anytime soon based on data-driven decisions. Did that just occur this week? In a speech, I think, up in New York?
There are a diversity of views. I wouldn't want to dwell on any one of them in particular.
No, it's okay. But what I'm trying to explain to people who think the president can give you a call, you make a decision, it happens, that never happens. Wouldn't have happened under Powell, wouldn't happen under you, wouldn't happen under anybody who's responsible chairman. I just wanted to make that point. The last thing, if you could just tell me, I know you don't want to get in. I think Senator Britt asked you some questions. I love the fact that you're doing reform. I would like to see the project charter for the task forces, if you have that. If people are managing this, milestones, any sort of dashboard you have, the things that any well-put-together set of task forces would have assembled for a 6-month project. I'd like to just track it, not necessarily for the record, but if you could commit to have a meeting with the people running it with me, I'd like to see that just to watch the mechanics play out over the next 6 months. And then lastly, if you can, I believe Silicon Valley Bank is a classic example of why the Fed needs to have its independence on monetary policy, but on bank examination and supervision. I believe a U.S. senator should minimally be able to go into a SCIF and understand why banks like Silicon Valley Bank had multiple matters requiring attention and then matters requiring immediate attention well before they failed. And nobody knew except some examiner and likely people in San Francisco, in the San Francisco Fed. That stuff has got to change. I don't see any rational basis for that independence, and we've got some legislation I'd like to talk with you about. Thank you, Mr. Chair.
Thank you.
The chair recognizes Mr. Warnock.
Well, thank you so very much,
Lucky
Madam
you.
Chair. The American economy is heavily leveraged on...
We're now listening to Senator Raphael Warnock, Democrat from Georgia.
And this is an issue that I'm very interested in, been engaging and talking to folks in the industry and folks outside of the industry, various stakeholders. According to a Bloomberg analysis, AI spending most recently climbed to about 8% of the U.S. gross domestic product, driving the country's economic growth. Chair Walsh, you have long been bullish on AI. However, up to now, despite investors betting big on them, none of the major AI models have been meaningfully profitable. What are the consequences to our economy if none of these companies ever become profitable?
So if they were to disappoint investors, I think the capital markets would dry up for them, and some of that capital investment would be curtailed.
I guess that's one way of putting it. I guess I'm getting at where ordinary folks are in the midst of that. The markets, behind the markets are real people who have retirement savings and who are trying to make their present as well as their future work. American retirement accounts are increasingly tied to AI. And so there's the human issue, driven by massive increases in the stock prices of chip and AI companies. You might talk about the current markets in a way it's sort of it's tall and narrow. Let's imagine if we are in an AI bubble. What would happen to our economy and more specifically Americans' retirement savings if that bubble popped?
So I think it's a fair question, Senator. I take it seriously. I'm not in the business of providing a Wall Street newsletter, but I'll say broadly to your question about the effects on the economy. Booms and busts do not help the real economy, and they don't make the central bank's job easier. What the central bank is trying to achieve is price stability, full employment, all in the context of financial stability. On the question of these AI companies, certainly the surge in their investment and the surge in their valuations is notable, but I'll also note one other thing, Senator. Over the course of the last couple of months, we've seen the market cap, both of the public companies and of private companies, under some pressure. At the overall indices, we do seem to see a broadening out. Now, why is that? Because earnings now for the last several quarters more broadly are moving up. I don't want to suggest that that should give us any complacency, but what the Fed's looking for is economic strength to broaden and the inflation that we talked about earlier to become more narrow.
So I'd be worried about a massive economic slowdown. You know, the impact of Wall Street on Main Street, and I'd be worried about job losses. Stock prices tumbling would mean Americans could not retire as planned. And I don't want to see taxpayers holding the bag should this AI bubble pop. I'm not against AI. AI is not going anywhere. Right. It has both promise and peril. I just want us to be thinking critically about this from all angles. Earlier this month, you announced a new task force to assess the effect of AI on productivity and jobs. The three individuals you chose for the task force are tech executives who have directly worked for or with AI labs, all three of them. Yes or no, will the Fed include anyone on this task force with an alternative viewpoint on AI? For example, anyone who represents the workers whose lives may be upended by increased adoption of AI tools and technology.
So, Senator, it's a fair question. As I mentioned to your colleague a few moments ago, what I'd say is one of the people on those task forces is an academic. Now, I don't want to suggest that the academic is representing some
You don't want to suggest that the academic is being academic.
I don't want to suggest that, but this isn't a faculty lounge discussion. What I do want to suggest is that academics' work has spent a lot of time talking about prior technology shocks and the displacement that it has on labor. The assurance I can give you is that these three people on that task force, like the other task forces, they're not the deciders. You're talking to one of the deciders.
Right.
The 19 of us around the FOMC with a breadth of backgrounds and interest, we're going to decide what we think of their conclusions.
Yeah, well, as a decision maker, I always want various viewpoints. I certainly have nothing against an academic expertise. I think, you know, that's important, and it's too often ignored in some of the appointments that we've seen around here lately. But here's my problem. Americans are worried about what AI will mean for the economy. I'm wrapping up, sir. And I'm worried that this viewpoint isn't represented at the Fed, and I would look to broaden.
Senator Lummis, your time is yours.
Thank you so much.
Thank you, Mr. Chairman, and welcome, Mr. Chairman.